Hello everyone and welcome back. In today's video, we will talk about everything from the basics to advanced financial management and setting you up for success in your accounting career. We will start with the basics understanding of accounting, bookkeeping, record keeping systems, tracking and reporting transaction and key accounting concepts. We will also walk through the accounting cycle. Next, we will explore financial accounting, where you will learn about the balance sheet, income statement, cash flow statement, and financial ratios. We will also explore the difference between accrual and cash accounting. Moving on, we will understand financial management, covering the concept of finance, its broad areas, and its role in business. We will also discuss the goals of financial management, including profit, wealth, and market share, the functions of financial manager, the principal-agent relationship, financial system, and securing investments in business. Then, in the corporate finance section, we will discuss corporate finance goals, the nature of corporate finance decision, and factors influencing capital structure decision. We will explore the relevance of debt and equity in capital structure, dividend decisions, and agency problem, and give an overview of mergers and acquisition. Finally, we will explore Tally software, including Tally ERP9 and Tally Prime. We will cover the basics of GST, GST registration, input tax credit, and the return process under GST. Not just that, we have saved the best for last. We will show how to manage these tasks using Tally software, including online GST portals. We have added timestamps in the description, so you can always jump to your favorite part of this video. So, are you ready to learn practical accounting skills and get hands-on with Tally? Let's get started. So in this session, we will discuss basics accounting, introduction to financial accounting, basics of Tally ERP9 and Tally Prime, Tally in financial management, corporate finance, GST using Tally, GST structure, GST registration, GST returns, input tax credit, that is ITC, online GST portals, and Tally in payroll management. So these are the few topics we are going to discuss in this particular video.
In simple words, accounting could be defined as the process of recording, summarizing, analyzing, and reporting financial information pertaining to any business. Although it seems like the brainchild of contemporary financial setting, the earliest attempts of accounting date back to the ancient civilizations. And this very fact highlights the importance and involvement of accounting in human life across centuries. Moreover, the significance or importance of accounting is not just limited to the technicalities of running a business. Its essence permeates through our day-to-day lives and composes a variety of ordinary activities like filling our income tax returns or even making a monthly budget. Since these tasks could prove to be quite tedious more often than not, I am here to beat your struggle by introducing you to some basic terms used in accounting, a few essential concepts as well as particulars related to financial statements and the accounting cycle. So just sit back and watch your ordinary accounting troubles fade away. Before moving on, let's look at some of our learning objectives. So we'll start by knowing what is accounting, what is the need of accounting, and also what is the use of accounting. Then we'll know the importance of a term called bookkeeping in accounting. Furthermore, we'll be knowing basic terms and terminologies that are used in the accounting world. And also we'll know some of the ways in which we can record transactions. Then we'll know how we can track those financial transactions either from B2B, business to business, individual to business, and so on. Then we'll be knowing how these transactions are converted with the help of accounting to three financial statements: balance sheet, income statement, and cash flow statements. Then we'll know some of the basic accounting concepts that are a must to know when we are learning accounting. Then at the end, we'll walk you through the various phases of an accounting cycle. Let's start off by knowing what is accounting. So the first thought that comes to our mind when we hear the word accounting is something related to money and certain transactions involved, right? So the way of recording financial transactions related to an individual or business is called accounting. So it is basically logging certain expenses that have been incurred or revenue that has been generated. So now it involves accounting process involves three major phases. The first one is recording, second is reporting, and the third one is analyzing those transactions for various stakeholders and regulators involved. So it can be internal stakeholders like the board of directors or external stakeholders like general public who wants to invest their money in the company, or regulators like SEBI, Securities and Exchange Board of India, or Tax Department. They would want to know that what are the financial transactions happening in your company. Now, second question that comes to our mind is what is the need of accounting? Now, for an individual, it could be knowing about the certain expenses they have incurred over the past month or the past year, and also in what all categories their expense was. Was it in food, travel, shopping, etc.? Also, for a business, it could be knowing what are the best selling products of the company or how much cost they have incurred while producing those products. Also, they would want to know how much budget they spent in, let's say, marketing. So, for all these questions, we would need a certain set of rules and procedures in which different numbers are set up. So, this way in which all these numbers are summarized together is called accounting. And also, the third question that comes to mind is what are the benefits of accounting? Now, accounting would be used to develop a more efficient way of utilizing the money, which is also called cost control, and also to make very well informed decisions and thoughtful decisions for the company's future. You will also gain an understanding of how your competitors are doing by seeing those financial statements or accounting statements. Therefore, it becomes really important to learn accounting so that we can grow our business exponentially. Next, we'll talk about the types of accounting. Now, there are primarily five types of accounting. So, we'll go through each one of them one by one. The first one is financial accounting. Now, financial accounting deals with the summarization and recording of various transactions into building three major statements. The first one is balance sheet, second is income statement, and the third one is cash flow statement. Now, these statements are readily available in public domain because it is both for the internal stakeholders and external stakeholders of the company. Next is management accounting. Now, this deals in identification, analysis, measurement, and interpretation of money related transactions. The point to be noted here is that management accounting is only for the internal top management of the company, and no information is available outside the company. The third type of accounting is tax accounting. Now, tax accounting involves the calculation of various taxes that the corporate has to give. Now, this type of accounting deals in the tax payments and tax returns of a company. So, it involves maintenance of GST records, paying of corporate taxes, etc. And also, this type of accounting is very important for individuals like you and me. So it involves filling of income tax returns, declaration of your investments, whether you have any capital gains involved or not. The next type of accounting is credit accounting. Now, credit accounting deals in the liability section of the company. Now, liabilities can be any. It can be a loan from a company, a loan from an individual, an organization outside the company, or even the mortgage that the company is bearing. Now, these type of liabilities have to be accounted and it comes under credit accounting. The last type of accounting is cost accounting. Now, cost accounting is a subset of management accounting, which deals primarily in the cost side of the company. So the cost can be cost of production, cost of operation, and other miscellaneous variable costs. Next, we move on to bookkeeping. Now, bookkeeping is a very common term used in the accounting world. It is a systematically noting down of various transactions that are happening in a company on a day-to-day basis. Let me explain you this with an example. Let's say that you are an owner of a phone manufacturing company and would want to know what are the total profits that are earned. Now, in order to know the profits, you need to know what are the costs that has been incurred in making that particular phone. So let's run through the steps of it. The first would be design. The design team would design a particular phone. Then there would be material cost, like the cost of casing, the cost of screen, the cost of various sensors and cameras, and also certain things would be procured by third party vendors, like let's say chipset or batteries. So these all would be the primary cost of a phone. On the top of it would be secondary costs like electricity bills, supply chain and logistic cost, and various other costs. So after this, you would be marketing the product. Then you would incur a marketing cost, and then you would sell the product. Now, the revenue that would be generated after selling the product minus your cost incurred would give you the profit remaining. Now, all these costs have to be noted down step by step in a systematic manner, so that later you could go back and see what are the costs that were incurred. Now, the process of systematically noting down is bookkeeping. Now, what are the benefits of bookkeeping? So, bookkeeping provides an accurate picture of how well the company is doing, whether the company is in profit or is in loss. That would be understood when we do bookkeeping. Next would be it helps detect any fraud or irregularities in the transaction. So there can be times when certain things have been missed by a memory. So we can find what that is. We can detect frauds. We can detect what are the errors in certain transactions. The third one would be tracking inflows and outflows. So it means what are the cash that has come in from selling the product and what are the costs that were involved in making that particular product. So how much cash is available and how much cash has gone out of the company. Now, bookkeeping in itself is a long and a tedious task to do. And to make sure everything goes perfectly in the most efficient manner, this is divided into two sections. One is record keeping system, and the second one is tracking the transactions. Now, in order to make that system, there should be some terms and terminologies that are commonly known to everyone, like revenue, assets, and so on. So, we'll know about that in the coming videos. And the second part is to track these transactions. Now, the transactions can be a lot of different types. It can be complex transactions. It can be a very straightforward, a one-on-one exchange of money transaction. So to know all those transactions, you need to know what are the types of basically tracking those transactions. So we'll know that coming forward. The first phase that we'll be talking about is record keeping system. Now, before moving on, let me ask you this question. Can a profit of a company be greater than its revenue? We'll find the answer of it at the end of this module. So first off, record keeping system. So in order to develop any system, there should be some common terms and terminologies that should be widely accepted. For example, the head of a governing body of the country would be the prime minister, while the head of any government of a state would be chief minister. Now, these both terms are commonly accepted, and both you and I know what they are. Now, similarly, in the accounting world, we have some terms and terminologies that are commonly accepted, like revenue, liability, asset, expense, equity. So we'll know each one of them going forward. The first one is revenue. Now, the amount generated by the company from its core operations by selling a product or a service in a given period of time is called a revenue. Now, let's say that you are selling samosas. So each samosa is of 20 rupees. Now, 20 rupees, the selling price would be your revenue, right? So the point to be noted here is that the revenue is not equals to profit or loss of a company. It is just the selling price of the company. Okay. Next up, we'll know about expense. Expense is the total cost incurred by the development of a particular product or service. An expense does not have any future benefits. The example of expense would be rent, electricity, your telephone bills, etc. Now let's take an example. Say that you are selling a cup of tea. So your one cup of tea would be sold for 10 rupees. Okay, 10 rupees. Now this 10 rupees is your revenue. You would also have certain expense in it, like to make a cup of tea you would need what? Sugar. Let's say in a cup of tea it is rupees 2. You would need tea leaves. that would be rupees 3, and milk would be, let's say, 1 rupee. So now these three sections, 3, 4, 5, 6, your 6 rupees would be your expense. Now, if I subtract my revenue out of the cost that I have incurred, I'll get rupees 4. That is my profit or net income. Now, if I say, can the net income be negative? The answer is yes. So, for example, your revenue is rupees 20 and expense is more than that, 30, then you would have a net income of minus 10. That would be your loss. Next is assets. Now, asset is something that has a future economic benefit to the company. So it can be cash, real estate, investments, machinery, patents, office equipments, vehicles, etc. Now, assets can be divided into two parts. Number one being current assets. Current assets. And the second one is non-current assets. Now, current assets would be something that have an economic benefit within an year. So this is short term. So it would be short term investments or short term account receivables, etc. Whereas non current assets would be something which drive an economic value after a year. So these are long term investments or investments in land, investments in equipments, investments in vehicles, etc. Assets can also be distinguished into two other types. Let me show you. It can be distinguished between tangible and intangible assets. So tangible would be something that is physically present, what you can touch or feel, like land, equipments, factories, vehicles, etc. While intangible would be something that we cannot see or touch. That would be patents, copyrights, or even trademarks. These all come in the category of assets. Now let's talk about liabilities. A liability is something that the company has borrowed either from an individual or an organization. So the example would be bank debt, mortgage, money owed to suppliers, tax owed to the government, or even wages that is due to be paid. Now the liability can also be divided into two parts: short-term liability and long-term liability. Short-term liability would be short-term loans. Long-term liability would be long outstanding loans or mortgages. So these are the examples of liability. Next is equity. Now, equity is the amount of capital that is invested by the promoter of the company. Equity is basically, in layman's terms, the ownership of a company or a thing. Let's take an example. Let's say that you as an individual is buying a car. So the car cost 1 crore. Okay. And you have 20 lakhs in hand with you. And the rest 80 lakhs you take a loan from a bank. Now the 20 lakhs that you have in hand is your equity, and the 80 lakh is your liability, and this car that you bought is your asset. Okay. So basically you have 20% of ownership, which holds true this equation: equity equal to assets minus liability. Equity, that is 20 lakhs, equal to 1 crore asset equity minus 20 lakh, 80 lakh of liability. The next module is tracking transactions. So in the previous module, we already learned some of the basic terms and terminologies that are used in accounting, be it revenue, asset, liabilities, equity, expenses, etc. So now in this module, we'll know what are the different ways in which we can know that a transaction is occurring, right? So what is the second question that comes to our brain is what is the need of tracking transactions? So let's say that you are living on rent and you have paid a security deposit to your owner in cash. So at the end of the tenure, you demand your security deposit back, but the owner refuses to give it, stating that you have no proof that you paid that amount. Now, in this case, what would you do? You have no proof of the transaction. You have no proof that you paid the owner the specified amount. In these cases, it becomes essentially important to have a proof of those transactions. So it can be an invoice, it can be a receipt that is being generated, a bill, we can say. So these are the things that are a must to have when it comes to noting down these transactions in the account books. Now, the first step in the process is knowing that if there is a sale occurring. So what is a sale? A sale is a negotiation between two different parties in which there is an exchange of money with goods or service. So one side should sell a good or a service, it should provide a service. The other side should pay the amount or the money to it. In the earlier times, it used to happen that there would be no exchange of money, but it would be a barter system in which you could give a material or a good, or you can receive a good or a service. But now in this era, you have to give money to avail any goods or service. So that is the first step in tracking our transaction, that a sale should happen. Now, in order to know that a sale is happening, you should either have a receipt to it. Now, what is a receipt? So the receipt is an acknowledgement document that the seller has received the payment by the buyer. Okay, so the example that I gave you, when you are on rent and you're paying your rent, that the owner will give you a document stating that the amount is paid. So that is a financial transaction that is called a receipt. Next up is invoice. Now, invoice is the piece of paper that is given to the buyer by the seller to collect payment. So basically, the difference between invoice and receipt is that in invoice, the payment has not been made and it is invoice is requesting you to pay that amount. While in receipt, the amount has already been paid and you are getting an acknowledgement of it. Now, the invoice are mostly popular between business to business transactions, as they have a lot of transactions in bulk that are due to be paid in the coming months ahead. So that's why it is mostly popular in business to business transactions. Now, another thing is both the receipt and invoice have a lot of things in common, like the order date and the order number would be mentioned in the invoice or the receipt. The description of the amounts that have been sold or bought would be listed there. If there is any tax deductions, it would be mentioned. If there is any discount or a coupon that is applied, it would also be mentioned. Apart from it, it would also have the seller's address and the buyer's address as well. So the last type of transaction that we are looking at is employee compensation or payments. Now, this is very internal to an organization, in which as a owner of the company or as a board of director, you would look at what is the total amount that is being paid to the workers, to your employees, and also what are the total deductions are happening. So what type of deductions we are talking about? TDS reductions, that is tax reduction at source. And also, since like it is pandemic going on and everyone is working from home, so the internet reimbursements that are happening, that also are needed to be accounted for. So all the transactions are to be noted down in account books. So after the bookkeeping phase comes the third element of the accounting process, called reporting transactions. Now, these transactions can be reported by making three financial statements known as the balance sheet, the income statement, and the cash flow statement. Now, just like you and I used to have our report cards during college and school days, similarly for a company, these financial statements act as a report card so that we can analyze how fundamentally strong the company is. We can also know what are the assets, liabilities, what is the expense and revenue of the company, and also what is the equity of the owners in it. So all these informations can be extracted from these three financial statements. Now let's look at the first statement, balance sheet. So balance sheet is the information about the assets, liabilities, and equity of the company. We have already discussed these three terms before, so we'll know where they are placed in a balance sheet. Before moving on, there is a term called an accounting equation. So we'll know what that is. So accounting equation states that an asset is equals to liabilities plus the equity. Now, what does this mean? So this means that the assets that the company owns is equal to the liabilities or what the company owes to its lenders plus the equity of the owner or the promoter of the company. Okay, so this is called an accounting equation. So this thing is really important point to be noted, that asset equal to liabilities plus equity. Now we look at a balance sheet of a FMCG company. So here we have the balance sheet. Okay, before moving on, let me tell you where can you find these balance sheets. So if you go to any company's website, be it Reliance, Adani, or any other company, you can go to their website. So there would be a section called as shareholder information. So you click on that, then you will have a PDF document of annual report. So you click on that, and in that annual report, you will find all these three statements: balance sheet, income statement, and cash flow statement. So now in this case, this is a balance sheet of a FMCG company. This is a balance sheet. Now, as mentioned before, it has three major sections: asset, liabilities, and equity. So we'll know what that is. So the first part here we can see is the asset heading, right? So this part until here is the asset section. Then comes the equity and liability section. So this is the equity section. Okay, wait. This is the equity section. And from here to here is the liability section. Now, assets, as discussed before, has two parts: non-current assets and current assets. Non-current are the long-term assets and the current assets are the short-term assets. Now here we can see the different categories like PPE, property, plant and equipment. So it has an asset value of 20,650 in 2020, and the other side it is also given for 2019. Now why does the company make a 2020 balance sheet include a 2019 balance sheet figures? Right, this is because if you are a shareholder of the company, then you would want to know what are the changes from the previous years to this year. So that is why they include a section for previous years figures as well. So now we look at what are the different sections. It has a work in process category, then the assets, the loans. Now why is that the loan is considered in an asset? So this is the value of the loan that is given to us. So we'll make a good use of it in the future. That is why it is considered in the asset section. Later we'll see it will also be provided in the liability section. Then we have other financial assets, deferred tax. Now these are a very minute things that are also included. The details of this would be in the annual reports under the sections as mentioned in the note section here. So this is the number. So if you look at its annual report, it would have these sections under which the details of the particular thing will be told in detail. Okay, so as we can see, there are some short-term inventories, short-term financial assets that have to be paid before or within a year, right? So these are the current assets. Now, the total asset here is mentioned as 1,61,704 lakh rupees. So this figure is in lakhs, so it is mentioned as 1,61,704 lakh rupees. Now in the second section, we have the equity part of it. So this is the share capital and the shareholders equity capital. So these things are also a part of the balance sheet as mentioned. So we'll look at three figures totally in total equity, total assets. Now comes to the liability sections. Now liability has Again, long-term liabilities that are non-current, so it would be financial liabilities and other financial liabilities for which the total description would be given in the annual report. Other than that, they have current liabilities like short-term trade contracts, micro and small enterprise contracts, and other contracts as well that needs to be paid within a year. So the total liabilities would be 70,798 lakh rupees. Okay. So now, according to the accounting equation, asset equal to liabilities plus owner's equity, so let's see that if that holds true or not. So total assets is 1,61,704 lakh rupees, which should be equal to liabilities is 70, right? So that should be equal to 70,798 plus the equity. Total equity is 90,906. Now, if I add this figure here, what do I get? 7,864,101,797,1,179,16. So we get the exact same figure as of assets. Now this states that our balance sheet is in balance and the assets equal to the liabilities plus equity. Hence, this balance sheet is correct. So the second financial statement that we will discuss is called the income statement. Now, this statement tells us about the company's revenue, expenses, and also the tax incurred on the company by the end of a financial quarter or end of financial year. Now, in a nutshell, this statement provides us the information about the profitability of the company. Okay, so just like balance sheet had an accounting equation, this too has an accounting equation of its own. So in this case, it is the revenue earned by the company minus its expenses would give us the net income. Now, net income can be both. It can be either profit or loss. Okay, now let's look at an example. So here we have a profit and loss statement. So income statement is also called as a profit and loss statement. So we have this income statement from a FMCG company, fast moving consumer goods. So FMCG is basically the company that deals in the daily utilities like toothbrush, toothpaste, biscuits, and all this stuff of daily consumption. So here we have three sections. The first one is the revenue. Then there is this expense part, and lastly we have the taxation. Okay, so as mentioned, the equation revenue minus expense equal to net income should be valid. So let's look at how it is. So we'll look at the 2020 variant of it, and we can also compare it with 2019. So I'll be taking 2020 for this one. So let's look at the sections of the profit and loss statement. So the first one is the revenue. So now revenue has two parts: revenue from operations. So operations is the day-to-day activities that the company is doing. That's the primary objective. Second one is the other income. Now other income can be the investments that the company is doing in land, or it's renting out spaces, or it's investing in either, let's say, mutual funds or in different companies. So that would be the other income. Okay, the total combination of these two would be the total income. That is 3,04,610 lakhs. Okay, so then it is the expenses part of it. Now, expenses for an FMCG company, it would be the raw materials that it would buy and also maintaining the inventories, logistic management. So all these things would account for that. Okay, apart from these three costs, there would be the salaries of the employees that need to be paid, certain financial costs like paying the rents or electricity bills and everything like that. Now, the next would be the losses. So there would be certain losses and depreciation in it. So what would be a depreciation for an FMCG company? So these are fast moving consumer goods. So they would have a shelf life or an expiry date in it. So the nearer the material would be to the expiry date, so the lesser cost they have to sell it to the wholesalers. So that would be the depreciation in it. Now, combining all the expenses, we get a total expense that is 2,45,223 lakh rupees. Okay, so if I subtract this total income from the total expense, I would get the profit before tax from operation. So let's see, 304610. If I subtract it with 245,223. Okay. So if I subtract this, what I will get? What is this? 1, 10, 7, be 8. Then it would be 523. Then 10. Okay. 14, 4, 9. Okay, so it is 59,387. That is the exact amount we have profit from operation. So now the case would be if the expenses would be more. So if the expenses were more than the total revenue generated, then the net income would be a loss. But in this case, since the revenue is greater than the expense, it is a profit, right? So this would be mentioned over here. And now we can compare. The net profit had been a little less than the previous year. Okay, so next would be the taxes. So tax would be GST. So it would be a central GST or a state GST or other small tax that are the road tax would be there, toll tax, different types of taxes for the movement of shipments. So in this case, that would also be adjusted, and then the total income tax would be 16,079 as mentioned. So if we subtract our total profit from the taxation, we'll get the exact profit after tax. Okay, that is 43,308. Now let's look at this. So our profit from operations before tax was less than the previous year, right? As you can see, but the taxation for this year is less than the previous year. So our net profit is more than the previous year. So the taxation and everything has also to be accounted in when you are looking at how the company is performing. So this would also be one criteria here. Let's look at another company in which the net income is a loss. Okay, so here we have a profit and loss statement for a airline industry, for a airline company. Now in this case, we can see that you have revenue mentioned and other income mentioned. So now here it is not revenue from operations, actually it is operations only. But in case of airline, it has contracts with customers buy tickets, right? So here it is that operation income. Okay, then you have expenses. Total expenses is marked here. You subtract total income from expenses, you will get the earnings before taxation. Okay, so different taxes would be mentioned here. Then now in this case, if you actually calculate what is the total here, earnings are positive since the revenue is greater than the expense, but the taxes are pretty high. Okay, so if you subtract this together, this with this, 17,000, 5,007, so it would be 17,339 plus 703 plus 5,450.0.08.12 is there, 0.12 here and 3 4 here. So if you add this thing and subtract this 12th earnings before taxation, 738. Okay, so this comes out to be in the loss side of it. Since the expenses are more, so it will come a loss. So that's why they have written loss for the year. In certain statements, it will just write net income and the figure would be negative. So negative means it's a loss. Okay, so other taxes. So the total loss of the year is 9,347, which has dramatically grew from 2019. So this is not a very good sign when we look at this income statement. So the next and the final statement that we'll be talking about is a cash flow statement. Now, cash flow statement tells us about the cash inflows and outflows of a company. So it is divided primarily into three types. Number one is the cash flow from its operational activities. That is the heart of the business, what they are working for, what is their business for, and all that stuff. So the second one is cash flows from investing activities. Now, investing activity means acquiring land, acquiring different entities in the company. All this thing comes under investment activities. Number third is cash flow from financing activities. Now, this would include rolling out of dividends. So the company rolls out dividend if they are earning really good profits. So it rolls out dividends for their shareholders so that they can share the profits of the company with them. The third one is cash flow from financing activities. Now, this would include rolling out of dividends. So the company rolls out dividends if they are earning really good, if their cash flows are really good. So they roll out dividends to share their profits with their shareholders. And also, they could financing activities would also mean that repayment of interest on different types of loan that the company has taken. Okay, now let's look at a cash flow statement. So here we have a cash flow statement of the same FMCG company. So as mentioned before, that it has primarily three types of cash flows. First is the A part, that is cash flow from operating activities. Now, we have seen it in the income statement, that profit before tax. So it is the same value. Let's check. So in the income statement, we had this profit before tax from operations that was 59,387. Okay, so here we see that is the same amount in cash flow that has been carried forward from the income statement, 59,387. Now there are certain adjustments that are made. Now these adjustments, as you can see from here to here, all this would vary from company to company, sector to sector, it would vary. So now we won't get into this what it is, because it would have been different for an airline industry, for an FMCG company, for a motor company, and all these things would be different. So there are certain adjustments that need to be made, certain property, land, recoveries, logistics, losses or incomes that should have to be adjusted for. So that is mentioned in this section. So after adjusting, we have a net profit of 63,548. After that, the working capital that is required for the company, it also has certain adjustments in their inventories, trade practices, and all this stuff, financial assets. So these things are also adjusted. It can be plus or minus. So increase is mentioned in brackets. So this is minus, decrease, plus, 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 plus. This is minus. After this, we'll get a net amount of 61,759. Now, this is the cash that is generated from these operational activities. Now, they would incur certain taxes on it. So after subtracting the taxes, we will get a net amount of 47,405. So this was part A. I'll just mention that 47,405, or I'll mention in the next slide. So the second part is, wait, first I'll mention 47, what was it? 405. Okay. So now the second part is the cash flow from investing activities. Now I already mentioned you what it is. So it is the loans that are released, the interest release, the payment acquisition of land, property, and sale of any equipment if there is any. So these things are also added, subtracted in the way it is. Now the total net cash from investing is this 7,472. So we'll add 7,472 to it. Now cash flow from financing activities is most of the times in negative, because these are the things that are rolled outside of the company, like dividends are paid to the company, the interest on the loans is paid back to the banks. So in this case, all these things would be subtracted. So the net cash in financing activities would be negative. Okay, these all would be negative. Interest on liabilities, interest paid on lease, principal payment of liability, dividend, and dividend tax paid. So all this is negative. So we have a negative figure. It's in brackets of 19,063. Now, what should be in brackets and what not? That would depend. It would have some of the values could be positive and negative. You have to actually see which one is positive, which one is negative. So in this case, this financing activities is negative. So I'll add both of the A and B from operational investing. I'll add, and financing I'll subtract 19063. Now I will get the net value that is mentioned over here, 35,814. Now, what happens in this case is that it is rolled, there is a cash and cash equivalent at the beginning of every year. So, that is basically the end of previous year's cash flow statement's last entry, that is cash equivalent. So, as you can see, year ended in 2019, you had a cash equivalent of 52,590 lakh rupees. So, this added with this year's cash equivalent, so this value here is posted here because the end of previous year's cash flow entry would be this year's beginning cash flow entry. Okay. So this added with the net increase in cash flow would give us the equivalent for this year's end, 2020's end, and it would be marked as 2021's beginning. Okay. So these are the three things in cash flow statement that needs to be known: cash flow from operation, investing, and financing. Okay. Next, we look into some of the accounting concepts that are a must to know when we start accounting. So the first one is separate entity concept. Now this states that the owner and the company are two different terms, they are two different entities. Now you would ask me, hey Madhur, we already know this, that a company and an owner are always different, so why do you want to make a module out of it? I'll tell you why. So when you start a company from scratch, let's say you are having a startup or you start your entrepreneurial journey, so it becomes really important to not mix yourself and business together. I'll show an example. Let's say that uh, I have a restaurant. So, okay, this I have a restaurant. Now, this is my personal self and this is my business self. Now, what does this mean? This means that if I have a restaurant, then I'll invest some of my personal stuff in the business. I'll give an initial capital. I'll give a capital to it. Let's say 60,000. Now that business with that 60,000 will purchase stuff like raw materials for cooking. It will get some staff. It will give employment. And let's say it then sells dishes to earn revenue, right? So in this case, let's say that the company is profitable. So it will get some profits that will go to the company C. Now these profits are owned by the company, but it is a property of me because I am the owner of it. So now this business will transfer its profit to me, right? So in this case, how a separate entity works. Now the profits will directly not go into my account. It will come to first the business account and then it will be transferred to my own personal account. Now what happens if the business has taken some loan, right? And my restaurant has some land in it that is owned by the business. Now, let's say if my personal self and the business, they are not separate entities, but are together as one. So now in this case, if by chance the business defaults on the loans, the collateral will be of the business and me together. Now, this can create an issue because then my personal assets will also get sold, which is a problem, right? So that is the reason why business should be separate. So the loans that will be issued are purely on the business land or for the business, not for my personal self. Therefore, it becomes essentially important to have two separate entities, one for my personal self and the second one for business, even if I own 100% of the business. The next accounting concept is going concern concept. Now, this is a very interesting concept which states that the company or the business entity should continue to run its operations for a very long time in future and also should not shut its operations midway. There can be certain reasons for that. For example, if the promoter of a company dies or a board of director resigns, the company should keep running its operations for a foreseeable future. This also states that the revenue of the company should only be charged for the things it utilizes. Let's say the company has taken a loan from a bank for 5 years. Now, in that 5 years, the company should utilize those funds to grow the company forward and should not let that fund be left unutilized. Another point in this concept is that the company should not liquidate itself. Now, what does liquidate mean? Now, liquidation means to shut down all the operations and selling off all the assets to repay any debt it has from banks or other entities. So, this concept makes an assumption that the company is reliable, consistent, and maintains continuity for a foreseeable future. This is also about being optimistic about the company, that its assets and resources will grow over time. So all the business transactions and other long-term third-party contracts are held in a belief that the company will run its operations for a very long time. Let's take an example. So if the company, let's say, buys expensive machinery of 60,000 rupees. So, and it assumes that the lifetime of that company is 6 years. So 6 years. This means that for all three, so this means that for all those 6 years, each year that company uses that machine's worth of 10,000. So the next type of accounting concept is called a double entry concept. So this is the most important type of concept in the accounting world. It has many other names, like it is also called as dual aspect concept, dual transaction as concept also. Okay, so for understanding this, first we need to understand what is a debit and credit. Okay, so let's say that you are buying a phone of 5,000 rupees. So 5,000 you will pay to the seller, right? 5,000. Now this amount is going out of your account to someone else's account, right? So this money is going away from you, right? Similarly, let's say a friend gave you 5,000 rupees as a gift. Okay. So this money is coming to you, right? So debit is something what goes out, credit is something what comes in the accounting terms, right? So now you understand. For example, you have also seen many messages when you withdraw money from your account, right? So the message comes that some XXX amount is debited from your account. Now this is what goes out of it. And if for example your salary comes to your account or something like that, or someone sends you money, then the message comes from the bank as this amount is credited to your account. So credit is what comes in, debit is what goes out. Now coming to the double entry concept. So this states that any transaction in the world has two aspects of it. One, what goes out, second, what comes in. So let's say that you are going to buy vegetables, right? So buying a vegetable, you would give cash. So cash would go out of you while the vegetables will come to you, right? So there are two aspects involved in it. So in the accounting terms, that entry will be made into two different accounts. One would be the vegetable account, the other would be the cash account. So the cash would deplete while the vegetable account would increase, right? So let's take another example. If you're buying a table or a camera or a phone, so in that case also, if when you are transacting a money to someone else, it is reducing your cash account, while you're getting something, a camera or anything, your camera account would increase, right? What is this camera account or vegetable account I'm talking about? It is the asset account that you would increase, right? So there's one more thing, that double entry does not mean you make two entries in the same account. It is two entries but in two different accounts, and they are two different types. One is going out, the other one is coming in, right? So what is the benefit of it? It has four major benefits. First, it gives you a clarity of how the your business is performing, or also to maintain good accounting records. In an accounting world, the transaction is accurate when it is correct up to two decimal places. Thirdly, it would give a good holistic view of the company finances, how the company is doing, and it would reduce any bookkeeping errors if they occur, right? So these are the four key benefits of double entry concept. Next, we talk about matching concept. So in this concept, I'll explain you with the help of an example. Let's say that you are a retail seller and your business is of selling phones. Let's say that in order to sell phone, you purchase 20 phones. So I'll say by quantity and revenue. Okay. So let's say that you bought 20 phones for 10,000 rupees value. Okay, so your total buying cost is 2 lakhs, right? Now you sell that same phone for, let's say, 15,000, and you sell quantity is 10. So your net revenue is 1 lakh 50,000. Okay. Now, seeing these two things, your buy price and selling price, you would say that, you know what, it is a 50,000 rupees loss, right? You would conclude that it is a 50,000 rupees loss. But is it so? Now, matching concept tells us that if you are looking at the revenue, then we need to first look at what is the cost incurred to gain that revenue, right? So in this case, we only sold 10 quantity of 15,000 value, right? So what would be the cost incurred for this 10 units? That would be 10 into 10,000, since we bought it for 10,000 rupees. So the total cost for that 10 phones would be 1 lakh rupees, right? Now, if I subtract that 1 lakh from the selling price of 15,000, I will get a net 50,000, and that would be my profit, right? This would be my profit. Therefore, the concept of matching defines and states while preparing an income statement, so the revenue is corresponding to the relevant expenses. We cannot change the quantity of different things and then say that, okay, the revenue is deferred or it is a profit or a loss. We cannot conclude until and unless we have seen the cost in which it is made, right? So this was matching concept. So now, after learning about all the basic terms and terminologies like asset, revenue, bookkeeping, receipts, invoices, also after getting to know about the different accounting concepts, now we are in the position in which we can actually know how the accounting cycle works and what are the various steps that are involved in it. Okay, so let's look at the accounting cycle. So it has primarily 7 steps. So let's look at each one of them. So the first step of the accounting cycle is the collection of various transactions. Now, this is our first step. Now, we already know how we track these transactions. It is through receipts, bills, invoices, and so on. So in the same way, we will know each one of them by their bills. So we will collect all of those transactions. We'll collect the invoices, the bills, the receipts that have been generated that are kept with us. So we'll all collect that and store in one place. Now, the second step of this accounting cycle is to record into a journal. So we need to make a journal entry. So I'll tell you what a journal is. So journal is basically a book in which you note down what are the transactions that are happening. I'll show you the example of how a journal looks. So in accounting, this is how a journal looks. So it has a journal number over here. That is the starting. So this journal number is unique. Now this tells you that various types of journals that are present. So this would give you a look at what it is. Now the first step is to writing the date. Now this is important because it will tell you at what date that particular transaction happened, the posting date of it. So that we'll mention it over here. Then second column comes the account. Now there are a lot of different types of account in accounting, like the cash account, the cost of goods sold account, the inventory account, the receivables account. So all these are different types of account. Now the third and the fourth columns are debit and credit. Now, as you have learned in one of the accounting concepts, the double entry concept, in which every entry has to be made into two different accounts, right? So here in this case, our first account is cash and the second account is inventory. Okay, so now these two things are mentioned over here, but you can see that there's a little gap in between, right? This is to differentiate between what are debit entries and credit entries. Now in this, in cash account, the money is debited, so it is written as debit. In the inventory account, the money is credited, so it is in the credit side of it. Okay, so that is why all the credit entries to have some space from the start. So that is why this gap has to be maintained. And this is one entry, right? So there can be n number of entries down here of various accounts. Okay, the most important part of it is that the total debit here should be equal to the total credit. Okay, so that is very important in a journal entry, that all the debit side and the credit side should match. Okay, so the next phase after journal entry comes maintaining a journal ledger. So the journal ledgers are basically the accounts, the combination of various journal entries into one single book, right? That is called as a journal ledger. Now the difference is that earlier times we did not have a modernized journal ledger. It used to be most of the times something called as T accounts. So T accounts would look something like this. On the left side would be debit, on the right side would be credit. Okay, so these were made for all the different types of accounts. Like let's say there's a cash account, there is a accounts payable, right? So these T accounts were made for every single type of account, and those were to be clubbed together to make a one general ledger, right? These were known as sub ledgers. Sub ledgers. Okay, so on the left side is debit, on the right side is credit. For example, you would have to give, you are liable to pay 3,000, let's say $4,000, right? So you will debit $4,000 from the cash account and you will credit the same into the accounts payable section of 4,000. Okay, so then there would be one book that would combine the two into recording things, right? That is known as a journal ledger. That's all. Next is trial balance. Now, trial balance is a document that is required to be made to ensure there are no errors involved in the accounting process. Now, the errors could be, you may skip an entry, you may skip a transaction in one of your accounts, or you may replace the debit side entry to a credit side entry. Or even you can make two entries of the same transaction in one single account. So all these mistakes have to be taken care of when we are dealing with a large scale business, right? In which multiple transactions happen every single minute. So this is why it becomes important to proofread everything, right? So let's see how a trial balance look. So a trial balance can be posted on any given time in an accounting period, right? So for a trial balance, first we need to know the end date, which date it is posted. So that would be the top heading of a trial balance. Then we have three columns. The first one is the accounts. So which type of accounts are utilized in the transactions? So these are mentioned in the first column. The second column is the debit side and the third column is the credit side. So all the transactions happening would be taken care of in this. So different accounts would have different entries that need to be put. So in a typical layout of a trial balance, so the first entries, the first accounts are mostly assets. Then comes the liability side of it. Then comes the owner's equity, revenue, and expenses. So this is a general layout of how a trial balance is. First comes the asset, then liability, equity, revenue, and expenses. So this is the way. Similarly, like a journal entry, in this also, you have to make sure the total debits is equal to the total credits, right? So everything needs to be in the perfect order. The equation should satisfy debit equal to credit. Okay, so after covering all the four steps, we come to the fifth step, that is adjusting entries. Now let me explain you how it is with an example. In India, the financial year is considered to be from 1st April to 31st of March. 1st April of, let's say, 2020, 31st March of 2021. Now there can be some situations in which some of the payments are done in between of these accounting cycles. So for example, one of the purchases is done on 30th of March, right? So now it becomes complicated to know where to put these transactions, either in the previous accounting cycle or the new accounting cycle, right? So this happens in mainly two cases. The first one is known as prepayments. So the good, you haven't received it yet, or the one that you have not purchased yet, but the payment is done, right? So it is called prepayments. And the second would be a deferred revenue. So now these things have to be taken care of, where to put these payments or where to put the deferred revenue. So all these calculations are involved in the adjusting entries that a company does. Next is preparing financial statement. So we have already discussed the three main financial statement, that is the balance sheet, income statement, and cash flow statements. So after this process, all the data that we get, all the numbers that we get are then aligned together to make three financial statements, right? After preparing these financial statements, and the last step of the financial accounting cycle comes closing entries. Now, what are these closing entries? So after finishing all the processes, be it journal entries, be it posting in a ledger account, be it checking if the debits is equal to the credits, or adjusting those entries and making all the financial statements, in this step, all the temporary accounts, be it ledger accounts or be it journal entries, everything is set to zero for the next accounting cycle. And all the things that are left over are sent to the owner's equity, because at the end, they are our major stakeholders in the company. So everything, be it profit or loss, is transferred to the permanent accounts of owner's equity. So this happens in an accounting cycle. Now let's look at what we learned in this course. So we started by knowing what is accounting, what are the different types of accounting. Then we moved on to knowing what does bookkeeping means in accounting, what is the importance of bookkeeping. Then we talked about the phases of bookkeeping process. First is creating a record keeping system. Second is tracking those transactions, right? So that we learned. The third part, reporting these transactions. We learned to make three of the most important financial statements called the income statement, balance sheet, and cash flow statements. After that, we looked at some of the most important accounting concepts that are a must to know when it comes to accounting. After that, we had a step-by-step analysis of different steps involved in an accounting cycle. Before moving on, let's talk about our learning objectives. So we'll be starting with knowing what is financial accounting, what is the need of financial accounting. Then we'll know about the three main financial statements called the balance sheet, income statement, and cash flow statement. So we'll be discussing in depth what are the various components of it and what is the uses of all three statements. At the end, we'll be discussing about the various financial ratios that we look at when we analyze different companies and their performance, how well they are doing, how stable they are, what are their growth perspectives. So we'll look at that in the module of financial ratios. What is financial accounting? So, as the name suggests, financial accounting is something that is related to finance or money, right? So, it is basically the recording, summarizing, and analyzing of various business transactions that are happening in a company on a day to day basis. So, all these business transactions are then noted down and used to create three major documents called the balance sheet, income statement, and cash flow statement, togetherly known as the financial statements. Now, these financial statements are utilized by both the internal stakeholders and external stakeholders of the company. Internal stakeholders would include the top management of the company, And external stakeholders would include the retail investors or the common people who would wish to invest in the company through stock markets. Now, these statements would provide an accurate view of the financial health of the company, whether the company is in profit or is in loss, whether the company has accumulated too much debt and liabilities in its side, or does it have surplus amounts that it would give out as dividends. So, all these things have to be documented in these financial statements. Before talking about these financial statements in depth, let's talk about basic terms and terminologies that are used in the accounting world. So there are mainly five types of accounting terminologies, one being asset, liability, revenue, equity, and expenses. So let's look at what is an asset. Now, asset is a resource that drive future economic benefit to a company or an organization. So it consists of cash, office equipments, machinery, land, property, and investments. It can be a short term investment or a long term investment. All of it comes under asset because it drives certain value for the company in the coming years forward. So, not all assets are visible to us. There are some which are intangible, like patents, intellectual property rights, trademarks, etc. Some of them are tangible, like cash, land, property, machinery, etc. Next is liability. Liabilities would be of two types basically. Short term liability would include short term debts. Long term liability would include long term mortgages, long term bank loans, etc. Next comes equity. Equity is the amount of capital that is owned by the promoter of the company. It tells us about the ownership of a company or a business entity. What you see is known as an accounting equation. It is known as equity equal to assets minus liability, or in the other terms, asset equal to liabilities plus equity. Okay, so let me show this with an example. Let's say that you are buying a truck for your company for your logisticals needs. You're buying a truck worth 1 crore. Okay, but you only have 20 lakh in hand with you, and the rest 80 lakh you take a bank loan, right? So in this case, that the 20 lakhs that you have in your hand is called your equity, and the 80 lakh that the loan that you have taken is called liability because you have to give it back, right? And the 1 crore that you have is called an asset because it would drive a future economic benefit when you use this truck in the logistical needs or to get raw materials or to deliver products. This would drive a economic value in the future, right? So this is asset. Now if you subtract equity equal to asset minus liability, if you subtract the assets of 1 crore minus 80 lakh, you would get 20 lakh as equity, right? So this right here is also called as the accounting equation, right? Which is very important to know. Next is revenue. Revenue is the amount that is generated by the company from its core operations by selling a product or a service in a given period of time. So the point to be noted here is that revenue is not the profit or a loss of a company. Revenue is the selling price of a particular service or a product. Let's say that you are selling samosas of 20 rupees each. So that 20 rupee that you are selling would be your revenue because we haven't subtracted any cost that is incurred from it. So it is the total amount. Next is expense. Expense is the cost that is incurred in the development of a particular product or a service. Now, expense would not have any future benefits, right? Now, if we subtract an expense from the revenue, we get net income. Net income is basically if the product is in profit or loss. Let's take an example. Let's say that you are selling tea that is of 10 rupees. Now, this 10 rupees is your revenue, as this is your selling price, right? Now, making of tea, the cost would be milk, let's say of 2 rupees, sugar, 1 rupee, and tea leaves, that would be of 2 rupees again. So the total making cost would be 5 rupees, right? So this part would be your expense for making that particular product. Now, if you subtract these two, subtracting 5 from 10, you would get 5 rupees. That is your net income. So it is profit, since the expense is less than the revenue, you get profit. If the expense is greater than the revenue, then you would have a loss. If the expense is less than the revenue, then you would have a profit, right? Next, we'll be talking about the two methods of recording transactions, that is accrual based of accounting or cash based accounting. Now we'll know the difference between the two coming forward. So first we'll start with cash accounting. So cash accounting is a method of recording transactions in which the entries are made only when the cash has exchanged hands between two parties. So the revenue is entered and the expense is noted only and only when the cash has been received or paid out. So let's say that you are purchasing a raw materials for your business. So the day on which you give out the payments as cash will be recorded in the expense account. Secondly, when you make the sale of those products, on the day you receive that cash from the particular customer, then the entry will be made in the revenue account. Okay, let's take an example. Let's say that you are a retail phone seller. So for that, you would need to first purchase the phone from the company and then sell it to the seller, right? So first step would be to purchase the phone from the company. Let's say you paid 15,000 rupees, okay, to get that phone on 20th, let's say December, okay. Then you would sell that particular phone for 20,000 rupees on, let's say, 29th of December. Okay, and the cash you will receive of that particular phone, let's say 2 3 days later on 1st Jan. Okay, 1st Jan is when you receive the cash. Okay, now what cash based accounting states that you will make the entries only on the day you have either paid out the cash or received the cash. In the case of expense of 15,000 that you purchased from the company, you will make the entry on 20th December because you have paid out cash on that particular day. After selling that particular phone for 20,000, you will make that entry on 1st January and not 29th December because you have received the cash on 1st January. Now you have to look at the December account. So in December account, you have paid the money to a company, right? To the phone manufacturing company. So that will show me a loss of 15,000 as the money has went out of you. Similarly, in case of January account, since the entry is made in January, so in January account, it would show me a profit of 20,000. Now, this is not a correct picture of a financial health of a company as in two different months in a particular time in history. So it is giving me an unrealistic example of how things are going. Now we'll know the disadvantages of cash accounting. As mentioned before, that it is not accurate to identify the financial position of a particular company in a given period of time. Second, it is not recognized by both GAAP and IFRS. Now, what is GAAP? GAAP is General Accepted Accounting Principles. So, second is IFRS. It is International Financial Reporting Standards. So, both of them discourage the use of cash accounting because it does not give a very good picture of how the company is doing. So, no big company uses it. So, if you have a very small business like selling of tea or selling of samosas, then this would work out, but not on the scale in which you have lot of products and service to be delivered in the coming months that would have a deferred revenue. Next comes, there are a lot of loopholes since it is a very vague standard in which you will only account it when something is received or when something is gone out. So it would involve a lot of unfair practices, which is why it is discouraged. Next up is accrual accounting. So in accrual based of recording transactions, what exactly happens is the revenue is noted down when it is earned and the expense is noted down when the expense has incurred. What does that mean? So for example, that you are selling a bulk order of 35 of particular product. So on the day of that particular order, you will be writing it down in your revenues account on that time. The payment of the clients can come later, that's not an issue, but on the day in which the order has been placed, on that day it will be marked in your revenue account. Similarly, when you buy your raw materials, so on the day when you have made that purchase of the raw materials, on that day it will be marked in the expense account. So the bills of those raw materials can be paid later. So in the previous example, what we noticed in cash accounting was that on 20th December, when you purchased the phone from the manufacturing company and you sold it on 29th December with the payment by the customer being done on 1st January. So 1st January was noted down, right? But in this case, in accrual type of accounting, the entry into the revenue part would be done on 29th December itself. So what would happen is in the December account, there would be an expense of 15,000 on 20th December, and there will be a revenue of 20,000 on 29th December. So this is the difference between the two, cash accounting and accrual accounting. Now in this case, if you would know what is the profit that you would earn, that is revenue minus expense. So revenue, if I subtract expense from revenue, it will be 5,000 rupees. So this would be the profit in December account. Now this would give a good and accurate picture of how the company is going in that particular month, right? So that is why accrual based accounting is preferred over cash based accounting. We'll look at some of the advantages of accrual accounting. So in this case, first, it gives a very good picture of how the financial situation or financial health of the company is. Secondly, it works on all the standard principles like Financial Accounting Standards Board and GAAP, generally accepted accounting principle. Both of them recognize accrual accounting as the basis in which the company should record their transactions. Thirdly, it shows exact amount of profit and loss that is beared by the company. So it gives you an accurate picture of that. Next, we'll be talking about one of the three financial statements. So we'll start with balance sheet. We'll know the various components of a balance sheet, and also we'll have a sample balance sheet that I'll show you to have a deeper understanding of what balance sheet exactly is. So balance sheet contains the information about three primary objectives. That is, it tells us about the asset part of it. Asset means the future economic benefit that it would give. Second, it tells us about the liability section of it. Now, liabilities are what are the borrowings of the company, what it is liable to pay outside the organization, right? Thirdly, it tells us about the ownership of the company, the equity part of it. Okay, so the four major headers in a balance sheet that you will find are these things called current assets, current liabilities, non-current asset, non-current liabilities, and also the equity part. You will find it. Okay. So first we'll talk about current assets. Now, current assets are something that the company can convert into cash within a year. So these are also current assets are also known as short-term assets because it is readily available within a year. Okay. So now balance sheet typically tells us its ability to repay any debts that it may have, right? So it just gives you a glance of it, how the company is doing, how much assets they have, how much liabilities they owe to someone, and what is the owner's equity in it. Okay. So the examples of current assets would be its short term investments, that would be a very short term based, short term mutual fund, short term anything that would be converted into cash within a year. That would be a short term investment. Second would be marketable securities. Now, this would be a purchase of governmental things like government bonds, corporate bonds that can be cashed out within a year. Next would be amount receivable. Now, this would be like the company has given out loans to other organizations or other business entities that would be repaid within a year with an interest on it. Okay. So this would also come under the current asset. Then it would be the in hand cash that the company would already have in its bank account, which it can use immediately during an emergency or during any other event. It has readily available. Next is the inventories that it possesses. So it can have a lot of work in progress inventories that are currently in use or being used in the coming months. So that would also come under current assets. So this was about current assets. Now we talk about current liabilities. Now these are the obligations that the company are due to pay someone within a year of operation. So in an year, what the company is liable to pay comes under current liabilities. So it would be accounts payable, short-term loans that it has taken from banks that it needs to repay within a year. the dividend. So if the company is very profitable, so that profit amount it would share it with its stakeholders, internal stakeholders or general public, or the people who have bought its shares. So it would give out to them. So that would be dividends payable. Then it would be notes payable. Now, the examples would include first accounts payable. Now, accounts payable is an amount that is owed to a supplier of a company, of a primary supplier or vendor that it owes, right? That it needs to repay within a year. That would come under accounts payable. Second is dividends payable. Dividends is if the company is very profitable and it has an extra money that it wants to give back to its shareholders or the ones who have bought its share. So that would come under dividends payable. So this happens either quarterly or once in a year, so that it needs to pay out, or it can reinvest in its own company, but this is an extra amount that it gives out. Third is notes payable. Now this is the amount that it owes to a bank if the company has taken a short term loan that it needs to pay back, or to a financial institution, that comes under notes payable. Then comes accrual liabilities. Now these are short-term liabilities that the company has incurred. So it would be the interest on loans that it needs to pay back. It can be the tax that is liable to pay to the government, or it can be the salaries or the wages of employees that needs to be paid within 1 year. So these all things would come under current liabilities or short-term liabilities. Next would be non-current assets. Now, non-current assets are also called as long-term assets or long-term investments that the company has made that is more than one accounting period, right? That would include the investment in government bonds, corporate bonds, mutual fund and real estate that are in perspective of long-term arrangements. Okay, so these are not short terms. They would not withdraw the money in 1 year. It would probably be for like more than 1 year, for 5 years or 10 years, that the company thinks that this investment that they are making would give them hefty returns in the end. Second would be, now there comes two things in asset. One comes the tangible assets that you can physically touch, feel, experience it, right? So that would be property, plant and equipments that you can physically see and that you would make use of it in the foreseeing future. Second would be intangible assets that you cannot touch with your hand or see it with your naked eye, but that exists. That would be patents, trademarks, intellectual property rights, and copyrights. So these would come under intangible assets. As non-current assets are, they are also long-term assets of the company. Next comes is non-current liabilities. Now these are also similarly non-current means long-term, which are not due within 1 year. So all these bonds payable, long-term loans, deferred tax liabilities, long-term lease. So some of the times what happens is that a company takes a place for rent for like 5 years or 6 years in total. So the rents that needs to be paid out may be paid later depending on how the company's current situation is. So that would be a long-term lease that it would have to pay. Then it would be the deferred tax that it needs to pay to the government or regulatory bodies. Then it would be the long-term loans that it has taken for over a 20-year period or a 10-year period, something like that. Next is bonds payable. Now what happens is sometimes the company would ask loans from the banks that would be too huge for a bank to give out. So in that case, what happens is companies issue bonds to normal public or normal shareholders in which they guarantee a nominal interest rate on that particular amount. So for example, if someone is willing to buy the company's bond of let's say 50,000 rupees with a 7% interest, so this person would give the company 50,000 rupees, and in return they would give them a bond certificate stating that the company would be liable to pay him 50,000 rupees with 7% interest. Okay, so that interest part of it that needs to be paid is called bonds payable. Next, now we look at a sample balance sheet and know what are the components where they fit in. And to know where do you find all these financial statements. So if you go to the company's website, any company, it can be Tata, Mahindra, Reliance, Adani, anyone you can pick, you can go to their official website. So in that you'll scroll down, at the end of the page there will be a column called as investor relations. You click on that, then there will be options of reports. So in that there will be an annual report. So that is a very huge book. So it is a PDF of around 1000 pages. So in between of that you will find all these financial statements there. So I'll show you how it looks like. So this is how a balance sheet totally looks like. Now it has three main columns. The first one is the header part of it, which tells us where the amount is received or going. Second is the note sections. So everything cannot be fit into this particular sheet. So there are some headers that has notes involved. So in the annual report, you can find the detailed description of each header there, where the money is and everything. So you'll find that in the note section here. So the next column would be this year's financial status of the company in 2021. So this is a 2020-2021 financial report. So the in India, financial accounting period starts from 1st April to 31st March. So every year 31st March is when this balance sheet comes out. So it gives us of a previous accounting cycle also, just to compare how the company has done in the previous accounting period. So this is how it gives an overview of it. Okay, so the first section is always the asset section of the balance sheet. So the first section is always the asset section of balance sheet. So you'll find assets on the top. So it is divided into two parts, non-current and current. We already discussed what that is. So as mentioned, we have property PPE, property plant equipment, other intangible assets, financial asset, loans it has given out, investments and other things mentioned over here, right? This is the non-current asset part of it. The current asset would be other trade receivables. This is the short-term ones. This is the long-term ones. Okay. So the total of these two, 1 and 2, the total of 1 and 2 would be mentioned over here. So this is the total assets. So the second part that comes is, so it has equity, share capital and other equity. The total of that is also mentioned here, 45,504 lakh rupees. Then comes the liability section of it. So liability is also divided into non-current and current liability. So that would be trade payables that we discussed, financial liabilities. So it has, depending on industry to industry, there are a lot of different types of headers. Okay, for an automobile industry it would be different, for an airline industry it would be different, for a petrochemical industry it would be different, or similarly as garment industry it would be different. So the headers would depend on sector to sector in which the company deals with. So now the subtotal of current liability is mentioned here, of non-current is mentioned here. Now we have previously discussed our accounting equation, which states that assets equal to liabilities plus equity. So the asset part of it, that is total assets 59,013 lakh rupees, should be equal to total liabilities plus equity. So this balance sheet has already done it for us. So total equity and liability, as we can see, is 59,013, which matches the total assets, which says that the balance sheet is already balanced and it is accurate. So the next financial statement that we are going to discuss is called the income statement. Now the income statement tells us about the revenues, expenses and the tax incurred by a company in a particular period of time, maybe a quarter or annually. Okay, so this is also known as profit and loss statement. So in a nutshell, it tells us about the profitability of a company. Okay, the main headers: revenue, expenses and EBITDA. From these three headers, we calculate a number of things like gross profit or net income or operating income. All these things are calculated using these three headers. So what is this EBITDA? Revenues we have discussed before, expenses also we have discussed before, but what is this EBITDA? EBITDA means earnings before interest, taxation, depreciation and amortization. So interest would be, I would be interest. So interest would be if the company has taken loans or something like that. So how much interest it to pay to the bank or from wherever the loan has been taken. Second is the taxes. So what are the taxes it has to give to the government, or the road tax that would be involved in logistical supplies. So all that thing comes under taxations. Then comes depreciation. So for example, if a company takes a truck and it is going to use for let's say 50 lakhs, and let's say that it is going to use it for the next 10 years. So after that, on the 10th year, let's say its value is only 10 lakhs. Okay, so in that 10 years, it has lost 40 lakhs of value, which is called as a depreciation. So the value that has decreased by the use of that asset is called depreciation. Next is amortization. Now, amortization means that paying off your debt in a regular repayments over a course of time, fixed repayments over a course of time. Payments are called as amortization. Okay, so this thing would be in EBITDA. Now, income statements can be a lot more complex than it seems. So, to understand it more easily, so I've broken down the income statement into several steps to make you understand more comfortably. So, the first part of an income statement is the revenue or the sales, right? So, the total revenue that has been generated by the company through its operations by selling of particular goods or service that the company is dealing with, and also the interest it has gained by several investments or any other things that it might have gained money from. So that would be a total revenue. Now, if you subtract COGS, what is this COGS? This is the cost of goods sold. So if you're making a particular thing, like if you're an automobile company, you're making cars, so what is the cost that you have incurred while building that particular car is called the cost of goods sold. So if you subtract that from revenue, you would get a term called gross profit. It would have a lot of different expenses involved, like let's say financial cost, employee cost, transport, logistic cost, etc. So all these things would come under operating expenses. Okay, so from that gross profit, if we subtract operating expenses from gross profit, we'll get EBITDA, that is earnings before interest, tax, depreciation, or amortization. Now, in some instances, there would be certain companies that would attach their depreciation and amortization in operating expenses. Okay, this would be technology companies, because technology companies do not have much of the products that have a depreciating value or amortization in general. Let's say that a technology company has several softwares, so it would not have a very big depreciation over the years, so they consider it under operating expenses. But other companies like oil, petrochemical, automobile companies, they have huge machinery which gets depreciated over the times, so that would be another section in income statement. But most of the technology companies keep it inside the operating expenses. Okay, so after subtracting this, you will get EBITDA. Now, in EBITDA, if you subtract the depreciation and amortization value, you will get EBIT, earnings before interest and taxation. Okay, from that, you subtract the interest part of it, then you will get your first thing, earnings before tax. Okay, so this is a major component when it comes to knowing how the company is performing, because tax would be almost the same over the years depending on the revenue and other factors, also government policies and everything. But main purpose to analyze a income statement would be earnings before tax, because it would give you a clear picture how the company is performing. If you subtract the tax part of it, then you will have your net income. Now, this will tell us if the company is profitable or not. So, this can be either profit or loss. Okay, so this was the major components, breakdown of components of an income statement. Now, let's look at an actual income statement of a company. So this is how it looks. It looks similar to a balance sheet, but has different particulars involved. So it has main sections as revenue, expenses, and taxes, right? So similar to balance sheet, this also has three major sections. One is the current year in which the values are given for. The other is previous year to compare how much performance it has gained or lost over one financial year. Then would be the note sections. This would be an elaborate picture of what are the different particulars here. Elaborate picture would be in the note section. Okay, so let's see it. First is the revenue of operations, and the other income would be their investments or something like that, in which they have gained good amount of interest. Then revenue from operations is their core thing in which the company is standing there. So this is their USP, the way in which they make money. Okay, second part comes the expenses. Now this would include employee expenses, various financial costs, depreciation, and other expenses. So just as I said, some of the companies include depreciation and amortization in their expense part of it. So this company has done the same. So we can see, get the values of it. Now we get the total expense. After adding all these things, we get the total expense. That is 22,457 lakh rupees. So I would stress on this other expenses. Now everything cannot be put in an income statement. So you will find these other small minute expenses in the note sections. Okay, so 19th would be the note in the annual report where you would find this. Now we can see they have given us a good picture of profit or loss before their taxation. So this is earnings before tax. So if we subtract the revenue, total revenue, that is 26,855, to the total expenses, that is 22,457, we'll get earnings before tax of 4,398. Okay, so this part is earnings before tax, and we subtract other tax expenditures from it, then we'll get a net profit or loss, which they have calculated as 3,202 lakh rupees. So this is our net income. Okay, there can be several other things like mentioned over here, which depends on company to company and sector to sector. Okay, so we'll not go in depth on that note, but this would be your net profitability of the company. Okay, so how to differentiate between loss and profit in income statement? So as in this case, they have given loss in bracket. So anything that you see in bracket would be a negative value. Okay, so some companies directly give a negative value over here. Some of them give it in bracket. So it varies from company to company. Okay, so last section we see here is something called as earnings per equity share. Okay, so what does that mean? So this is called a financial ratio that we look for a particular company to compare it with other companies and to see the trends over the past years, how it is doing. So this we will know in a last module. We'll know it in detail what EPS means, earnings per share. So this was all about income statement. So the financial statement is called the cash flow statement. Now cash flow statement tells us about the cash inflows and outflows from the company. So it gives us an idea how much cash does the company possess in hand at a particular time. So the main components of the cash flow statement, or the main headers in a cash flow statement, are three of them. The first one is cash flow from operational activities. The second is cash flow from investment activities. And the third is cash flow from financial activities. Now let's look at what does cash flow from operational activities mean. So cash flow from operational activities tells us about the cash that is spent or earned in the operations of that particular firm or business entity. So these particular operations are the core of what the company stands for. So its main product or service, how much cost that has been incurred, how much revenue it has gained. So it tells us about that. So this includes, as mentioned, revenue, working capital, how much amount is needed for its day-to-day operations. Then it's expenses. Now expenses would be rent, it would be the wages that it needs to pay to its employees, it would be electricity bills, and so on. So cash flow from operations is the addition of net income, the working capital changes, and non-cash components. Okay, next is cash flow from investing activities. Now this would be the amount that is spent on other investments like mutual funds, land, property, equipment, acquisition and mergers with different businesses, and also investments in marketable securities, that would be corporate bonds or government bonds, something like that. Next would be the cash flow from financing activities. Now, this would include raising and deploying for various financial activities like issuance and repayment of any debt or loans, as mentioned. Then it would be the payment of dividends, lease payments, issuance of equity. So, the major chunk of cash flow from financial activities for any business is generally either the repayment of loans or the repayment of debt or dividends. Okay, that constitutes the major chunk of portions in financing activities. Now let's look at a cash flow statement of a company. So as mentioned before, that it has primarily three types of cash flows. First is the A part, that is cash flow from operating activities. Now we have seen it in the income statement, that profit before tax. So it is the same value. Let's check. So in the income statement, we had this profit before tax on operations, that was 59,387. Okay, so here we see that is the same amount in cash flow that has been carried forward from the income statement, 59,387. Now there are certain adjustments that are made. Now these adjustments, as you can see from here to here, all this would vary from company to company, sector to sector, it would vary. So now we won't get into this what it is, because it would have been different for an airline industry, for an FMCG company, for a motor company, and all these things would be different. So there are certain adjustments that need to be made, certain property land recoveries, logistics, losses or incomes that should have to be adjusted for. So that is mentioned in this section. So after adjusting, we have a net profit of 63,548. After that, the working capital that is required for the company, it also has certain adjustments in their inventories, trade practices, and all this financial assets. So these things are also adjusted. It can be plus or minus. So increase is mentioned in brackets. This is minus, decrease, plus, 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 plus. This is minus. After this, we'll get a net amount of 61,759. Now, this is the cash that is generated from these operational activities. Now, they would incur certain taxes on it. So after subtracting the taxes, we will get a net amount of 47,405. So this was part A. So now the second part is the cash flow from investing activities. Now I already mentioned you what it is. So it is the loans that are released, the interest release, the payment, acquisition of land, property, and sale of any equipment if there is any. So these things are also added, subtracted in the way it is. Now total net cash from investing is this 7,472. So we'll add 7,472 to it. Now, cash flow from financing activities is most of the times in negative, because these are the things that are rolled outside of the company, like dividends are paid to the company, the interest on the loans is paid back to the banks. So in this case, all these things would be subtracted. So the net cash in financing activities would be negative. Okay, these all would be negative. Interest on liabilities, interest paid on lease, principal payment of liability, dividend and dividend tax paid. So all this is negative. So we have a negative figure. It's in brackets of 19,063. Now what should be in brackets and what not? That would depend. It would have some of the values could be positive and negative. You have to actually see which one is positive, which one is negative. So in this case, this financing activities is negative. So I'll add both of the A and B. From operational investing I'll add, and financing I'll subtract 19,063. Now I will get the net value that is mentioned over here, 35,814. Now what happens in this case is that it is rolled, there is a cash and cash equivalent at the beginning of every year. So that is basically the end of previous year's cash flow statements last entry, that is cash equivalent. So as you can see here in 29, year ended in 2019, you had a cash equivalent of 52,590 lakh rupees. So this added with this year's cash equivalent, so this value here is posted here, because the end of previous year's cash flow entry would be this year's beginning cash flow entry. Okay, so this added with the net increase in cash flow would give us the equivalent for this year's end, 2020's end, and it would be marked as 2021's beginning. Okay, so these are the three things in cash flow statement that needs to be known: cash flow from operation, investing, and financing. So as common citizens, as retail investors, we would also like to put our hard-earned money into some of the best companies so that it can grow in the stock market. Okay. So in order to do that, we look at these financial statements that we discussed before, and apart from it, we also look at some of the financial ratios that are derived indirectly or directly from the financial statement itself. So let's to get a very good view on the performance of a particular company. So let's look at our first financial ratio called earnings per share. So earnings per share is the distribution of company's profit to the outstanding shares it has allotted. Okay. So it basically it tells us about the earnings of the company per share. So how it is calculated? So we got the net income from the income statement that we got, and the dividends that the company has given in a particular period, divided by the total number of shares that it has allotted. Okay, that is out in the market. Let's take an example. So example would be, let's say the company's net income, XYZ company's net income is 22 lakhs 15,000 rupees, and it has allotted 15,000 as dividend. Okay, and let's assume the total number of common shares would be 20,000. So if we calculate it, it would be 2 lakhs over 20,000. So that comes out to be, EPS comes out to be 10 rupees. Now what does it mean? So let's say that you as an investor has bought 200 shares of the company at, let's say, 500 rupees price. Okay. So if I multiply this 200 rupees with the EPS, it would give me 2000 rupees. Now, this 2000 rupees is the company's earnings that has got because of you, that you have invested the money in. So now this 2000, what the company can do is it can give back to you as dividends, or it can put the money into its own company for its growth purposes. Okay. So when the company puts its money in the growth purposes, it is bound that the share of that particular company would go up because it's investing in itself to for a better future. So the share price will go up, hence the value of your shares will also grow up. So this is what EPS means. Next is, so now the PE ratio tells us about the profits to the earnings of a particular company. So it is basically how many times more I'm ready to pay for a particular stock than its earnings. So let me give you the same example that we had before. So in that case, our price per share was 500 rupees and our earnings per share was 10 rupees, right? So our PE ratio is 50. So basically, I am willing to pay 50 times more than its earnings. So now what is this value? So this PE ratio tells us about, is the company overvalued or undervalued? A very large PE ratio would mean that the company is overvalued. So it is probably the time in which you do not want to invest in such a company. While on the other side, if the PE ratio is very less, I mean in single digits or very less, then it means that the company is undervalued and it is a good time to open your position in these companies, start investing in these companies. This is generally what it means in a broader perspective, but again, it would vary from sector to sector, company to company. So this value, we can actually compare it with its peers. Okay, the peers would be different companies which are operating in the same spec sector. So we can compare different auto companies, different petrochemical companies. So you would have the choice to look at its PE ratio and choose which one would you like to invest in. Okay, so this is what PE ratio means. The next financial ratio is called return on equity. Now, return on equity tells us about how much money the company is making on its shareholders' equity. So basically, it tells us about how efficient is the company in making profits. Okay, so it is calculated by dividing the average shareholders' equity to the net income. Now, net income you will find it in the income statement, and average shareholders' equity you will find it in balance sheet. Okay, you'll find shareholders equity. How do we calculate average? So for a financial year, so you'll take an average of the first month and the last month, you will get average shareholders equity. Now let's take an example. Let's say a company is having a net profit of around 150 crores, let's say, and its average shareholders equity is around 700 crores. Now the return on equity would be around 0.21. So it would be around 21%. Now this is your ROE. Now for any company in general, saying it is that the ROE should be more than 15 to 16% is considered good. Okay. Below this is considered on the weaker side, but above this is good. But there is a catch. So return on equity is not the primary financial ratio to look at. It can be misleading at times. For example, if the company has taken debt, too much loans, then this ratio would become greater, which would lead to biased results, which would not be accurate in our analysis. Okay. So looking at ROE, first you need to look at its financials in detail. Does the company has a lot of borrowings or something like that? You need to check before analyzing purely on the basis of ROE. Next financial ratio is debt to equity ratio. So this tells us about the borrowings of a particular company. So how much the company is in debt per 1 rupee of shareholders equity. So the ratio can be calculated by dividing the total liabilities of the company. So debt to equity ratio can be calculated by dividing the total shareholders equity to the total liabilities of a company. Both the things you will find in the balance sheet, liabilities as well as shareholders equity. So on dividing it, you will get the debt to equity ratio. Now, if the debt to equity ratio is too high, it means that the company is in financial trouble. Okay, so it is not making enough revenue even to run its operations. So this can be a very risk factor if you are willing to invest in such a company with high debt to equity ratio. Let's recollect what we have learned so far. So, we started by knowing different financial accounting terms and terminologies. We got to know about the difference between cash based or accrual based accounting. Then we had a detailed analysis of what is a balance sheet, what are the various components of balance sheet. Then we moved on how the income statement looks like, what are the basic steps involved in calculation of certain things like EBITDA, net income, gross profit, etc. Then we had an in-depth view of what cash flow statement is, what are different headings and components of a cash flow statement. Then we got to know about the different financial ratios that help us in recognizing a good company and a bad company in their performance, right? So that was in financial ratios.
So why we require this tally? Okay. So in tally, we have so many versions and we are going to use for accounting and financial purpose, for our financial reports and other purpose we are using the tally for, like small companies, big companies or medium scale companies. They are also using this tally, correct? So we are going to learn the software tally and how to work with a tally or how to use the tally and what are the basic concepts we require to use tally in our organization, that we are going to learn. Okay, so let's start with the agenda points. So in this session, we are going to discuss about the first one is the basics of accounting. That is the basic terminologies or basic concepts of accounting we are going to discuss. And I will tell you why we require this basics of accounting in tally. Okay. Next, we are going to discuss about the branches of accounting. Either we call it as branches or types of accounting or various kinds of accounting we have, that we are going to discuss. And next we are going to discuss about the GST, that is your goods and service tax. Why we require this GST in tally? Because we need to give some input to tally also, because it is a software. We need to give some inputs, then only we can get the accurate financial reports or accurate data of the organization. Okay, so then we are going to discuss about the introduction to tally. Okay, then we are going to start with the features of tally, purpose of tally software we are going to use in the organization, and the steps to install tally in our system. And the last one we are going to discuss about the hands-on part. So how practically we can use tally in the software, that also we are going to discuss. So these are the few topics we are going to cover in this tally course. So the first, we have already discussed that we are going to discuss the basic accounting or the basic concepts of accounting we are going to discuss, correct? So in that first one, in the accounting, bookkeeping. The bookkeeping is also called as the primary entry of books or primary entry of record of all the transaction. Okay, so it is the art of recording business transaction in the books of accounts in an orderly manner. So in the organization, so in a day, they are going to do so many transactions or so many activities or tasks, correct? So each and every task or activities or the transaction in terms of money, we can easily value the transaction in terms of money that they are need to record in their primary books or primary books of accounts. We call it as bookkeeping. So all the transaction they need to record. Why we need to record this transaction? Because if we want to do like any financial statements, we require this transaction. From this transaction only we are going to start all the books of accounts. Like in tally also, if we have this transaction or the bookkeeping records, that we need to give as a input to tally. Okay, because we need to give what is the transaction, whether it may be a asset purchase or asset sold or goods purchase, goods sold, or we are going to expenses, that is we are going to pay expenses like printing and stationery or any other postages, telegrams, fuel, coal, gas, for other expenses we are going to pay. So all those transactions, it is very, very important to give as an input to the any software, correct? So that is the reason we require this bookkeeping. The definition of bookkeeping is, it is the science and art of correctly recording in the books of accounts all those business transactions that result in the transfer of money or money's worth. But the transaction should be valued in terms of money only. Whether we are going to give money or we are going to give equals to the money. For example, if we are going to purchase some X product from the other business or other organization, on that time they required our goods. whatever we are going to produce in our organization. On that time, what we are going to do, whatever the value of that X product and our product, we are going to compare. For their one product, we are going to give two products, or for their two products, we are going to give one product of our organization. So that is money's worth. So this is the bookkeeping and the meaning and definition of bookkeeping, and what is the use of recording this bookkeeping, and this is the very important for giving as an input for Tally software. Because if you are not given proper input, then you are not going to get the accurate financial statements or accurate financial reports from the Tally software. So bookkeeping is very important role in the Tally software also. We are going to use this word accounting or accounts, correct? So what do you mean by this accounting first? So according to American Institute of Certified Public Accountants, that is AICPA, accounting is the art of recording, classifying and summarizing in a significant manner in terms of money, transaction and events which are in part at least of financial character and interpreting the results thereof. So the first word, that is the art. Okay, we need to record in a manner that whatever the accounting standards we have. I think so you heard the word GAAP, GAAP, generally accepted accounting standards or accounting practice we call it as. So we are going to maintain our books as per the accounting standards. Okay, if for example, if you don't have or if you are not following the GAAP rules and regulations or standards, then I'm going to record in my own way, or X person will going to record in other way, or other organization they are going to record in their own ways. So on that time the differentiation will be there, correct? So that is the reason all the companies they needs to maintain their books of accounts in the same standard or in the same procedures. That is the art of recording. What we are going to record first thing. So earlier we have already discussed, right? The bookkeeping or all the transaction we are going to record in our books of accounts. That is the recording. If we miss one recording or one transaction of any activity, if we missed, okay, then our final output or the final financial report, that will not accurate, correct? So that is the reason it is an art of recording and classifying. What we are going to classify? We are going to classify as a cash flow statement, fund flow statement, income statement and assets and liabilities. So all the transaction we are going to classify it into this category, whether it is an asset or it may be a liability, or it is an current assets, current liability, long-term debt, or it is a capital. So all those things we are going to divide, correct? So that is called classifying. Next, we are going to summarize. Summarizing is nothing but we are going to post it to the particular or the correct books of accounts only. Okay. For example, the purchase of raw material. If you are going to mention in the sales account, that is wrong, because we need to mention in the purchase of whatever the X company or with the whatever the person we are going to purchase in their individual ledger account we need to maintain first. Then we are going to maintain at a sales account, correct? So like that we need to summarize all this significant manner and in terms of money. So each transaction we need to mention or we need to record in terms of monies or money's worth. Because if we purchase raw material, what is the worth of that raw material? We need to measure in terms of money only. So that we need to mention in the books of accounts. And all the transaction and the events which are in part at least. So whatever the part of our organizational activity that we need to record. That is must and should. Then a financial character. So the whatever the value or the money we are going to record the transaction, and it should be interpret. So we need to give the interpretation for like in a quarterly wise or yearly wise or half yearly wise, we need to give the interpretation for the particular books of account, whether it may be a profit and loss account, income statement or your balance sheet, we need to give the interpretation. So if for example, for last year and for this year, the current assets were increased or current liabilities was decreased, fixed assets was increased. What is the reason why it is increasing from the last year or from the last quarter? That interpretation should be there in the books of accounts. Next, the process of accounting. Just we have discussed about the definition. As per the AICPA, we have discussed the meaning on definition of accounting, correct? So what is the process they are going to follow in the accounting? So first one, classification into assets, liabilities, capital, revenue, and expenses. So these are the broadly 5 categories of accounts we have. So whatever the transaction or whatever the recording we are going to do, we are going to classify as this 5 categories. First one, as an assets. So which is owned to that organization. If for example, you are the company or you are the proprietor, then which is your company, for that you have owned that asset or own that property, then we call it as an asset to that organization. Next, liabilities. Liabilities is nothing but what we owe to others. That is not your money. You are going to take from others. For example, bank loan, or you are going to take as a debenture. Okay, you are going to issue debt certificate and you are going to collect the money, or you are going to take the third party's money, that is as a loan. Okay, all this money is not yours, but you have taken from others, that you need to repay along with whatever the interest rate you have fixed or the contract is there. According to that, you need to pay the interest also. That is called liabilities. Next, the capital. Capital is nothing but it may be the owner's complete amount he has invested in his organization, or he is going to collect money from all the investor who is going to ready to invest their money in that particular organization. They are called as investors, correct? So they are going to collect the or pool of money from all the investors. He is going to invest in his organization, or he is going to utilize that money in his organization as a capital. Then we call it as capital, whether it may be a proprietor own money or it may be collected from the investors. That is called capital. Next, the revenue. Revenue is nothing but the income or the profit we are going to get for that particular organization. For example, they have sold goods. Okay, the company is going to sold goods of 10,000 rupees, but they have spent for producing that product is 5,000 rupees. So they have produced it for 5,000 and they have sell it for 10,000 rupees. So the 5,000, remaining 5,000 is there, right? So that is called revenue, or we call it as profit to that organization. So whatever the revenue, interest received, dividend received, or rent received, or you are going to get any income of selling the assets. Okay, all those things will comes under the revenue. At the end, expenses. Expenses is nothing but the money spent for our day-to-day activity. That is for printing and stationery, or for coffee or any other snacks, food items. For that you are going to spend money, or you are going to give salary or wages or transportation expenses. All those things will consider as a expenses for the organization. So these are the 5 broadly classified categories of accounting. Okay, whatever the transaction is there, we need to divide or we need to classify for this 5 categories. Preparation of income statement. So income statement is nothing but it is a account that we are going to maintain all our income at the left hand side of our books of account, and the expenses or the whatever the amount we are going to spend, okay, that we are going to maintain at the right side of the accounts. So all incomes left side, all expenses right side we are going to maintain, and we are going to get the whatever the balances left side or right side, that we are going to take from the income statement. Next, we are going to give the communication of results. So whatever the profit we have or whatever the loss we have, that we are going to communicate. And the last point, identification of accounting transaction which have documentary evidence. So in this books of account, the main thing is for each and every transaction, whether we have the supporting document or not, or each transaction is backed by any evidence, that is your voucher or bill or any supporting document, it is there or not. If it is there, then only they are going to consider the transaction as a valid transaction. Otherwise, they are going to reject the transaction, because each and every activity we are going to do in the organization or the transaction, for that we need to give or we need to support it by the documents only. Next, the functions of accounting. So what are the different functions of accountings are there? So if you use the accounting software, that is your Tally, if you are going to use, what are the functions it's going to do? So first one, recording. So in the Tally software, the first thing we need to do this recording of all the transaction. In the Tally, first we need to give the input, correct? So for giving that input, we need to record all the transaction, correct? And then what we are going to do, we need to classify the transaction into 5 categories. That is your assets, liability, capital, revenue and expenses, correct? So that software only will take care of which is the assets, liabilities. When we giving the inputs only, we need to give whether it may be an asset, it may be liability or the capital or the revenue or the expenses that we need to give before we give for the input. So there is no need to classify the transaction into categories by the tally. So next, the summarizing. So as per the whatever the inputs we are given, and already we have given some mandate of like what is the depreciation percentage, how we are going to maintain books of accounts, everything we need to give as an input, correct? So according to that, it's going to summarize the transaction, whatever we have given. And we are going to analyze the transaction. In the manual books of accounts, what we are going to do, the accounting manager or the whatever the frontline manager or matrix member or the auditor, they are going to analyze the each and every books of accounts, whether where we are lagging or where we have the sufficient funds or where we can get the sources of funds for our organization. All those things will be, we need to analyze in the organization. But in the tally, so it will analyze all the transaction and it will give the report. Okay, that is the one big feature of tally. Next, the interpretation. In manual entry, we need to give the interpretation. So what is the reason why we are lacking in the sales for this quarter, or how to overcome from that, whatever the low sales to high sales. All those things we need to give the interpretation. And the last one, we are going to communicating. So communicating to matrix member or to the managers. Okay, we are going to give this communication, correct? So in the tally, the final, whatever the transaction are done, classified, summarized, recording, everything. Okay, after analyzing, it will give the report. Whatever the interpretation done by the tally as per the transaction, that will give the reports to that whoever the authority is there. So they can easily go and he can download that report and he can work on that, whatever the lacks are there or whatever the deficits are there or where they have the very good stability in their organizational activity, that they can easily get to know from this tally softwares. So next, we are going to discuss about the branches of accounting. So we call it as branch or we call it as types of different accountings. Okay. So why we require this to study in this course? Okay. So because manually we need to give all these inputs to the tally. Once you download the tally or install the tally, so as per your organizational standard. So if, for example, I'm running a sole trading concern. So as per my company, what is the turnover limit or what is the accounting type we are going to maintain? Okay, or it may be a partnership company. Their books of accounts little bit vary will be there, correct? And if it comes to joint stock company or MNCs, they are going to maintain in their own ways, correct? So on that time, we need to give the inputs to the tally software also. So on that time, this branches of accounting is also useful for the who is going to learn these softwares or who is going to use this software for their organization. So these are the basic things they need to know about the branches or the types of accounting also. So let's begin with the branches of accounting. So first one, financial accounting. So what do you mean by this financial accounting? The word only indicates finance. Finance is nothing but the cash or the money transaction we are going to do in the organization. So usually the first step of the books of account is the bookkeeping, or we are going to record the transaction in the books, correct? So that is the first transaction or first activity we are going to do. So from the bookkeeping to end with the financial statement or financial reports, that we call it as financial accounting. So all the transaction, it may be monies or money's worth we are going to record in our books of accounts. That will comes under this financial accounting. Whether you have invested your money in the organization or you are going to invest your money in some other organization or some investor or invested money in your organization, all those things will comes under the financial accounting. And in this financial accounting, we will get to know what is the gross profit, net profit, or the whatever the organization, the net worth, total net worth of the organization. All those things we are going to learn in this financial accounting. So this is very, very important type of accounting in the organization. And if you are giving the inputs to your software, that is the tally. So on that time also, make sure that which company yours or which sector you are belonging to, what is your turnover limit. Second one is accrual basis. So that we are going to maintain on the basis of credit. So these are the two types of accounts we are going to maintain, or we are going to maintain our books in the organization. So whether it may be a cash basis or accrual basis, that is also very, very important while you are giving the inputs to the tally software. Next, the cost accounting. In the cost accounting, usually we are going to use this type of account for getting the what is the per unit cost. Okay, if for example, we are going to produce 10,000 products at 10,000 rupees. So that is the total cost of production is 10,000. What is the per cost then? What is the fixed overhead there, or fixed expenses is there, or how much is the variable expenses per unit? All those things will be count in this cost accounting. And if you are a manufacturing company, the almost all 40 to 50% you are going to based on this cost accounting only. Financial accounting is also there, but that is one part. The majorly we are going to deal with this cost accounting, because how much raw material we are going to purchase, how much we have used, how much in work in progress, how much finished goods were there, and what is our turnover ratio, how many days once we need to order the raw material from the organization or from the suppliers. All those things will be decided in this cost accounting. So while giving input to your tally software, you need to mention how much is the credit repayment period we are going to allow, or the supplier, how much they are going to allow credit period for us to repay the money while we purchase the goods on the basis of credit, and how many days once we need to do the ordering of raw material or ancillary products, or how many days the work in progress will be there. So all this information you need to give it to the tally software, because whatever the inputs you are going to give, based on that it's going to analyze and interpret the data of an organization or your reports, correct? So you need to thorough with these concepts, then you can give some inputs to the tally software for your organization. Next, the management accounting. So management accounting is nothing but the managerial decision will be taken as per this whatever the record we are going to maintain in this type of accounting. So for example, so how much percentage you are going to give the dividend to your equity shareholder, that will comes in the financial accounting. Why? Because based on our profit we are going to decide. When it comes to management accounting, any changes in the HR policy or the organizational policy or any bonus we plan to issue for our employees in the organization, or the money, extra money or the bonus money we are going to issue, or if you are increasing the OT, that is overtime expenses, or any food allowances, if you are going to giving to the your employees, then the management accounting, under that we are going to take this all this managerial decision. So individual managers or the frontline managers, they cannot take this decision. The metrics member or the management of that organization, okay, they need to take all this decision. On which basis they are going to take? So they are going to take this management accounting and they are going to analyze the reports, how much we have the profit and how much we need to spend for our employees, for their benefits or fringe benefits, perquisites, any other things. So that decision, or if they are changing the process of the manufacturing, so whatever the flow of the manufacturing process will be there, if they are going to rechange or they are going to change in the organization, that is also they need to take in the management accounting. Or HR policies, if they are going to change for their employees, that is also under the management accounting only, they need to take all this decision. Next, the important thing is tax management, or we call it as tax accounting. So why we require this tax management or tax accounting? Okay, so if you are going to pay salary to your employees, okay, so you need to deduct the professional tax, that is 200 rupees you are going to deduct, and for your whatever the professional tax, after that you are going to deduct the TDS, tax deducted at source, because source is the salary, correct? So from that salary, if you are going to deduct the TDS, so for their tax purpose, for the employees tax purpose, correct? That is, we call it as provisional for taxation, that you are going to deduct. For all those things, you need to have the better knowledge about this tax management in the organization. So how much we need to cut the TDS, how you are going to get to know how much salary is that person is drawing, and as per the tax slab rate, how much you need to pay tax after 1 year. That is for the next assessment year, how much you need to pay tax. all those things will be calculated, correct? So for that purpose, the tally software, when we are going to give the inputs, this tax management or tax accounting is also very, very important for the organization to know about these different types of accounting. And the next one, the corporate accounting. So this is the new branch is added to our accounting or the branches of accounting. That is, if you are going for any mergers activity, or if you are going to amalgamate with the any other organization, or you are going to acquire some other company. So nowadays, if you look at the newspaper or in the whatever the news or magazines, so many companies are going for this acquisition, merger or amalgamation process, correct? Why they are going to go for this, whatever the mergers, acquisition or amalgamation? Because they are going to get the synergy. So additional benefits or extra benefits they are going to get. If for example, X and Y companies are there, the X company is also producing the same product, but the cost is very high. So here the X company is producing at the very less price and these people are producing for very more price. If they amalgamate or if they merge together, then what they can do? So this X company, they can amalgamate with the or merge with the Y company. They can also produce the whatever the number of products with the minimum of or minimal cost of production. And this Y is good at marketing that product. So they are spending very less amount for marketing. But X company is selling more expenses for selling their products. So on that time, this X company will get the synergy of selling techniques, that Y company is going to get the techniques of producing at a lesser price. So X company will get the whatever the marketing techniques or sales techniques are there from the Y company, they are going to get as a synergy. The X company is going to give their whatever the production process or flow of the products that they are going to give for the Y. That is the synergy for the Y company. So this is how they are going to do this mergers and acquisition. Or if for example acquisition, so the big companies, what they are going to do, they are going to purchase these small companies. For example, take as an automobile company. So if they want to produce one car, so all the whatever the inputs are required, they are not going to produce in their own manufacturing unit, correct? So for producing one car, they required glass items, they required leather, they required all this like painting they required, iron they required, everything they required, correct? So engine. So on that time, what they are going to do? So if the company have the very good sound in the financial position, then what they are going to do? They are going to purchase this ancillary service products companies only. They are going to acquire and then they are going to produce that whatever the automobile or whatever the car they are going to produce. That is also one scenario. Or else if you have the financially that company is stable and if they have the sufficient fund for acquiring the other company, then also these companies, big companies will go and acquire the small companies. And the last one is forensic accounting. So this is also new accounting or new type of accounting. So forensic accounting is nothing but this, they are going to use it for finding the errors or identify wherever they have done the mistransaction, intentionally or unintentionally. If you do intentionally, then we call it as window dressing. That is manipulation of books of accounts they are going to do, right? So where they have done and what is the amount they have varied from the actual one to whatever they have done the changes. So all those things will be found in the forensic accounting. So these are the 6 broadly classified branches of accounting we have. So all this information we need to give as an input to the tally software. So we required all this basic knowledge of all these types of accounting, and then only we can give as per our organization whatever the limits or standards we have. For that we can give the input. Next, the golden rules of accounting. So this is the very important in our accounting. Whether you are going to use tally software or you are going to manually enter all the transaction, you are going to maintain books of accounts or using any other software. These 3 golden rules is very important. First one is personal accounting. So personal account, that is debit is the receiver, credit is the giver. So if for example, if you are going to receive, okay, then it may be debit. Okay, why? Because as a person also we have classified into few categories, that is artificial person, natural persons. Okay, so if for example the proprietor is going to withdraw his money for his personal use, then it call it as drawings. Then for example Mr. X is the supplier of goods to our company. Then X account we are going to maintain as a personal account. So all these things will be there. And if it comes to real account, so all your assets and liabilities also will comes under the real account. So debit what comes in. For example, purchase of furniture for 10,000 rupees. So if you purchase the furniture for 10,000 rupees, debit what comes in. So for the organization, what is coming? The furniture is coming to the business, correct? So furniture account debit. 2. Credit what goes out. So if you are going to purchase the furniture, you are going to pay in the form of cash, correct? So cash is going out of the business. So on that time, what goes out that needs to be credited? That is, cash is going out of the business. So cash account is credited. And in the amount column also, debit side 10, credit side 10,000 you need to write. That is how we need to categorize the real account or personal account or the whatever the rules are there. And it comes to nominal account, debit all expenses and losses and credit all income and gain. As per the nominal account rule, all the expenses or losses are there that we need to debit. As per the nominal account, credit all our income, gain, profit that we are going to maintain in the credit side. Next, the process of accounting. So this is very, very important if you are going to do your accounts in the manual or you are going to use any software. So first, okay, we are going to start with the bookkeeping. That is the primary books of accounts. Then the transaction will be posted to the, or we are going to pass the journal entries. And then after journal entry, we are going to pass it to the ledger account. That we call it as posting to ledger account. Then we are going to create this trial balance. Then the financial statement. That is your income statement, cash flow statement and balance sheet. So in manual, we are going to use or we are going to follow this process of accounting. If it comes to tally, okay. So in tally, what we are going to do? So if we just give the input, that is a bookkeeping. Whatever we have recorded the transaction, we need to give as an input. So it will only generate your journal entries, ledger account and trial balance. Then the financial report also it will make ready for you people. So there is no need to explain all these steps because nowadays in the software, okay, so each and every transaction it will be analyzed, it will be passed to journal, ledger, trial balance and the balance sheet with the interpretation of the report that will give by the tally software. So this is the process of accounting we are going to maintain in manually. In the accounting software also they are going to follow, but you can't see what is the next transaction or when next step we can't see. Just it will give the direct output whatever we have given as an input. So next, we are going to discuss about the introduction to GST. That is your goods and service tax. So if you are a company, okay, leave it the individual person. If you are a company, then this GST will play a very, very, very important and crucial role in the organization. Because earlier days, we are going to pay so many taxes, that is sales tax, value added tax or central tax, excise duty, all those octroi. We usually in the inventory management we use the word octroi also. So all these taxes were there, correct? But nowadays we don't use all these taxes. Instead of all these taxes we have replaced and we call it as GST, that is your goods and service tax, correct? So why it is required or why it is important to learn in the tally software? Because we need to give a input. So here also we have so many different types of GST rates will be there. So for each and every product and category, the GST rate will be changed, correct? So and the time of supply, place of supply, all those things will be mentioned. And you are going to learn these concepts also in this course. So reverse mechanism or ITC, that is your input tax credit. All those things if you want to claim, so that need to maintain in your financial reports also, correct? So for that purpose, you need to learn this GST also and you can give as a proper input to the tally software. So just we'll look at the brief or the basic concepts of GST. Introduction to GST, that is your goods and service tax, is a comprehensive indirect tax levied on the supply of goods and services in many countries. So for individuals, as a consumer or a customer, so it is a indirect tax. Why? Because we are not paying directly to the government, correct? If for example, if I go to any hotel, I'm going to purchase some or I'm going to order some items. I'm going to pay whatever it may be 8%, 18% GST to the hotel shopkeeper. Correct? So I'm not going to pay directly to the government. So on that time, so that whoever is the owner for that hotel or for that organization is running, okay, so that person needs to pay that money to the government on behalf of his customers. Correct? So on that time, whatever we have paid, so he needs to give the proper input to the tally software that how much percentage they are taking from these customers as a SGST and CGST, that is your state goods and service tax, central goods and service tax. Correct? So all this information, how you are going to give the input means you need to, or the organization who is going to give as an input to that software, they need to learn about the GST and the interest rates and the ITCs and other few concepts in the GST. GST is a consumption tax that is imposed on supply of goods and services. It's destination based tax, which means it is collected at the point of consumption. So I already given the example, correct? So if I'm going to take, or if I'm going to order something in the hotel, then only I'm going to pay this whatever the 18%, 8%, 28% GST, correct? So that is the reason GST we call it as consumption based taxation. At the point of consumption only we are going to pay tax to the shopkeeper. So these are the few key terminologies we are going to use in the GST, and these few things, okay, so these terminologies we are going to give as an input to the tally softwares, because I will tell you one by one. So first one, very important, that input tax credit. If for example I am the manufacturing company, I am going to purchase the raw material from the other companies, correct? So it may be XYZ or ABC company. So from that ABC company, I'm going to purchase raw material, and that time I need to pay GST for that ABC company. So if I already paid tax to that ABC, again I need to pay government for this whatever the goods we are going to produce, correct? So on that time, how much GST you have paid for your supplier, okay? On that time, you can mention that amount or whatever the percentage you have paid for whatever the turnover, that you can mention in the GST report, and you can claim that money as a input tax credit from your GST or from our government. So that is the reason. So this input tax credit is also very important, because if you are not given proper input for the tally software, so instead of giving 10,000 rupees, if you given 5,000 rupees, so other 5,000 will be lost, correct? That is for 1 year. So if you are going to use the tally software for next few years, then whatever the inputs you have given, if it is wrong, then you are going to lose your money and you are not going to get the accurate report also, correct? So that is the reason you need to learn about these GST concepts also. Next, the threshold limits. Usually the GST council members, so they are going to give these threshold limits. But for your organization, so they are going to give threshold limits for overall all the organization or all the industries. But based on your industry or whatever the products and services you are going to produce, for that we have different like GST rates, different threshold limits. So for your tally software, you need to give the proper threshold limits. You need to fix. If you are not fix the proper threshold limits, then it may be given the wrong reports or wrong financial analysis or interpretation for your organization. So this threshold limits is also very important while giving the input for a GST return. Next, the reverse mechanism or reverse charge mechanism. So I have given the example of I am going to purchase raw material from ABC. So on that time, usually what we are going to do, our company is going to pay to that ABC company whatever the GST percentage were there. If for example, that person is not registered under the GST, so then what we are going to do, whatever we have planned to pay as a GST percentage, that amount we are not going to pay for him. We are going to pay from our end to the government, because we have the GST number or we have already registered participant. So we need to pay money for the government instead of giving to other person. So that is called reverse charge mechanism. Next, GST, that is your goods and service tax identification number. So for all transaction or all the reports while you are going to generate or you are going to create, so on that time the GST number is also very important to give in the tally software, because all the transaction or all the books of accounts we are going to maintain with that identification numbers, the unique number. Why? Because if you are going to claim GST return, or if you are going to whatever the income tax for your employees, for all those things you require this GST number. Next, the supply. So how much goods you are going to supply, and from which place or which time you are going to supply, or which is the place of supply. All those things are very, very important for the calculating the accurate report or generating the proper reports. Next, taxable person, GST return. This is very, very important. So in GST return, we have from GST return 1 to GSTR 11. Okay, we have different categories of GST returns were there. So you need to mention which GST report will go to which one. GSTR 1 will give one criteria, GSTR 1A is going to give some other criteria. So which is feasible and which is required for your organization. That input is very, very important. And GST council members. So all the state finance minister with the heading by the central finance minister. That team we call it as GST council. So they are going to decide what is the GST rates for that particular state. Next, the place of supply. So from which place to which place you are going to supply the goods, and which is the starting place and which is the ending place. That is very, very important, because if you are going to send goods from Andhra Pradesh to Karnataka, then the Andhra Pradesh is one place of supply and you are going to reach that destination or goods to that Karnataka is the other place. So these two places we have different GSTs or GST rates. Then according to the which is the place of supply, for that they are going to charge the GST rates. That is very, very important. Next, the time of supply. So how many days? For example, in which financial year you have started this transaction and in which year you are going to end, and you are going to receive money from that particular person or from that particular organization. That is also very, very important. Next, types of GST, that is your central goods and service tax, states goods and service tax, union territory GST. So these are the few types of GSTs, and as per the whatever the industry you are belonging to and what is the percentage we are eligible to charge for that particular product and services, that you can particularly you need to give the proper inputs in the tally software. Otherwise the count, or for example, instead of giving 8%, you have given 18%. So you have collected 8% from your customer, but you are paying government to 18%. So the remaining 10% is burden for the organization, correct? So on that time, they need to take care of all these things. Next, the GST interest rate, I've already told you. So we have 0%, 5%, 12%, 18% and 28%. So these are the few percentages are there, and for few goods and services, it is exempt also. So these are the few GST interest rates were there. And I already told you the input tax credit. So if you are going to get the refund from the government, whatever you are paid earlier or you are going to pay, instead of paying to the government, you paid some other person, and that time you can get that refund from this input tax credit. So ITC is a fundamental concept of the GST, the system that allows registered business to claim a credit for the GST they have paid on their purchase and expenses. If, for example, the printing and stationery is a expenses, or you are going to pay money for your employees through the check or through the banking transaction. So for that, you are going to pay some tax, or whatever you are going to pay for your X supplier or Y supplier. For that, you need to pay GSTs. All these things will be taken and you can get as a refund from the government. For getting this ITC also, we have eligibilities. First, that is being a registered taxpayer under the GST. You need to be registered under the GST, and if you have the GST number, then only you are eligible to get the refund. Next, goods or services for business purpose. So for example, if you are going to purchase, I have already given the example, correct? So from the ABC company, I'm going to purchase the raw material. So for that raw material, I'm going to pay GST, correct? So that needs to be refunded. Why? Because you are paying for your expenses. Raw material you are going to invest, that is the expenses for the organization. We are purchasing that raw material. So on that time, for that you need to get the refund. So if you are going to purchase, then for all those things you have to be maintain the documents. So in the accounting also I told you, so all the transaction will be backed by the supporting documents or from the evidence, correct? So here also you require the evidence. And if you are using that whatever the raw materials purchasing for your business purpose only. If you are going to purchase that whatever the raw materials and you are going to use for your personal purpose, then you cannot claim the input tax credit for that particular transactions. Next, possessing valid tax invoices and documents. So you need to produce all the whatever the proper documents or proper invoices or evidence you need to provide. Then only you can get the ITC. And the last one, for complying with GST laws and filling the returns. So for making the final report, GST reports. Okay. So for that you require ITC criteria also. If you are getting the ITC, then whatever the as per the GST law you need to adhere and you need to obey for whatever the rules and regulations they have, and then you can get the filing of GST returns. So if you are getting the GST returns from the Tally software, okay, how much I need to pay for the government and how much refund I can get from the GST portal or from the government. So all those things will be generated in the Tally software only, but you need to give the proper inputs. So next we are going to discuss about the introduction to Tally. So before this we have discussed about the basic concepts of accounting, what are the branches of accounting and the introduction to GST, input tax credit, all those things we have discussed, correct? So the main reason of discussing all these concepts, because we can give the proper input to Tally, so we can get the accurate reports or appropriate financial reports with the less or minimal error. So that is the reason we have learnt all these basic concepts. So now we are going to learn about the Tally. So Tally is a popular accounting and financial management software. So widely used in businesses and individual for managing their financial transaction and records. So usually in the earlier days, we are going to use the manual entries, correct? In the financial accounting, we need to use all this, whatever the managing our finance and whatever the reports or financial transaction, we are going to use the financial accounting. So now that will be replaced with the manual work. The Tally we are going to use, and this is very, very popular accounting software. And financial management also, we are going to find out what is the time value of money, future value of money, or what is the future cash flows, or forecasting the future data. All those things we are going to do manually. But through this accounting software, that is Tally, so we can get the whatever the forecast data, whether it may be a future value, present value, or present value annuity, future value annuity, all these things we can generate from this Tally software. It's not only for the business, as individuals also. So the millionaires or few others also, they are going to use this Tally software for the managing or to manage their activities or financial transaction in their organization or their personal life. It is a design to streamline the automatic various accounting tasks, making it easier to maintain accurate and up-to-date financial records. So they have done the streamline of whatever the process of accounting we have seen, correct? So first is bookkeeping. From that bookkeeping transaction, we are going to pass the journal entry. From journal entry, we are going to post it to ledger account. From ledger account, we are going to prepare the trial balance. From trial balance, we are going to prepare all our financial reports or financial statements, correct? So in the Tally also, the process is set by inbuilt, and we are going to get the accurate and up to date. So till which date you are going to give the information. For example, at tomorrow, end of the day. So what is the last transaction you are going to give as an input to that Tally software? That information or for that particular transaction, till that they are going to generate the report and they are going to give you all these financial reports. So next point, Tally software is a versatile accounting and financial management tool. So if, for example, I already explained you the GST concept, branches of accounting, income tax and financial accounting. So in the branches of accounting, we have 6 types of accounting, correct? So all these 6 types of accounting that will be managed in the Tally software. So all types of accounting, financial management or tax, GST, everything we are going to maintain in the one platform, that is Tally, correct? So that is the reason it is a versatile accounting and financial management tool. And so widely they are going to use all the businesses for individual to streamline their financial operations. So financial operations is nothing but the day-to-day operation activities or financial transaction they are going to made in their organization or their business or for their personal activities also. The primary purpose of Tally is to assist the efficient recording, management and analysis of financial data. So in the accounting also, we have saw the definition of accounting as per the AICPA, correct? So here also they are given that Tally is going to do efficiently recording, that is your bookkeeping. Next, management. Management is nothing but, so whatever the classification of books of accounts or transaction into 5 categories, correct? So that they are going to manage. Analysis. Analysis in the sense, so it's going to analyze all the books of accounts and it is going to interpret the data also, and it will give the proper accurate report, that is analysis of the financial data, and then it's going to give the accurate report to that whatever the users are there. So is both accurate and convenient to use even if you are not well versed with the accounting. So because of this reason only I've just explained the basic concepts of accounting, because if you are going to analyze or if you want to go through with that financial reports given by the Tally software, we need to know some knowledge or basic knowledge about the Tally and the basic knowledge about all this accounting and the financial management. If you have the knowledge, then only you will get to know what is this assets, what is this liability, and why it is in the left side, why it is recorded in the right side, why it is lagging, all these things. Okay, if it is given the report also, you need to know about the basic concepts, then you can easily understand the financial reports of an organization, or you can interpret in your own way. So that is the reason all the basic concepts are required for Tally. Next, the features of Tally or the characteristics of Tally software. So first one, accounting. So this is the major feature of Tally. So earlier days, if you remember or if you saw, okay, so the organization, they are going to maintain the big ledger books, correct? So it's like 200 pages or 500 pages of ledgers book they are going to maintain to record the transaction and prepare the books of accounts. They are going to carry or they are going to maintain that ledger books. But nowadays, no companies are maintaining these ledger books. Why? Because everything they are going to do computerized or digitalized transaction they are going to do, correct? So that is the reason they are not maintaining that old, that is paper version of accounts. So this Tally is also, it is well versed or well equipped with this accounting tools or accounting standards, accounting procedure, or all the financial reports. So that is the reason it is the foremost and major feature of Tally accounting. Okay. So next, billing and invoicing. Before this transaction recording also I have told, that is bookkeeping. So all the transaction, it may be monies or money's worth, that needs to be supported by the collateral or supported by the evidence or the documents, correct? So this is the billing and invoicing. So if you are not going to provide the proper billing or proper invoice or proper document to the Tally for each and every transaction, that will be rejected by the Tally software, it seems. So, and if you are going to sold goods, for that it will generate the invoice, or you can manually also give the input and we can generate the invoice from the Tally software. So that is the reason. So this is also one of the major feature in the Tally. So next, inventory management. So inventory management is the most difficult and crucial role in the organization. Why? Because the economic order or economic reorder quantity. So the standard threshold limit will be there. If that goods or if the stock is going to come to that level, they need to order, or they need to reorder the raw materials or whatever the ancillary services. What is the work in progress? What is the turnover period? And as per the FIFO method, they are maintaining the inventory in the organization, or LIFO method they are following in the organization. So FIFO is nothing but first in, first out. LIFO is nothing but last in, first out. So if the goods is coming first, that goods should be go out first. In the LIFO method, last goods we are going to purchase, that should be go first out. So if you are maintaining the books of accounts in that manner or not. So all those things are very crucial in the organization maintaining this inventory management. So here in the Tally software only, it's going to take care about all this inventory management also. Next, the GST compliance. I already discussed about the GST, that is input tax credit, GST rates, or reverse mechanism or reverse charge mechanism, all those things, correct? So here, if you have any issues or if it is have any like problem or if it is any error in the GST, that will be shown this is error. And what is required for that, that will also give some suggestion. According to that, we need to check and we need to update the whatever the GST complaints were there in the Tally software. Next, multi-currency support. So you can maintain your books of accounts in the whatever the currencies are there. Like for example, in Indian rupees also you can maintain your books of accounts, or in the dollar, or in the euros, or in whatever is required, or from which country you need to produce your balance sheet or financial report. So for that particular company, you can convert that currency and you can show the reports also. So multi-currency support will be there in the Tally. Next, the bank reconciliation, like crucial account we are going to maintain. Bank reconciliation statement. So if for example some check bounces happen, or we are going to submit the check today, but it's not going to get the amount today within 24 hours. By next day, we are going to credit that amount. Then what is the cross entry you are going to do for the bank reconciliation statement? All those things will be done by the Tally only. So next, financial reports. So the accurate financial reports as per your inputs, it's going to generate and it's going to give it to the whatever the ultimate end users are there. So for that, they are going to give these financial reports. Next, the TDS and TCS. So already given the example of you are going to cut the TDS from your employee salary because that is the source you are going to pay for the employees. So from that, how much TDS you are going to make and how much tax collecting you are going to collect it from the source. All those complaints will be there, or any refund issues will be there. On that time, through this Tally software, you can easily generate that report for that particular person or for that particular transaction, and you can show this is the amount we have deducted and it is remitted to the government, or this is the source we have collected. All those things will be there in the software. Next, payroll management. So payroll management is nothing but the amount you are going to pay. That is your compensation for your employees or for the management or for the matrix member or to the wages you are going to pay for a laborer. All those things, payroll, payment related things will be managed by the Tally only. Next, the backup and restore. So whatever the financial data are there, it will be have the stored, or it will be in the backup they are going to restore, and we can get the old reports also. That is also possible through the Tally software. So next, data security. So if you are enter the data or whatever the input you are going to give the Tally, okay, it's not going to disclose to the others. Only whoever is there the support or whatever the IT support we have required for the Tally software, for them only you can get the data. Otherwise, they are not going to disclose your organizational data or personal data to the third party. You are the only one person you are going to use the Tally software. You will know what is the data are required or what is the reports you require. That will give it to you only, not for any other purpose. So the data will be safe and secure. So audit and compliance features. So whatever the auditing we need to do, like for example in manual thing, internal audit team will go into audit, and then chartered accountant will come. The audit team, they are going to check and analyze the all the reports. But here it is like audit free. If you are make any error in giving the inputs, then only it will give the wrong or the false statement or reports, correct? But if you are given the proper input, then you are going to get the accurate financial reports. So then it no need of going for this audit reports also. That is your internal audit. And whatever the complaints is there, that is also complaints free. And we have remote access also. So nowadays we have Tally software with the mobile app also. So if you are using Tally software in the organization, so you can use in the mobile also. So whatever the requirement are there, or if you are required, or if you are needed some any information, on that time you can just go and you can use the mobile app also for the getting the whatever the data from the Tally software about your organization or for your personal things. Next, we will discuss about the purpose of Tally software. What is the main objective of this Tally software, and why we are going to use this Tally software, and what are the objectives or the purpose of this Tally software? Okay, so first one is financial record keeping. So what the purpose or what is the major purpose we are using this tally is recording our financial transaction, correct? So whatever the financial recording or financial records are there, that we need to maintain in the tally software. So earlier, you will maintain all the books of accounts or all the ledger accounts, everything in the manual way, correct? But now using this tally software, because we need to record all the transaction or all the financial records in a systematic manner. So as per AICP also we discussed, right? What is the definition of accounting? So it is a systematic or art of recording all the transaction, analyzing, classifying, summarizing and interpreting the results, correct? So on that way, we need to record all the transaction or all the financial records in one manner or as per the standards. So that is the financial record keeping. That is the main purpose of using this tally software. Second one, the double entry of accounting, or we also call it as double entry system of bookkeeping. What do you mean by this double entry system of bookkeeping or double entry accounting? So it is nothing but for each and every transaction, we have two side effect. Either it may be a debit and credit, or it may be a debit and debit, or it may be a credit and credit, or it may be a credit and debit. So two side effect should be there. If any one transaction, if you are going to take, that should be reflect in two times. So just an example, purchase of plant and machinery and paid in the form of cash 50,000. So here, which are the two side effect? First one is the plant and machinery. Asset is going to comes to the business. That is one side effect, correct? So other side, if plant and machinery comes, something needs to go out, correct? Because we are purchasing the plant and machinery and we need to pay either cash or through bank or whatever the forms, correct? We need to pay. So cash is going out. So 50,000 value of plant and machinery comes to the business. That is one side, and the other side, the cash is going out. So these are the two side effect. So this is the just an example for double entry of accounting or double entry system of bookkeeping. So next one, financial reporting. So in this financial reporting, we have all the other accounts we are going to maintain. That is your profit and loss account, trial balance, or your income statement, like balance sheet, correct? The assets and liabilities, that all those things we are going to record in the financial statements. So as per the standards, and what is the, like for example, depreciation, what is the depreciation we are going to charge as per the Companies Act for professional books or for intangible assets or for tangible assets. In that also we have subcategories. So all those things as per the standard, how much we are going to charge the depreciation and what is the provisional for taxation we are going to record. Everything that input should be given to the tally software. Then we can go for this using the financial reporting. Next, the inventory management. So this inventory management is also very, very important because the manufacturing units or manufacturing companies, they're struggling like anything to maintain this inventories. Because so many raw material will come, ancillary service products will come, and work in progress will be there, semi-finished goods, finished goods, all those things will be there, correct? So on that time, maintaining the accurate balance or accurate information of the inventory management, that is very, very challenging in the organization. So here in the tally software also, they are going to give the accurate information, whatever the inputs you are going to give. So based on that, it will give the appropriate account balance of the inventory. And in inventory also, we have different methods. So few companies will use FIFO method, that is first in, first out method. Or some companies use LIFO method, that is last in, first out. So as per the FIFO or LIFO, which one they are going to follow. So as per that, they need to record all the transaction. And the order quantity also. If for example, if they have the minimum order or minimum raw material stock with them, so in which time they need to order the supply or they need to order with the supplier. Okay, so that is also very, very important. All those things will be taken care by the tally software. Next, the GST and tax complaints. So the GST, I already explained you about GST, correct? So goods and service tax, in that we have three categories, that is CGST, SGST and IGST. So as per this, okay, so which is the SGS percentage or CGST percentage or IGST percentage, and what is the input tax credit? And we have different rates of GST also, correct? So 0% is there, 5%, 8%, 18% and 28%. So which category of products or which goods is fall under the which rate? So all those things are very, very important while you are giving the input to the Tally software. Next, the customization. So you can do the customization or whatever the changes is required as per the management or to the metrics member. Okay, so we can do the, or we can enable the features and we can do the customization of Tally software also. That is also possible. And the last one, the multi-company support. So you are the only company using the Tally? No, right? So many other companies, whether it may be a partnership, joint stock company, HUF, so many small companies also they're using the Tally software. So it is going to give the multi support for all the companies. Okay, so if for example your competitor is X company, Y company, Z, they are the competitor, but they are also using the Tally software, and there is no need to worry about the whatever the privacy or the data security. Okay, that Tally software, whatever you are going to maintain in your organization, that data will not be disclosed to any other companies or any other third parties or outside of your company. Okay, they can't get the information of your company's information. So the next is, what are the difference between all Tally versions? So we have various Tally version, correct? So once they given or once they update, the version is going to change, correct? So for example, take an example of your mobile phones. So once you purchase, okay, the version is different one. So once they given updates for your mobile or softwares, then what you need to do? You need to update. Correct. So on that time, what will happen? So the new feature, whatever they are going to add to your mobile phones, that will be enabled. Correct. Like that also, here also they are going to do the changes as per the whatever the accounting standards will change, or the GST will change, or like for example, whatever the percentages, that is your depreciation percentage will vary, or the books of accounts you are going to maintain. If they given any other changes, then as per that they need to do the changes, correct? Or they need to update the versions also, or the software also, correct? So earlier we have only sales tax, value added tax, excise duty, but after that they implemented GST after 2017, correct? So after 2017, then they need to do the changes in the software also, whatever the Tally software you are using. For that they need to give that whatever the advanced features or advanced technology is changing. As per that they need to do the changes in their software also. First, they have introduced Tally 4.5 version. So in that, the Tally version or Tally software, they are going to do only so based on the whatever the account with the inventory. So especially for, I already told you, so inventory management, maintaining in the organization or managing in the organization is very, very crucial, correct? So first they have started with the Tally version for 4.5 is for account with the inventories. So whatever the inventory accounts that we are going to see in the coming slide also. Okay, I will explain you one by one. So that they have started. Second, they have done or they have updated Tally 5.4. So window based account with inventory. So window based is nothing but the individually we are going to use the word tabs in Excel, correct? So like that, the windows or the tabs, separate tabs for each and every accounts. If you heard the word previously also, F7, F6, F5. So the functional keys is arrow for the 11 accounts. Okay, it will be linked with that number. Okay, like that they have done the window based account with the inventories. Next, Tally 6.3. So in this version with online finalization auditing. So if for example, earlier two cases are there, correct? That is 4.5 and 5.4. So on that case, the offline auditor should becomes, or the internal audit team or the account manager, they need to finalize all the books of accounts, because they need to verify whether all the transactions are recorded or not as per our company standards. Okay, or as per whatever the requirement they have. So according to that, it is there or not. They need to check and they need to finalize, correct? They need to verify. So in this 6.3 version, they have given online finalization of the auditing process. That is the one feature they have added for this 6.3. They have added few more, but this is the major feature they have done or changes they have done in this 6.3 version. Next, the Tally 7.0. So it is given the feature of import and export feature. If for example, if you have the PDF data, or take an example of Excel data you have. So from Excel, we can import or not. Or if whatever the data is there, we can export to the PDF or export to the Excel or any other docs, correct? Like that feature is there or not earlier. So in the new one, that is in the 7.0 version, they have done they have added the new feature called import and export features. That is the updation they have done for the Tally 7.0. Next, Tally 7.2. So in this 7.2 version, they have added the VAT, that is value added tax, TDS, that is tax deducted at source, and the excise duty. Because whatever the changes they have done, or whatever the rate of interest is there for VAT, TDS and excise duty on the goods and services. Okay, so for that they have updated this Tally 7.2 with the VAT, TDS and excise duty. This is very, very important for 7.2 version. So after that, few days or few years, I think so, we have started using the GST also. Then they need to update it to the whatever the GST is there as per the format or as per the standard. They need to do the changes or they need to replace the software. Next, Tally 8.1 with FBT and excise duty. So FBT stand for fringe benefits and taxation or the tax. So why they have introduced this FBT in the Tally 8.1 version is, in the earlier version, that is in the 7.2 version, they have added VAT, TDS and excise duty, correct? So while paying the salary for their employees, this FBT is very, very important. That is your fringe benefits and whatever the tax they need to deduct, all those things, correct? They need to calculate, and according to that they need to deduct the TDS also, correct? So that is the reason they have introduced the FBT and the excise duty. Next, Tally 9.0. So in this 8.1 version, whatever is there with the payroll system, multi-language extra formality features they have enabled for the Tally 9.0 version. So already they have introduced the FBT, but in the Tally 9, they have introduced whatever the payroll system they have introduced. For that, they have given multi-language extra formalities or formality feature they have enabled in the 9.0 version. And finally, the whatever the latest one, that is your Tally ERP 9.0. So ERP stand for Enterprise Resource Planning. So in the organization, whatever the resources they are going to use, so for that they need to do some planning also, or they need to coordinate, correct? Organize, coordinating. So for that they have done so many changes and updated the Tally ERP 9.0 version. Tally ERP 9 with remote access facility. Okay, so because in the pandemic situation, so many organization, not so many, almost all the organization they have done the remote access, correct? So on that time, this Tally also introduced this remote access for all the employees or whoever using or whoever the authority of using the Tally in the organization, they are given this remote access facilities also, and multi budgets and scenarios and the etc. So multi budget is nothing but the organization. We have different kinds of budgets. I think so you know the meaning of budget, correct? So budget is nothing but it is an estimation of inflow and outflow of the cash in the organization. So in that also we have different kinds of budget. Varieties of budget types are there, correct? So according to that, the organization, whichever is required. So that is the multi budgets, and the budget in the sense the volume of the net worth or the whatever the net worth of the organization, that is also they have included, and the scenarios, few scenarios also they have included in the ERP 9.0 version. Next is the advantages of Tally ERP 9. So in this Tally ERP 9, the first feature or the first advantages of this Tally ERP 9 is remote access. Because in the pandemic situation or now also in the current situation also, so many companies are allowed or enabled this work from home options, correct? So in that scenario, that companies, whatever the work from home employees are there, or the matrix member or the management team or the managers, they require this access to the Tally, correct? So the Tally ERP 9 have the remote access for whoever authorities are there to enable or to use the Tally ERP 9 in the organization. Next, Tally.net. So this is also one more advantage. So whatever the information or whatever the bookkeeping recording transactions are there, that we can easily use in the Tally .NET feature. So next, simplified installation features. So easily you can go and install the Tally ERP 9. It is very easy steps you can easily follow as per the whatever the it is going to display on the screen. Okay, download, installation, whatever the features, enable, disable, all those things. Okay, it is very easy to installation also. And next, control centers. Control center is nothing but, for example, the service centers. So if anything you are facing issue with the Tally software, or if something needs to be changes, or some you need to do as a customized version for your organization. So all those things will be enabled through these control centers. If you are not getting the proper way to do that, then you can inform the control center. Then enhanced look and feel. So that is the surface or the interface of the system. Okay, it looks very comfortable and you can easily feel that we can use or we can do the whatever is required for the Tally software or for the organization with the Tally software. Next, enhanced payroll complaints. So if you manually, if you are going to calculate the salary of each employees, then what will happen? So someone is present on that day, someone is absent, leave, or LOP, all those things will be there. So manual calculation will be very difficult and it takes time also. And we are going to receive complaints also. This is not correct, this is not correct, I need to receive this much of amount, but I have received only this much. So that complaints will arise. But in the Tally, there is no issue of payroll, whatever the complaints are there, because the computerized entries will be there. According to that, that will calculate and it will give the whatever the salary for that particular employee. Next, exercise for manufacturers. So I have told so many times, inventory management, managing the inventory in the organization, it is very crucial part in the organization. So the manufacturing sector, okay, if they're using this Tally ERP 9 software, so they can reduce easily whatever the time they're spending on maintaining the inventory management in the organization, that can be reduced. Okay. Next, auditors edition of Tally ERP 9. So whatever the auditors, they are going to check and they are going to verify, and then they will give the financial reports, right? Like that here also in the ERP 9 version. So they are going to do the whatever the auditors or how the auditors are required, like that it will prepare and it will generate the reports. And the last one, enhanced tax deducted at source, because from the each employee based on their salary and whatever they have the like tax planning or whatever the standard deductions or whatever the deduction they have made, based on that they are going to calculate and they are going to cut the tax deducted at source from all the employee salary. It is also in like one way, it is a provision for taxation of that particular employee. So it will be maintained in the Tally software only. Okay, so these are the few advantages of Tally ERP 9. Next, we are going to discuss the very important one, that is what are the steps for installation and set up the Tally ERP 9 in our system. Okay, as an individual, if we want to use Tally ERP 9, in the initial only I have told this Tally we can use it for the business purpose or for our personal purpose also. So managing the funds in the organization or managing the funds internally, that is personal fund. For that also we can use this Tally ERP 9, correct? So first one, before you install the Tally software, okay, first you need to check the what are the system requirements are there. You go and visit the Tally website. Okay, so in the Tally website they are going to give the what are the requirements are there, your system requirement, whether it may be what are the ROM size is required or whatever the consumption of GB capacity for downloading and installation of the Tally software in your system, all those things. Okay, whatever the requirements are there, that they are going to mention in their website. So before downloading only, it will give all these cautions. Okay, so first you need to check the what are the system requirements, that is that software will be supported to this laptop or not, or for this particular system or not. That is very important, correct? So you need to check all these things. Then you can go in their website only, they are going to give or they are going to show the tab called download. Okay, so there you can get the Tally ERP 9, the download version. Okay, just click on that download symbol, then it will be take time and it will be downloaded in your system. Next, so as per the whatever the instruction, you can go in your laptop, check the whatever the Tally ERP9 software, click on that, then it will give the whatever the ways or the roadmap. So first finish or finalize the whatever the version is there and then install. Lastly, it will update in your system. That is the whatever the install the software. Okay, so just you need to look at the whatever the system requirement and where you can get the or download a version in the Tally ERP9 and install procedures or process of installing that you can do this one. Okay, these are the 3 steps. Next, the setting up of Tally. So first one, start Tally. So in that, wherever it is downloaded, just click on that. It will start the start Tally or welcome to the Tally software. That will give the whatever the welcome tabs. Okay, then whatever once it is completely installed and it is opened. So first you need to do is activate your license. That is as per the ERP9, okay, or Tally ERP9, they are going to ask the subscription also, correct? You need to pay the subscription and then you can get the licensed version. You can get the free version also. It is only for trial purpose, okay, not for the regular use. So if you want the Tally software for the regular use or for your organizational needs, then you need to activate your license. That is Tally ERP9 software license you need to enable or activate. Then you can go for using the Tally in your organization or for your system. Next, create a company. So you need to create the company in your Tally software. For this also, what are the steps involved in the creating the company in Tally? That is also there in the coming slide. I will explain. And what are the criterias or whatever the supporting documents it will ask for the creating a company in the Tally software. All those things will be explained in the coming slides also. Next, the enable features. So in the Tally ERP9, for example, like 10 to 15 features are there in the Tally ERP9, which is required to enable for your organization. You need to select that one. If some features are not required for your organization, on that time, no need to enable. If it is enabled also, you need to disable that feature. Why? Because if it is required for your organization, then only you need to enable that feature. Otherwise, it is waste of using that features or that will give some other data only. For example, yours is the manufacturing sector and if especially they have done the feature for service sectors. So if you enable that feature, it will be like manufacturing as well as service sector. Both the features will be available in the Tally. So on that time, unnecessary confusions will be there. Okay, so that is the reason whatever is required for your organization, just enable that software or feature in that software. Otherwise, don't enable it. Next, configure your chart of accounts. So chart of accounts is nothing but what is the flow of accounts you need to maintain in the organization. For example, first journal entry, ledger account, after ledger account, trial balance. From the trial balance, you need to prepare P&L account or income statement. From the income statement, you are going to prepare the financial statement. That is your balance sheet. Okay. In that also balance sheet, horizontal format is there, vertical format is there. So as per the what is required for the organization, first you need to configure that kind of charts of accounts only. Next, enter opening balances. So once you enabled or once you select the which chart of accounts you required, you need to enter, that is manually we need to do the enter the opening balances of each account, because first time you are using the Tally in your company name, correct? So on that time you need to give the input as a opening balances. If for example capital, so 5 lakh rupees is the own capital and 10 lakh rupees is the equity share capital, 5,000 rupees of preference share capital, like that you need to give all the opening balances for individual accounts. Next, start recording the transaction. So whatever the day-to-day activities or day-to-day transaction you are going to make in your organization, that needs to be recorded in the Tally. Why? Because if you are going to record manually, like as an input you need to give for the Tally software, then only it will generate the whatever the final reports or financial reports for the organization. So you need to give the all the inputs. Next, set up security and user access control. In the earlier also I told whoever is required or whoever is the authorized persons to use the Tally software of your organization. So you can give the access control. Only for this ID. They can use the Tally software. Otherwise, they cannot open or they cannot use the Tally software, because whatever the data you are going to maintain in the organization's data or company's data or the net worth, balance sheet, all those things will be there in this Tally software, correct? So that is the reason you need to give the access. Only for that person they can enable the whatever editing or giving the input, all these options. Otherwise, there would not be given any access to the any other person. Next, data backup. So whatever the data is there in the software or you are given as an input for that software, that should be done as a backup also. So if something happens or system crashes happened or any other chances of destroying the data, so on that time also you can easily get that, or we can do the restore of that data. So that is called the data backup should be there for the Tally software also. Next, explore Tally documentation and support. So whatever the documentation is required for Tally, okay, you need to check that, and as per that, whatever the documents or whatever the evidence, supporting documents, everything you need to give for the Tally software also. So this is the setting up of Tally in the laptops or your system for the organizational use or to your personal use also. Next, we will see, so what are the enable or disabling of Tally features. So earlier also in the before slide I would explained about, so what are the additional features they are going to give. So if you want that feature or not, okay. So for that also, before installation you need to click on the whatever is required for your organization, that is enabled or it may be disabled. That is very, very important. So I'm adding few screenshots for your reference here. Okay. So in the Tally software also it is visible that enabling or disabling of Tally features, that is accounting features. So especially this is required for only accounting purpose, not for any other things it will ask. So I've already explained you, right? So whatever the company name you are going to create, so whatever the supporting documents or whatever the information it is going to ask, once it is given the company name, see here we have given that dummy name, that is ABC company. So we can give the actual company name, whatever the company is there, correct? So as per like whatever the XYZ Private Limited or X&Y Brothers and Company or HUF Limited, whatever it may be, like that, the original name only you can give here. That will enable and it will be shown in the top of the organizational, whatever the Tally software interface is there. Next, so here we are looking at the accounting features. So we need to do the enabling or disabling in the accounting features. So in the first one, that is general, integrate accounts and inventory. So if you are going to club the inventory with the accounts or books of accounts with the inventory management or inventory accounts, that is, if you want that feature, just click on yes. Otherwise, it should be no. Then, so income or expenses statement instead of P&L account. So if the organization is maintaining the income statement or it is maintaining the profit and loss account, so it is given the option. So if you want the income and expenses account, or it may require the profit and loss account. So if you require income statement, then it is no. If you are not required the P&L account, then you need to give us yes. Next, allow multi-currencies. So if your organization, it's going to run its business only in India, so there is no need of going for this multi-currencies. If for example, that company is there in India, but the branches are there all over the world. Okay, on that time, this multi-currencies option or the feature is required. So you need to click on yes. And for each individual feature enabling, it will confirmation or it will ask for confirmation, yes or no. That is whatever the changes you have made, that needs to be enabled or not, or accept or reject. Okay, that feature is also there. And outstanding management. Next, cost profit control or cost profit centers management. So whatever the cost controlling needs to there in the organization, that also individual they are going to give. So for individual features, you need to enable or disable the feature as per your requirement. Next, invoicing. So each and every transaction or the recording of each and every transaction that should be supported by the document or by the bills or by the evidence, correct? So for creating this invoice also, whether it may be a e-invoice or manual receipts, everything. So for that also you have so many features that needs to be enable or disable for the organization. So first one is allow invoicing. So you need to allow or you need to disable, correct? So for that we need to give yes, because for all the transaction needs to be supported by the document or from the whatever the invoices are there. So yes, like that individual thing we need to give the special features or required or not. Next, the budget and scenario management. So in that, maintain budgets and controls. No. If you required, you can click on yes. Like that, banking features. So enable check printing. If you look at the whatever the current account checks, the company names also there in the check, correct? So that required or not. And other features, allow zero valued entries, all those things. If you required or not. If you required, then you can click on yes or you can click on no. Next, here they are going to give the functional keys arrow buttons. So F1 is accounts. F2 is your inventory things. F3, if you click on F3, it will take to the statutory, that is the legal mandatory requirements. Next, F4, that is tally.net. F5, it is audit. F6, it is add-ons. So if you require any other features also, you can enable here. Next, enabling or disabling of tally features, that is statutory and taxation. So this is also very important for giving the inputs, because all the legal requirements, whether it may be a cutting the TDS from the salary of an employee, professional tax from the employee, whatever it may be, correct? So that is very important. So company is same, ABC company. Here the feature for that is the tab name, statutory and taxation. So enable dealers, that is excise, set alter or dealer excise details, that is if you required yes, because enabling the whatever is the excise duty. Okay, if for example I'm going to purchase some raw material from the other suppliers or from the other party, then this excise, it's very important. We need to give input of their information. So follow the excise rules of invoicing, yes or no, or enable value added tax, that is your VAT, yes or no, or enable service tax, all these things, and enable tax deducted at source, that is TDS, that should be enabled. Okay, set or alter the TDS details, yes, because whatever the as per the legal requirement, if it is something is changed, then we need to do the changes. Enable tax collected at source, TCS, we are going to collect the source, right? So for that also enable features, or already told you FBT, that is fringe benefit tax. Okay, enable the fringe benefit tax, or set or alter the changes, that is also needs to be enabled. So tax information, that is VAT TIN number, and now it will ask GST number also, correct? So that tax identification number you need to give, and whatever the interstate sales tax number or PAN or income tax number, all these things you need to give in this details, then it should be all the enabled features will be shown here. Next, we will discuss about the creating a company in a Tally software. So already I have explained you. So what are the things we need to create initially once you install the Tally software in your system, correct? So here we will see what are the required documents or required names or whatever the TIN number or whatever the verification details is required. Okay, that we will discuss. So first, once you launch the Tally in your system, okay, next you can go and activate the whatever the select or the appropriate license, that is the we need to activate the license version, correct? So then you can go for creating a new company, because you need to run the Tally software with the name, that is either it may be your personal one or the organizational one. So personal also you can give your personal details, for your organization give the whatever required for the organizational details. So configure company information. So once you go for configure, so first thing it will ask name, what is the name of your organization, that name thing you need to enable first, that is whatever the company name is there, you need to give the proper name as per the registration. Okay, next mailing name, so whatever the mails, okay, or the replay or the response from your organization, it will go out for the others. That mailing name should be there. Then address, the complete address of your organizational, that is the head office. That information you need to provide. Next, the financial year. So financial year, so if your organization, you are going to maintain the financial year like 1st of January to 31st of December or 1st of April to 31st March of the next year. The financial year you need to inform or you need to mention in this tally. Next, the books beginning from, that is as it is what I have told about the financial year. Okay, like in the books also. So the books also start from the 1st of April of this year and ends on the 31st March for the next year, correct? So that also you need to specifically mention which is the starting period of your books and ending period of your books of accounts. Next, the maintain. That is, maintain is nothing but you need to day-to-day wise or regularly you need to check and update the whatever is required for the organizational thing. Like for example, I already told you there are two methods of bookkeeping are there. That is, first one, on the basis of cash basis we are going to maintain, or accrual basis also we are going to maintain. So which one your company prefer to, okay, that you need to inform. Next, use security control. So for just take an example of Gmail, it will take like 2 steps of verification, correct? Whether it may be send the OTP to your registered mobile number or it will blink in your mobile, whether you are the person is using that Gmail or not. That you need to confirm yes or no, correct? Like that, the security controls also you need to enable and you need to give the informations. Lastly, you need to save and create the company. So in the last also I have explained you, right? In that it is ABC company. It is visible on the head of the interface, correct? Like that, whatever the name is given after creating the name of the company and giving all these details, then you need to save that, okay, whatever you have added, then it will display it on the interface of the Tally software. Next, in that after creating the company, okay, next it will ask company information menu will be opened or it may be enabled, okay. So after that, in that enabled feature or in that company tab, the right of the gateway of Tally area displays the company information. So right side of the display, okay, the display, that is your system display, will be divided into 2 parts, that is left side and right side. So in that right side, that will display all the company information, okay. So this menu has following 3 options. In that right side, you have select company, create company and quit. Select company is nothing but we can select few other, like if for example, take an example of Tata. They have the name of Tata, that is the brand name or the company name. Under that we have so many sub units or strategic business units are there, correct? So that units you can create. Then if you want to quit also, you can go and click on the quit symbol. So it will quit the whatever the display tab is there. So just I will show you the whatever the reference screenshot I have added, that I will show you. So this is the interface, that is Tally interface looks like, and in this whatever the company you have given the information, that will be displayed below this. And then so the right side, that is the company information, select a company, create a company and quit. So what is required for you people, if you want to select a company you can select, or if you want to create few other strategic business units you can create, or you can go for quit. So if you click on quit, it will exit from this tab. So and then whatever the companies you are going to create, not only your company or not only your strategic business units, you need to create other companies also as a vendors, because you are going to purchase raw material from X Limited, you are going to sell the goods to Y Limited or for Y person, or whatever ancillary service products you are going to purchase from ABC company. All these things companies are required, correct? So you need to create all this company information and it will be enabled or it will be displayed here in the left side of the system. See here, it will show all the details, whatever is there, F1, select the company, and whatever is required here. Also list of the selected companies that will comes here, and date of last entry, what is the last entry you have made for that particular company, that is also displays once you enter the details. Next, after creating, okay, So it will show like directory, who is the directory or name, okay, mailing details and the address of that, or company details, that is currencies they are going to maintain in rupees, that is symbol rupees, or if you are maintaining in dollars or yen or pound, that will appear here. And the financial year, that is 1/4, whatever the starting date, and the whatever is the books of beginning, that is when you are going to start using the books in your tally. Then maintain accounts with inventory. So whatever you are going to maintain in the books of accounts, that also you can specify here. State, pin code, telephone number, mobile number, email number, all this information will be displayed. This is the overall information you have given as an input for creating your company. So see here also they are given currency information, that is base currency symbol, that is formal name Indian rupee, number of decimal prices to, like that all the information you need to click or you need to give as a input here. Then only your company information or company accounts will create in the tally software. So this is the how the company creation in the tally it will looks like. Once it is saved, then it will be saved automatically and it will display the company name. This is the company details interface you can see. Next we will look at the different types of vouchers and how to create in the tally ERP 9. Okay, so first is purchase order. Okay, you need to create all these vouchers, okay, in your tally software, because the purchase order, once you order the how many quantities are required and from which supplier and what is the rate you have decided, that is pre-decided rate will be there, or whatever the market value is there. So all those things is required, correct? So you need to first give the purchase order. So you need to create this voucher also. Next you have purchase voucher. So once you send the order, okay, they are going to send the goods, correct? So that needs to be called as a purchase voucher. So ordering is different, purchasing voucher is different, correct? You need to get the purchase voucher. So you need to create in the tally 9 or tally ERP software purchase voucher. So next point, rejection out. So once you purchased, for example, I have ordered 100 units of whatever the raw materials from the XYZ Limited. So once the XYZ Limited sends the goods, so during the loading or during the unloading or during the transportation, 3 units are damaged. So that needs to be sent back to the XYZ Limited and we need to replace the whatever is the actual one. That is the fresh raw material or 3 units of fresh raw material we need to get from the XYZ Limited, correct? So for that we need to enter the rejection voucher also. Next, the payment voucher. Once they have also sent that 3 units, then what you need to do? So you need to give the payment to that XYZ Limited, whatever the number of days of credit they are going to allow, whether it may be a 30 days, 45 days or 15 days. After that you need to pay, right? So for that you need to enter the or you need to create the payment voucher also. Next, the debit note. So this debit note is include of your how many number of products you have purchased, how many was recent, that is for the damage purpose. If you are returned, then at what date you need to repay that money for the vendor. If for example XYZ given 15 days of credit repayment period, so after 15 days we need to pay the money for XYZ, correct? So on that time this debit note will give the information of how much we need to repay and which date we need to repay, all this information. Next, sale order. So whatever the procedure we have done for purchasing, like that same or similar thing we need to maintain for our sale also. So sale order is nothing but some other person or our buyers, okay, they are going to quote the estimation. I require 10 units of XYZ company products or your company products at this date and this whatever the amount. So that sale order they need to maintain in a separate voucher. Next, sales voucher. So once it is ready, they need to create the sales voucher. Then rejection in. So how we are going to send the damaged goods to our vendor? We are going to return, right? Like that only we will also receive the return from our buyers because it is damaged or something has happened for that product. So they are going to return. That we are going to maintain in the reject in or rejection in. Next, the receipt of voucher. So how many days we are going to allow for that person, whoever is the buyer. So we call it as a debtor, correct? So for that debtor, how many days we have allowed to repay that money. So all those things information we are going to mention in the receipt voucher. Next, credit note. In the credit note as well as debit note. Like in the debit note, we are going to maintain our creditors information. In the credit note, we are going to mention our debtors, that is our buyers information, how many days is the allowed period for repayment of the money, all those things information. Next, the contra voucher. So contra is nothing but, so we need to close. For example, XYZ sends 100 products. In 100 product also we are going to reject. Why? Because for whatever the expectations, like whatever the features or whatever the quality, quantity, because of that we are going to reject that order. On that time we need to pass the contra vouchers also. Next, the journal voucher. Journal voucher is nothing but the journal entry. We are going to pass the journal entries, right? Like that we need to pass the journal voucher here. Manufacturing. So once we receive all this raw material, what we need to do? That raw material we need to send it as an input and we need to get the output from our manufacturing unit, correct? So manufacturing voucher we need to generate. Next, stock transfer. Once it is produced, final product, we need to transfer stocks to the, either it may be a stores or to the buyers. That all these vouchers, okay, all these varieties of vouchers you need to maintain in the Tally software. So because of this only I told you the inventory management in any organization, maintaining or managing inventory in the organization is the very, very crucial role in the organization. So all these vouchers are necessarily you need to maintain, then only you will get the accurate report or accurate financial reports in the organization. So in this course, we are going to learn how the accounting we are going to use in the Tally. So for that, we require the basic knowledge of accounting as well as Tally. Okay, then we can get to know how to use the Tally for accounting and other financial reports. Okay, so first we'll look at the agenda. So in this session, we are going to discuss about the first one is Introduction to Financial Accounting. The financial accounting is nothing but all your financial reports and other income statements. Like all the basics of accounting we are going to discuss in this first point. Next, we are going to discuss about the Tally fundamentals, like how the basic of Tally or how it will be working or how we can install and how we can set up the company or other things in the Tally software that we are going to discuss. Next, we are going to discuss about the recording transaction in the Tally. That is your how to create a company, how to create a voucher, or if you are using the Indian currency or which currency you are going to use, all those things. That is the we are going to do it in the recording transaction. Then we are going to discuss about creating financial statements, like how the Tally is going to generate the financial statement and how the reports looks like. That we are going to discuss. And then we are going to discuss about analysis of Tally reports, how to analyze the financial reports generated by the Tally software. That we are going to discuss. And the last one we are going to discuss about the Tally tips and tricks. So what are the shortcut keys or how to use in simple method, that we are going to discuss at the end. That is the Tally tips and tricks. So let's begin. Next, we are going to discuss about recording transaction. Okay, so here we are going to discuss about the recording transaction in Tally. So how to create a company or how to work with the whatever the voucher types and what are the details it will ask for creating a company, what is the accounting period, all those things we are going to discuss here. Okay, so let's begin. So creating and managing company in Tally. So if you want to create a company, like first you are going to download the Tally software, you are going to take the license, you are going to activate the key, and once you start using the Tally, first you need to create a company in Tally. Because if you create a company, then only you can start acting or start doing the or recording the transaction in the Tally software. So that is the reason the first step is to create a company in the Tally. So company creation. So first, what are the steps involved in creating a company, that we are going to discuss, and I will show you in the hands-on also. So consideration for naming and configuration. So what is your company name? What is the configuration you require? Like for example, your company is a sole trading company, or it is a joint stock company or a partnership company. Which category of company is yours? For that, what are the turnover limit or what is the advantages of getting from the government? All those things you need to configure in the first step. Next, company configuration, configuring company details such as address, fiscal year, and more information are going to ask. That is your, what is the mail ID, landline number, fax, mobile number, all those things it will ask. That every detail you need to submit. Next, setting up security control and access level. So for which are the people they can access your financial reports in Tally software. That also you can control all the access from this tab only. So this is how it looks like. Okay. So I will show it in the hands-on also. Just for the reference, I'm showing it here also. So this is your Tally interface looks like. And for creating a new company, these are the details it's going to ask, like company name, mailing name, address, financial year begin from, and books begin from. Like few companies, what they are going to do, they are going to do financial year is different, but they are going to maintain or they are going to start the books of accounts from one more date or one more accounting period. So that is the reason it is asking both the one. And next, which state, country, telephone number, mobile number, fax, email, and your company website and other details. Mainly the base currency symbol. That is the which country currency you are using for your Tally software. So many other countries currencies will be there. So according to your company needs and requirements, you need to select the which are the symbol you require. So I will show you in the hands-on part also here only. If you go to the Tally software, once you activate your license key, then this page will be appear. Here you can have the tab of go to. Whichever you want to go, that you can select. So here I'm selecting the company. In that company, we are creating new, correct? So create, so then it will appear. I have already shown you in the PPT also, correct? So your company name. For example, I'm going to give XYZ Limited. Okay, this is my company name. Next, mailing name. What is your mailing address or your email ID of that company? So xyz@gmail.in. So this is the mailing address and the residential address or the office address. So just number 86, 8th cross, some XYZ Levitt. This is the company address. Next, you can go for whatever the Bangalore or any pin codes that you can give it here, Bangalore. Next. So here in the state, whichever the state your company is running or existing, in which location it is, like in Karnataka, Gujarat, Bihar, Jammu, Kashmir, whichever the state, you need to select that. I'm selecting here Karnataka. Next, the country is India. Telephone number, if you have any number, you can just give the number here, or else you can go. Next, telephone number, for example, simply you can give any other 856 number. So if company is creating, then you need to give your original company numbers only, because we are creating a dummy company here. So I'm giving the XYZ information. Okay. So next, after telephone, mobile number is also there. So whatever the number is there, just you need to give the 10 digits of number. Next, fax. If you have the fax, you can give, or else you can go next. Email address, already we have given, that is xyz@gmail.in. Next, website, whatever the XYZ website is there, just XYZ. That is the website that you need to give https // all those things you need to give if you have. Okay. Next, the financial year begin from, that is usually we are going to start the financial year from 1st April of that current year, and we are going to end from the 31st March of the next year, correct? So here also financial year, the 1st April 23, and the books begin from 1st April 23. Okay. Next, the base currency symbol. If you want to change to any other country, you can change, or else if you want to keep it Indian currency, then you can keep it this only. At the end, okay, the pop-up will come, accept yes or no. We want to create this company or not. If you want to create, then we need to click it on yes. So our company is created. Next, it will ask the company created successfully, enable the feature as per your business need. In this slide also I have shown you, right? Creating company and then configuration of a company, correct? So which are all the features if you want to enable or disable? This is the platform where it will ask for enable and disabling of the features. So first one, see here, it is already showing company XYZ Limited. Show more features. If you want, you can click yes, or else whatever the features are enabled, that just it will show that features. So first one, accounting, maintain accounts. Yes, we need to maintain the books of account, so it should be yes. Next, enable bill wise entry. So usually what we are going to do, each and every vouchers or the bill we are going to make enter in the Tally software. That is the one way. Otherwise, the companies, what they are going to do, they are going to maintain or they are going to record these bills in day wise or weekly wise, depending on the company nature of products and goods they are going to sell. According to that, they are going to select. If you want to do bill wise, yes. Otherwise, you can select it as no. Next, maintain inventory. So each and every organization, the main objective of the organization is to maintain proper inventory in the organization. So we need to select yes. Integrate accounts with inventory. Yes, because whatever the goods will comes to the business or going out of the business, all the transactions should be recorded, and we need to get the accurate what is the stock is there in hand or in the godown. That is the reason it is as. Next, taxation, enable goods and service tax, that is your GST. If you are a company needs to pay GST to the government, then you need to select yes. Or if some companies, if it is GST is not applicable, then you can select it as no. And once you select for the GST, it will ask which state. It is Karnataka. Then registration type, you are a regular registered or composition scheme under your registered or regular SEZ. So just I will click it on regular. Okay. So access of any other territory, if it is yes, then you need to select yes, or else it is no. Next, if you have the GST number, if you are registered under the GST number, you will get the 15 digits of GST number that you need to enter here, because all the entries will comes under this GST number only. So periodically of GSTR1. So you need to refile or you need to file the GSTR1, whether you can go for monthly or quarterly. Just I will select it as monthly. So invoicing applicable, yes or no. Next, the e-way bill acceptable, yes. And the applicable from 1st April 2023. Why? Because we are starting the book from 1st April 2023. And applicable of interstate, yes. If it is only intrastate or interstate, that is depending on the business. Next, the pop-up, accept yes or no. So once it is done, we need just click on yes. Next, enable tax deduction at source. So if you are going to cut or if you are going to deduct the TDS from your employees, then you need to select yes. If you are not deducting, then it is not required. Okay. So these are the configuration key it will ask. Then accept. See, XYZ Limited, we already created this company. No vouchers are entered. So once we go ahead, okay, then I will show how to enter these vouchers also. That is, each and every transaction we are going to record, all those things will be there. And here you can see create, we already created. If you want to do alter, or if you want to do edit, or if you want to do some other changes, additionally you need to change, then you can go for this alter. Okay. Next, we have charts of accounts that we will discuss in the presentation. Then I will explain you here. You know what are the different types of accounts we are going to maintain in the organization, correct? So you are going to, first we are going to do the journal entries, ledger account, then we are going to create a trial balance, then we are going to create P&L account, then we are going to prepare financial statements, correct? So these are the broadly classified categories of accounts we are going to prepare in the organization. So in Tally also, what are the different kinds of all these accounts are there? Okay, that we are going to discuss. Understanding chart of accounts, definition and the purpose. So why we need to understand this charts of accounts first? In the earlier only we have discussed what you mean by accounts, what are the different types of accounts we have, what is the purpose of accounting, what is the objective of accounting, everything, correct? So here also in the Tally they have different accounts they have given here, like as per the chart. That we are going to discuss one by one here also. Just I will show it in the Tally software and how to create or how to enable the acting or features that we are going to show. And what are these importance and classifying these charts of accounts also I will explain you one by one. Okay. So this is just I have added here as a sample copy or sample screenshot of how it will looks like in the Tally software. If you go to gateway of Tally, just click on chart of accounts. See, you are going to get to know what are the charts of accounts are here. So change company or show inactive companies, all those things options are also there. We don't have any other companies, just we created only one company. So only one company is there. So that is the reason no need to use this change company or show inactive company. So if you want to create ledgers, we can create it ledgers here. Next, voucher types. That also I will explain you one by one what are the different types of vouchers in Tally it is there, and how to create a voucher in the organization or company. Vouchers we are going to create in the Tally software. Next, currencies. While creating only I have shown you the what are the different types of currencies we can change, correct? So there only it will ask which country or which type of currency you require. And next, budget, the whatever the inflow and outflow of the cash or estimation of funds of the organization that we are going to do here. And scenarios, what are the different scenarios we are going to operate the organization. If it comes to inventory management, then we have stock groups. We have different categories of stocks, correct? Raw material, semi-finished goods, finished goods, work in progress, ancillary products, all those things that will comes under this. And units, how many different units are there in the organization. For example, one main organization will be there. Under that, we have different units or 5-6 units or 5-6 sub-units over there. So for that, we need to record all this information here. And godowns, how many godowns they are going to maintain for that particular organization or for that particular company, that we are going to enter here. So this is the chart of accounts looks in the Tally software. Next, we are going to discuss about the voucher entry in Tally. So how to create a voucher in the Tally software, or what are the different types of vouchers are available in the Tally, that we are going to discuss now. So first, the types of voucher. So here I have added the screenshot. If you go for the list of voucher types, I will show you in the hands-on part also. So first, the attendance in the sense, the whatever the employees attendance they are going to calculate or they are going to record in the Tally software, that is there. Next, contra entries. So usually we solve this contra entry in the journal entries, correct? So contra entry is nothing but the same transaction which will appear in the debit and credit both the side in a same day. So that is called contra entry. Next, credit note. Credit note is nothing but the whatever we are going to get as a sales return. For that we are going to create a credit note. Debit note. Debit note is nothing but what we are going to send it to others, or purchase return that we are going to record. Delivery note, whatever the goods delivered or not, that entry we are going to do it here. Job work in order or job work out order. Journal entry, that is material in, material out. Memorandum, payment, payroll, physical stock, purchase, purchase order, receipt, receipt note, rejection in, rejection out, reversing journal, sales, sales order, and stock journal. So these are the different types of vouchers we need to create in the Tally software. Now I will show you in the Tally software also. So here, after the charts of account, then groups, ledger, then you have the voucher types. Just click on voucher type. See here, list of voucher types, whatever I have shown you in the presentation. Same, contra, credit note, debit note, delivery note, job work, sales order, stock journal. All those things are required to prepare your financial statement. So if you want to create any purchase or purchase order, receipt number, for each and everything we need to create a entry, or we need to make a entry. Then only you will get the accurate information in the financial reports. So I will show you how to create a voucher types also. Okay, voucher entry in Tally, that is recording sales and purchase transaction. So how to record this sales and purchase transaction or cash and bank transaction. So if you want to do sales, for example, the company is going to sold goods to Mr. XYZ for rupees 5,000 rupees. Okay, this is a transaction. How you are going to make an entry? So cash or bank account, whether that XYZ person is going to pay in cash or is going to pay in the form of check or DD, correct? So cash or bank account to sales account, because we are going to give the goods to him, correct? So on that time, there are two entries. One is in sales also we need to show, and one whether it may be cash or bank transaction that we need to enter, correct? For any transaction there will be 2 entries. Okay, that is minimum 2 entries will be there. If for example purchase, if you are going to purchase goods and services from ABC company, then purchase account debit to cash account or to bank account. If you are going to pay cash, then it is cash account. If you are going to pay through bank, then you need to mention as bank account, correct? So 5,000 rupees debit, 5,000 rupees credit. Like that 2 entries we need to made. So details of purchase order. If you want to create a purchase order in the Tally software, means these are the informations are required to create one voucher entry. So product that are ordered. So for example, I have ordered the 50 products. So product that are ordered is 50. Quantities, that is in kgs, meter, number, etc. Whatever the weight we are going to do. Okay. So example, I'm going to take it in the numbers. So 50 numbers I have ordered. That is quantities is also 50. Price at which it is ordered. So for one product, for example, 100 rupees. Okay. The name of the vendor to whom the purchase order is being sent. So for whom we are going to send that goods, or from whom we are going to purchase that goods, that we need to enter. Shipment address or delivery location where the goods are required, that we need to enter. Billing address of the company. On some time what will happen, the shipping address is different, billing address is different, because the head office is located in the prime city, but the plant is located in the any industrial areas, correct? So there are 2 address will be there. Next, the terms and conditions of a payment. So how many days you are going to allow as a credit repayment period. After that they need to pay the money, or after that you need to pay money to them. Okay, that things we need to mention here. Due date of delivery or consignment. So all those things required to create one order or one voucher in the purchase. Once we create the purchase order in the Tally software, this is how it looks like. See here, the purchase order, Max Electronics, the address, description to, that is Max Electronics, the same address or whatever the other address if they provided, that we need to enter. Supplier who is going to supply the raw materials or whatever the goods. Next here, voucher number and the date and whatever the terms of delivery. After that, description of the goods. What are the goods you are going to send, or due date, quantity, rates per, whether it may be a number, quantity, kilo, that we need to mention here, and the amount. So next, the amount in the words also, and whatever the signature, okay, authorization, that is going to at the bottom of the right corner. This is how the purchase order or the purchase voucher entry, once you done in the Tally, it will looks like. Just I will show it in the Tally software also. So here, purchase order, just click on the purchase order, see the name of the purchase order. So just example, VSN Electronics ELC. Okay. Next, if it is any other alias, if you have any pet name or any other like company, okay, you can, or the proprietor name, that you can enter here. Purchase order, if you want, you can give it in detail, or activity types of voucher. If it is yes, then you need to create yes, otherwise no. Method of voucher numbering, automatic, manual overhead, manual, multi-user auto, none. So if for example you are the only one person is going to create, then it is automatic. One by one entry we are going to create, right? The serial number will be continued. So just click it on automatic. Next, numbering behavior on insertion or deletion. So retain original voucher number, because once we delete also or once we remove also, that voucher serial number should be there, correct? So next, set or alter additional number details. If you want, keep it yes, or else no. Retain original voucher number behavior, yes. Use effective dates of voucher. If you want, you can create yes, or else it is no. Allow zero value transaction. If it is zero value, the value is nothing. In that case also, if you want to maintain, then keep it as yes, otherwise it is no. Make this voucher type as operational by default. If you want, you can yes, or else it is no only. Allow narration in voucher. It is very, very important. The one sentence of explanation for that order, that you can keep it as yes. Enable default accounting allocations. If you want, you can yes, or else it is no. WhatsApp voucher after saving. So this Tally software directly send this voucher to the in the WhatsApp also. Whatever the XYZ person is there, for that it will be sent. So if you want, you can create yes or else it is no. Print voucher after saving. So if you want to file it, that whatever the vouchers, then you can give it as yes, otherwise no. Default, nothing. Set or alter declaration, yes or no. Name of the class, whatever the category, that you can create here, or else yes or no. The pop-up will come, accept yes or else it is no. So we already created one purchase order. Like that, each and every entry or each and every transaction, it may be a sales order, stock journal, or it may be a rejection in, rejection out, or it may be a debit note, credit note, all those things, it will pop up here, and you need to create the voucher individually, then you can go for the next step. So next we are going to discuss about the trial balance. Okay, so the trial balance is a statement where we can easily classify the assets, losses and expenses, debit side, and in the credit side, sales, income and gains and liabilities, that we can easily classify it into credit side. And this statement we are going to prepare with the help of all the closing balances of a ledger account. So once we prepare the ledger account, whatever the closing balances we are going to get, whether it may be a cash, bank balance, or purchases, sales, or whatever the other assets and liabilities of an organization, that closing balances we are going to take, and then we are going to prepare this trial balance. Okay, so what is the main purpose of creating this trial balance? Okay, so if you want to create income statement or profit and loss account, okay, then you require this trial balance. With the help of trial balance only, we are going to prepare this profit and loss account or the income statement in the organization. So next, understanding the trial balance as a tool for financial validation. So we are going to use as a financial tool means once we start transferring all the transaction or all the closing balances of a ledger account of a trial balance into the financial statements, then easily we can check which transaction or which ledger account already we have taken or which one we have not taken for the creating a financial statement. So that is the where we are going to prepare this trial balance, and we are going to cross verify as a tool, or we are going to use as a tool to create a financial statements. Okay, so steps to prepare a trial balance in Tally. So that I will explain you in the hands-on part. So if you go to Tally software, here you can show the day book. Okay, so in the day book, what we are going to do, we are going to enter the date, particulars, that is the whatever the transaction you are going to make, the voucher type and the voucher number. Once you enter the voucher or once you create the voucher, that voucher number will come here, and whatever the debit amount or else the inwards quantity, here credit amount and the outwards quantity, that we are going to record it here. So once you entering the vouchers, how I created the purchase order, like that each and every transaction vouchers we need to create in a Tally. Then you can in the day book one by one it will appear here. From this day book it will go to the journal entry. From the journal entry it will take it to the ledger account. From the ledger account you will get the trial balance. Okay, so this is the pathway of creating the trial balance in the Tally software. Okay, then also you can go for here, save and view. Once you've done with all these voucher entries, then you can get the final one here. Next, profit and loss statement. So the process of creating a financial statement is, first we need to record the transaction, that is your bookkeeping. Next, from that bookkeeping transaction, we are going to pass the journal entry. From the journal entry, we are going to post it to the ledger account. From that ledger balances or the closing balance of the ledger account, that we are going to use, and we are going to prepare the trial balance. Once we prepare the trial balance, the next step is profit and loss statement. So if you want to create a profit and loss statement, you require the trial balance account. Okay, so what are the components of profit and loss statement? Okay, so in the profit and loss statement you require all the profit or the gain from the organization. Usually the main source of income from the sales only. You go for any companies, or you can take an example of any company. The main revenue come from sales. Correct? So that is the main profit. Okay. After that, the other incomes also. For example, company is going to receive a rent of their other property, or some building they have given as a let out as a property for rent. Then they are going to receive a rental income. If the company is invested their money in some other organization, or in the government bonds, or in the post office savings bank deposits, then they are going to get the interest on that particular deposits. That is also a one kind of income. If it is any other incomes are there, that is the income part. Next, when it comes to expenses, so all expenses and losses they are going to record it here only. So expenses in the sense, any purchase of raw material or printing and stationery, telegram, postage, water, fuel, gas, any other expenses, salary paid, wages paid, okay, all those things will comes under the expenses. And whatever the depreciation charged on the fixed assets, that is also we are going to take. That is the few components we are going to take for the consideration of a P&L account or profit and loss statement. Next, calculating the net profit or loss. So as per the process, we need to enter all the expenses and the losses and profits and the incomes in the profit and loss statement. Finally, you will get the net profit or net loss from the organization or from your profit and loss account of that particular organization. So this is the steps for preparing the P&L account or profit and loss statement. So first, gather all the financial data. So that will be available. How? We already created journal entry, ledger account, trial balance. From these three only, we are going to get all the financial data. Correct? Collect data from sales records, expenses, receipts, and bank statement. Next, when it comes to next step, that is categories of revenues and expenses. So we are preparing P&L account. That is your profit and the losses, or your revenue and the expenses. That category you need to make. Which is the profit for the organization, which is the loss, which is the revenue, which is the expenses. Okay, that category you need to make. Next, calculate gross profit. So from the gross profit, next we need to deduct all the operating expenses. That is your day-to-day expenses of an organization that we need to deduct. Then you will get the operating income. From that operating income, you need to include other income or expenses, that is any administration expenses and income that you need to add. Then you will get the final net income or net loss of the organization. So this is the profit and loss statement. So here the Tally software, the P&L statement or profit and loss statement looks like. See here, profit and loss account, the XYZ Limited company for 1st April 2023. So here it is a debit side and it is a credit side. So here also particulars amount. So net profit. Once you start entering all the transactions here, okay, in the particulars column. If it is a expenses, then we are going to record it in the debit side, this side. If it is a profit or the income, then we are going to record it in the credit side. So once we start entering all the details, then you will get the net profit or net loss here. The total of both the sides, total of debit side, total of credit side, it will show it here. And if it is a debit balance, it is a net profit. If it is a credit balance, it is a net loss. This is how the profit and loss account statement looks in the Tally software. Next, we will discuss about the balance sheet. Okay, so once you learn the journal entry, ledger account, trial balance, profit and loss statement, and the final one is balance sheet. So in this balance sheet, we need to make a categories of assets, liabilities, and the equity. So these are the three broadly classified categories are there in the balance sheet. So balance sheet is nothing but it is a statement of assets and liabilities. What is owns for the organization and what we owe for others. That is your balance sheet, correct? So explanation of assets, liabilities, and the equity section. So assets is what the company owns. Next, the liabilities are what the company owes to others. And the third one, equity. That is through the shares the company is collected money from the public. for their organization. That is the equity. So if you know what are the categories or what are the items comes under this category, then we can move on to the creating a balance sheet. In simple, balance sheet as a snapshot of the company's financial position. So if you just look at the balance sheet, what is the total of assets, what is the total of liabilities, that is the net worth of the organization, then you will get to know what is the total net worth of this organization. So what is the value of that particular company. So that is the reason it is called as just as a snapshot. If you look at, then you will get to know what is the financial position of that particular company. So what are the objectives of this balance sheet? So it helps in ascertaining a financial position of the business on a given day. So if you want to check each and every day, what is your balance sheet net worth, or what is the total of your balance sheet, assets and liabilities, if any difference were there or not, just you need to check, or you need to give all the entries each and every day, and then you can check the financial reports of your organization. Next, details of owners' equity can be determined. So what is the owner's own fund and how much is the equity oriented fund or equity fund of the organization, that we can check. Next, the information from the balance sheet helps you to create provision for future loss or contingencies by creating a reserves. So the unexpected things like COVID comes, correct? Like that, if any other circumstances or situations comes in the future, so the company owners, the managing directors, they can see the balance sheet, and whatever the contingencies they need to create for their organization, they can create. It provides a snapshot of business health, including the economic resources the business owes, and the sources of financing for those resources. So if the company requires money for the next whatever the other activities or other product line, for any other things if they require, they can go for planning for the owns and woes of the organization, or if they have the own fund, or if they want to owe from others, that they are going to decide from this balance sheet. Ascertain if the business is financially autonomous and therefore solvent, if they are the financially sound or not, that they are going to check. If it is not sound, then what is the solvency position of that particular company, they are going to check. And the last objective is determine the financial liquidity of the business. The liquidity is nothing but easily we can convert into cash, or it is near to cash. Okay, that is the one more information or the objective of creating this balance sheet. Next, the components of balance sheet. So in the balance sheet, mainly we have two categories. One is assets, another one is liabilities. Under liabilities, we have three categories, that is owner's capital and your equity capital, that will comes under the capitals. Second one, the long-term liability. Okay. Next one is current liability. These are the three categories. For example, owner's equity, the owners or the proprietor own fund, equity share, preference share, reserves and surplus, that will comes under the capital. When it comes to long term, if the company is issued any debenture, or if the company taken any term loans or secured loans, that will comes under the long term liability. When it comes to current liabilities, the current liabilities is like your creditors, bills payable, bank overdraft, or any prepaid expenses, that is outstanding prepaid expenses, that will comes under this current liabilities. These are the one category. When it comes to in another category, that is assets, under that also we have three categories, that is subcategories: fixed assets, investments, and current assets. Under the fixed assets, we have land and building, furniture and fittings, plant and machinery, and other etc. will comes under the fixed assets. When it comes to investments, any amount or any money the company is invested in other companies. Okay, that is our investment, that is the asset for the organization. And the next one, current assets. Under the current assets, cash, bank balance, bills receivable, inventory, and any other short-term assets like our prepaid expenses or advance paid for any expenses, all those things will comes under the current assets. So these are the few components of balance sheet. The process of preparing a balance sheet. So prepare ledger account, Next, preparing the unadjusted trial balance. Preparing adjusted trial balance. Fourth step is preparation of trading and profit and loss account. And finally, we are going to prepare balance sheet. Already we have discussed ledger account, trial balance, and the profit and loss statement, correct? After profit and loss statement, we are going to prepare the balance sheet. Whatever the information from the trial balance and the profit and loss statement, we need to prepare the balance sheet. So this is the process of creating the balance sheet. And now we will look how it will look in the, or how it will be looks like in the Tally software, the balance sheet. So if you click on the list of reports, in that we have balance sheet. Just click on that balance sheet. See, liabilities is one category, assets is other category, XYZ Limited. So liabilities amount as on the 1st April 2023, because we are starting the books from 1st April 2023. So capital account. So whatever the amount is there, you need to enter here. What are the loans? That is your liability. Whether it may be a long-term loan, we are going to take it here. In current liabilities, we are going to take the other liabilities. Okay. Next, profit and loss account, that is opening balance and the current period that we are going to enter here. When it comes to current assets, all your current assets, fixed assets and other investments, we are going to record it here. So balance sheet total will comes or appear here, and the assets total appear here. So this is how we need to create the balance sheet in the Tally. So no need to prepare all these things. Once we enter the ledger account and trial balance, all the information will appear easily in the balance sheet. You can get here, and if you want to save and you can save, or else you can just look at the balance sheet and then you can move on. Next, we are going to discuss about the Tally reports overview. So how the Tally reports looks like and how to analyze the Tally reports, that we are going to see in this video. So types of reports in Tally. So the overview of financial statements, that is the balance sheet, that one statement or one report it will generate. And next, the stock summary. So if you want the monthly reports or weekly reports or quarterly wise reports, you can generate the stock summary also, because you need to reorder the quantity and how much stock is there in the organization. For all those things you need to check, correct? That is the one. And next, other reports also, that is your ledger account, cash account, or the cash flow statement, fund flow statement, all those things you can generate the other reports. I will show you the reports also. And we have the option of customization options and filters. So in the Tally software, however you require, like customized you can show it and you can filter it out also. So this is just an sample of audit report in Tally. It is generated in Tally. So the independent audit reports to the board of directors and the shareholders. Company name is ABC, address, the whatever the XYZ address is there. Report on the financial statement. Here it is written, we, in the sense XYZ, have audited the accompanying balance sheet of ABC as of December 31st, 2000, whatever the date. Everything they are going to mention, what is the cash flow and what is the financial statements and management responsibilities. That is, what is the plan of action or what is the action to be taken care by the management. All those information they have written here as a report, and finally they have given or they have submitted the sample audit report. So after preparing all this, okay, if you click on analysis, then if you are going to generate the report, then this is the sample report or sample. It will looks like this only. See here, if you go to final accounts reports, so if you want to check the balance sheet, if you double click on balance sheet, it will open balance sheet. See, because we are not enter any information, so it will looks like this only. So next, profit and loss account is also there. If you just double click on that, the profit and loss statement will open. So whatever the information or whatever the financial statement, it will appear here. And next, your trial balance and your receipts and payments. If you double click on that, you will get here. Or if you want to more information, just click on show more. So here all your balance sheet, profit and loss account, ratio analysis, trial balance, cash flow, fund flow and receipts and payments. All this information or all these financial statements, it's going to appear in the Tally. So individually you can just check or you can save it and you can just get the printout also for your reference. So this is how we are going to generate the financial reports in the Tally. Next, we will discuss about the tips and tricks in Tally. So that is the keyboard shortcuts in Tally. So this is the general shortcuts. Alt F1 to close the company. Okay. Next, Alt F2 to change the company. Control plus A to accept a form wherever you use it. Okay. Control plus Alt plus B to check the company statutory details. Next, Alt plus F3 to select the company from the list. Okay. Next, Alt F9 to see the detailed list of shortcuts. In Tally shortcuts only it can appear in the Alt F9. Next, the gateway of Tally, that shortcuts. Just if you press G to open the gateway of Tally in the screen. Next, R to open the display menu for reports. I to open the display menu for statutory reports. X to open the display menu for exceptions report, and the V to open the display menu for voucher reports. So these are the few shortcuts for gateway of Tally. Next, the voucher entry shortcuts. F2 to change the date, F4 to toggle between voucher types, F6 to select the narration, Control plus P to print the voucher, Control plus R to repeat the narration, Alt plus P to print a report. So these are the voucher entry shortcuts, and these are the report shortcuts. Alt plus 2 to view the detailed report, Alt plus E to export the report in different formats, Alt plus I to zoom in on a report, Alt plus U to upload the data into the cloud. So these are the few shortcuts we can use, and we can easily enter all the details in the Tally, and it will make easier to use these shortcuts, and you can enter all the details required. So here is a quick recap of what we learned in this particular course. Okay. So first we have discussed about understand the core principle of financial accounting, the emphasizing the systematic recording and the analysis of transaction for informed decision making in business management. So what is the definition of accounting? What are the users, or who are the users of accounting? What is the objectives and other things we have discussed in the accounting and financial accounting things, correct? Next, we have discussed about the master Tally basics by navigating the interface, creating companies and gaining hands-on experience, establish a solid foundation for efficient Tally usage. So how to create a company, how to create vouchers, or how to create any other transaction, all those things we have discussed, how to install all those things, correct? Next, learn the essential of recording diverse financial transaction in Tally, covering the chart of accounts, comprehension and practical voucher entry, exercise for accurate daily financial tracking. So all the transaction, that is your chart of account, in that also I have shown what are the different list of accounts we have, all those things we have explained. Next, we have discussed about the generate and interpret crucial financial statements such as the trial balance, profit and loss account, and balance sheet using Tally. So how to create all these three financial statements using the Tally, that also we have seen in the hands-on. Gain insights into the financial health of a company. Next, we have discussed about the explorer of various Tally reports and enhance the data analysis skills for extracting valuable financial insight, customizing reports, and interpret the data to support informed decision making. So how the financial reports looks like, and I have shown you the sample of auditing report. And lastly, we have discussed about the tips and tricks of Tally software. Discover the time-saving keyboard shortcuts, troubleshoot common issues, and implement efficient data entries techniques that we have discussed. And practically also we have seen how to use that shortcut keys in the Tally software.
Hi. Financial management is one of the most sought after course in the area of economics. In fact, for those who are aspiring for the career in the area of banking and finance, financial management is a must-learn area. Well, money is something that we quickly recall for the discussions on finance or financial management. Of course, we're not wrong. In fact, the entire domain of financial management revolving around finance or financial management is on money. I'm very sure at individual level, we all know what is finance, how finance works in real time. But with the help of this course, let's try to put our understanding of financial management into a perspective so that your journey of understanding financial management in the advanced levels would be smoother. So why delay? Let's begin our journey. Welcome to the course on Introduction to Financial Management. My name is Pawan Kumar Chandrapa. So in this course, we will be discussing the concept of finance, the definition of financial management in business, the goals of financial management. We also discuss the scope of financial management, the functions of finance manager, the agency relationship, which is one of the most important topic to be discussed in the area of financial management. We discuss about it, the agent and principal relationship. And we also talk about the financial system. We talk about the entire ecosystem of financial system and how each component in the financial system are interconnected. And we also talk about the safety of investments in business. Well, we have a lot to understand. Let's begin our journey with the first topic, the concept of finance. The concept of finance is basically originated from economics. So, what is economics? How an individual or a business or a government making use of these limited resources to fulfill the unlimited dreams or unlimited desires is all about economics. So that's the underlying principle of economics. So the concept of finance is derived from these notions. So basically, when we talk about finance, we talk about cash, we talk about banks, investments, loans, funds, and we talk about forecasting. So forecasting the need for money. We talk about borrowings, where to borrow, how much to borrow. We talk about investments, and we also talk about budgeting. So what is budgeting? So budgeting is all about choosing an investment alternative. There are so many investment alternatives. Which one is the best project? Which is the best project to invest in? So choosing the best alternative. So this discusses about budgeting as well. Basically, finance is an art or science of money. We said money is the epicenter of this entire discussion of financial management, of course. Well, when we say finance is all about money, we need to understand finance is also, it's an art of managing money. It's a science of managing money. So why we call finance is the science? We call the finance as science because finance dependent on certain principles for deriving the results. For example, when we talk about the time value of money, we dependent on a compounding or discounting principle, right? We talk about conversion of present value of money into future value, or we talk about conversion of future value of money into present value. So there are certain principles on which the finance is actually dependent. So that's the reason we call finance is the science, because there are certain procedures to be followed to calculate the values. So that's why we call finance is the science. At the same time, we claim that the finance is also an art. Why finance is an art? Because when we are doing a calculations, when we are analyzing the money, we need to, understand it is purely based on the skills and abilities of an individual, how to analyze the financial transactions and how to interpret them, how to report them. So it is an art. So it is completely dependent on the individual who is actually conducting this analysis of the financial results or the concepts that are related to finance. So that's the reason we call finance is also an art. Let's jump into the next level of discussion. What are the broad areas of finance? Basically, the finance can be discussed under three important categories: personal finance, business finance, and then public finance. So these are the categories in which we discuss the area of finance. What is personal finance? Is it something related to an individual? Yes. Personal finance is about how an individual earns some money, how individual is earning money, how income is coming to him or her, what are the sources from which an individual is earning their money. For example, when we talk about personal income, there are 5 different heads, right? So 5 important heads: income from salary, income from house property, income from business or profession, or income from capital gain, income from other sources. So these are the sources from which an individual is earning money. Now, these are the sources of income. Finance talks about how an individual is actually earning from these sources, how money is flowing to his bank accounts. The next thing is spending. How an individual is spending. Let's say he has earned 1 lakh and how is spending 1 lakh, right? So spending on, for what reasons is spending? Is he spending for medical expenses, or is he spending for investments, or is spending for daily cash requirements, or is spending for to buy any long-term assets? So that is the spending pattern that we analyze in finance, in personal finance. Well, we understood there is an income, there is a spending. Now, let's assume the income is more than spendings. Let's say he's earning 1 lakh and he's spending, say, 80,000. So 20,000 is something that is called saving. This is the surplus. Now, with the surplus, what is he doing, or what is he or she is doing? Is he or is she saving this money and keeping it in the bank deposits, or how she is making use of that money? Is she investing this money, or is she buying some long-term assets? This all is discussed under personal finance. Now, let's say the income is lesser than the spendings, right? So let's say the income is 80,000. The spendings are 1 lakh. Absolutely, there is a deficit, right? There is a deficit of 20,000. So how an individual is matching this deficit? From where is bringing that money, right? He may have to go for borrowings, right? He may have to borrow money from the other sources to fill this, to bridge this gap of income. Earning is 80,000, spending is 1 lakh. So 20,000 is the deficit. So that is the discussion of personal finance. So how an individual is managing these deficits is the discussion of personal finance. Well, when there is an income, when an individual is earning cash, he need to pay the tax. Every individual is supposed to pay the tax. So how much of taxes he is paying, on what areas he is actually paying taxes? Is he paying income tax, or is he paying business taxes, or is he paying sales tax, or is he paying any other taxes or gift tax or whatever? So that is the part of discussion in personal finance. Again, there is something called a retirement. Again, for every individual there will be a retirement, right? So how an individual is planning for the retirement? Is he spending everything he's earning, or is he saving some money for his retirement? So that is the discussion of personal finance. So retirement planning, is he investing in long-term investment options, where he's investing in bonds or debentures, or is investing in long-term assets to earn the long-term returns? So that is the discussion of personal finance. That is part of personal finance. Well, so these are the things that we discuss when it comes to personal finance. Now, business finance. As the term business finance reflecting business, how a business is dealing with finance, how the business is handling the financial aspects. Well, every business will have cash flows, cash inflows, and cash outflows. So what is cash inflow? The sources of money. So what are the sources from which a business is earning money? Or what are the sources from which the business is borrowing? Let's say when the business is good, the business may be making profits, and these are the cash inflows. These are the positive cash inflows, right? So when the business is expanding, how a business is catering the needs, the financial needs of the business, right? So from what are the sources the business is borrowing? So that is the discussion of a business finance. So what are the sources of finance? So what are the applications of finance? So how the business is borrowing money, how business is getting cash flows, and how business is making use of those cash flows. Financial decisions, right? So how to bring money, what are the financing decisions? Let us say the business has some money, the excess money, how business is investing that money in the market, for what rate the business is investing money in the market. So that is very important area of discussions in business finance. The dividend decisions. These are some of the very critical decisions for a business. So how to pay dividend, how much to pay, at what intervals the dividend needs to be paid. Of course, there will be regulations in each country at what intervals they need to pay the dividend, but it is up to the decisions of a company to pay or not to pay the dividends. Taxes. Every company is paying the taxes, right? So there is no exception for any business. At least in India, businesses are paying taxes. There is a separate corporate tax which they're supposed to pay, and it will be revised every year. So that is the discussion of business finance. So operating and marketing decisions of a company. So what are the operating decisions? What are the operational aspects of the business? And we talk about the marketing aspects, how money is required for marketing activities. And also the accounting aspects are very much part of the business finance. CSR, corporate social responsibility. So business, it is not just about earning profit. They also have certain social responsibilities, social obligations. For example, taking care of children's education in the poor societies, or to take care of the parks or the roads or the bridges, the construction or maintenance of those, or to take care of orphanage houses, or to take care of any social activities which are at the larger cause for the society. So that is also part of the discussions in business finance. Well, the third important area in finance is the discussions on public finance. So what is public finance? How a particular country is managing the money, how the country is managing its financials, right? How a country is handling the demand side of the economics or the supply side of the economics, how the prices are managed. Because we all know price is the intersection of demand and supply. So how a country is managing these aspects, how a country is managing inflation. So what is the inflation level in the country, and what is the healthy inflation rate that is required for a country to grow consistently. So that is also part of the discussions in public finance. So with inflation, there is also discussions on GDP, the gross domestic product, the budgeting, the forex, foreign trades, and reserves. These are also part of the discussions in public finance. Now, financial management in business. So we have understood how financial management of finance works in individual's life or in aspect of country, but we'll dive deep into understand what is financial management in business. Basically, financial management in business it's an application of management principles in financial activities. It is an art or science of managing money to meet the predefined objectives. So basically, it is the process of planning, organizing, controlling, monitoring financial resources with a view to achieve organizational goals and objectives. So every organization will have certain set of objectives, and to achieve those objectives, there is a need for financial resources. So how a business is handling these financial resources to meet those objectives is the discussion of financial management in business. In business, financial management is the process of handling a company's finances in a way that generates value for the overall business. Remember, financial management is an organic function in every business. There will be a dedicated department to take care of the financial aspects of a business. So they take care of all transactions. They analyze all the transactions. They do projections for the business. They analyze the requirement for financial resources. right? And the person who is responsible to take care of the financial activities is generally called as a financial manager. Of course, there are different dimensions to see the financial manager. There are various titles in which we can call the financial manager, of course, but the roles and responsibilities of finance department is all about taking care of cash inflows and cash outflows. At strategic level, financial management is all about planning cash inflows and cash outflows. How company or a business is planning the cash inflows and cash outflows is the discussion at strategic levels. At tactical levels, financial manager or the people who are responsible to take care of financial aspects at the ground level or the entry level is to record the transactions, business transactions, analyze and produce the report for in front of the management to take strategic decisions that are related to the business. So that is at two different levels we can see in an organization. Now, it's very important to understand what are the goals of financial management. There are three important goals for financial management: profit maximization, wealth maximization, and improving market share. Of course, there are a series of goals for financial management, but ultimately, all those things will boil down to these three important goals: profit maximization, wealth maximization, and improving the market share of the business. So, what is profit maximization? Profit maximization. You all know a business is an economic entity which is running to make profits. There is no business on the planet Earth which is running for charity, right? If it is purely running for charity, then it is not called as business, it is a charitable organization. When it is a business, they need to earn profit. Why they need to earn profit? There are various reasons why they need profit. So, what is the profit in business? It is simple. Revenues. What is the revenue? What is the excess of revenue that business is earning over the cost? Let us consider a business is generating 10 lakhs of revenues for this year, 2022. The cost of producing that product or service is, let's say, 6 lakhs. The remaining 4 lakhs is the profit for a company. Now, this 4 lakhs, what is the kind of profit it is a different discussion altogether, right? It may be profit before tax, right? PBT, right? This is profit before tax. Profit after tax. Earning before interest and tax. Earning before tax, depreciation and amortizations. So what is profit before tax? This is the tax. This is the profit before deducting the taxes, because every business is liable to pay the taxes to the government. So before deducting taxes, what is that company has is profit before tax. What is profit after tax? It is, of course, it's a self-explanatory. Profit after paying the taxes to the government. Earning before interest and tax. Remember, every business will have financial obligations. Let us say when the business has borrowed some money on interest basis, they're supposed to pay the interest. So what is the revenue? What is the earnings before paying interest and taxes? That is EBIT, earning before interest and taxes. EBITDA, earning before tax, depreciation and amortizations. Remember, if it is a tangible asset, a business apply depreciation. If it is intangible asset like copyright, patent, they'll apply amortization. So depreciation and amortizations are most common in any business, right? So what is the earnings before tax, before depreciation or before amortization? So that is earning before tax, depreciation and amortization. So it's need to be very clear what is the profit that we are talking about. Now, how a business can increase the profit? A very important term, profit. By increasing the units sold, by increasing the number of units sold, increasing the price per unit, price per product, price per service, cost minimization, reducing the cost, or maybe locating new investment opportunities, or maybe acquiring new business ventures in the same line of business, or maybe from the different line of businesses. Or it may be an expansion of an existing business. So there are various other ways to earn profit. Well, the theory of profit maximization is appreciated by many scholars. At the same time, there are criticisms too. So what are those appreciations? What are those favor towards profit maximization discussions? There are certain arguments that says, yes, profit is important for a business. At the same time, there are criticisms which we will see a little later, right? So now, what are the arguments that are in favor of profit maximization theory? The very reason why business exists is for profit. The basic purpose of business is to earn profit. In fact, profit is considered as the meter for determining the success, right? So with profit, the business is considered successful and on track. And if the profits are not there, business is considered is a curse, is a sin for the society, right? Many times, profit is essential for the survival of a business. Only when the business is able to make profits, they can survive the competition, they can survive in the dynamic business world. Only profit-making business can think of tomorrow. Only profit-making company can create future, right? That is the reason profit maximization is very important. And also, we need to understand profit is accepted by the society as long as the profit is earned in a legitimate way. For example, the profits are earned with legal routes. It is accepted. The society is okay as long as it is a win-win for the society, win-win for the business, for the employees, for the stakeholders, to the customers, right? For everyone. So there is no problem earning the profit. It is required. It is very important. And society considers it is not a sin as long as it is legitimate. There is also an argument that a business which is loss making is a burden to the society, right? A business which is under huge losses, they may not be able to pay the salaries. They may not be able to pay their stakeholders. They may not be able to pay their suppliers. They may not be able to pay dividends. They may not be able to pay taxes or interest on the borrowings. Though ultimately they'll become a sin, or they may become burden to the society. These are the in favor of profit maximization. These are the arguments in favor of profit maximization. Now, there are certain arguments where profit maximization is criticized. The very important argument against profit maximization is the profit is not clear. So what profit are we talking about? Are we talking about net profit, or we're talking about the gross profit, right? We're talking about profit before tax, or we're talking about profit after tax, or it is earning before interest and tax, or it is profit before interest, tax, depreciation and amortization. So what profit are we talking about? It's not very clear. So when we say the ultimate goal of financial management is to maximize the profit, which profit the business wants to maximize? So that is not clear. So that is a criticism against profit maximization theory. Duration. What is the duration for which profit maximization goal is set? Is it long term, or it is short term, say 1 year, less than 1 year? Many a times, businesses are compromising on their long-term profits when they are focusing too much on the short-term profits. So that is the sin. That's a very, unwanted sign of profit maximization goal. Scale factor. Synchronization between size of the business and volume of profit. Many times you would have heard that the cost of setting this business is, say, 10,000. And the profits we can expect from this business is 1 lakh. Don't you think it is something unusual? Your investment is just 10,000 and you're going to earn 1 lakh. And there is the smell of illegitimate activities in the business. You just invested 10,000 and you are saying you are going to earn 1 lakh. How is that really possible? Because when a business is investing 10,000 or 10,000, a business may expect 30% or 40% or 50% returns, considering the risk return factors, right? How are you able to make those many times of your initial investment? So that is something is a very big question mark when it comes to profit maximization. Consideration of time factor. Are we considering time factor when we talk about profit maximization? The question is unanswered. The profit maximization focusing only on maximizing profit. What is the time duration we are considering to earn that profit? Is it 1 year, 5 years, 10 years, 20 years? What is that? Is unanswered. That is a criticism on profit maximization theory. Undue aggression towards profit maximization may lead to the social evils. When a business is too focused on making profits, when they're very aggressive about making profits, there will be scope for corruption, quality drop, mis-selling, false promises, undue influences, right? So it may lead to all those things. It ignores risk associated with profits. What is the risk associated with profit? Remember, risk and reward are two faces of a single coin. So what is the risk we are going to take to earn the profit is not discussed under profit maximization theories. Wealth maximization goal. So very important, very popular goal of financial management, wealth maximization. And this is one of the most, the recent approach towards financial management. And it is popular too. When it compared to profit maximization, wealth maximization goal looks very attractive. So before we understand what is that is catching the attention of the corporate world, let us understand what is wealth maximization. What is wealth? Wealth maximization is basically an increasing the value of business to increasing the value of shares held by the stakeholders. When we say stakeholders, who are the stakeholders to the business? There are two important categories in which we can segregate, we can classify the stakeholders. External stakeholders, internal stakeholders. Who are the stakeholders who are external to the business? Creditors, governments, suppliers, tax authorities, customers, media, and the society. So these are the people, these are the entities which are outside the business. They're outside to the business. They're not insiders to the business. Now, who are the insiders to the business? Insiders to the business may be shareholders, managers, board of directors, and employees. So these are the people who are internal to the organization. So value of these stakeholders is to be increased. How? Through wealth maximization. We're talking about wealth. So what is wealth? Basically, wealth maximization means increasing the price of the share or ensuring the dividends are paid to the shareholders. Let us say I have invested rupees 100 in a particular share. After 1 year, company is declaring a dividend of rupees 10. That 10 is the value. That's a value maximization. Now, let's say the price of the share is 100. By the end of this year, the price of the share is, let's say, 120. So this 20 is the wealth. That is a wealth that is created by the business. So wealth is maximized. The share price is increased. We calculate the wealth of a business through various techniques. So one of the ways to calculate wealth of a business is through NPV, net present value. So what is net present value? Net present value is the present value of benefits minus present value of all the costs, right? So that is a calculation of wealth. Now, what are the arguments in favor of wealth maximization goal? So it takes care of larger interest of the stakeholders. We're not talking about profit, we're talking about wealth. increasing the value of stakeholders. So it takes care of larger interest of the stakeholders. Wealth is based on cash flows, not on profits. In profit maximization, we talk mostly about the profit. We talk about profit before tax, profit after tax, EBIT, earning before interest and tax, profit after tax, right? So these are the aspects we discuss the profits. But in wealth, we're not talking about the profits. We're talking about the cash flows, how much cash flows the business is able to generate. Long-term perspectives rather than the profit maximization goals. When we talk about profit maximization, we talk about how to increase the profits. When we talk about wealth maximization, we talk about how to increase the value for stakeholders in the long run. Remember, profit is looked for the short run. Wealth is looked at the long run. A consideration of time value of money, wealth maximization goal do consider time value of money. The rupee earned today is worth more than the rupee that would be earned tomorrow, right? So it gives weightage to that principle. Wealth maximization goal considers risk and uncertainty factors and help board members to create consistent dividend policies. Well, so these are the favored arguments of wealth maximization goal. Now, there are certain criticisms on wealth maximization also. So what are the criticisms on wealth maximization goals? It is prescriptive idea, not a descriptive idea. So creation of wealth for the stakeholders is just prescriptive, just prescribing that wealth of the stakeholders need to be increased. How to increase this wealth of the stakeholders is not discussed under wealth maximization theories. Wealth is not socially desirable. This is one of the most debated criticism on wealth maximization. So why it is not desired? Why it is not appreciated in the society? There are various reasons. The wealth should not be concentrated on few hands. When a business is concentrating on wealth maximization, the wealth will be concentrated. For example, when we say the business is dominated by major players in the corporate world, let's say, we talk about Alibaba, we talk about Elon Musk, we talk about Bill Gates, we talk about Ambani, right? We talk about Mark Zuckerberg, right? We talk about many others who are the legends in the business and who are creating wealth. So what is happening? The wealth of the world is concentrated on a few hands. It is concentrated. When the wealth is concentrated on a few hands, what will happen? They'll destroy the competition. They may destroy the competition. They may ensure there is a dominance of their business in the entire industry. And ultimately, that will cause serious problems for the end users, the customers. So that is one of the arguments put forth why wealth maximization should not be a consideration for financial management. Of course, there are debates on that. Of course, there are arguments against which is not true, but this is something that is discussed in the domain. Maximization of shareholders' value is a very generic term, or it's a vague term. When we say maximizing the stakeholders' value, when we mention stakeholders, it also includes the debenture holders, the bond holders, the creditors, everyone who are just invested their money for fixed interest, right? So what is that they're going to earn? When the business is able to create wealth, when the business is able to add value to the business, what will be the benefit for debenture holders who are just receiving a fixed interest every year? And how the value of these stakeholders increased is a question mark. So wealth maximization is not really focusing on the debenture holders, on the creditors who are receiving fixed interest from the business, no matter how much ever the profit the business is making. They're kept in a separate note. They are not considered for the profit. They are just considered for interest payments. The decisions of manager to maximize wealth may lead to employees exploitation. When the business is too aggressive on wealth maximization, the employees may be exploited. The customers too may be exploited because the business is concentrating on wealth maximization. So that is something that is criticized in financial management. Improving market share is the third important goal of a financial management. What is improving market share? Improving market share is a very generic term. Like every industry will have players within, and every player will have their own share of business in the industry. Let's say we talk about FMCG. HUL, Nestle, ITC, Britannia are leading the market of FMCG sector, right? HUL, Hindustan Unilever Limited, is leading. They have a major market share. And then comes Nestle, and then comes ITC, and then comes Britannia. And again, they keep competing for the market share. So improving market share is a very important goal of financial management. That is also important. The financial decisions taken by the financial managers should be in line with improving market share. The financial decisions taken should improve the market share. The telecom sector, Jio, Airtel, Vodafone, BSNL, right? So Jio is leading the market. They have a major share in the entire industry of telecom. Steel industry, JSW, Tata, they're leading the industry. They have the market share. Automobiles, Maruti Suzuki, Hyundai, Tata, M&M, Honda, right? So they're all the market leaders. They have major share, especially Maruti Suzuki has the major share in automobile industry in India, right? So the decisions taken by a business should improve the market share of a business. Investors can understand the market share of company through various sources, right? So how to understand the market share of a business? There are various ways to understand the market share. For example, one of the common routes is to analyze the annual reports of a business. So understanding the size of the balance sheet is the way to understand the market share. There are other ways, like they can go to published material on companies. They can check television, they can check newspapers, right? There are various sources from which they can understand the market share through advertisements also, right? And also increase or decrease in the market share indicates the current position of the business. So if the market share of the company, let's say automobile industry, Maruti Suzuki has got major share in the industry, whether it is increasing or decreasing is also one of the major parameter to understand whether the company is doing good or not. So that is the reason why we need to understand the market share of the business. Economies of scale. By focusing on economies of scale, companies improve the market share. So what is economies of scale? By increasing the number of units sold, they can reduce the cost incurred in manufacturing those goods or services, or producing those goods and services. So by producing large number of quantity, selling large number of quantity, they can increase the revenue for the business. So that is economies of scale. Growth in market share also grows the revenue. When the market share of a business is growing, that indicates that the business revenues are also growing. And the growing market share will efficiently manage the competition. So if the market share of a company is increasing, the competition is very well managed. The competition is, to an extent, it is reduced. So that is the importance of improving market share. So what we wanted to understand is improving market share is a very important goal of a financial management. The financial manager should take decisions, the finance decisions, in line with this particular aspect, improving the market share for a business. Now, how do companies increase market share? There are various ways in which companies can improve the market share for the business. Reducing cost, increasing the volume of sales, promotion, improving the efficiency, introducing new products to the market, customization or standardization, customer loyalty, improving the customer loyalty, introducing new technologies, talent retention, and acquisition of existing firms. There are various routes through which the market share can be improved. Well, market share improvement is also not free from the criticisms. There are a couple of criticisms on improving market share, why financial management should focus on improving market share. Acquisition may lead to monopoly, right? When there is a focus on improving market share, there will be scope for monopoly or duopoly. So what is monopoly? Only one company is ruling the entire market or the entire industry. What is duopoly? Only two companies are ruling the entire industry. Right now, if you look at Indian telecom sector, there is a situation of duopoly, right? You can see Jio, to an extent you can say it's a monopoly, but it is not established because Jio is got major stake, major share in the entire telecom industry. There is also some other players like Airtel. They also successful in retaining their market share to an extent, right? So you can see the situation of duopoly, Jio and Airtel ruling the market. So that is not good because when there is monopoly or a duopoly situation, the customers will be impacted. How? There will be less alternatives because customers cannot go for alternatives. They have just Jio or they have Airtel, right? They cannot go beyond those two players because they have the major share and they are the top players in this industry. And when they have dominance in the industry, they can increase the prices because there is a dependency. People have dependency on these companies. They can increase the prices. The customers can do little about that, or they cannot do anything about that. They just need to pay and use the services because there is no alternative in the market, right? Unethical practices will increase when there is monopoly or duopoly. The unethical practices will increase, like sales, like quality drop, fake promises, service failures, or those things that will increase when there is monopoly or duopoly. So market share improvement, though it is very important for a business, at the same time, when the market share is improving, the companies need to also understand that they need to ensure the services are not compromised or the offerings are not compromised. So that is very important. And that is one of the criticisms of market share improvement. Well, what are the functions of a financial manager? So what are the functions performed by a financial manager? What all roles he will play in his designation in finance department? Estimation of capital requirement for the business is one of the very important, very critical function of a financial manager. Why? Because understanding the capital requirement, understanding the scale of business, what is the scale of business need to be understood. Then only they can make estimations of capital requirement, how much money is required. Only when they understand how much money is required for the business, they can understand where to procure the funds. Let's say the money is required to take care of short-term requirements of the business. They can understand what is the right source to go for funds. Once they understand what is the estimation of capital requirement and how to procure funds, they need to take decisions on capital structure. So I need 10 lakhs for my business debt. How much I should borrow from equity? How much I should borrow from government sources? How much I should take from public, right? So it's all very important. They need to understand how much each source. Let us say I need 10 lakhs. I want to borrow 8 lakhs from equity, 2 lakhs from debt, or 5 lakhs from debt, 5 lakhs from equity, or 5 lakhs from debt, 2 lakhs from equity, 3 lakhs from retained earnings, right? Remember, even when the business is using its own capital, that is retained earnings, when the last year they have made profit and they have retained the money, and that is also has cost. They cannot assume that it is free. There is a cost implication for the reserve, that is the bank balance in proprietor's account, right? So that is another decision to be taken by a finance manager. What is the capital structure to be for this business? A resource allocation, understanding for each section how much of financial resources are required and when is something that financial manager need to understand. disposal of surplus. Disposing the surplus. What is surplus? It may be profit. Profit. How to distribute profit? Who will be given the first major share of this profit? How much to give? These are the decisions to be taken by the finance manager. Management of cash is very important because business also need to maintain certain cash to take care of daily activities, right? So what is the petty cash that is required to take care of daily requirements? What is the working capital requirement? All these decisions to be taken by the financial manager. Principal agent relationship in business, agency theory. So this is one of the most debated topic in the area of financial management, and it is most important areas of discussion. Often, this is causing a serious problem in the corporate world. Who is the principal and who is the agent in business? Basically, principal and agent relationship in business, it's a fiduciary consensual relationship between two people in the business. These two people will have their own set of duties and responsibilities. When these two parties are not able to take care of their duties and responsibilities, the conflict of interest arises, and that's when the agency problem arises in general. In a generic example, let us talk about mechanic. So, mechanic, right? How agency problem arises with mechanic. Let's say, consider you have a car and there is some problem. There is a left pulling issue in your car, and you will take your car to the garage and you will show it to the mechanic. Mechanic know that just by doing wheel balancing, this problem can be sorted, and it will just cost the owner, say, less than 5,000 to do that wheel alignment. Now, when the car is given to the mechanic, a mechanic is the agent, the owner is the principal. When principal has assigned certain duties to the agent, it is a duty of the agent to take care of the best interest of the owner. That is supposed to happen. When that is not happening, that is when the agency relationship, the agency problem will arise. The car is given to a mechanic, and mechanic know that it is costing less than 5,000. Despite that, the mechanic will suggest the owner to go for a very major repair work or to replace some spare parts in the car, which will cost owner, say, 20,000. Mechanic knows that it is just costing 5,000 to the owner if that is going for wheel balancing, but still is suggesting some replacing some spare parts which is of no use. So the agency problem arises. Same with the doctor, same with the lawyer. There is just cough and cold that you can get it tested and you can take medicine, that just over-the-counter medicine, but still you have gone to the doctor to check. But doctor knows that it is a very common flu, which can be, that can be cured with 2 to 3 days of medication, which will cost less than 1,000 rupees to the patient. But if the doctor is not doing that, if the doctor is suggesting to go for some scanning, some major medical tests which are of no use, even the doctor is aware of that. That is when that agency relationship, agency problem arises in this situation. Now, when it comes to a business, how agency problem arises? In business, there are two parties involved. One is agent and one is principal. Who is the agent and who is the principal in a company? Principal is the shareholder, right? The shareholders who are actually invested in the business. They are the owners of the business. Who is the agent? Agent is the board of directors or the chairman, who is actually entitled to take care of the operations of the business, the entire business, because the shareholders may not be able to participate in the day-to-day activities of the business. And that is the reason they are hiring board of directors or top officials of the company, including CEO. Now, It is the duty of CEO or board of directors to take care of the best interest of shareholders. The decisions that CEO or the board of directors take should be in the best interest of the principal. Who is the principal? The shareholders. When the decisions of board of directors is not in line with the requirements of the business, when that is not in the larger interest of the business, when that is not in the larger interest of the principal, that's when agency problem arises. There are so many examples in this context. You can take Satyam case, where Ramalinga Raju was the key person in Mahindra and Mahindra who actually manipulated the accounts, which is not in the best interest of the shareholders. The shareholders have not told him that to alter the annual reports to impress the society, to impress the governments, or impress the investors. It was not in the best interest of stakeholders. Right? Same holds true with Malya. When he was in the position to take key decisions to the business, when the shareholders choose him as the CEO or a board member of a particular group, he is not supposed to take the decisions that will harm the interest of the shareholders. Right? There are so many cases where agency problem arises, and it's very damaging to the business. When this kind of situations arises, there will be survival question. Business may survive or it may just vanish, because when there is a compromise to the best interest of the shareholders. That is agent and principal relationship. In agent and principal relationship, agent is hired by principal, and principal pay rewards to agent for the work, for the duties performed by the agent. But when the agent is not impressed about the rewards that he would expect from principal, he may find other routes to increase his financial rewards. And that's when he'll get into the agency problem. Now, this is the time to understand the financial system. So, why we need to discuss about financial system when we talk about financial management of a business? We need to understand business is part of the system, and finance is very much connected with the financial system. A business is a part of the entire ecosystem of a country, right? So we need to understand the financial system, how financial system of a country is functioning, and how a business is connected to the financial system. A financial system of a country can be broadly discussed under three areas: financial instruments, financial markets, and financial intermediaries. It may be any country. It may be for India. It may be for any country. But these are the areas when we can discuss the financial system. Let's understand what are financial instruments. What are the financial instruments we talk about, and how these financial instruments are relevant to the business. Financial instruments are the assets for a business or for any entity. These financial instruments will have economic value. That's very important. They'll have economic value, and these financial instruments are traded in the market. It may be in the exchange, or it may be in the over-the-counter market. It may be traded on a listed stock exchanges, or it may be traded in over-the-counter environment. Financial instruments will have legal validity, legal tender. That's the reason these are considered as instruments, especially financial instruments. These instruments can be real or virtual. It may be intangible asset, or it may be a tangible asset, tangible instrument. It may be a long-term instrument, or it may be short-term instrument. It may be a long-term instrument like share, or it may be a short-term instrument like T-bill, the treasury bills issued by Reserve Bank of India. Right? Now, what are the financial instruments we talk about? Financial instruments may be equity shares or debentures, bonds, preference shares, certificate of deposit, mutual fund, T-bill, or receivables, any of such instruments. But what we need to understand, these instruments can be classified into two categories, where short-term and long-term. Anything that is invested, any instrument that is traded for less than 1 year is a short-term, which beyond that is a long-term, in a generic understanding, right? So debenture is traded for long-term. It's used for 5 years, 10 years, longer term. Bond, right? Debenture is long-term. Bond is long-term because it is traded for more than 1 year. Preference shares, long-term. Certificate of deposit, again, it depends, but considered as long-term. Mutual fund, long-term. T-bill, short-term. Receivables, short-term. Equity shares, long-term. Right? So equity shares are traded, equity shares are issued to the shareholders, and it will be maintained for longer duration. Now, the financial instruments can be viewed under two broad umbrella terms: money market and capital market. Money market is, as I mentioned, money market is for short term, less than 1 year. So it may be T-bill, right? It may be certificate of deposit, right? It may be promissory notes, commercial papers, bank acceptance, or repurchase agreements. Capital market, long term, debt, equity, or derivatives. Debt instruments are entitled to receive fixed interest. Equity holders are entitled to receive dividend. Derivatives, again, it's profits, right? So higher profits. Dividends, when we say derivative, the derivative may be forward contract, futures, options, or swaps. These are the common derivatives that are traded in the market. So these are capital market instruments. So money market instruments, capital market instruments. Now, financial markets. We understood the financial instruments that are traded in the market. Now, what are the financial markets? Financial markets are the marketplaces where the people or the individuals buy or sell the financial instruments. So whatever the instruments we have discussed so far, those instruments are bought and sold in the market. And this is the platform. Financial markets are the platform where we can buy or sell the instruments. What are the financial market that we can see generally? It may be a debt market where only debt instruments are traded. Equity market where all equity shares are traded. Primary market, that's also called as IPO, right? IPO. Secondary market, exchange traded, right? So exchange traded. OTC, over the counter market. Cash market, daily transactions, right? So daily, the banks are borrowing between the banks. Banks within the group will borrow from each other for short-term requirements. So commodities market, where commodities are traded. Money market, where all short-term financial instruments are traded, less than 1 year. T-bill, certificate of deposit, all those instruments are traded in money market. You cannot see these markets in isolation, in generally, because many times these markets are overlapping. For example, equity market, secondary market, primary market, right? And money market. These instruments are traded on a particular stock exchange, right? So these secondary instruments are traded in stock exchange. Money market instruments are not traded in the stock market. They're not traded, right? They're available with the parties. So money market instruments, for example, T-bill, certificate of deposit, right? All those things. Financial intermediaries. So who are financial intermediaries? Financial intermediaries are the parties who enable trading activities. So they are the people who actually bring buyers and sellers together. They facilitate the trading activities. For example, the brokers on stock exchange, right? So these brokers enable investors to trade or invest on particular shares, to buy or to sell and they are the intermediaries. So who are the intermediaries generally that you can see in the market? It may be banks. Why bank is considered as the intermediary? Because they borrow from those who are having excess money. They'll lend it to the people who are actually in need of money. So they come these two people together and they'll connect them. Insurance companies, pension funds, mutual funds, investment banks, stock markets, and agents and brokers. Remember, all these parties are regulated. Banks are regulated by Reserve Bank of India. Insurance companies are regulated by insurance authorities, IRDA. Pension fund is also regulated by pension authorities. And mutual fund, again, it comes under SEBI. Investment banks regulated by SEBI. Stock markets regulated by SEBI. Agents and brokers, definitely they are regulated from SEBI. What is SEBI? Securities Exchange Board of India. It's a watchdog of capital market. Security for investments in business. Now, it's very important to understand the security, how secure the investors are in business. There are various investors in the business. There may be equity shareholders, bond holders, there may be creditors. There are various categories of investors to a business. Now, the question comes, are all these people equally safe? It's very important to understand not all these people are safe, and there are priorities for each of these categories of investors who are saved first when there is something wrong with the business, when the business is approaching bankruptcy. Creditors, bondholders, preference shareholders, and equity shareholders are common people, common investors for a business. At the same time, there are various other categories of investors who actually invest in a business. Now, let us understand who is safe in the business and to what extent they are safe. What is the ranking of their investment safety? This we will understand with a simple example. It will be a very funny and interesting example to understand who is safe in the business. I hope this will help you understand who is safe, who is more safe in the business. Let us take this flight example. The flight is flying high in the sky, and it is a very reputed flight where hundreds of passengers are traveling in this under different categories of seating arrangements. Consider there is something wrong in the engine, and the flight is at risk, right? The flight is about to crash, and pilots get to know that there is some problem, and they'll announce that there is a problem in the flight, and the passengers are expected to jump out of this flight with parachutes that are provided at the exit door. And remember, there are only 4 categories of people who are traveling in this flight. First class, business class, then economy class, and coach plus. Okay, and this is the exit door. Okay, and exit door is here. This is the exit door. Now, when there is some problem with the flight, who will be saved first? That's a question. Is coach plus people allowed to exit the flight first? The answer is no, because their seating arrangement is far behind to the exit door, and those who are sitting close to the exit door are supposed to be allowed to exit first, because they can quickly exit the flight and they can allow space for business class people and then economic class people and coach plus. Otherwise, there will be unwanted juggling between these passengers, and there will be some other problem later. Right? To avoid that situation, the first class people are allowed to exit the flight first with the parachute, and then the next class of people, business class people and economic class people and coach plus. Right? Now, let's say there is some problem with the flight. The first class of people will jump out of this flight first because they are sitting very close to the exit door. This is the situation with the very common situation where the flight is going to crash or flight is going to have crash landing. Right? Now, let us try to understand the same example in business perspective. Consider this flight is a business flying high in the sky, doing great, and it is doing fantastic, right? And the business is generating a lot of profit, and something goes wrong. Something goes wrong, and the business started declining. And there are various categories of investors to this particular business. Who are those investors? Loan holders, bond holders, preference holders, and equity holders. Now, let us consider the business is at the bankruptcy. Now that business is going to crash. Who will be saved first? Remember, loan holders are the people who will be saved first. Okay, debenture holders. When we say loan holders, debenture holders are saved first. They are allowed to exit the business with their stake. Then the bond holders, and then preference shareholders, and then equity shareholders. This is the order in which they are saved. Let us assume the loan holders, bond holders, and preference holders will get their stake, get their money back from the business, and they'll exit the business. If there is something left over, will be given to equity shareholders, else equity shareholders will incur loss. Okay, and that is the reason we say equity is risky, loans are less risky. The loan holders will receive fixed rate of interest no matter how the business is doing. Equity shareholders will receive dividend, the profit, based on the performance of the company. So when there is something wrong in the business, loan holders saved first, then bond holders, and then preference holders, and then equity shareholders. So here is the quick recap of what we have learned so far in this video. Finance is all about money. It talks about cash, bank, investments, savings, forecasting, borrowing, investing, and budgeting. And there are various other aspects as well. So what are the broad areas of finance? Personal finance, business finance, public finance. Financial management is an art and science of managing money to meet predefined objectives. We have understood why it is science and why it is an art. We have understood what are the goals of financial management: profit maximization, wealth maximization, and improving market share. These are the three important goals of financial management. There are so many other goals, but ultimately all other goals will boil down to these three important goals of financial management. Then we have understood who are the stakeholders to the business. We have understood the stakeholders to the business may be internal stakeholders to the business, or it may be external stakeholders. Who are those internal stakeholders? Maybe board of directors, employees, right? Shareholders, right? They are the internal stakeholders to the business. Who are the external stakeholders? Creditors, bondholders, suppliers, customers, media, right? Society. So these are all external stakeholders to the business. Financial management. We have understood the scope of financial management. We've discussed investing activities, financing activities, and dividend activities of financial management. So finance extends to these areas. And we have understood the principal and agent relationship, agency theory. So what is principal and agent relationship? It is an arrangement where one entity lawfully selects another person or an entity to act on behalf of the principal. So agent and principal. Financial instruments, financial markets, and financial intermediaries are the constituents of financial system. And lastly, we have discussed how safe the investments in business, who faces higher risk and who has less risk in the business. So that's all in this video. I hope you all enjoyed these videos. Thanks for watching. All the best.
Hello, welcome to the introductory session on corporate finance. My name is Pawan Kumar Chandrappa. Corporate finance is not a new subject. The subject has its roots way back in 15th century. But the subject started gaining traction only by 1900, especially after the mid of 50s. Earlier, the subject was discussed as a section, as a part of financial accounting. But now, the subject has grown so big, which requires a minimum of 1 year to understand the length and depth of this particular subject. So it largely discusses about the time value of money, one of the building blocks of financial management, the sources of funds, the mergers and acquisitions, capital structure, raising capital, financial derivatives, and capital budgeting. So in this session, we are not going to cover all of this. We are going to handpick some of the important topics that are prevalent in corporate finance. So in this session, we'll be discussing about what is corporate finance decisions, capital budgeting techniques. We'll be discussing about the capital structure and mergers and acquisitions. What is corporate finance? If you ask this question to different individuals, you would get different answers. Some people may claim that corporate finance is a part of financial accounting. Some people may claim that it is just an extension of financial accounting, or it is all about the financial modeling. Or some people may say that it is all about investment decisions and capital budgeting techniques. Though all these answers are correct, but none of these answers are giving you an appropriate picture of what is corporate finance is all about. Before we dive deep into understanding what is corporate finance, let us quickly take a real-time example, a real-time daily life example, so that it gives you a perspective. Let's assume that you want to start a business. Okay, so you want to start a business. Let's say it is a small manufacturing firm you want to start. With a limited number of employees, you want to start your business. What is that you need? What is that required for your business? It would be the idea, which is most important and the first important thing. You need to have a business idea. A business idea, when I say business idea, it would be a practical business idea or a feasible business idea, right? Then what else we need? We need skills to perform duties to succeed in the business. What else? The most important ingredient for business is money. Money is required for virtually everything in business. When we say money is required in the business, it would be for various reasons. For example, it would be to pay your suppliers, to buy raw materials, to pay your employees, to pay the stationaries, to pay the rentals. It may be for any reason. Now, money is required, inevitable for business. We need money. Without money, we'll not be able to start the business. Technically, it is not possible to start a business. But where do we bring the money? A businessman can find various routes to find this money, right? Because this money is not available free of cost. This is not in abundance. This is a limited resource which is coming with cost. For example, if 10,000 rupees need to be received from some external sources, it would come with its own cost. Now, when we say the money is important for a business, the same thing is true with a corporate also, with a multinational company also. They also need money for various reasons. For example, to pay day-to-day operations of the business, to take care of daily expenses, to pay salaries, right? To pay service providers to import raw materials from various locations, to pay the rentals of the buildings, the assets, to pay off the existing loans, or it may be to acquire new assets. It may be any of these reasons. So, in that context, corporate is business, finance is nothing, it's all about money, a corporate finance. So, now let us understand the definition of corporate finance so that it gives you a right perspective about what it is all about. Corporate finance is a broad area of finance that discusses about the sources of funds and the application of funds and the strategic decisions that finance manager take to increase the value of stakeholders. When we say the sources of funds, that means from where a businessman can bring money. What are the sources available? What are the options available to raise funds? When we say the application, right? The application of funds. When we bring money into the business from various sources, how these funds have to be utilized, how these funds have to be allocated for optimum results. In business, every choice that a business makes has financial repercussions or consequences, and any decision which touches the finances of a business is all about corporate finance. Largely, all that a business does comes under the rule book of corporate finance. Now, let's understand the goals of corporate finance. Why the corporate finance is, demanded so much, why it is growing to become a separated division in every corporate, why companies are having their own corporate finance divisions, why it is so important. Survival of the business is one of the most important goal of corporate finance. Corporate finance focuses more on the survival of the business rather focusing only on the profit maximization. Because when the business is able to survive during the tough conditions, the business will ensure it will take care of profits in the better conditions. And I think that is the reason why companies have been focusing more on survival even now during the COVID pandemic, the ongoing pandemic. The business firms, the corporates have been focusing more on survival than focusing more on profit. I think that is the reason the companies have been focusing on cutting cost, cutting expenditure, cutting the salaries, cutting the infrastructure cost, and cutting their employees, right? So they're focusing more on the survival. The corporate finance focuses more on the survival of the business rather focusing only on profit maximization. Beating competition is another important goal of corporate finance. Beating competition in the sense when a business is running, it is not running alone, right? So every business will have alternative, every business will have competitor, every company will be having competition in terms of price, quality, quantity, market share, geographical market share, and in all other aspects. So beating the competition is another important goal of corporate finance. Maximizing sales, maximizing market share are the goals of corporate finance. Every company prefer to maximize sales, thereby maximize the market share. Every company wants to become number 1, 2, 3. They want to be ranked first in the market. So every company strives towards that, and corporate finance goal is one among corporate finance is focusing more on maximizing the market share. Minimizing the cost is another important goal of corporate finance. So every attempt of the business should be focused towards minimizing the cost, maximizing the results, minimizing the cost, maximizing the value for the business. But everything ultimately boils down to maximizing the value of stakeholders. So that is the ultimate goal of corporate finance. So maximizing the value of stakeholders. When we say the stakeholder, who is the stakeholder? The stakeholder is the person or a group of persons who are interested directly or indirectly in the business, who have active or inactive roles in the business. They may be internal or external to the business. Who are the external people who are interested in the business? Who are the external stakeholders to the business? They may be customers, they may be current customers or the past customers, or they may be the potential customers who are about to buy, about to become your customers. The suppliers, people who are actually supplying raw materials and other, the basics for manufacturing or services. They may be creditors, people who have given money to a business, the investors who are interested in the business, the tax authorities. The tax authorities are the people, the tax authorities will always be interested in business because they expect every business to pay tax according to the law of the land. The media continuously and closely monitors the functions and the operations of the business. The government agencies will also monitor the activities of business. So these are the external stakeholders to any business. Now, who are the internal stakeholders to the business? They may be shareholders, board of directors, employees, managers, auditors, or legal consultants or tax authorities. So these are internal stakeholders to the business. Now, let's understand corporate finance decisions with a small example. Let us consider a company is planning to spend 10 million for acquiring new assets if the proposed business project is approved by the client. So what are the corporate finance decisions to be taken in this case? A company is planning to spend 10 million for acquiring new assets considering a new business project. So what are the corporate finance decisions in this case? Should the project be accepted or rejected? What is the expectation of investors? Whether the investors are looking for profit or they're looking for capital gain. What are the cash flows from the project? So when the cash flows are expected to begin? How long the cash flows are expected to continue? When the project would break even, when the business would reach no profit, no loss zone. Break even is nothing but no profit, no loss zone. That means this is the point at which the total cost incurred by the business and the total revenue generated will be equal. And beyond this point, the business will start generating profit. Until then, it was a loss, and after that, it would be profit. But the break-even point is no profit, no loss zone. If this project is not accepted, how company can utilize 10 million? And what is the opportunity cost involved in this particular project? Opportunity cost means the cost incurred by the business by taking this particular project. If this project is not accepted, what else the business would have accepted? To explain this particular topic, opportunity cost, I would like to take a small example. Opportunity cost. Let's say there is a popular lawyer in a city. Let's say he's a civil lawyer. He's too good in handling civil cases and is very popular. At the same time, the lawyer is very good in typing. So most of the time, he prefers to take care of his typing activities by himself. So in this case, what is the opportunity cost? Just because the lawyer is too good in typing and is too good in law profession, he should not be going towards typing. That means he should not be spending too much of his precious time in typing, because his time is more valuable in law profession than in typing. Instead of spending so much of time on typing, he can just hire an accountant or typist who can just take care of typing activities, and the lawyer can pay the minimal salary to the typist, and focus more on law profession to earn more and more business projects, more and more, cases. Not the business projects, it's a cases, right? So that is opportunity cost. What is the cost incurred by choosing an alternative? What is the dividend payout plan when the company is planning to pay the dividend? Whether the company is really interested in paying dividend, or they just don't want to pay the dividend, rather they just want to make it a capital gain for the investor. Now, let us understand the nature of corporate finance decisions. What are the typical characteristics of corporate finance decision? Long-term orientation. The corporate finance decisions are taken from long-term perspective, and the decisions taken will have long-term repercussions. The decisions taken under corporate finance will have long-term goals. Most of the time, the corporate finance decisions will not focus too much on the tactical activities or day-to-day operations of the business. Rather, they focus on the long-term goals of the business. That may be creation of value, maximizing the profit, maximizing the wealth for the stakeholders. So all long-term orientation. Decisions on the large investments. So it largely discusses about how the large investments can be brought into the business. Okay, so what kind of investments can be brought in, what is the cost to be incurred, to bring that particular fund. So the large investments, where to invest money, from where to bring money to the business. So this is all about that. Impact on the financial results. The decisions taken under the umbrella of corporate finance will have, the financial repercussions on the business. It will directly hit the top line or the bottom line. It may be the gross profit or the net profit. High notch of risk. The decisions taken under corporate finance will have high element of risk, because every decision will have its own consequences. It will be like a double-edged sword. So either way, it would hurt the business. Sometimes it would bring benefits, but most of the time the decisions taken under corporate finance will have, the risk. Irreversible in nature. Like once the decisions are taken, it cannot be reversed. The business cannot reverse the decision. Once it is taken, it is done. So the business can just expect the consequences or the results. That's all. They cannot reverse it. So now we will focus more on the factors influencing the capital structure decisions. So on what basis companies choose a particular source, whether it is a debt or equity, on what basis they choose. The factors influencing the capital structure decision, can be broadly classified into three categories: economic factors, industry factors, and company specific factors. Okay, so now let us first understand what are the economic factors, economic specific factors. Nature of the business. Okay, so the nature of the business will have bearing on the capital structure of the business. For example, if the business is, FMCG, okay, so FMCG, the cash conversion cycle will be the quicker. Okay, so if the cash conversion cycle is quicker, they can go for, the debt. Okay, when they have the problem with cash conversion cycle, they have longer cash conversion cycle, so then they can go for equity, because equity capital is important when when the business is oriented towards the long run. Okay, so they cannot do the things in a matter of fortnight, or they will not be able to do anything in the matter of 1 month. They take unusual time, they take longer time to convert their cash. into cash, back into cash. Okay, so cash, raw materials, finished goods, inventory, and then cash. So stock market. When the company is listed with the stock market, generally they tend to have equity orientation because they have access to equity capital. So they prefer to go for equity rather going to the debt capital. Taxation. When it comes to taxation, as I said in the previous slides, so interest paid on the loans will be tax deductible. Okay, so there is a tax advantage, linked to the debt source of capital. So when the company is preferring to enjoy the tax benefit, they go for the debt capital. If no, they'll go for equity. A rate of interest. Okay, so as I said, the rate of interest for debt will be comparatively lesser than the rate of interest that rewards you are supposed to pay for equity holders. So in that case, the companies will go for the debt. If they're okay to pay higher rewards to the shareholders, they'll go to equity. Credit policy. Okay, so what is credit policy? What is the credit terms given to the customers? Okay, so sometimes the companies are very liberal. Okay, there is something called net 30. Okay, there is something called net 60, net 90. Okay, so what is this? This is nothing but this is the time given to the the debtors. Okay, so debtors are cleared in 30 days, 60 days, or 90 days. Let's say the FMCG, let's say the FMCG company is giving products to the seller. Okay, they're allowing this the shop, the middlemen, to pay within 30 days or 60 days or 90 days. Okay, so 30 days is the given time. So 60 days, within 60 days they can pay. Within 90 days they need to pay. Okay, so this is the credit policy. So this they're giving the credit policy, net 30, net 60, net 90. So they're liberal. Some companies will go for net 90, net 60. Within today they're buying the products. Within 90 days they have to pay the money back. Okay, some companies 60 days they'll give, some companies will give 30 days. It depends on the business. Seasonality. What is seasonality? If the business is seasonal, okay, so they'll go to, for example, in the rainy season they produce woolen blankets or whatever. Okay, in the winter season, so they'll go for the debt funds. Okay, because their business is seasonal. After the season they won't be having any business, so they're very seasonal in nature, so they'll go for debt capital. They'll ignore equity capital. Competition is another factor which decides the capital structure. Okay, so some companies understand that the competition level. If the competition is too high, they'll go for equity because the business is uncertain because of competition. So if they go for equity, they need not bother because the risk is shared between the shareholders. And if the competition is lesser or it is comparatively manageable, they'll go to the debt funds. Life cycle of the industry is another factor which actually having bearing on the the capital structure. And the age and size of the company. If the company is younger company, they'll go for, if the company is younger and small in size, if they're ambitious, they'll go for equity. Else, if the company is at the saturation level, they'll go to the debt. Okay, the form, the age of the company and the size of the company matters a lot. Okay, so if the company is younger and they're very ambitious, they prefer, because they're ambitious, they'll go to they'll go to debt capital because they're ambitious, they're confident of earning money. Okay, so they'll go to that. When the business is younger, they're not sure of earning. Okay, they're actually thinking about whether we are really able to make mark in the market. They'll go to equity because they understand the business is uncertain, they don't want to take the risk. Okay, so they prefer equity. Older companies will generally go to equity again. Okay, older companies, while they'll go to equity because they're in the saturation level, they know the business is going to saturate and they're confident that the risk is higher, they'll not go for equity funds. They prefer to go for equity because in equity the risk is shared. The form of the company, okay, it depends on the nature of the company. If it is a single owner company, it is a sole trading company, they'll have their own preferences. If they have partnerships, they'll have their own preferences. If they joint a company, they'll have their own preferences. Stability of the earnings. If the earnings are stable, they'll go to equity. Sorry, they'll go to debt because they're confident that they're able to generate the revenue, right? If the earnings are not stable, they'll go to equity because they are not sure of making returns. If their credit standing, if the company's credit standing is good, they'll go to debt. If their credit standing is in question mark, they'll go to equity. Again, the management's philosophy. If the management is, not interested in sharing the ownership and control on the business, they'll go to debt funds. If the company is open, the management's approach is open, and they like, ideas from all over. They like, they want to give control. They want to give stake to the, investors. They'll go to equity. So these are the aspects which generally influence the capital structure decisions. Now let's understand one of the most important topic in corporate finance, that is capital structure. So what is capital structure? Capital structure is nothing but it's a combination of various sources of funds. For example, let's say a business is running and it is requiring funds for various reasons. It may be to daily tactical activities, or it may be to take care of its long term, the goals of the business. So it requires money. Now, when business requires money, the business may borrow from various sources. It may be borrowing from debt funds, or it may be borrowing from equity sources, or maybe it may be preference capital, or it may be, considering the retained earnings, because there is something called retained earnings. For example, companies will generate profit year on year sometime. So what they do, instead of distributing everything to the equity shareholders and the others, so they retain one portion of the the profit, and they'll just retain with them for future requirements. It may be to emergency, or it may be to take care of the future projects. So in that case, the retained earnings will also be a part of capital structure. When you say the entire capital of the company is a bucket, okay, so if you consider this is the bucket of all the cash, all the sources of funds, so what is the proportion of each source, and what is the proportion of the source from which the company is borrowing or the business is borrowing? Let's say equity, debt, and retained earnings are part of the capital structure of a company. So what is the proportion of equity in the capital structure? What is the proportion of debt in the capital structure? Or what is the proportion of retained earnings in the capital structure? Sometimes companies will make a combination of both. Let's say 30% of the funds will be from the debt sources and 70% of the funds from equity sources, or it may be other way around. Equity plus equity will be from 30% of equity or 70% of debt. Okay, it depends on the company. So depending on company, this will be different. Now let's understand. Let's say there are two components. Okay, there is a debt capital, there is an equity capital. So what is the advantage of having debt capital in the business? So what are the advantages? Lower interest rates. Let's say a business is funded with debt capital, so the interest will be lower. Let's say there are 6% of interest paid on the loans, so 6%. And what if the same amount is received from the equity? Let's say, what is the interest rate, what is the earnings, what is the return expected from equity? It would be more than the debt rate, right? So it will be, equity will be more, expectation will be more in case of equity. Short-term needs. So debt funds are more suitable for taking care of the short-term needs. Tax advantages are there. If the business is funded with debt capital, it will be, there will be tax advantage, because this you need to remember, interest paid on the loan is tax deductible. Okay, interest paid on loans is tax deductible. Okay, very important thing. So that is one of the reasons why some companies will go for debt capital rather going for equity. Simple loan repayment, if it is a debt capital, the repayment schedule will be simple and straightforward. There will be no excess, no additional expectations. Once the the repayment schedule is decided, and that is what the company is going to repay every month or year or whatever, so on the regular intervals, so that will be decided, so business can have a clear idea of what is to be paid for the next month or the next year. So what are the limitations of having debt in the capital structure? Okay, so what is the minus, what are the limitations, what are the cons of having debt capital in the capital structure? Repayment risk. Okay, so when it comes to the debt, this has to be repaid. Okay, debt means loan. Okay, so the borrower will be obligated to pay this back to the the lender. So a repayment risk is always there, irrespective of your level of profit, the margins you're doing. So repayment has to happen. Bankruptcy risk, if something goes wrong in the business and there is a situation of liquidating the business, the the lenders, the debt holders should be paid first, which we will be discussing in a short time. So I'll be explaining how risky it is for the debt holder, for example, for how safe it is for the debt holder. So in case of debt holders, so debt holders will be paid first if something goes wrong in the business. So the business has to pay the debt holders first, and then the business need to take care of the remaining the lenders. Impact on the credit rating. Okay, when the business is unable to pay the obligations on time, the credit rating of the business will go down. So that is another risk for a business. Collaterals. If there is no collateral for the business, it is too difficult to raise funds through the debt funds. Generally, the debt capital is suitable under the following circumstances. Ready to make regular payments. When the business is ready to make the regular cash flow payments, in that cases the debt capital is suitable. If the credit scoring of the company is good, they can borrow money in the market, because the market will give the loans at affordable rates. If the business possesses collaterals, then they can go to debt capital. Now let us understand what are the benefits of funding a project with equity capital. Long-term orientation, because equity capital is long-term oriented source of fund. Okay, so this is not given for the short-term requirements, this is not given for operational activities, this is given for the long-term requirements of the business. The risk sharing and added value, because the shareholders share the risk of business to the extent or to the proportion of shares held by them. No regular payment to investors. Companies need not pay the regular coupon payment or interest payment to the investors. So only when there is a profit in the business, the company will pay the dividend. Otherwise, there will be no dividend, or there will be no repayment. There will be no regular payment of dividend. Then what are the limitations of equity capital? Share profit. Equity shareholders will have rights to get a share in the profit of the company, and they'll be the owners of the company to the proportion of shares held by them. And there will be a potential conflict, because there will be conflict. There will be chances of conflict with the shareholders, directors, and the other stakeholders of the business. And the last limitation of the equity is higher cost. Okay, the equity comes with higher return expectations. So the business may not be able to pay that much of cost, because it is higher, because they're going to assume higher risk compared to the debt funds. So they definitely expect higher returns. Equity capital is suitable under the following circumstances. So when the credit worthiness of a business is an issue, okay, so in that cases, the companies generally go for equity. When the business is ready to share the profit and control on the business, they'll go for equity funds. The company is ready to share the profit and they're ready to share the control. When the business is not confident of generating profits, when the business is uncertain, they'll go for equity because they don't want to take the risk of borrowing from someone and be under the obligation to pay the outstanding irrespective of the level of business operations, success of business operations. Ready to share the decision making control with the equity partners. Okay, when the business is ready to share the control over the decision making aspects of the business, they'll go for equity funds. Now, the third important decision is the dividend decision. Okay, so paying dividend. Generally, when the shareholder invests some money in the company, there are two expectations. Okay, so one, when the amount is invested in the company, when the person, okay, so invest money in the company, they expect two things. One, it is dividend. The second thing is capital gain. Capital gain. Okay, so some companies give both, some companies give dividend. Okay, so it is important. Okay, every investment in equity will have these two benefits, but in some cases some companies pay dividend and some companies don't pay dividend every year. Okay, though dividend is an expectation of an investor. For example, if I deposit 10,000 rupee in a bank, I expect 7% or 8% of interest to be given to me every year. If the same amount is invested in equity market, I expect 10 or 12% of return to be given to me every year. Okay, the 12%, what I say 12% is nothing but it is a expectation. Okay, not sure, expectation. And if bank is giving 7%, that is again an expectation. So these two things. So when it is invested in the company, they may give dividend. That dividend is nothing but this expected amount. This percentage of amount is coming. That means maybe more or less it will be my expectation from the company. And what is the capital gain? Let us say, yeah, I have invested 100 rupee in a company. First year, the company is giving me the dividend of 10 rupee. Okay, so what is my amount? So 10 rupee I'm receiving. So total amount is 1110. Okay, so I receive this amount. Okay, so 100. So 100 rupees I keep with the company, and the remaining 10 rupee I take it off. I'll enjoy this. Okay, this 100 rupees is again invested. Next year again, if it is 10%, then 10 rupee. Okay, plus 10 rupee. So this is the dividend part. Let us say I don't want to take this 10% from the company. I want to keep it. Okay, 100 plus first year 10 rupee plus second year 10 rupee. Okay, so 120 rupees will be with the company, and this is given to the shareholder when he liquidate his stake with the company. So that is called capital gain. Okay, so that is a capital gain. When you realize your stake, you will get that amount. Generally, some companies pay the dividend, some companies won't pay. There are multiple reasons for the same. Some companies pay dividend because they're concerned about the public. Because let us say investor invested 1,000 rupees in the business. Next year, it is not giving any yield. So what happens? The perception of the investor will be, it will be affected. For example, the investor would think that, what happened? I've invested 1,000 rupees last year, no return this year. What happened to my money? What happened to the business? What is happening in the business? So they'll be concerned. So just to avoid these concerns, business every year declare a dividend for the equity shareholders. Okay, so by declaring dividend, they give confidence to their investors, just that we are doing a good job in the market. We are able to generate money out of your money. So that is the confidence they are giving to the shareholders. In some cases, companies don't pay dividend. For example, in many cases, Apple don't pay their dividend. Okay, I'm not saying they never pay dividend, but they prefer not to pay dividend on regular intervals, like a frequent intervals, like year on year or quarterly on quarter, because there is two things. One, by paying dividend, you can keep your investors happy. That is one part. But at the second thing is, like, if business keep distributing the profit among the shareholders, what if there is a good investment opportunity for a business? When there is an opportunity, if there is no money with the company to invest in that particular business, so business will suffer, business will lose those precious business opportunities. So some companies retain these dividends and they reinvest. Okay, so this is called reinvestment. Reinvestment. They reinvest this money in the business, and they'll, earn more returns, and they'll satisfy the needs of their investors. Okay, so that is the reason some companies don't pay dividend, because they want to reinvest that money in profitable business opportunities. When there is no profitable business opportunity that is existing and the business has no such opportunities, what they do, they simply distribute dividends. Sometimes you need to understand, when the company is regularly distributing dividend, it doesn't mean that the company is doing great. Okay, they just wanted to keep investors happy. That's why they are doing this. In another case, if the company is not giving, the dividend at all, don't be happy. The company may be in problem, or the company may not be having money to pay you, right? So the company must have taken your money and invested in a business project. The money must have been freezed over there. So the business must have not got any money to give you. So that is also a risk. So it is not right or wrong, but business works according to their own strategy. So they definitely keep all these things in their mind. So considering, what if I don't pay dividend and what if I pay dividend? So they know the consequences of both. So they, keep the decisions on track. So that is about the dividend decisions. Now let's understand one of the most important topic in corporate finance. This is agency relationship, or principal agent relationship in corporate world. Most of the time, this becomes a serious problem in the corporate world, and sometimes the companies close down because of this particular reason. Okay, so before we dive deep into understand what is principal agent relationship in corporate world, let us quickly have a look at a simple daily life example, which would give you the right perspective to understand what is principal and agent relationship in corporate world. Let's say you have a car. Okay, you have a car, and there is some problem in your car. There is some noise coming out from the engine part of the car, and you prefer to go to the garage to test it, because you don't know, you're not from mechanical background, you don't know anything about that, and you want to take your car to the garage. Now you take your car to the garage and connect with the mechanic. You will instruct him to check the problem. What is the problem in the car? Because you're experiencing some noise coming out from the engine. Now, by giving this responsibility to the mechanic, so you're just asking the mechanic to just check what is the problem. You'll become the principal, because you're instructing. You are the owner of the asset. You are instructing to mechanic, and you are the principal now. Now, mechanic is accepting your order, and you need to work according to your best interest. What is that you asked? You asked him to check the problem in engine part. Now, it is the duty of the mechanic to check and tell you what is the problem. You should do that, because he is your agent. You are the principal, he is your agent. The duty of agent is to work according to the best interest, according to the best interest of the principal. What is principal expected? is the same thing you need to do. Now, if the mechanic do the same thing, he'll just check the car and he identify the problem, he let you know this is the problem, this is the exact problem. There will be no agency problem that arises between you and the mechanic. The principal and agent relationship is smoother. But most of the cases that won't happen. Let's say in this example, mechanic don't want to disclose the actual problem. He would come and suggest you to go for a costly repair work, which would cost you some 20,000 rupees, right? But the actual problem is just a minimal, it's a nominal problem which could have been solved by taking a repair work at, at least within 5,000 rupees. But now mechanic is trying to reap maximum benefits from this opportunity. He is not ready to work according to the best interest of the principal, that is you. Now he is working according to his self-interest. He is focusing on his self-interest. He wants to make money. Now the agency problem arises between you and the mechanic, the principal and the agent. The same thing happens even in the business. Okay, so in a limited company, in a private limited company, the shareholders hire the board of directors and managers to take care of the daily activities of the business, because shareholders, they'll not be able to take care of the daily operations because they are not specialized, they are not ready, they may not have time to focus more on the day-to-day activities of the business. They just choose board of directors or managers in the annual general body meeting, and they'll ask them to take care of the best interest of the shareholders and the overall business. Now, by doing that, shareholders will become the principals. Okay, they have become the principals. They're principals. Now, shareholders are hiring whom? They're hiring board of directors, or they're selecting board of directors. They'll choose some 5 to 6 individuals who can take care of the operations, the day-to-day activities of the business, or they can run the business on behalf of shareholders. These board of directors will become the agents. Okay, so they are the agents of the shareholders. So shareholders are the principal and board of directors are the agents. Now the duty of board of directors is to work according to the best interest of the shareholders. So what is that shareholders are expecting? Ensure the business generates enough of profit to take care of expenses, to take care of outstanding liabilities, to take care of future projects. That is the expectation from the shareholders. Now it is the duty of board of directors to ensure that the business generates sufficient profit, excess profit, so that the dividend can be distributed to the shareholders, the expenses can be paid to the to the stakeholders, or it can be the business can pay the tax, the business can take care of rest of the activities. If the business is not able to run, if the board of directors are not able to take care of the interest of shareholders, that's when the agency problem arises in the business. For example, in Satyam Computers example, Ramalinga Raju was he was supposed to take care of the best interest. He was in the board. So since being a board member, he was supposed to take care of the best interest of shareholders, but he did not do that. What he did window dressing of accounts. He manipulated the accounts, right? So because of that reason, most of the problems have been created for Satyam Computers, and ultimately it was had a lot of problems. So that is called the principal and agent relationship. Let's quickly refresh our memories, like what have we discussed so far. Corporate finance is a broad area of finance that discusses about the sources of funds and the application of funds. Every choice that a business makes has financial consequences, and any decision which touches the finances of a business is a corporate finance. Maximizing the value of shareholders or the stakeholders is the ultimate goal of corporate finance. Stakeholders to the business can be broadly classified into two categories: internal stakeholders and external stakeholders. Corporate finance decisions are irreversible in nature. Agency problem arises when agent fails to act in the best interest of his or her principal. So now let us discuss about one of the most frequently discussed topic in corporate finance, especially in investment banking. So these are the most commonly discussed topics all over the world. So when it comes to business, so the merger and acquisitions are recently discussed, and they've been given a lot of importance nowadays because the business firms have been embracing mergers and acquisitions for various reasons. So in this section, let us understand, so what are the reasons why merger and acquisition is inevitable or important or necessary for a business. Okay, so before we understand the detailed aspects of mergers and acquisitions, let us quickly understand, so what is merger is all about. What is merger? Merger, before we discuss about what is merger, I want you to go through these four important terminologies, or four important or strange terminologies that I've mentioned here. So you can see 2 plus 2 is equal to 5. Big fish eating small fish. Enemies become friends and friends become a single family. Two different flags unifying to raise a new flag. It looks very strange and the statements looks very odd, but I'll promise you that after the completion of this particular section, you will definitely find answers to why we have mentioned 2 plus 2 is equal to 5, and why big fish eating small fish, why it is mentioned here in this context. Okay, so let's move on first to merger. So what is merger? Merger is a process in which two or more business entities come together to form a new entity. In this process, both business entities cease to exist. Okay, so that's a definition of merger. So in merger, what happens? So two different individuals or two different companies come together to form a new company. Let's say there are two companies, right? So company A is a individual entity. Okay, so this is a company B is a separate entity. So these two companies will come together to form a new entity called C. Okay, so in this process, what happens? A plus B both will lose their existence and C will be formed. In this process, both A plus A and B companies will lose their existence and C will gain existence, and that will continue to run. And A and B will become history. Now, why companies generally merge? So what is the reason why companies come together and they merge? What are the benefits and what are the reasons why they merge? Generally, companies merge because of synergy benefits. Okay, so this is one of the most important term in corporate finance. Synergy. Okay, so synergy benefit. What is synergy? The performance of combined entity will be better than the performance of separate entities. See in this example, in the previous example, so the performance of A and performance of B, when they perform individually, it will be different, and when they come together, the performance of this combined entity will be different. So that is the reason you have seen that 2 plus 2 is equal to 5. Let's say the performance of company A is 2, okay, and the performance of company B is also 2. But when company called C is formed, the performance of company is 5, and this is nothing but this is the synergy benefit. Okay, so with the performance of combined entity will be better than the performance of individual entities, and that is the reason we have mentioned that 2 plus 2 is equal to 5. And when the companies come together, when the merger happened, these are the benefits they gain, like market reach. When the companies come together, they can reach the marketplaces of each company. For example, company A and company B. Company A is strong in Asia, company B is strong in Europe. So when they come together, company B can have access to company A's market, and company A can have access to company B. So they can perform and they can access the market of each other. Reduced cost. When the companies come together, the cost of operations will drastically come down because the performance of combined entity will be better than the performance of individual entities. The competition will be eliminated. For example, let's say company A and company B are competitor in the same market, okay? In the same FMCG market. Let's assume that they are into FMCG. And let us say there are other companies like company P, okay, company T, small companies. Now, when company A and company B come together, and those two companies are the market leaders in this FMCG segment, and when they come together, there will be no major competition. Okay, so they can create a kind of control in the in the marketplace. They can capture the entire majority of the market, and they can rule the market for a definite period of time, or maybe indefinite period of time, because the company P and company D or whatever, so they're very small, they're not strong enough to compete with company B and company A. But when company A and company B come together and they form a company called company C, right? Company C. So company C is much bigger than company B, company A and company B, and companies P and company D. So the performance of this company will be better than the performance of company A, B, P, D individually. Okay, so they eliminate the competition this way. Now the growth. Some companies merge with some other companies because of growth requirements. When they really want to grow in the business, they go to the merger. Increase supply. Okay, so when they come together, the supply will be the higher the supply to the market. Let's quickly have a look at some of the examples for merger and acquisitions. Vodafone Idea merger, Flipkart's acquisition of eBay India, Tata and Bharti Airtel, Disney acquired entertainment assets of Fox, Verizon Yahoo deal, Google buying HTC's smartphone business, Cisco acquired Broadsoft, Johnson & Johnson acquisition of Acleon. So these are some of the examples for mergers and acquisitions. Let's see the example for merger and acquisition, the example for acquisition separately, but these are the common examples for the merger and acquisitions. And we will discuss the examples when it comes to the specifics of merger. Now, let us understand the classification of merger. So what is the classification? How the mergers are classified? Basically, the merger is classified into three broad categories: horizontal merger, vertical merger, and conglomerate merger. Let's understand each one of this one by one. Horizontal merger. So what is horizontal merger? In horizontal merger, two business entities operate within the same industry yet competitors to each other. Okay. For example, Amazon and Flipkart are into e-commerce business. Okay. So they're in the same business, the same industry, e-commerce, and they're competitor to each other. In Indian market conditions, environment, they're competitor to each other. Let us assume that, Amazon wants to acquire Flipkart, or the Flipkart wants to merge with Amazon. Okay, that is called, the horizontal merger. In reality, it may not happen, but I'm just giving an example that, when companies in the same industry, they come together to form a new entity, that is called horizontal merger. The best example for horizontal merger of Bank of Madura with ICICI Bank in 2000. merger of Centurion Bank with HDFC Bank. You can carefully observe this. The bank which is merging with ICICI Bank, right? So it is shown small compared to ICICI Bank. Same here, Centurion Bank is shown smaller than HDFC Bank. There is a reason for the same. For example, when it comes to ICICI Bank, when the companies come together, according to the definition we discussed just now, merger is something that, when both entity A and entity B will come together to form entity C. In that case, both the entities will cease to exist and the new entity will continue to exist. But in this case, in this merger, it is not the case. ICICI Bank, after the merger with Bank of Madura, it is still performing. The reason is, it was a request from Bank of Madura to get merged with ICICI Bank. Okay, so there was not an intention from ICICI Bank to acquire the Bank of Madura. Bank of Madura shown interest in merging with ICICI Bank. That's why the assets and liabilities of Bank of Madura have been merged with ICICI Bank. In this case, ICICI Bank continued to exist. Bank of Madura lost its, the presence, the footprint. Same holds true with Centurion Bank. Centurion Bank merged with HDFC Bank, and they've transferred all the assets and liabilities to the HDFC Bank. So this is called the horizontal merger. You can observe this. ICICI Bank, Bank of Madura, both are the banks and they're in the banking industry. Centurion Bank, right? HDFC Bank. So both are banks and they're from banking industry. They're merging. So this is called horizontal merger. So now let's understand vertical merger. In vertical merger, two business entities in different stages of production process, they come together and they form a new entity and they merge within the base entity. For example, let's say a car manufacturing company. Okay, let's say Tata. Tata manufacture cars using various components. In some cases it is they import glass, they import steel, they import fiber, they import tires, they import and many more items, right? So when they import so many items, sometimes they feel like instead of importing these components from different service providers, why don't we acquire that particular company and we reduce dependency on the externals. So in that case, companies acquire the company which is operating in the same production process, okay, in different stages. Tata Motors acquired an 80% stake in Trilix, an Italian design and engineering firm. So this is the example, okay. And Reliance acquired Flag Telecom Group in 2010, and that is another example for vertical merger. Conglomerate merger. The third important category of merger is conglomerate merger. So in conglomerate merger, the entities, the companies, the business firms which are merging will have no relationship at all. They'll be from different segments, they'll be from different industries. So they have no relationship within, but still they want to merge. So those companies show interest in merge. Okay, so they want to merge. They want to be part of merger process. For example, the merger of Tata and Sky. You know this. Tata is basically they're into automobile segment. Sky is into 21st Century Fox. 21st Century Fox is the company, the mother company, and they're into content distribution platform. They have no relationship at all, but still they come together to form a company called Tata Sky. Now we have understood what is merger. Let's move on to understand what is acquisition. Okay, so before we move on to the definitions and the explanations of what is acquisition, I want you to see an image which gives you an example, which gives you a hint of what is acquisition. You can see this, a big fish, right? So the big fish is eating the small fish, right? So big fish is eating the small fish, and this is eating another small fish. The same holds true when it comes to acquisition. An acquisition is a process of one business entity acquiring another one In this process, the acquired company ceases to exist while the acquiring company continues to exist. Okay, so in this example, so this is the big company, this is the big fish, this is the small fish. When this big fish, eat the small fish, this will lose its existence and the big fish will continue to exist. Okay, so that is called acquisition. The same holds true with big companies. Some big companies acquire small companies. And when they acquire, the small companies will lose their existence. The big companies will continue to exist and they continue to operate. Now, you must be thinking why acquisition happens. We have seen merger happens because of synergy benefits. Now, why companies acquire another company? Okay, when companies come together, they'll have synergy benefit, that is merger. Now, why companies acquire another companies? There are various reasons why companies acquire other companies. A few reasons are to obtain a specific product. Okay, when it comes to software companies, they acquire other companies just to acquire the software product. To increase the size, to obtain control over the critical resources in the market. Okay, so these are the reasons why companies acquire other companies. These are some of the important reasons why companies acquire. Now let's understand the classification of acquisition. So what are the types of acquisitions we see in real time? Acquisition by consolidation, acquisition of assets, acquisition of stocks. Now let's see what is consolidation, right? Acquisition of consolidation. In acquisition by consolidation, in this, the combination of assets and liabilities of two companies. When companies, they'll have their own assets and liabilities. Okay, so when they come together, they'll transfer their assets and liabilities, both. The best example for acquisition by consolidation, a France-based IT company Capgemini acquired Nasdaq-listed IT company iGate for 2,500 million in 2015 in India. This was an example for acquisition by consolidation. Now, the second type of acquisition is acquisition of stocks. Okay, so in this, by acquiring the stocks, a business can earn the control over the other business. Example is GIC acquired Nirlon, right? So Singapore-based GST acquired 63.9% of stake in Mumbai-based Nirlon company, and the value of the deal was 28 million. The third type of acquisition is acquisition of assets. In acquisition of assets, the bidder acquires all the assets of the target firm. The bidder may prefer acquisition of assets to avoid the target firm's liability. Sometimes it is not necessary that the acquisition of assets and liabilities is compulsory. Sometimes the acquiring company may anticipate to acquire only the assets of the company, not the liabilities, or they may acquire both assets and liabilities. It depends on the company which is acquiring the other company. They can choose, they can opt or not to opt for the acquisition of assets and liabilities all the time. Best example, Ola Cab acquired Taxi for Sure. This was 120 million deal. Now, let us quickly have a look at the advantages and limitations of mergers and acquisitions. Now, we have seen that, the examples for mergers and acquisitions. Now, what are the advantages and limitations of mergers and acquisitions? Why companies prefer to get merged with other companies, and why companies prefer to acquire other company? Why companies, like to be acquired by some other companies? Let's understand the benefits of mergers and acquisitions. Let's first have a look at the advantages of the merger and acquisitions. By merger and acquisition, the companies can increase their market share. Okay, so as I said, when the company is operating in Asia and other companies in Europe, and both are market leaders in Asia and Europe, when they come together, they can increase the market share. And in this process, they can reduce the cost and they can enjoy the economies of scale. What is economies of scale? When they produce the bigger quantity, the cost will come down. Okay, the cost will come down. That is called economies of scale. Access to new talent and technology. When companies come together, so they can share technology, they can share human resources, they can share the process, they can share the culture. Okay, so they have access to the resources of each company. They'll have access to each other. When the companies come together, it will be easy for them to face the competition. As I said, I have mentioned in the previous slides. So facing competition will become much easier compared to the competition that individual companies face generally. Access to new marketplaces and tax benefits. When companies come together, they need not pay tax twice. Okay, when they are working, when they are operating separately, company A and company B, they are supposed to pay 35% or 30% of tax according to the tax laws of the land. They are supposed to pay the tax. But when they come together, they'll not pay two times. They'll pay only one time. That is a tax advantage for the business. Now, what is the dark side of merger and acquisition? Why some companies prefer not to merge or acquire other companies? Creates cultural gap. When company A and company B come together and they want to merge, they come because company A's culture, the company's B culture may not be same. Okay, when they're culturally divergent, when they have difference in cultural aspects, it is difficult to consume. Company A employees find it difficult to adjust with company B's employees culture, and the same holds true with company B's employees. So that is one of the major reasons why companies prefer not to acquire or merge with some other companies. The job loss because of merger, the job loss happens. Exhaustive reskilling because the complete process will be redefined because both companies would have been following different process or maybe conflicting process, so they will not be able to understand the process of each other. So they'll be reskilled. Uncertain results. What happens after merger, what happens after acquisition is still a question mark. It is not that we'll not be able to explain how the results would be. It is just an anticipation, it is just a forecast. So the results of merged company, the acquired company, the new company will be very difficult to understand or very difficult to predict. So these are some of the important limitations of mergers and acquisitions. Now, we have mentioned that companies would prefer to merge with other companies and some companies prefer to acquire other companies. Now, what if the company don't want to merge with other company? Okay, so both the companies, let's say company A and company B, both are doing really good in the market. They have their own market share. They have their own client base, a strong client base. Now, the company don't want to merge with some other company, or the company don't want to face the competition. The company don't want to face the acquisition threat. So how they can defend themselves? There are various reasons through which companies can avoid mergers and acquisitions. Divestiture is one of the method through which companies can avoid merger. In divestiture, what happens? Companies generally sell off or close down some of their unproductive cost centers, unproductive business units, which brings unnecessary pressure, financial pressure on the company. And these unproductive units are the targets of the acquiring company. Some companies are looking at the company like they are observing that this particular cost center, this particular business area is weak. We can capture that and we can make their business strong. So that's the perception they have. So to not to give scope for such thoughts, so companies sometimes go for divestitures. The best example for divestiture is Thomson Reuters. They have tried this. They divested some of their unproductive, loss-making business units. They've sold it off and they've cleaned it. Okay, so by cleaning that business unit, they have removed the financial burden and also they have removed the attraction. Like the companies will not see at that particular business units. Spin-off. Spin-off is another method through which companies generally, avoid mergers. They defend against merger. In spin-off, companies establish a separate entity, separate business unit, and the shares of that particular new entity will be distributed to the existing shareholders. So that is spin-off. The example, PayPal. PayPal established a separate business unit, that is eBay, and they've given the shares of eBay to the existing shareholders of PayPal. Split off is another example how business can defend against the merger, right? So in split off, what happens, the entire business is split into various parts, and the shares of that particular segment will be distributed among the existing shareholders. General Electric and Synchrony Financials. This is the best example for split off. Golden Parachute. In Golden Parachute, generally, companies, avoid, merger using Golden Parachute. For example, they announce hefty packages to the existing, board members, and they put a condition to the acquiring company that immediately after the acquisition of the company or the merger of the company, the board members need to be, given that particular reward, the higher reward. And also, if those board members need to be removed from the board, and they should be given a, hefty compensations. Okay, so that will make, the acquiring company, they discourage acquiring company in that format. Crown jewels. What is crown jewels? In crown jewels, company, sold, like before the acquisition of the company, companies will sell their imported assets so that the deal will become unattractive for the acquiring company. Poison pills is another method for defending against merger. In poison pills, soon after the company hear that some other company is trying to acquire business, what they do, they simply borrow money from debt sources, and these debts are taken under the condition that soon after the merger, these debts to be repaid immediately. Okay, so this is called poison pills. White square. In white square, what happens when the company understand that there is some other company is trying to acquire this business? Soon after that, they request their friendly company to acquire some of the important portions, some of the important assets of the business, or take control over the business, some sections of the business. Yeah, these are the examples for each one of this, right? So in white square, that is what happens. And in white knight, what happens? In white knight, majority of the assets will be sold to the friendly company so that the deal will become unattractive. So that is the method companies generally use. White square and white knight, these are two similar methods, but the difference is in white square method, only a few assets will be given to the friendly company to protect, so that the control will be reserved with the friendly company, and the acquiring company will find it unattractive. In white knight, what happens? Majority of the assets will be given to the friendly company, and they'll have full control over the majority of the control over the business, and this will make the acquiring company, they discourage the acquiring company. Now, let us understand. Now we have understood what is merger and acquisition. Now let us understand what is the alternative for merger and acquisition. Joint venture is a best alternative for merger and acquisition. If the company don't want to merge or acquire another company, so they can go for joint ventures. For example, in joint venture, companies come together to form an entity for a specific reason, okay, for a definite reason, and this is for the limited duration. It is not going to be a lifetime activity. This is going to be for a specific reason. For example, State Bank of India and Bharti Airtel have announced a joint venture to offer banking services to consumers. So this is an example for joint venture. Another method, alliances. This is an informal arrangement In this, businesses come together to cooperate without the need of an equity component. So business come together to cooperate with each other without any financial stake. For example, ICICI SEC enters into a strategic alliance with AM Capital in 2015. Vodafone entered an agreement with ICICI Bank for M-Pesa. Another method which is available is leveraged buyout. Okay, so in leveraged buyout, company purchase and another company by a small group of investors will purchase this particular company, and this particular deal is largely financed through debt. So the debt is used instead of equity. They use debt to purchase this particular deal. Why this happens? Why leveraged buyout happens? This is to raise the necessary funds to acquire control from the existing shares and shareholders by issuing debt. As a result of the purchase, the control is left with a small group of investors and ownership of the company changes from public to private. An example for this is deal between Tata and Tetley. Okay, so they become Tata Tetley. So this was a deal. This was the biggest ever deal. It's a cross-border acquisition and also first ever successful leveraged buyout by an Indian company. So here is a quick recap of what we have learned so far. Corporate finance is a subdomain of finance which discusses largely about the sources of funds and application of funds within the business, maximizing the business returns while minimizing the cost and risk is the ultimate goal of corporate finance. In other words, you can say maximizing the value of stakeholders is the ultimate goal of business. Corporate finance decisions involve around capital investment, capital financing, and dividend decisions. NPV, the net present value, is the present value of an investment's expected cash inflows minus the cost of acquiring the investments. The break-even point is the level of sales or output at which the total cost will be equal to total revenues, and consequently, there will be neither profit nor loss. Capital structure of business refers to the sources from which the business financed its requirements. A merger is a combination of two companies to form a new company. The capital structure of business refers to the sources from which the business financed its requirements. So that's all in this course. I hope you enjoyed this course and I hope you learned. Thanks for watching. All the best. So one of the most important topic in this session is how secured are you? Okay. So when I said in business, things are uncertain. Okay, nothing looks safe in the virtually nothing is safe in the business because business is something that uncertain. We replace the word business with uncertain most of the time. Why? Because business always deal with uncertainties. Business always foresee the future. Okay, so they anticipate, they expect, they dream of making profit, they dream of generating returns, they dream of creating value. So now let us say in a business there are multiple investors, right? There are debenture holders, there are debt holders, there are equity holders, there are preference holders, right? So how secure are their investments in the business? This is very important because when we say the business is uncertain, if something goes wrong, whose money will be given first? Okay, let's see that with a simple example which will give you a clear idea of who is safe in the business at what proportions. This is a flight. Okay, assume that this is a costly flight, and this has got 4 class of seating arrangements. One is first class, business class, economic class, and coach plus. Okay, so let's assume this flight is flying on the sky. okay, and something goes wrong. Okay, you remember this flight has got only one exit door. Okay, so this is the only exit door. There is no other door for passengers to escape and save themselves. Okay, it may not be completely true in the real life, but I request you to assume, because I'm going to explain something which is very important. So this is the only exit door. If something goes wrong, who will be saved first based on the priority? Because these people are sitting very close to the door. These people will be, helped to exit first, because if the crew allow these people to exit first, there will be, there is a rush and there will be panic, and there will be chance of, people losing their lives just because they are in panic. Okay, just to quickly allow them to exit, the crew would allow the first class people to exit first from the from the flight. Once these first class people are released, these people are allowed to exit the flight first, the next level of people who will be allowed to exit the flight will be the business class seat people, and next will be economy class, and then the coach plus, so that all these people are allowed to exit the flight based on the priority. What is the priority here? The priority is only the thing is that, if first class people are allowed first, the second class people, the business class people can be allowed next. Okay, so that is a priority. So that's how people will be saved when it will be something, something goes wrong in the flight and it is about to take off, right? So it is about to burst or something. Now this is the flight was flying high on the sky. Something goes wrong, landed. Okay, so immediately after the landing, the first class people allowed to exit first, then business class, and then economy class, and then coach plus people are allowed if the time permits them. In this case, remember, first class people are safer compared to business class, and business class people are safer compared to economic class, and economic class people are safer compared to coach plus. And who is serving the maximum risk when it goes something wrong? Coach plus passengers, right? And who is more safer compared to the coach plus? First class people. Okay, the same holds true when it comes to the business as well. Okay, let's say this flight is a company. Okay, this flight is a company and it is flying high on the sky, and the company is doing really good, and unfortunate business is uncertain, something goes wrong, and who will be saved first in the company? It will be the loan holders. Okay, those who have given loans will be allowed first to exit the business. That means they will be given, in case of liquidation of the business, the loan holders will be returned their funds and then they'll exit immediately. Okay, so in the liquidation, if something remains, okay, the remaining amount will be distributed among the bond holders. So those people will be saved next after loan holders, and then preference equity holders will be given priority. If something left with the company in terms of assets or cash or any infrastructure, so any assets, they'll be given first. The preference will be given to the preference equity shareholders. After paying all these people, loan holders, bond holders, and preference holders, if something is the remaining in the business in case of liquidation, the amount will be given to the equity shareholders. So what you need to understand, the equity shareholders assume highest risk in the business, and the loan holders will assume the lowest risk in the business. Okay, so if something goes wrong, equity shareholders will have a lot of risk, and loan holders will have lesser risk. Okay, so this is the obligation for the company to pay off loan holders first, and bond holders next, and preference holders next, and equity holders. If there is nothing left over, there will be nothing to be paid to the equity shareholders, because the very basic nature of the equity is that the equity shareholders are the owners of the company to the proportion of shares held by them. So that is how the equity shareholders run the risk in business, and the loan holders enjoy that risk, the lesser risk in the business. Remember, for enjoying this, okay, so they'll be given a highest return when the company makes profit. Okay, I'm just writing an example. This is not a true amount. Okay, so these people will be given 12 to 14% of return. Okay, and these people will be given 6 to 7% of return. Okay, so these people, just because these people are assuming highest risk, they're given highest return, and these people are assuming lowest risk, the lowest return. The mathematics is quite simple. Okay, I hope you enjoyed this example. So this is how the investors are secured in the business. Quick recap: accepting all the business opportunities is not a wise decision in business. Payback period method discusses about how quickly a business can recover the initial investments. Net present value is the difference, the present value of cash outflow and the present value of cash inflow. Internal rate of return is the rate at which the present value of cash outflow is equal to the present value of cash outflow. The break-even point is the zone at which the total cost of the business is equal to the total revenue. Capital structure is a collection of various sources of funds for a business. To quickly summarize, we have discussed about the concept of corporate finance. We have discussed the meaning and the background of corporate finance. We have understood corporate finance is part of financial accounting and it is part of financial modeling. And this also discusses about how business acquires funds and how it utilizes them for maximizing the value for the stakeholders. And we have discussed about the goals of corporate finance. So what is the goal of corporate finance? The ultimate goal of corporate finance is to maximize the value of stakeholders. So maximizing the value of business is the ultimate goal of corporate finance. And we have discussed about the stakeholders to the business. So who are the stakeholders to the business? There are two categories of stakeholders to the business: internal stakeholders and external stakeholders. Internal stakeholders are those people who are internal to the organization. They are maybe they may be employees, or they may be managers, or the board of directors. They may be shareholders, or they may be internal auditors, or any other individuals who are internal to the organization. Who are the external stakeholders to the business? External stakeholders are those people who are external to the organization, but they have active interest in the business. For example, they may be creditors to the business, or they may be the suppliers, or they may be the customers or clients, or they may be the government authorities or tax authorities or legal consultants, or any other person or any other individual who is actively interested in the business. They may be the media, or they may be any other into external parties. So they're called the external stakeholders to the business. And also we have discussed about the nature of corporate finance decisions. So what are the typical characteristics of corporate finance decisions? So what is the nature of corporate finance decisions? For example, we have understood that the corporate finance decisions are irreversible in nature, right? So once taken, corporate finance decisions cannot be reversed. The business has to face the consequences, whether it is positive or negative. The business has to face the consequences if the decision is taken under corporate finance decisions. Corporate finance decisions are long-term in nature, so they allow long-term vision. The corporate finance divisions take the decisions for long-time perspective, and they'll not get into the tactical activities of the business. And the corporate finance decisions are risky in nature, right? So that is high risk decision taken under the umbrella of corporate finance decisions. So every decision taken under corporate finance decisions will have a risk element in it. And we have discussed about the agency relationships, right? So what is agency relationship? This is the relationship arises between the principal and agent. So the principal is the person who actually instruct the agent to act on behalf of his or her best interest. So when the agent and principal work together, the agency problem doesn't arise. And when the agent does not take care of the best interest of the principal, the agency problem arises. So we have discussed about that in detail. I think you are able to remember the example we have discussed about the mechanic and the car owner. So that is the best example for understanding the agency relationship. Corporate finance decisions. We have discussed about the corporate finance decisions. The corporate finance decisions are broadly classified into three categories: investment decisions, financing decisions, and dividend decisions. And we have also discussed about the capital budgeting techniques. So this is part of investment decisions. We have discussed the capital budgeting techniques. So we have discussed the four important capital budgeting techniques: the payback period, net present value, and we have discussed about internal rate of return, and also we have discussed the break-even point. So what is payback period? How quickly the business is able to recover the initial cost. So that is the discussion under payback period. And we have discussed about the net present value that reflects the whether the cash flows received are positive or negative in nature. Okay, if the cash flows received at the end of the duration is positive, we accept the project, and if the cash flows are negative, we reject the project, and if it is zero, we still accept the project. And also we have discussed about the internal rate of return. What is internal rate of return? Internal rate of return is the rate at which the present value of all the cash outflows are equal to the present value of all the cash inflows. So we calculate internal rate of return, that is a percentage, that is the interest rate we calculate to understand at what point the present value of cash inflow are equal to the present value of cash outflow. And also we have discussed about the break-even point. What is break-even point? Break-even point, that this is the point at which the total revenue is equal to the total cost. So every business dream to reach, they'll have a dream to reach this particular point. The moment they reach this point, there will be no profit, no loss. And beyond this point, the companies can start enjoying the benefit of profit. And also we have discussed about the capital structure. We have discussed how the capital structure of any business is formed. We have taken an example and we have explained about that. We have discussed about capital structure with debt, equity, preference, and retained earnings. So sometimes companies will prefer to go for debt, and sometimes they prefer to go for equity, and sometimes they prefer to mix both of them in different proportions. And the last topic we discussed in the course is the merger and acquisition, one of the most important, the trending topic in corporate finance. So why companies merge? What is the merger and what is acquisition? So generally companies merge or acquire other company because of synergy benefit, and mergers or acquisitions are happening because of various benefits they carry. So mergers and acquisitions have started long back, and now in most of the cases we hear about mergers and acquisitions. We hear about these two terms more frequently because setting up a business is the most complicated task. So once it starts, there will be a lot of challenges. So companies prefer to go for acquiring or merging with some other company rather than setting up a new business. Or even the individuals, instead of starting a fresh business and building the base for the business, they prefer to acquire the business which is already running in the market. So that's all in this course. I hope you all enjoyed this course. I hope you learned, and now you'll be able to apply these topics in the real life. Thanks for watching. All the best.
So in this session, we are going to discuss about the first one, the basics of Tally. That is the introduction to Tally, how to download the Tally or how to set up the Tally features and what are the key features of Tally. All those things we are going to discuss in this particular agenda point. So next we are going to discuss about the overview of financial management in Tally. So with the financial management, how can we include Tally software and how can we get the whatever the financial management purpose objectives we can reach for the particular organization, that we are going to discuss. And then we are going to discuss about the Tally for budgeting and planning. So what do you mean by budgeting, or what is the types of budgets and how they are going to create budgets using the Tally, and how to plan, that is forecasting the future budget, that we are going to discuss. And then we are going to discuss about Tally for cash flow management. So in financial accounting also we are going to do the cash flow statement, correct? Right? Like that only in the financial management, the cash flow, how the cash inflow and outflow of the organization, okay, they are going to manage, that we are going to discuss. After that we are going to discuss about Tally for financial control and security. So how to control the finance in the organization and how to secure the data, financial data in the organization with the tally. That we are going to discuss. Next, we are going to discuss about tally for tax management. So in this, we are going to discuss about how the tax management we are going to generate the reports, filing the e-returns or the GST reports, all those things using the tally. Okay, that we are going to learn. Next, we are going to discuss about the overview of financial management in tally. So how we are going to consider the tally software using for the financial management activities. Okay, first we will learn about the what you mean by financial management, or how to manage the finance in an organization, how important it is. Okay, that we are going to discuss first. Introduction to financial management. So financial management refers to the strategic planning, organizing, directing and controlling of financial tasks within an organization to achieve its objective. So the word only indicates the word financial management, correct? So finance is nothing but the money or monetary terms. How we are going to manage, that is inflow and outflow of cash or the money managing in an organization. How to plan or how to manage the fund means first we need to plan how much inflow we are going to expected for this particular year or for this particular quarter or for the particular month. Based on that, how much we need to spend as an expenses or for the promotional activity, purchasing the raw material, salary, other things, and how much we need to invest on others. That is like securities or real estate or any other investment avenues the company can invest, that they need to think, correct? That is the planning. Next, once we plan, next we need to organize. So what are the sources of income is available for our particular company, which is offering less rate of interest for the organization. So based on that, we need to organize the funds for the organization. Next, directing. So we already planned, correct? How much fund we need to invest on the particular real estate or for the purchasing the any fixed assets or for the salary, rent, other things, correct? So based on that, we need to allocate the fund. Then we need to control over the funds. So if you don't have the control on the funds, then it's not going to whatever the your plan or for the estimated budget, that won't be possible, correct? So on that time we need to control over the financial task with an organization. So why we need to do this, all this planning, organizing, directing, controlling means we need to achieve the organizational goal, the company's goal or the common goal of the organization. To achieve that, these are the few steps we need to follow for the financial management. It involves managing financial resources effectively to ensure the organization financial health and sustainability. So this financial management is going to give the brief about the how financially healthy that company is or how sound financial position they have in the organization. So after the meaning of financial management, we are going to discuss about the what are the key activities of financial management. That is the one or the other activities they are going to conduct in this financial management, right? So we'll discuss one by one. So first one is budgeting. So budget is the nothing but what is the estimated cash inflow and outflow for the particular year or the particular quarter or for the particular month. That we call it as budget. So if, for example, I have an estimation of getting the revenue of 1 crore rupees and at the same time I need to spend at least 80 lakhs of rupees for the whatever the expenses and the payments. That is the approximate we are going to create as a estimated budget, correct? That is the budget. That is also one of the activities under the financial management. Next, cash flow management. So managing the fund in the organization. That is the financial management, correct? So the inflow and outflow of the cash. For example, I am getting the 10 lakh rupees of amount as an organization. So in that 10 lakhs, I am going to pay whatever the salary, other expenses, everything, I am going to close within 3 lakhs rupees. So remaining 7 lakhs is there. So in that 7 lakhs, how much I need to invest on the particular real estate or for the plant and machinery or for any other fixed assets or in the other companies' securities or the government bonds. That all cash flow management should be done in the financial management. Next, financial reporting. So whatever the dividend decision or the capital structure or any other decision we are going to finalize, right? So for that, each and every report should be there. And whatever the financial statements we are going to prepare, profit and loss account, all those things, it will relate to the financial management. Next, the risk management. If you are investing 1 rupee on any other company or any other securities, means whatever the risk is involved in. In the example, I have taken 10 lakh rupees I am going to receive as an inflow cash, correct? So in that 10 lakh I am going to spend 3 lakhs rupees for all the expenses and the payments. So in the remaining 7 lakh rupees, the whole 7 lakhs I am going to invest on securities, or in that 7 lakhs, 3 lakhs I am going to invest on security, 2 lakhs on real estate and other 2 lakhs on debenture. Like that I need to aggregate or I need to allocate the fund. Why we are going to allocate or diversify in the fund means because of reducing the risk in the organization. Whatever money we are going to invest, for that, whatever the risk involved in that, we are not going to looking at the only returns. We need to look at the risk also. So we need to diversify the risk in the whatever the fund we have invested. So that is the reason we need to check at the risk management also. And next we are going to discuss about the next activity is investment decision. So while taking care of whatever the amount you are going to invest, on that time you need to first think of what is the risk involved in that particular. That is called as investment decision. That 3 lakh rupees I am going to invest on securities, 2 lakhs on debenture, 2 lakhs on real estate. So that 7 lakh rupees I am going to invest, right? So for that we need to plan. That is the investment decision. Next, cost management. So each and every rupee, whatever we are going to spend or we are going to give to the others in the organization. For that we need to do the cost management, cost per unit or cost for the particular bundle of products or for the particular project, product line or for the particular order. All those things we need to control in this cost management. Next we are going to discuss about the other activity called strategic financial planning. So how tactically you are going to manage the fund in the organization. So if for example for this particular year I require 10 lakh rupees. After investing all those money, then only I am going to get the profit, right? So for that 10 lakh rupees, what are the sources are available? And at what time we need to take from X person or Y person or the from this whatever the banker, at what time we need to take and how much we need to take. That strategic financial planning is very, very important in the any organization. Because I require 10 lakh rupees, but in that 10 lakh rupees, first quarter I required only 3 lakhs, other quarter is going to 2 lakhs and the next quarter is going to 3 lakhs and remaining at the last quarter, correct? For example, for the first quarter I required only 3 lakhs, but I have took the bank loan of 10 lakh rupees at the beginning only. So for that 10 lakh remaining other 9 months I need to pay interest, correct? That is the loss for the company. If you are utilizing that money, then if you are taken, then that is okay. If you are not utilizing, just you are taking the money from the any banker or any financial institution, keep it in the organization, that is a loss, correct? So that is the reason we need to do this strategic financial planning. And the last one, financial complaints. So is there any complaints or any queries about the whatever the fund in the organization or any outsiders? All those things we need to check in this financial management. So these are the brief about the what are the key activities conducted or done in the financial management. Next, financial management principles. So what are the principles we need to follow for this financial management in an organization? So first one, goal alignment. I have already taken the example of 10 lakh rupees. So if I have 10 lakh rupees as an inflow, in that 10 lakh, 3 lakhs is going for whatever the expenses and the payments. So remaining 7 lakhs, if you want to reach the whatever the company objective or company goal, how to reach that goal? For that we have the different ways we need to create, correct? So through the whatever the company profit and whatever the surplus funds we have, we need to invest on some other securities or any other assets, and then we can easily reach the common goal of an organization. So first we need to set a goal. For that goal we need to reach. So we need to create a different ways, that is vision and mission statements, correct? So that we need to follow for the goal alignment. That is the first principle. Second one, profit maximization. All the business or each and every business activities done for the purpose of making profit, correct? So reducing the whatever the cost of an organization. How much is possible to reduce? We need to minimize the cost and maximize the profit in the organization, because each and every activity we are going to do it for the purpose of profit only, or else for money only, correct? So that is the reason profit maximization is also very, very important in an organization. So that is the other principle of financial management. Next, risk return trade off. So I have already taken the example of 10 lakh, correct? So same example I am going to take for risk and return also. If that 7 lakh rupees, if I am invested on equity shares of an other company. So equity shares, yes, it will give good return. At the same time, we have the risk also. High risk, high return. So that is the reason what I am going to do. 3 lakh rupees only I am going to invest on equity share. Other 2 lakhs I am going to invest on debenture. Other 2 lakhs rupees I am going to invest on the fixed assets or in the real estate. So this is the diversification of fund. Why I am going to do this diversification? If for example, risk is high in the equity share, at the same time in the debenture risk is very minimal, because we are going to get the what is the fixed rate of interest is there, that we are going to get, correct? So that is the reason. So we are going to diversify the fund and we need to balance the risk and return in the organization. That is the one more principle of financial management. Next, the time value of money. The rupee value of today, it's not going to same for the next day or for the next month or for the next year. It's continuously it's going to change, correct? So 10 rupees value is today, whatever we have 10 rupees. At the same time, after 1 year or after 2 years, the 10 rupees doesn't have the same value of 10 rupees. It's going to decrease. At the same time, if you are invested that 10 rupees in any other security, then you are going to get the more value than the 10 rupees. If you are not invested, just if you keep on money with you, then the 10 rupees value is going to decline. That is the time value of money. Next, consistency and comparability. So whatever the amount we are going to, or whatever the fund we are going to manage in the organization, in the form of consistency we need to maintain in any activities, and we need to compare. If for example, if I invested my money in equity share, how much I am going to get the risk, or how much I am going to get the return. If in the same time, same amount I am going to invest on the debentures and the bonds, how much I am going to expect the returns, or how much risk involved in that. So like that we need to compare. That is also one of the principle of financial management. Next, liquidity and cash flow management. So liquidity is nothing but near to cash. So how much the money is going to invested that company on the current assets or in the short-term investments. Why it is short-term investments? Easily we can convert that money or whatever the securities into easily into the cash, whether it may be any assets or it may be any small like shares or the government bonds and other things. Easily we can convert and we can get the money easily. That is called liquidity. With that we can easily manage the fund or the cash flows in the organization. Next, cost benefit analysis. How much cost we are going to invest or the incurred for that particular product, or how much benefit we are going to get it from that particular product. That is the cost and benefit analysis. Next, we have budgeting and planning. So for each and every activity, first what we are going to do in the organization, first we need to do the budgeting. How much money is required for that particular project or for that particular activity, and how much we are expecting the profit from that particular project or from the particular product. That is the budgeting and planning we need to do. That is also one of the principle. Next, transparency and accountability. So whatever the activities or whatever the cash flow management we are going to do or fund management we are going to do, that should be transparent. The matrix member or management, everyone can easily analyze and they can take any decision regarding the any activities. So that is the reason they need to be in the transparency, and for each and every activity or transaction, that accountability should be there. And the last one, ethical consideration. So ethically we need to consider all the fund in the organization. In ethical way we need to invest and we can get the money back. These are the few principles of financial management. Next, we are going to discuss about the role of tally in financial process. So how the tally is going to help in this financial process in an organization. So first one, automated bookkeeping. So automated bookkeeping is nothing but, so whatever the entry we are going to make. For example, in the bookkeeping, the date book, we have a day book, correct? So in that day book, we are going to enter each and every transaction happen in the organization. So the date book, what is going to do? All the transaction wherever it is required, like in journal entry, ledger account, or sometime if it is required for any financial purpose, like any project, individual project wise, on that time we can easily take this automated bookkeeping transaction for whatever the reports or the financial statements we can easily consider for this automated bookkeeping. Otherwise, in the manual entry, what we need to do? So each and every time we need to manually record the transaction. But here, once we record the transaction, automatically we can take whatever the accounts or whatever the books we are going to prepare. For that, we can take these entries. Next one, the ledger management. So each individual account we are going to maintain a ledger account, correct? So for cash or bank or for plant and machinery, land and building, each and every account we are going to create a individual ledger accounts. So for financial management also, whatever the money is going to comes to the organization in the form of cash or in the form of bank, any other, that we are going to maintain in this ledger account. So once we enter the transaction in day book or in the bookkeeping, from that individual transaction will be taken care in the journal entry. From the journal entry, we are going to prepare this ledger management in the or ledger account in the Tally software. So the cash and the bank, these two accounts easily we can take, and we are going to prepare the cash flow statement or the whatever the cash inflow and outflow of the organization, that we can prepare. Next, financial reporting. So after ledger account, we are going to prepare the trial balance. So from that trial balance, we need to prepare P&L account. From the P&L, we are going to prepare the balance sheet, correct? That is the manual process. Here, if you given just the entry in the day book, it is automatically it will take to journal, ledger, trial balance, P&L account, and the financial report will be ready for that particular organization. So that is the one of the role of Tally in the financial process. And next we have budgeting and forecasting. If for example, whatever the variable expenses, variable income, fixed expenses, fixed income for that particular organization or for the particular whatever the project, if you given, so how many number of products you are going to produce. For example, if you are given for one product, what is the fixed cost, what is the variable cost, what is the cost of production, everything if you are given once, you can easily calculate for how many number of products you need to produce or how many number of units you need to produce. For that easily you can take the budget and the forecasting also. If you want to produce 100 products for the next month, how much money is required for that particular activity. All those things will be taken care in this Tally software. Next, taxation, invoicing and billing. So each and every transaction we are going to record. Like once we are entering the whatever the voucher, in that only the whatever the supplier or the whoever the buyer, everyone's investors, all the GST number or whatever the PAN number, it's there, correct? So easily we can enter in the entering the voucher numbers or the voucher entry. On that time we are going to give this all these details, correct? So once we given the details, automatically it will calculate the taxation and the invoice and whatever the billings, everything will be done. Next, cash flow management. So in the second point already discussed the ledger management, correct? So individual cash account and individual bank account. Through that two ledger account, we can easily maintain this cash flow management in the Tally software. Next, inventory management. So inventory management means how much stock, the raw material, work in progress or the finished goods or whatever the stock is there in the warehouse, all those things. LIFO method, FIFO method, whatever the organization is following, all those things if you give as an input for the Tally, so based on that it's going to create or generate the inventory management of an organization also. And bank reconciliation, so this is very difficult job, creating the bank reconciliation statement for whatever the transactions, okay. So for that also no need to worry, Tally is only taking care of that bank reconciliation statement, multi-currency support. So transferring one invoice from the one country currency to other country currency, all those things will be possible. And user-friendly interface and the complaints management. All those are the few roles we can easily taken care in the Tally for the financial process. Just all these things I will show it in the Tally software also. So I already taken the example of automated bookkeeping, correct? Daybook. So here if you go to Daybook and click on Daybook, see here date, particulars, voucher type, voucher number, debit amount or inwards quantity, credit amount, outwards quantity. So these are the transaction. For example, today whatever the date is there, XYZ number of months or whatever the month, year, we are going to enter in the date column. Particular, whichever the supplier is. For example, XYZ person is the supplier. So we need to take XYZ, whatever the private limited or limited, whatever it may be, that we need to enter. Next, voucher type. It is a credit note or debit note or the purchase, sales, whatever the vouchers are there. We have 14 types of vouchers. So that type we need to enter here. And voucher number, that is the serial number or the bill number given on the that particular receipt, that we need to enter, whether it may be inwards or the outward, that we can easily enter here. Like that, each and every transaction we need to enter in the day book. This is the primary books of accounts. Once you do this, then it will automatically take for the journal entry, ledger account, all those things. I have also discussed about the ledger account, correct? So the ledger account, if you go to chart of accounts, if you double click on chart of accounts, see here you have the ledgers. So in the list of masters, in that we have ledgers, correct? Double click on that ledgers. See, these are the few ledgers account we already created for this. Okay. Current assets, under that bank accounts, cash in hand. So if it comes to the whatever the financial management, these two are very, very important, because if you are going to do cash flow management, budgeting, all those things, these two accounts they are going to consider. So bank accounts, you can enter whatever the bank accounts details, that is whatever the day books you are entered, that will comes to bank accounts, or if it is in cash account, all those things it will come here. So individual all the ledgers account like deposits, loans and advances, stock in hand, debtors, fixed assets, investment, miscellaneous expenses, all those things will be there in the ledger account. So once you enter the day book, automatically it will go to journal entry. From journal entry it will comes to ledger account. Next, we also discuss about the financial reporting. So in that financial reporting, mainly first we are going to prepare the profit and loss account and income statement. After that we are going to prepare the balance sheet, correct? See here we have a profit and loss account, or we call it as income statement also. So profit and loss account, double click on the profit and loss account. See here whatever the particulars, ABC Private Limited, that is the year beginning, and whatever the debit side and credit side. If you are going to make a entries, then automatically whether it may be a net profit or the net loss. If it is a debit side, it is net profit. If it is a balance is there on the credit side, then it is a net loss. Like that we need to prepare the P&L account. And after P&L account, once we completed this, it will automatically go to balance sheet. See here liabilities on the debit side or the left side, and the assets on the right hand side. So all our current assets, fixed assets, we are going to record it here, and here all our capital, shares, debentures, and the whatever the long term loans and the short term loans, that is the current liabilities, all those things we are going to enter here. This is the balance sheet, how it looks like in the Tally software. Also we have discussed about the bank reconciliation statement. This is the very crucial and very difficult task in the any organization. Okay, so if you go to gateway of Tally, in that we have banking. If you double click on banking, there you have bank reconciliation. If you double click on this bank reconciliation, it will take whatever the ledgers. If you want to create any ledger account, you can just click on the account number and just click on create. It will create the bank reconciliation statement also. So these are the few whatever the roles in the Tally for the financial process. Next, functions of financial management. So first one is estimation of capital requirements. For example, for this particular quarter, we need to produce 50 number of units, whatever the company is going to produce the goods, correct? So for that 50 products, how much investment is required? If for example, that 50 units we are going to produce in this particular company for this particular quarter, means we are going to get a profit of 10 lakh rupees. So for getting the 10 lakh rupees of profit, how much we need to invest or how much we need to spend on that particular 50 units of cost of production. So for that we need to estimate the capital requirement. So for the 10 lakh rupees of profit if you want to gain, then you need to invest 50 lakhs rupees of amount in that particular 50 units of products. So not only that, whatever the salary, whatever the wages we have paid, rent of the building, all those things we need to consider, and we need to create this estimation of capital requirement. And in the beginning also I told you, if we are given, for example, for producing one product or one number of unit, for that how much is the fixed cost, what is the variable cost or the fixed expenses, all those things if we given the data. So automatically we can multiply with the how many number of units you need to produce and how much time or how much profit we can make. All those things easily we can make from this Tally software. That is the first function. Second one, determination of capital structure. If I have the equity share capital of 1 crore rupees, how much I need to pay as a dividend for the equity shareholder. At the same time, for that 1 crore rupees, 50 lakhs I am going to issue equity share. Another 30 lakhs I am going to issue debentures. Another 20 lakhs I am going to issue preference share. So on that time, how much I need to pay for the whatever the shareholders and the debenture holder, that we need to check. Based on that, we need to determine or we need to create a capital structure for the particular any organizations. That is also we can do it from the whatever the using the Tally software. Next, evaluate and select sources of funds. So what are the different sources are available? I already told you. If you required 1 crore rupees of capital, on that time 50 lakhs is the whatever the equity share, 30 lakhs is the debenture, 20 lakhs is the preference share. Like that we need to plan, correct? So that is the whatever the sources, equity shares is the source, debenture is the source, or the bank loan is the source. We need to check what are the sources are available for that particular company. And next, allocate and control of funds. How much we are going to allocate for the organizational funds, or how much I need to invest on the whatever the project A, project B, project C, and how to control over the funds in the organization. That is the one of the major function. Next, distributes the profits or surplus. So once we get the profit from any activity, for example project A, B, C, all those things are given the profit for the particular company, means how we need to distribute for the equity shareholders, debentures and the preference shareholders or any other bank loans. That is very, very important. And the last one, monitoring financial activities. So each and every financial activity should be monitored and the control over the funds in the organization. Next, the same whatever the functions we have discussed, it is in the like in an image format I am showing here. So financial management, that we have broadly classified into two categories: investment decision, financial decision, and one more is there, that is operating decision also. Okay, these are the three kinds of major classification. From this investment decision, first one is budgeting, working capital management. Budgeting is nothing but how much is the cash inflow and outflow, the estimation we are going to prepare. Next, the working capital management, the current assets minus current liabilities, that is called your working capital, correct? So how to manage that short term funds. And next, financing decision, that is cost of capital, that is how much return we are going to pay for the capital invested. And capital structure decision, that is if for example 1 crore rupees of capital if you required, so in that how much is equity, how much is debenture, how much is bonds, that plan we need to do. That is the capital structure decision. And the last one, leverages. So these are the broadly classified functions of the financial management. Next, we are going to discuss about budget creation in Tally. So if you want to create a budget, if for example, normally if you are going to create a budget for any organization, means what you are going to do, so you are going to take as a manual entry you are going to make, or in the paper, that is the traditional method of creating budgets that we are going to make, or we are going to use Excel or Google Sheets for the creating a budget, correct? But in Tally also, if you want to create a budgets, first we need to go to open the Tally software. In that gateway of Tally, there you need to go for assessing the budgeting module. So from that tab, if you click on that, then you will get the other option called create a new budget or the existing budget. So if you want to create new one, then you need to click on the create new budget. So if you click on that, then you will get a one more tab called allocate budget figures or allocate the fund. So for that, how much is the whatever the estimated cash inflow or the revenue generation, or how much is the expenses. All those things you need to allocate the fund in this budget. Next, after allocating, you need to click on the whatever the budget monitoring and variance analysis. So once that activity is completed, or the whatever the budget you have created, that activity or that task should be completed, then you need to check the variances, how much you have expected or estimated budget, what is the actual budget. If for example your estimated budget is 10 lakh rupees but actual budget is 7 lakh rupees, so the variances we need to analyze. And the last one, generating the budget reports. So after whatever the variance analysis, monitoring everything, we can get the generate the budget reports. Next, the basics of financial planning. So financial planning is nothing but we are going to forecasting the future, okay, for requirements or whatever the money we have. From that we need to plan for the future financial activity. So financial planning is the process of setting the goals, assessing the resources and creating a strategy to achieve financial objective. If for example, okay, so first if you want to make any profit or made any profit, then what you are going to do, first we need to set the goal. So for this particular quarter, company needs to achieve of 10 lakh rupees of profit. That is the goal. To reach that goal, next what we need to do, we need to assess the resources. What are the available resources are there with us, okay, to reach that 10 lakh rupees of profit for this particular quarter, okay. So in that, how much is resources are available, how much we need to take from the whatever the available sources, all those things we need to assess. Next, we need to create a strategy to achieve financial objective. To reach the 10 lakh rupees of profit for this particular quarter, how much sales we need to make. To make that sales, how much production cost is required, how much revenues or whatever the promotional activity, transportation is required. Everything we need to do the strategy in this financial planning. So it is a setting the goal, assessing the resources and creating a strategy to achieve that particular goal. This is called financial planning. It involves budgeting, saving, investing and managing risk to secure a stable financial future. So key components of financial planning, the first one is budgeting. Already we have discussed, budgeting is nothing but the estimated cash inflow and outflow of the organization. Emergency fund, so for any contingencies or for any other emergencies, the company needs to manage the fund. If for example 10 lakh rupees they have made the profit, means the 10 lakh rupees also they are not going to invest. In that 10 lakh, at least 10% or 5% they are going to keep it as an emergency fund. So that is the emergency funds. Debt management. So managing the whatever the borrowed money in an organization, that is also very, very important. Investment planning, how much they need to invest on the other securities or other assets, that is also important for any organization. Insurance coverage, why they are going to take this insurance means to avoid the risk or to minimize the loss for that particular whatever the activity they have conducted. So that is the insurance coverage. And the last point is tax planning. So tax planning is also conducted for the whatever the money, ethically we can reduce the tax burden. That is the reason they are going to do this tax planning. Next, setting smart financial goal. S stands for specific, M stands for measurable, A for achievable, R for relevant and T for time bound. So specifically whatever the measurable target we can set, and we need to set a achievable goals. If for example that company have the production capacity of 10,000 products per month, but we are going to target or we are going to set the target of 20,000 products, that is not achievable, correct? So that company have the 10,000 number of units they can produce in 1 month, then we need to set at least 10,500 or 11,000 we can set, not more than that, because the company production capacity only 10,000, then how can we set for 20,000? So we need to set the achievable goals and the relevant should be there, and whatever the time bound for particular month or for the particular quarter, like that we need to set the time bound also. Utilizing Tally for financial forecasting. So if you want to forecast any other things like for budgeting or any other financial activity, how they are going to use Tally for creating the financial forecasting. What do you mean by financial forecasting first? If for example, for the particular year, how much money is required? Okay, if for example, 10,000 rupees they required for the particular year. So for that 10,000, what are the sources are available with them? Whether they can go for bank loan or for any other securities if they can issue, or if they want to go for any third party loans or the party's insurance or any other things, if they can go, that they are going to check, that is the sources are available, and from that whatever the available sources, what is the rate of interest they are charging or how much we need to repay for them, that also they are going to check, and then they are going to forecast for the future. Next, Tally reporting capabilities. So in the Tally reporting, we have all the reports like creating a budget, or for our journal entry, ledger account, trial balance, income statement or profit and loss account, all those things, all the capabilities are there in the Tally software. But utilizing or optimal utilizing the Tally software is depending on the whatever the activities they are going to do. Historical data analysis, so whatever the past data or past budgets are there, based on that also they can analyze the data. And budget integration for forecasting. What are the budget integration? If for example using the historical data, how we can prepare or we can forecast the future budget, that is also we can do from the Tally software. Next one, implementing financial plans in Tally. First one, budget creation in Tally. We already looked at what are the steps involved in creating a budget. Next, the variance analysis. So how much the variance is there, like estimated budget and the actual budget, what is the difference, all those things we need to analyze. Next, scenario planning with Tally, cash flow management, real-time monitoring and adjustments. So whatever the real time, for example in this whatever the next day or for today only, whatever the changes is happening in the economy, based on that also we need to change the budget. So this cash flow management I will show you in the Tally software. See, if you go to gateway of Tally, here we have cash flow. So if you just double click on that cash flow management, see monthly wise it is there. April, May, June, July, August, all this month, that is particularly 12 months of period starting from the April and with the March of the next year. Okay. So cash movement, whether in the April we have inflow or outflow, net flow. If it is inflow minus outflow, you will get the net cash outflow or net cash inflow for the particular month. Like this we need to prepare, and the grand total will come here as a chart. Next, we are going to discuss about creating budgets using Tally. Okay, so what are the different types of budgets are available in Tally, or how to manage or how to create a budget in Tally, that we are going to discuss now. Before that, we are going to discuss about what do you mean by budgets, or what is the meaning of budgeting, what is the functions of budgeting, importance of budgeting, or what are the different types of budgets are there, that we are going to discuss. Okay, so introduction to budgeting. The budgeting is a systematic process of creating a detailed financial plan for a specific period, outlining expected income and expenses. So it is a financial plan of a particular period. I already told you, right? So we can prepare a budget for quarterly, monthly or half yearly or the yearly wise. So we can prepare the budget, and it is like a blueprint for the whatever the income and expenses we are going to get. How much income we are going to generate and how much expenses is expected. That is called budget. So in financial planning, budgets serve as a roadmap, providing a structured framework for managing financial resources. So through the roadmap only, so how much fund we have and how much we need to invest on the particular X activity, Y activity, or the X project, Y project, all those things will be dependent. What are the key components of budgets? So in that key components of budgets, first one is revenue projection, that is the how much revenue or how much income is expected. Correct? That is the first key component. And the second one is expenses projection. So how much we need to spend on that particular budget or for the particular whatever the duration, that is the quarter or monthly or yearly or half yearly. How much revenue is expected and how much we need to spend for the particular project. Next, the cash flow statement. Cash flow statement is the inflow and outflow of the cash in the organization. That is also through this budget only we can do. And operating budget is nothing but the day-to-day activities, operational activities, whatever the fund is required. For that particular, we are going to prepare this operating budget. Next, capital expenditure budget. Capital expenditure budget is nothing but investing on the capital assets or capital items like a long-term assets. It's like a purchasing the land and building, purchasing the plant and machinery, purchasing the furniture and equipments. All those things will comes under the capital expenditure. Next, the budget variances. If for example we have estimated budget of 10 lakh rupees, but what is the actual one? Whether it may be exceed for the 10 lakh rupees or the before that only or within that only we have completed that project. That we need to check the what is the budget variances. And next, contingency plans. If for example we have planned for the 10 lakh rupees of budget, so for example that budget exceeds, on that time we require another 1 lakh or 2 lakh rupees as a contingency requirement. So for that also we need to plan. That is the contingency plan. And the last one, performance matrix. So how the fund is going to perform in the market or in the whatever the products and services offered in the particular markets, or depending on the market conditions it's going to performance, correct? So that all those things are the key components of budgets. Next, the importance of budgeting, the financial planning and direction. So financial planning is nothing but the roadmap. Already we have planned and we have kept some money for whatever the roads or whatever the diversification we are going to do and the whatever the activities we are going to conduct in the organization. So that is the first importance. Second point is resource allocation efficiency. So how we are going to allocate the resources and how efficiently we are going to manage the fund in the organization. And the next one, goal setting and achievement. So how to set the goals in an organization, that is the organizational goal or the objective, company objectives. So to reach that objective, how we need to set the goal or how relevant it is, like that we need to set the goals and how we are going to achieve. That is the vision and mission statement. Okay. So next, the performance monitoring and control. So whatever the money we have allocated or allotted for the particular X activity or X project or Y project, so that we need to monitor the performance of that particular project. We need to monitor and we need to control over that activity. Next, the informed decision making. This is very, very important. Why? Because whatever the decision we are going to take, for example, we have 2-3 projects, project A, B, C. So project A is also going to give the profit, B is also, C is also going to generate the profit. But what is the quantum of profit we are going to get from this each project? If for example, project A is going to give 10 lakh rupees, project B is going to give 8 lakh and project C is going to give only 4 lakh rupees. So on that time, which one we need to consider for our particular organization? If for example, if you take on project A, that is the most suitable, or project B is suitable, or project C is suitable, depending on the profits and the activity we are going to select. And we need to take that informed decision because of this budgeting. So based on our cost availability or fund availability, based on that also we are going to take the decision, correct? So that is the one more importance of budgeting. Next, the cash flow management, the forecasting, inflow and outflow of the organizational fund. So that is also important in the organization. Through the budgeting only we can maintain this cash flow management also. And the motivation and accountability. So for each and every activity, the main motto is to make money or the earn profit, correct? So for each and every activity we are going to conduct, and for that each and every activity we have to be accountable for the all the fund of an organization. And the last one, risk management, managing the risk in the organization. That is very, very challenging, because I already given the example of 10 lakh rupees, correct? In the 10 lakh rupees, 3 lakh rupees is for expenses, remaining 7 lakhs. How to divide that fund? Okay. If for example 3 lakh rupees on equity share, 2 lakh rupees on debenture, 2 lakh rupees on bond, like that we are going to distribute, right? So why we are going to do? To diversify the fund, and we are going to minimize the risk involved in that particular activity. That is also one of the major importance of this budgeting. Next, the benefits of budgeting: financial control, decision making support, performance evaluation, resource allocation, goal setting and planning, cash flow management, coordination and communication, performance accountability, motivation and employee morale. So these are the few things we already discussed in the whatever the functions or the importance of the budgeting already we have discussed. So I'm not going to explain here, just these are the few benefits of budgeting. Next, the types of budgets. So this budget also broadly classified into two categories. One is operating budgets and other one is capital budgets. So operating budget is nothing but the day to day or the, for example, in the 1 year. Okay, in that 1 year we have the multiple of this operating budget. For example, some companies they are following 1 month or for the particular quarter or for the particular half yearly wise they are going to prepare this operational budget. Why? Because so they need to check about the like monthly how much sales they are going to get, or monthly how much operating expenses are there, how much profit, that is operating income they are going to generate. For those things also they are going to create this operating budgets. But when it comes to capital budget, this is for the long run or for the long term budgets they are going to prepare, particularly for 1 year or particularly for the next 2 years, next 3 years, like that they are going to prepare. So we'll see one by one. So first one is operating budgets. So operating budgets is nothing but it is like a very less duration of time they are going to prepare these budgets, like monthly or for projectly wise or the quarterly wise or the half yearly ones they are going to prepare this operational budgets. In that first type is sales budget. So usually monthly wise they are going to prepare this sales budget, because in 1 month, okay, how much sales is expected from that particular sales, how much revenue is generated for that particular organization. That is very, very important, correct? This is the main source for any organization. Through the sales only they are going to generate the income or the revenue. Next, production budget. If you want to do sales, before that you need to invest your money on this production activity, correct? So for that production activity, how much is the raw material cost, how much is the machine hour rate, labor expenses, fixed expenses, variable expenses, all those things will be counted in this production budget, correct? So how much is we need to allocate the fund and how much number of units or the number of products we can produce in that budget. That is we are going to do it in the production budget. Usually depending on the sales they are going to prepare this production budget. For example, this month we have sold 50,000 units of products. So next month approximately plus or minus 10,000 of that whatever sales they have done for this particular month. Like 50,000 they have made a sales, next month it's maybe 60,000 of sales they are going to make. So on that time, for that 60,000 of units or number of products they need to produce, how much cost is required for that 60,000 units of products, that they are going to prepare in this production budget. Next, cash budget. So cash budget is nothing but the day-to-day activity or for any petty cash, all those things they require this cash budget. Next, expenses budget. So expenses budget is nothing but how much expenses they require for the particular year or for the particular quarter or particular month, okay? They need to prepare this expenses budget also, like for whatever the printing and stationery, fuel and gas, coal, and whatever the wages they have paid for the transportation, other things, they need to check this expenses budget. Flexible budget. So flexible budget is nothing but based on the whatever the activities are conducted in that particular organization. If for example we have made the budget for 60,000 units of production budget, but in between some other orders are came, so on that time we need to ready to flex or ready to change that whatever the budget we have prepared. If for example 60,000 is our budget, we have produced or we are already created that budget, in between 20,000 units other extra, okay, we have got an order. So on that time we need to incorporate that 20,000 units also in that 60,000 budget. So on that time we need to make the whatever the flexible or changes are required, we can make and we can prepare this flexible budgets also. Next, the broad category is capital budgets. This is for long term. So capital expenditure budget. What are the things comes under the capital expenditure? First one is purchasing the fixed assets, that is your land and building, plant and machinery or furnitures or the motor vehicle or the truck or the transportation vehicles. That is the long term expenses, correct, or the long term assets we require. So for that they need to invest. So on that time they are going to go for this capital expenditure budget. Next, acquisition budget. Acquisition budget is nothing but if the organization having the surplus funds, and that time they are going to plan to acquire some other small companies, correct? So on that time what they are going to do, they are going to create a budget. So for that particular small company, okay, what is the net worth of that particular company, how much they are going to offer in cash, how much they are going to offer in shares or securities, all those things will be done in this acquisition budget. Next, expansion budget. If they have the plan of expansion of their business, if for example they are running only in the Bangalore, so they need to extend it to the Hyderabad, or they need to extend to the Tamil Nadu. On that time what they are going to do, for this expansion budget they need to prepare the land of whatever the land they need to purchase, or some land they need to take as a rent, okay? For that, whatever the building, whatever the equipments like laptops or plant and machinery, other things, and the salary, wages, all those things they need to consider, right? So for that they are going to prepare this expansion budget. Next, project budget. So individual project wise they are going to prepare a budget. Research and development, that is the R&D budget. So this R&D budget, why they are going to do is based on the whatever the technologies changes in the economy, or whatever the competitors products and other services they are going to introduce in the market, or the substitute products in the market. For all those things they are going to conduct this research and development, and then they are going to create the budget for whatever the expenses or income is required from that particular expenses, that is for the R&D. Okay, these are the few different types of budgets are there in the organization. Next, we are going to discuss about tally for cash flow management. So cash flow management or cash flow statement is nothing but the cash inflow and outflow of the organization, correct? For the particular month or particular quarter, or for the particularly yearly wise, we are going to prepare this cash flow statement. A cash flow statement is a financial document that provides a detailed breakdown of a company's cash inflow and outflow over a specific period. It categorizes cash flows into three main sections, that is operating activities, investing activities, and financing activities. So this cash flow statement we are going to prepare, or we are going to do the breakdowns for whatever the inflow and outflow of the organization. It may be particularly for quarterly wise or the yearly wise we are going to prepare. And in that we are going to classify it into three categories: operating, investing, and financing. We'll discuss one by one. So operating is nothing but the day-to-day activities, or for the monthly wise or for the weekly wise we are going to prepare this operational activities. So under this we are going to consider the sales, purchase of inventories, or payment of operating expenses, that is day-to-day expenses we are going to make, that we are going to consider under the operating activities. Next, under the investing activities, so we are going to invest on other companies. Like for example, we are going to acquire some other companies on that time, or we are going to purchase of equity share of an other companies or debenture of another company. That will comes under the investing activity. So investing activities involves in acquisition and disposal of long-term assets. This includes cash transaction for purchasing or selling property, equipment, and investment. Investment in the future growth and the stability of a business falls under these categories. So if you are going to sell a fixed assets, or if you are going to purchase a fixed assets, or if you are going to invest on other company, all those things will comes under investing. And the last one, financing. Financing is nothing but you are going to take the money from the any banker or financial institution, or if you are going to raise the funds through issuing equity share or debenture, all those things will comes under the financing activity. So financing activities involves transaction with the company's owners and creditors. So cash transaction related to borrowing, repaying loan, issuing or buyback of stocks, and paying dividends are categorized as a financial or financing activities. So monitoring cash flows in tally. So real time we can track the whatever the cash flows in the organization using the tally or cash flow reports. I already shown you, right? Just now also I will show you the cash flow. See here in the display of reports, in that we have cash flow. If you double click on cash flow, monthly wise cash inflow and outflow, and what is the net outflow. This cash flow is going to individually you can get to know from this tally software. So through this also you can easily budget, or you can do the activities control over the whatever the inflow and outflow of the activities in an organization. After cash flow reports, next is budget versus actual analysis. That is the what is the variance analysis. That is the actual budget versus estimated budget. And the last one is forecasting the capabilities. So whatever the capabilities they have, based on that they are going to forecast for the future. Next, cash flow budgeting in Tally. So creating cash flow budgets, category wise budget allocation, periodic analysis, integration with actual cash flows. So creating budgets or creating the cash flow budgets, using that whatever the available tab, we can monthly wise we can create the budgets, categorize the budgets, allocation, whatever the allocation you are going to make, based on that we can allocate or we can categorize the budgets. Periodic analysis like monthly wise or quarterly wise, in the report also you can see monthly wise it is given, right? So if you want to quarterly wise also you can take and you can analyze. And the last one, integration with the actual cash flows. So whatever the estimated and what is the actual one, you can integration with that. So analyzing financial data, that is using the financial ratio that you have, like current ratio, quick ratio, liquidity ratio, based on that also you can analyze, and interpreting the key financial indicators. So whatever the Tally software, in that whatever the reports they are going to generate, through that you can just check the, or you can analyze the reports and you can get the what is the indication of that. Okay, if for example negative cash flow or positive cash flow, all those things will be the sign of an financial indicators. Next, we are going to discuss about the introduction to Tally for tax management, whether it may be for direct tax or indirect taxation. Okay, so for direct taxation, whatever the employees they are there, correct? So for that employees, they are going to give the TDS certificate or form 16 they need to generate, all those things are there, correct? And indirect method, that is your GST reports or GST filing, all those things will be there, correct? That we are going to discuss. So Tally is a powerful accounting software that provides a centralized platform for various financial operation. It can create the businesses for all sizes, like small, medium or large companies or MNC companies, and it helps in managing their accounting needs efficiently. So whatever the manual entry they are going to do, each and every transaction they need to pass the journal entry, ledger, trial balance, P&L account, balance sheet. So this Tally is going to helpful for them if they do the whatever the bookkeeping entries or the day book. From that it will take to balance sheet. So the core competencies of this Tally software is accounting management and taxation management. So accounting management, all those things like your day book, inventory, and your financial management and financial reports, that is the accounting management. And the second category is taxation, majorly on the GST front. Okay, so that we'll discuss. So Tally's roles in automating and streamlining the tax process. Okay, so automation of repetitive tasks, for example filing the GSTR returns, monthly wise also they are going to prepare, or quarterly wise they need to check how much is the GST and input tax credit, all those things they are going to check, or reverse mechanism, all those things they need to check, right? So for this automation of whatever the repeated tasks are there, that is the one other competencies they have. And streamlining the tax calculation, if for example 100 employees are working in that particular organization, so how much TDS they are going to cut and how much they need to show the form 16 or how to generate the form 16 for that particular 100 employees, all those things will be streamlined by this Tally. Filing and reporting the whatever the financial statements, or it may be a tax returns or GSTR return, everything. Okay, that is the main role this accounting software or the Tally software is going to help in the streamlining the tax process in the organization. So few features are inclined for this taxation system. Okay, first one is automated tax calculators or tax calculations are there, real-time tax, seamless integration with tax modules, simplification of complex tasks or comprehensive reporting, compliance check and alerts, whatever the due dates are there or whatever the input tax credits we need to do, or reverse mechanism plans were there, on that time it is going to pop up or it will give the alerts. Audit trials, that is also there, and the GST filing and complaints. This is also one of the features of Tally towards the align with the taxation system. So significance of accurate tax management. So impact on financial statements, compliance with regulations, minimizing the errors, efficient audits, or timely filing the returns, financial planning, audit preparedness, and the efficient resource utilization. So these are the few importance. I think so no need to explain more about this, whatever the financial statements or complaints, regulations, minimum errors, all those things, correct? So in this Tally software, I will show you the GST reports and all. Okay, if you go to Gateway of Tally, in that more reports, there you can get the statement of GST reports. On this GST reports, double click. So you will get the track the GST return activities, GSTR1, GSTR3B, composition scheme 8 or GSTR4, annual computation, e-way bills, GSTR1 reconciliation, GSTR2A reconciliation, 2B reconciliation, Chalan reconciliation, GST utilities and other reports. So you can easily track one by one. So if you click on GSTR1, see B2B invoices, B2C, that is large invoices, export invoices, credit or debit notes, registered, credit or debit notes, unregistered, all those things will comes under the GSTR1. That is summary, taxable amount, IGST, CGST, UTGST or SGST, cess, tax amount, invoice amount. All these things were comes under the GSTR1, like that GSTR3B, 84, e-way bills, all those things. If you want to do any reconciliation, then you can go for GSTR1. So if you want to do the correction, if any needed, all those things will be do in this Tally software. Summary for this particular course. Here is a brief recap what we have learnt in this particular course. So first we have discussed about the understand the fundamentals of Tally, a comprehensive accounting software, and explore its key features for efficient financial tracking. That is the what is the purpose of Tally software, what is the features of Tally software, enabling and disabling of Tally features, all those things we have discussed, right? Next we have discussed about the foundational principles of financial management and how it implementing or how we can create in the Tally for the seamless integrates with these principles of streamlined financial process. What is the financial process? All those things we have discussed. And then we have discussed about the what is the definition and significance of budgeting, what is the financial planning, what are the different types of budget, that is operating budget and capital budget, under operating how many types are there, under capital what are the different types are there, that all those things we have discussed, and how to create a budget in the Tally software and how to monitor that we have discussed. Next we have discussed about the cash flow management. So what is the cash inflow and cash flow outflow of the organization, and what are the broadly classified categories of cash flow management, that is your operating, financing and investment. Okay, that activities that we have discussed. Last one is Tally's roles in efficiently managing various taxes like the GST or the direct taxation under the TDS certificates or whatever the form 16 for the particular employees, GSTR filing return 1, 3B, all those things, correct? We have seen this or we have explored in the Tally software also. So explore the specific features with the Tally designed for the seamless tax related functions, correct? So these are the few things we have discussed in this particular course of Tally for financial management. Hello learners, welcome to the course on GST, that is goods and service tax. Nowadays we are hearing this word GST or goods and service tax if you go for any retail mall, shoppings, for any other things, okay? So we are going to continuously or recurringly we are going to hear this word called GST. So today we will learn what is GST, how they are going to charge, or what is the interest rate, what is the tax structure, everything we are going to discuss in this. Okay, so first we will discuss the what are the agenda points for this course. So the first one, the tax structure in India. So how the tax structure is made for India, that is your direct tax, indirect tax, all those things were there that we are going to discuss. Second, we are going to discuss about the introduction to GST. So what do you mean by GST or the overview of GST, that we are going to discuss. Next, we are going to discuss the GST structure, that is how the GST system will work, that we are going to discuss. Then we are going to discuss about the GST registration. So if you want to claim or if you want to get the GST number, that is goods and service tax identifying number. So if you want to get that, how to register yourself or your company in the GST website, that we are going to discuss, or what is the process of registration, that we are going to discuss. Then we are going to discuss about the GST returns, how we are going to file the GST return and how many types of GST returns we have, that we are going to discuss. Then we are going to discuss about the GST complaints. So if any suggestion or feedback or any other claims, that we are going to discuss in the GST compliance. Next, we are going to discuss about the very important topic, input tax credit. So how we can get the refund from the GST. That is the simple meaning of input tax credit, that we are going to discuss. And we have different types of ITCs, that also we are going to discuss. And the last one, how the GST website looks like and how we need to log in, or what are the tabs are there in the GST Council, that we are going to discuss. These are the few topics we are going to cover in this course. So let's begin. So first, we are going to discuss about the tax structure in India. So usually the government is following these two categories of taxes. First is direct tax and another one is indirect tax. So the direct tax, if a word comes direct tax, first thing will comes to our mind is income tax. That is the whatever the tax burden an individual is going to bear, that whatever the amount he need to pay for the government as a income tax, that is direct tax. That is the person is going to directly pay tax to the government. That is the best example is income tax. If it is comes to indirect tax, so we have heard this word GST, correct? So if you go for any shopping, so usually we will go for we are going to go for shopping of clothes. So if you are going to purchase the clothes, or if you are going to purchase the food grains, then in the bill they are going to mention CGST and SGST. Some percentages they are going to mention, correct? So what do you mean by that CGST, SGST? So that is central goods and service tax, state goods and service tax, that they are going to charge. And we are going to pay to the shopping, or whatever we are going to purchase in that shop, right? For that shopkeeper, we are going to pay the tax percentage amount. We are not going to pay directly to the government, correct? So just we are going to pay for the whoever the shopkeeper is there, for them we are going to pay, and he is going to give the bill or a voucher he is going to give, correct? So that is called indirect tax. So the major difference in this indirect and direct tax, in the direct taxation, the person as an individual or the taxpayer, directly they are going to pay amount to the government. But in case of indirect tax, the taxpayer is going to pay, but not directly to the government, with the other parties like shopkeeper or the who is the vendor is there. For that vendor, they are going to pay. That vendor will remit that money to the government. So that is the indirect taxation. So these are the two major categories are there in India. Next, the features of indirect tax. What are the characteristics or the nature of this indirect taxes are? The first one, the important source of revenue. For a government, it's maybe any government. It may be Karnataka state or any other states, or it may be central also. So these are the main revenues they are going to collect from the individuals or from the taxpayers. Nowadays, we are going to do so much of shopping, whether it may be a food grains, or we are going to go for any outside, that is hotel or food grains, or shopping of clothes, shoes, any other material. So usually we are going to purchase and we are going to spend so much money in the shops, correct? So that whatever the GST we are going to pay, okay, that is the major revenue for the all the government, whether it may be a central or the state government. So that is the first feature of indirect tax. Next, tax on commodities and services. So just now I have given the example of shopping. So if you go for food industries, that is your hotel, correct? That is a service, that is not comes under the commodity, correct? So if you go for hotel also, service sector, they are going to charge. Or if you go for any other services, okay, it may be hospital, educational, all those things, okay, they are going to charge this GST. So for our services also we are going to pay, and it comes to commodities for food grains or clothes or our shoes or any other automobiles. For purchasing all these things, we are going to pay GST, correct? So that will pay for our commodities, that is goods as well as services. We are going to pay tax for all these things. Next, shifting of burden. shifting of burden is nothing but, so in the direct taxation, what we are going to do? We are going to directly pay to the government. But in the indirect tax or in the GST, what we are going to do? We are not going to pay directly to the government. We are going to shift whatever the tax amount or whatever the burden that we are going to transfer to the shopkeeper or to the vendor. Okay, that vendor is going to remit that money to the government on behalf of us. So that is called shift of burden. That is tax burden we are going to shift from one person to other person. And the next one, inflationary. So how this GST will work in inflation time. So inflation is nothing but the prices of the goods or the commodity is very high, correct? So on that time, how the price is going to change as per the indirect tax. For example, in the earlier days, the MRP is 10 rupees, for example. For that 10 rupees, we are going to pay tax as a sales tax or the VAT, correct? Before that, for producing that product also, they are going to purchase the raw material. For that raw material, they need to pay sales tax or the VAT they need to pay. After that, if they want to purchase any ancillary service products for producing that product, for that also they need to pay. So all these tax they are going to keep on the product MRP price. If for example, the cost of production for that particular product is 5 rupees, but they are going to sell it for 12 rupees. Why? Because the sales tax or the VAT that they are going to add and that burden will be shifted to the customer. But nowadays what happened? That will be the cascading effect is there for all this indirect tax. So after production of that particular goods, okay, whoever is going to purchase that product or services, for them they are going to charge this GST. So the price value MRP, earlier it is 12 rupees, now they are going to sell it for 8 or 9 rupees. Why? Because they are cascading the sales tax and value added tax or the central tax. All those things will be redeemed, correct? So that is the reason the inflationary will work in this indirect tax. Next, wider tax base in all the globe. So uniformly they are going to maintain this GST rate of interest for all these goods and services or whatever the commodities or whatever the services we are going to take. So we have the global scope of this indirect taxes. Next, we are going to discuss about the introduction to GST or the overview of GST. Okay, GST stands for goods and service tax. So whatever the goods or the products you are going to purchase or whatever the services you are going to take from the service sector companies or from the industries, for that we need to pay tax, that is the goods and service tax. So GST is a comprehensive indirect tax levied on the supply of goods and services in many countries. If for example, from India to other country we are going to export some goods, then we are going to charge this GST and we are the receiver of the GST amount, because other person who is going to export that product and services for their country, they are going to pay tax. So that is the main revenue for our India or for our government, correct? So like that, whatever for intrastate or the interstate, for example, we are going to send goods to Tamil Nadu or we are going to send goods to Andhra Pradesh, for all those things we are going to take the GST from that particular state. Why? Because we are the exporter or we are going to send the goods to the particular other place or other country or the other states, correct? So on that time, our government or our state government and the central government, they are going to collect the GST from that particular state. So GST is the consumption tax that is imposed on the supply of goods and services. It is a destination based tax, which means it is collected at the point of consumption. So I have already given the example, right? If for example, we are exporting goods or we are sending goods to the Andhra Pradesh. So Andhra Pradesh is the consumption point because they are using that product. That is the reason they are exporting, correct? So when they are using that product or they are going to consume that product, then they are going to pay tax because they are going to purchase from one party or from one shop, correct? On that time, they are going to pay tax on that particular shop. That shopkeeper is going to redeem that money or he is going to payment of that money to our state government because we are the exporter of that product and services. So at the point of consumption only, we are going to collect this GST. That is the main feature or the main characteristics of this GST. It is the consumption based tax. Okay. So next, after implementing this GST, what are the many taxes we are going to replace or we are going to eradicate it from our tax system? Okay, before that I will tell you cascading effects in GST. What do you mean by cascading effects? If, for example, in the earlier example I have taken, the central government is going to levy some tax, correct? Sales tax, value added tax, all those things will be there in the earlier case before implementing of this GST. So before that we have so many other taxes are there, but after implementing the GST in India, so all this, whatever the taxes are there, all these were replaced with the GST. So many taxes are replaced and called as a GST. So that cascading, tax on tax, tax on tax. For example, for producing 1 unit of X product, okay, so for that product we are going to purchase 10 rupees of raw material. So for that 10 rupees we are going to pay sales tax of 10%, for example. So 10 rupees of that raw material price plus 1 rupees of VAT or the sales tax, 1 rupees. So total 11 rupees is the raw material price, correct? So for that 11 rupees, again we need to purchase some ancillary service products. So for that we are going to pay tax, including tax, that price is 22 rupees, for example. So for producing that particular product, that is X product, we are going to spend 30 rupees. That labor cost, machine hour, everything, including 30 rupees is the cost of production for that particular one product. But we are going to sell it for 40 rupees. So 10 rupees profit with the tax we are going to sell. We already paid tax for raw material. We already paid tax for the ancillary service products. And after that also for finished goods, we are going to pay tax. So this is called cascading effect. Tax on tax, tax on tax, we are going to pay. Okay. So the main benefit of implementing GST in India, we have to reduce this tax on tax, that is cascading effects is reduced. So what are the multiple taxes we have eradicated with this implement of GST? So first one, excise duty. So whatever the like liquor or any other nicotine items, okay, if we are going to export, for that we have to pay excise duties. Okay, so and then service tax, or we also call it as sales tax. Whatever the goods and services we are going to purchase and we are going to taken from other states or from the other country and we are going to take to our home country or home state, then we need to pay this sales tax or the service taxes. Then value added tax were there, central sales tax were there, that is directly we are going to pay this tax to the central government. All these 4 taxes were eradicated. Not only these 4, we have many other sub taxes were there. All these were replaced and eradicated after implementing this GST. So these are the few main taxes. I think so if before 2017, if you remember, okay, if you go and shop for any other like jewelry, or if you go and shop for automobiles or any other spare parts of the auto, okay, then you are going to heard this word sales tax, central sales tax, value added tax, all these words you have heard before 2017. Now you are not going to hear these words frequently. Why? Because all these taxes or all these 4 taxes were replaced and now we call it as GST. So these are the few taxes were eradicated from our tax system and then they have implemented GST. Okay, so this is the cascading effect implemented after these effects in the GST system in India. Next, needs of GST in India. So what are the needs? Is it required to India implement this GST system? Yes. Why? Because the first one, the simplification of taxation. So earlier it is the tax on tax, sales tax, value added tax, excise tax, central sales tax, all those things we are going to pay. That is huge burden for a person or the consumer to purchase that particular product. And the price is also very high because we are going to pay tax on tax, correct? So that is the reason, and we need to easily simplify, or we can easily the simplifying of all these tax rates. So on that time, the sales tax, whatever the goods and services are there, or depending in the products, okay, they are going to change this each and every product, that service tax or whatever the percentage they are going to charge, that is changing. But now the GST, whatever the 1% is there. For example, we are charging 5% for one product, means all over globe we are going to charge, or in our India we are going to charge only 5% of tax to that particular product, not more than that. Okay, that is the first need of GST in India. And the second one, removal of tax cascading. I've already discussed about this, right? Cascading effect. So tax on tax, we are paying. That we need to remove or we need to eradicate from our Indian taxation system. So that is also the main need of GST in India. And the third one, creation of common market. So if it is GST percentage is same for all the globe. In the global market also India can participate, correct? Not only with the whatever the goods and services we have, and we have very specialized in producing that particular products or services, whatever we can export to other country or we can sell it to other country, that we can go and sell in our global market. India can also contribute in the global market with the whatever the goods and services available with us. Okay, so that is the one more need of GST. And the next, reduction in tax evasion. So in the cascading effect, we already discussed the tax on tax. Raw material also we are going to pay tax. For the whatever the ancillary services we are going to pay tax, and whatever the machines required for producing that product, for that also we need to pay tax. And after that, so the cost of production, on that we need to pay tax, and then they are going to add the MRP price, correct? So all these taxes they can evasion from the taxation system or for that particular product. That is also one more need of an GST. Next, boost to GDP growth. The GDP stand for gross domestic product. So whatever our domestic products are in the locally we are going to produce or we can manufacture, that GDP is going to increase. Why? Because we can whatever easily we can produce or we can manufacture, that goods and services easily we can market for other state or for the other countries also. So that will increase our GDP percentage in the economy. Okay, and it will give more profit to our state also, correct? So that is the reason we need to implement this GST in India. And the next one, SME empowerment, that is small and medium entrepreneurs. Okay, so this GST is going to encourage these SMEs. Why? Because the small medium entrepreneurs, they are going to run small of factories. Okay, whatever they produce, that will be used for the big manufacturing company as a ancillary service products or the supporting products for the main product. If for example, the production of automobile or a car, okay, they are not going to manufacture all the spare parts, whatever required for that particular car, that they are not going to produce or manufacture in their unit. Okay, so they are going to export that car body from one person, engine from one, and whatever the seats are required, correct? That seat or the floor mats, all those things they are going to export from one person, and glasses, whatever the mirrors, so many glasses are there, right? That they are going to import from one company or one factory. Okay, like this, all these products they are going to collect from each and everyone or whoever is going to produce that products and services. They are going to collect and they are used as a ancillary service products to produce that car. So on that time, this whatever seat covers or leathers, all those things, the small and medium entrepreneurs, they are going to produce. From there, they are going to purchase and they can give whatever the reasonable price is there in the market. They are going to give it to that small and medium entrepreneurs. That is also encouraging our SMEs in our economy. Okay, so that is also one more need of GST in India. And the last one, increase tax revenues. How the government is going to increase our returns? That is the rates of interest they are going to charge on our goods and services, whatever we are going to consume or we are going to purchase. Okay, so that government is going to collect from the shopkeeper and the revenue is going to increase to the government. And one more case is, for example, we are going to export the goods and services to the other countries or other state. Then also we are going to collect the revenues from that particular country or from that particular state. So it will increase our state's revenue also. Next, we are going to discuss about the key terminologies in GST. So what are the key terms we are going to use in the GST? Okay. So first one, the input tax credit, or we call it as ITC. So ITC is nothing but, like in general, as an income tax, we are going to pay tax, correct? And in our salaried company, they are going to cut the TDS, correct? After paying the tax, whatever the extra money we have paid to the government, we are going to take a refund, correct? That is in the income tax. So here in the GST, we are going to use the term called input tax credit for refund from the government. So if you pay any extra, or for example, I'm going to purchase that goods and services and I'm going to using for the manufacturing purpose and I'm going to make the final product and I'm going to sell. On that time, I can claim the input tax credit. That is the whatever the refund amount we can get from the government. That we call it as input tax credit. In a simple term, the refund from the government. Next, the threshold limits. The threshold limits is nothing but the barrier or the limitation we call it as, correct? So if for example, in the tax slab rate, 0 to 2,50,000 nil or 2,50,000 to 5 lakh 10%. So 5 lakh to 7,50,000 10%. Like that the tax slab rate we are going to divide, correct? So that 0 to 2,50,000 or 2,50,000 to 5 lakhs, that we call it as threshold limit. In the GST also, so we have the threshold limits. So if it is a small or medium entrepreneurs or businesses, okay, this is the turnover limit. So within that, if the turnover is, for example, less than 2 crore, there are no need to pay any GST. If their turnover is 3 lakhs rupees, they are not going to pay. If the turnover is more than 2 crores, then they need to pay GST. Like that is the threshold limits they are going to set in the GST. And you have one more question. Who is going to set this threshold limit? Correct? Usually we have questions. Who is going to fix that this is 2 crore rupees is the threshold limit. After 2 crores, we need to pay tax. Who is going to set? So in this GST, the GST council members, okay, they are going to do the meetings and then they are going to set these threshold limits. So this GST council member or GST council headed by the Central Finance Minister. So they are the main person or the chairperson for the GST council. They are going to head this GST council and they are going to fix the threshold limits with the state government, whoever the bodies are required to take the decision. Okay. So next, reverse charge mechanism. So reverse charge mechanism is nothing but, so in the GST system, the consumer or the whoever the end consumer user is there, he is going to pay tax to the shop, correct, or the shopkeeper. So in the reverse charge mechanism, the shopkeeper is going to give the tax or is not going to collect the tax from. The shopkeeper is not going to take any GST from that particular consumer, and the consumer only is going to pay to the government. Why? Because he is going to use it for that business purpose. He is going to purchase that goods or products from that particular shopkeeper and he is going to use it for his manufacturing or for the production activity. So he is going to claim input tax credit. That is the reason he is going to pay tax to the government. This is called reverse mechanism in the GST. Next, the GST. I think so if you go for any shops nowadays, that is especially if you go for jewelry shop or if you go for hotel or if you go for any hospitals, okay, so where you are going to pay money, right, on that particular whatever the cash counter or with that office, okay, they are going to keep this number GST and it is a combination of 15 digits alphanumerics. That is the alphabets also there and numericals also there. That 15 numbers of GST number they are going to mention, correct? So what is the GST number? Goods and Service Tax Identification Number. It is mean if whatever the shop or the gold shop or the hospital or the hotel, they are going to register under the GST and then they are going to get this unique number that is called GST number for their particular shop. So they are going to pay tax on that GST number only. So that is the reason usually in the shops they are going to mention the GST number. Okay. So if any other business person comes, he is going to claim that ITC. So if you want to purchase anything for his own manufacturing unit or for his business, then he can claim the ITC quoting that GST number of that particular shop. So that is the GST, Goods and Service Taxes Identification Number. Next, supply. Supply is nothing but the person or the shop who is going to supply goods to the other person or for the other business. So for the supply, they are going to charge the GST, correct? So the supplier is going to supply the goods for the X person and from that X person he is going to get the GST amount. Next, the taxable person. Who is the taxable person in this GST? So as a consumer, we are all the taxable person, or the shops. If for example, the supplier is going to supply goods to that shop. So on that time, the shopkeeper is also a taxable person for the GST. So who is going to receive the goods? They are the taxable person in the GST. Next, the GST returns. We have different GSTR returns are there. Okay. So each we have explanation, that is GSTR 1, 2, 3 subcategories also there, that I am going to explain in the coming slides. Next, the GST Council. I have already discussed in the threshold limits. The GST Council, they are the panel members or the body, they are going to take the decision on the threshold limit or whatever the goods percentage or the GST percentage for that particular goods, or for which goods we need to give the exemption, for which goods we need to charge high tax. All those things will be discussed and decision taken by this GST Council. And this GST Council team headed by the Finance Minister of Central Government. Next, the place of supply. So if for example, I will take the last example only. So Bangalore or from Karnataka, we are going to supply goods to the Andhra Pradesh. So which is the place of supply? So place of supply is the Karnataka, because we are supplying goods from the Karnataka to Andhra Pradesh. So he is the receiver. Andhra Pradesh is the receiver, Karnataka is the supplier on that time. So this is very, very important in the GST. And the last one, time of supply. So in which time or the dates he is going to supply goods from which place to which place. So depending on the time also, the GST rates will be changing, right? So they are going to check this time of supply also. So these are the key terminologies we are going to use in this GST course. Next, benefits of GST in India, or the whatever the advantages. Okay. So first one, reduction in cascading of taxes. So many taxes we are going to eradicate, and we are implemented this GST. That is the first one. Second one, overall reduction in prices. So because of this cascading effect, the product price or the price of the product, that is the MRP value, is going to decrease, and we are going to get at the reasonable price. Next, common national market, that is the global market. All whatever the manufacturer are there, or the suppliers or the exporter, they can easily participate in the global market. Next, the benefits of small taxpayers. So I have already discussed, they are encouraging this small and medium entrepreneurs as well as the taxpayers also. They are going to give the so much of tax reduction or tax rebates, and then they are going to encourage all these people. Next, self-regulating tax system. So this would be all these. If you go for any other states also, the tax percentage or the GST rate of interest is same. So there is no need to explain by any other person. If you purchase in the Karnataka also same, if you purchase in the Andhra Pradesh also, same GST rate will be implicated on the particular goods and services. So next, non-intrusive electronic tax system. So in the income tax, for example, we are going to go for the ITR and the income tax, whatever the website are there we are going to apply, correct, as an individual. But here we are not going to do anything, just we need to pay GST to the shopkeeper, and the shopkeeper will take further head, correct. Next, simplified tax regime. So we have only few interest rates in the GST. So easily we can recognize for this whatever the 0%, 5%, 8% or 28% for which we are going to charge. That is the simplified tax regime. And next, reduction in multiplicity of taxes. So many other taxes we need to pay, that they have eradicated, correct. That is the multiplicity of taxes. Next, consumption based tax. This is earlier also I have told. So whenever we are going to use or the consumer that particular goods or services, then only we need to pay GST. That is called consumption based tax. Next, the types of GST. So we have 3 types of GST. First one is central GST, that is CGST. Second one is state GST, that we call it as SGST. And the next one, union territory GST, that is UTGST. So these are the 3 categories or 3 types of GST we have. Usually if you go for any shopping or if you go for any hotel also, after purchasing or after having all this food, they will give the bill. But in that bill, they are going to mention only these two things, CGST, SGST. If for example, CGST they are going to charge 5% means SGST also 9%. If they are charging 8% of CGST, then SGST also 8%. The equal amount of percentage they are going to distribute for state and central. Correct? So central GST is nothing but whatever the amount we are going to pay as a CGST, that will directly remitted to the central government of that particular country. If SGST, if you are going to pay, that whatever the tax you are going to pay, that will be remitted to the particular state governments only. And UTGST, for example, I am going to send goods from Karnataka to Andhra Pradesh via Tamil Nadu. So on that time, the goods is going to start, that is supply from the Karnataka, it will go to Tamil Nadu and then it will reach the Andhra Pradesh. So on that time, the three states are coming to the picture, correct? So on that time, they are going to check which is for which state we need to pay tax and how much we need to pay and how much we need to pay it for the central. That is the combination of two or more state and one central. Okay, that we call it as UTGST in a simple meaning. Next, the GST interest rates. So I have already explained you the threshold limits. If it is 2 crore or for CGST 9% or CGST 10% or 18%, how they are going to decide? So here we have, these are the few interest rates were there. So based on this, they are going to charge for that particular goods and services. Okay. So first one, GST rates are usually categorized into different tax slabs. The specific rates and the items that fall into each slab can vary by country to country. From one country to other country, the tax slab rate, they are going to change. Why? Because if, for example, if the purchase of any auto vehicles, okay, in Karnataka, they are going to charge more GST. The same goods or the same vehicle, if you purchase in the Pondicherry, they are going to charge very less GST because they have very good number of difference of vehicles are available with the minimum price or the reasonable price, because they have very near to the manufacturing units, or they are going to produce the goods and services or the automobiles for a lesser price. So that is the reason they are going to charge very less price or less GST rates for that particular product. Like that in Karnataka also, the spice items, okay, we are going to charge very less. Why? Because we are huge manufacturing of, or we are going to produce a number of that spices. Okay, like that, the each country to country or state to state, they are going to vary this tax slab rates. The common tax slab might include 0%, 5%, 12%, 18% and 28%. So these are the 5 categories of interest rate were there. And with some goods and services being exempt from the GST also. For few goods and services, they are going to give the completely exemption. So if, for example, they are going to charge 5%. So in that CGST 2.5, SGST 2.5. If they charge 12%, 6%, 6% each, 18%, 9% each. Like that, the whatever the interest rate they are going to charge, they are going to equally distribute for the CGST with the SGST. Next, exemption and special rates. So certain items and services may be exempt from GST or subject to the special rates. So for example, basic necessities like food items, healthcare items, that is your medical, educational services might be exempt or taxed at a lower rate. So compared to other countries or other states, okay, they are going to charge very less, or in some time they are not going to charge also. Next, composition scheme. Many countries offer a composition scheme for small business. So GST's main need is, or the importance is, they need to encourage this SMEs, correct? So under this scheme, the business with turnover below a certain threshold can opt for a simplified GST process, paying tax at a fixed percentage of their turnover. So if it is 2 crore and less, then they will count under this composition scheme of GST, and they are going to pay only the percentage, whatever fixed percentage is there, just they are going to pay that percentage on the whatever the turnover they have made for that particular whatever the goods and services they have produced or manufactured. So that is called composition scheme. Next, we are going to discuss about the GST registration. So how we need to log in to that web page, and what are the process or what are the documents is necessary, and how to go with the standard procedure of GST registration, that we are going to discuss. First, the introduction to GST registration. So why we need to register under the GST, or why we need to take the GST number. What is the importance of GST registration, or what is the need of GST registration, that we are going to discuss. So GST, that is goods and service tax, registration is a fundamental legal requirement for business and individuals engaged in supply of goods and services in many countries that have adopted the GST system. So why we go for this, or why we need this GST registration? Because if, for example, if you are a person not register your company under this GST, and you are going to supply the goods and services for the other shops or for the other state or other country, then that person who is going to receive your goods and services, if he is registered under the GST, then he is not going to accept your whatever the goods and services you are going to send. Why? Because you are not registered under the GST. If you are registered under the GST, you have a GST number. If you have that GST number, then only they are going to accept your goods and service tax. Why? Because they can claim the input tax credit. And this is the legal mandatory nowadays for doing all these businesses. Not only for supply. If it is a small shops also, if it is a clinic, or if it is a small jewelry shop, they also need to take this GST registration, and they need to take that GST number. Because if they want to do shops, or if they want to run a business, this GST registration is mandatory as per the legal requirement. Next, the GST registration process through which a business or an individual register with the tax authorities to become a registered taxable person. GST registration process through which a business or individual registered with the tax authorities to become a registered taxable person for the purpose of collecting and remitting GST on their taxable supply. If, for example, I am also be a taxable person. Why? Because I am directly not paying GST to the government, but I am paying for the shopkeeper. If the shopkeeper is the registered taxable person, then only he is eligible to collect the GST from our customers, and then he can remit that money to the government. If he is not registered under the GST, or if he is not a registered taxable person, then if you pay tax also, he is not going to pay to the government. Why? Because he is not a registered taxable person. Correct? So if you want to collect the GST from the customer, and if you are going to claim the whatever the input tax credit or whatever the benefits you are going to get from the GST, then if you have become a registered taxable person, then only you are eligible to take all these rights or the features from the GST or the benefits from the GST. Once registered, the entity is legally recognized as a GST taxpayer and is required to follow the rules and regulation set out by the GST authorities. Okay, so if you are a registered taxable person, then whatever the GST authorities or the council member, they are going to give some advantages or whatever the tax benefits, whatever it may be. Okay, then you can enjoy all these services or whatever the benefits they are going to offer. If you are not a registered one, then you cannot offer or you cannot get any offers or claims from the GST website. The benefits of GST registration. What is the advantages or what are the benefits we are going to get if you are registered under the GST? So first one, the legal recognition. If you have the GST number or if you are registered under the GST, then you are a legal business authority or a legal business entity to run in the market. If you are not registered, then you are not a legal recognized or legal registered company or a business. Correct? So you are going to run a business, that's all, but it is not a legal one. If it has to be legally recognized, then you need to take the registration under the GST. Second point, The input tax credit. I have already told you the input tax credit is nothing but the refund. Whatever the amount you are going to refund it from the government. If you are registered under this GST registration process, then only you are going to get this input tax credit for your business. Otherwise, you are not going to get this input tax credit, or you are not eligible to get this ITC from the government. So next, complaints. Complaints is nothing but if, for example, any person or any other business, if they are going to misleading whatever the amount they have taken from the customer, or if you have any issues in the GST, or if you are not getting the refund, on that time you can easily claim and you can raise the tickets or the issues as a complaints in the GST website, and then you can resolve or you can get the whatever the suggestion or solution for that particular problem. Next, access to larger market. So if you are registered under GST, you can supply or you can export to the any of the states or any of the countries and any of the business also, because you are also registered under the GST and you have a GST number. So you can do the business legally with the any other persons or any other shops also. Next, the transparency. So if you registered and if you are going to legally recognized business, then the transparency will be there. If you any other person or any other shop, if it is required, they can easily click or they can enter your GST number and they can see whatever the turnovers or how you are going to file the GSTs and you are going to regularly paying the GST or not. All those things they can check. That transparency will be there. Next, competitive advantage. If, for example, if you are not a registered taxable person, okay, then other business or your competitors are registered under the GST. So other persons or whoever is going to purchase the goods and services, they are going to prefer that GST number. Whoever is going to register under the GST, they are going to prefer them and they are going to purchase from their shop, not from your business. And the last one, eligibility for e-commerce platform. So if you are purchasing from any e-commerce platform, whether it may be a Flipkart, Amazon or any other, okay, so for that also they are not going to get the eligibility. If it is Amazon, Flipkart, they are already registered under the GST and they are going to pay tax to the government. If they are not registered, then they are not going to get the eligibility to do the online business or online goods sale and buying in the online sites. That is your e-commerce platforms. So next, the GST registration process. So this is the 4 standard process or standard steps are there in the GST registration. Okay, so first one, application. So first you need to submit the application. So in that application, whoever the proprietor, their photo and their PAN card and whatever the taken permission from the whoever the body is authorized for the business, okay, and other few details of that particular business and the proprietor, they are going to ask in this application. They have to submit all those documents along with the application to the GST portal. That is the first step. Second step will be whatever the supporting documents they are going to submit, whether it may be a permission letter or the whatever the turnover, capital, capacity or the plant and machinery they have purchased or the bank loan, whatever the details they are going to produce. Correct? So that they are going to verify in the second step. So if, for example, all these documents, whatever they have sent, if it is proper, then they are going for a next step. Otherwise, if it is any legal issues are there or any litigations were there, or if we require other documents, then what they are going to do, they are going to resend that particular application to that person and tell them to, or they are going to inform them to submit whatever the required documents are there. That is the second step. Third step will be issuance of GST. So after verification, everything is good or everything is verified, then they are going to give this GST number. So in this GST number, it's going to contain of 15 alphanumerics. Okay, alphanumerics is nothing but the alphabets will be there and the numerical numbers also there. The combination of alphabets and the numericals, 15 digits of alphanumeric they are going to give as a GST number, and that is unique number. Whatever they are going to give it for the earlier person, So it is different from others. Okay, unique number they are going to give as a GST number. Next, so if it is any complaints are there or any litigations were there, then they are going to reject or they are going to ask for the clarity in the final step. So these are the 4 steps they are going to follow for the GST registration process. This is the standard one. Next, the mandatory registration. So for whom and all it is mandatory. Okay. So first one, persons making interstate taxable supply. So if it is a person or a business, they are going to supply the goods for the interstate. So I have given an example, right? So from Bangalore or to the Karnataka, they are going to supply to the Andhra Pradesh or to the Kerala or to the Tamil Nadu or to the Telangana. Okay, like this interstate they are going to supply of goods and services. Then that person should have to register under the GST. So second point, the person required to pay tax under reverse charge. That is, we have discussed, right? Reverse mechanism. So the person is not going to pay tax to the shopkeeper. Indirectly is going to pay to the government. Okay. For that case also they need to register. And the third case, casual and non-resident taxable person. So if he is a non-resident, then he need to register. Mandatorily he need to register under the GST. Next, e-commerce operator or those required to collect TDS. So the online sites, that is your Meesho, Flipkart, Amazon, all these things. Okay. So they need to register under the GST. Why? Because they are collecting TDS or they are collecting GST from the customers, correct? So they have to register under the GST. Next, the persons supplying goods through e-commerce operators. So if for example, Meesho, the Meesho is not going to supply the goods and services. The manufacturer, okay, through the Meesho, they are going to supply the goods and services. On that time, whoever the manufacturer or whoever the suppliers, okay, they need to register mandatorily. Next, persons making supplies on behalf of a registered taxable person. Okay, if for example, Amazon is the registered taxable person. Under that, for example, e-cart, okay, or e-com, okay, they are going to supply the goods and services. Correct? So on that time, that e-com express or the e-cart, all those things, they have to register under the GST. That is also mandatory. Next, input service distributor. So whoever the distributor main work is to, or main business is to, they need to distribute the whatever the goods and services are there or the products are there, they need to distribute, correct? So on that time, they have to mandatorily, they need to register. Next, every person supplying online information and database access or retrieval services from a place outside India to a person in India other than a registered person. Okay, so if you are supplying of data, okay, or you are going to do the retrieval services, whatever the data backup you are going to take for all these companies or all these services agencies, okay, they need to register under the GST. Next, the registration GST to be granted state-wise. So this GST will be given or they are going to provide it the state-wise. That is mandatory, and PAN mandatory for GST. In the process, I have already told you, right? So in the application, the proprietor has to submit the PAN card or PAN number, because on that basis, they are going to take this GST number. And the last one, the separate registration permitted for multiple business vertical in a state. So if for example, I have 3 different kinds of products and services companies. One is I am there in the food industry, I am there in the automobiles, and I am there in the stock market business. And one more is iron business, I am there. So if in the same name, I have 4 sub businesses, correct? So on that time, I need to take for individual business unit. For iron, I need to take separate. For food, I need to take separate, or for irons, or whatever the automobiles I have. For that, individually, I need to take the GST number. That is also mandatory for all the persons whoever running the subunits under the one name. That is also mandatory in the GST. Next, we are going to discuss about the input tax credit. that is your ITC. So already we have discussed, right? So it is nothing but as a refund, whatever the refund we are going to get from the government. Okay, that is called input tax credit. We'll see in detail. So input tax credit is a fundamental concept of goods and service tax system that allows registered business to claim a credit for the GST they have paid on their purchase and expenses. So whatever they have made the purchases, for that they can get this input tax credit, and for their expenses, sometimes they are going to spend for that goods and services for their business also, correct? So that is the expenses. For that also they are going to pay GST. So that will be refunded from the government as a input tax credit, ITC. The ITC helps reduce the overall tax burden and prevents the double taxation. So whatever the purchases they have already made, and for the expenses they have paid for the GST, so that will be, again, there are no need to pay that GST for that particular goods and services, or for that particular purchase of that goods and services. So that is the input tax credit. Next, the eligibility criteria for ITC. The conditions and criteria that businesses must meet to be eligible for ITC. So we have some eligibility criteria. If they meet that, okay, then only they can get the ITC or the refund from the government. So these are the conditions, or typically include the first one being a registered taxpayer under the GST. So we already seen the GST registration process, correct? So there is a need of GST registration. So if you are registered under the GST, then only you can claim the ITC. That is the first eligibility criteria. Second one, using the purchased goods or services for business purpose. So if you are going to purchase the goods and service and you are going to use that goods and service for the business purpose, then you can get the input tax credit or the refund from the GST or from the government. Next, the processing valid tax invoice and documents. So whatever the valid documents you are going to produce, or they are going to given for the GST portal, they are going to verify the documents and then only they are going to give the input tax credit. If it is valid, then only they are going to give. If it is not valid, they are not going to give any refund. And the last one, complying with GST laws and filling returns. So you need to obey for the whatever the GST rules and regulations are there. You need to obey for that, and then you are going to follow the whatever the rules and regulations for filling the returns in the GST portal. Then only you can claim the GST return, or you can get the input tax credit from the GST. So types of input tax credit. So what are the various types or varieties of input tax credits were there? So first one, input tax credit on inputs, that is the ICT one. Okay, so here they are going to give the whatever the inputs you are going to give. As per that, they are going to claim the ITC. Next, the input tax credit on capital goods. So as per the form of ITC2, you can claim the whatever the capital goods. Okay, on that you can get the refund or the input tax credit on the capital goods. Next, input tax credit on input services. So whatever the services you are consumed or you are taken for your business purpose, that is also you can get the ITC as per the ITC3. Next, blocked credit. So as per the ITC4, for few they are not going to give any refund. So it is blacked under the GST only. So that blocked for whatever you are going to do the transaction with them or with that GST number, that won't get the input tax credit as per the ITC4. And next, ITC in special circumstances, ITC5. For example, in the pandemic time, okay, they are going to give some free hand or exemption for the whatever the medical requirements are there. So or any emergencies are there. On that time, they are going to give some special circumstances. So on that time also you can get the ITC under this ITC5. And the last one, the transactional ITC. So transactional input tax credit is nothing but whatever we are going to waive off. For example, we are going to blending with the old taxation system and the new taxation system. So we have paid tax in the old system as well as new system. So on that time, we are going to verify how much you have paid in the old system, that they are going to transit in this new system and they are going to give the returns in this ITC. Next, we are going to discuss about the returns process under the GST. So here we are going to discuss about what are the varieties of GSTR returns are there and what is going to indicate. For example, GSTR 1 or GSTR 2 till GSTR 11 are there, correct? So that we are going to discuss in this video. So in general, the returns is also known as complaints verification. So how we are going to, like for example, income tax, we need to e-file and then we are going to get the form 16, correct? So like that, here also we need to do the whatever the turnovers as per the transaction or as per the turnover, we need to file or we need to do the verification for all the whatever the submitting the vouchers or the supporting documents with the GST portal. The mode for transfer of information to tax administration. So this is the way or the path we are going to follow to give the supporting documents or our turnovers. So this we are using as a mode. So GSTR returns. Okay. So to declare tax liability for a given period. So usually we are going to do the tax calculation for the 1 year, that is 12 months of period. It's going to start from 1st April of that particular year to the 31st March of the next year. So within that 12 months of time, whatever the turnovers they have done or whatever the transaction they have done, that they are going to given in that particular GST rates or whatever the GST they have collected. As per that, they need to file and then they need to pay the tax. Providing necessary inputs for taking policy decision. So as per the GST, whatever the decisions are there or whatever the mandatory rules and regulations are there, so that they need to taken care in this GST returns. Next, the features of tax returns in GST. So what are the features or the characteristics in this GST tax returns? So first one is based on transaction, that is invoice based tax return. So whatever, for example, the goods and service tax. So we have 0%, 5%, 8%, 18% and 28%, correct? So based on that, they are going to invoice based, they are going to do the transactions. Next, designed for system based matching of input tax credit and other details. So this will be applied in the import and export. So whatever the matching the input tax credit, that is the refund. So if for example, I'm also having the GST number, I'm going to supply goods for the other GST or the taxable person. So whenever they are going to import and export, so on that case, so I'm going to supply the goods for the taxable or registered taxable person. On that time, I can claim the input tax credit. So that is the reason we require this GST returns. Okay. So auto population from details of outward supply. So all the GST or whatever the transaction you are going to do with your GST number, that will be already recognized or registered under this GST portal. So auto reversal of ITC in case of mismatch. So the reversal process, that is reverse mechanism, that will be applicable here also. And the concepts of ledger, cash account or input tax credit and the liability. So all these concepts will be there in the GST portal also. So whatever the ledgers you are going to maintain for the particular account or for the particular business, that is there, or cash account you are going to maintain, or the ITCs, input tax credit you are going to get, all these things will be maintained. And the last point, no revised returns. So here once whatever the date on that particular time, what is the GST rates were implemented, okay, that will be charged. That not is going to revise or they are not going to do any changes in that GST rates. Here are the different types of forms are available for the GSTs or GST certificates. Okay, so standardized forms are from GSTR 1. So this is one form. So here detailed of outward supply of taxable goods or services affected. So from this GSTR 1 filing, we are going to get the outward supply of taxable goods and services. Next, we have GSTR 1A. So in this, details of outward supply as added, corrected or deleted by the recipient. So if there are any added or if they are corrected or whatever the addition they have done, or if it is deleted from that portal, okay, that they can claim in this GSTR 1A. So next, GSTR 2. So details of inward supply of taxable goods or services claiming input tax credit. So whatever the goods you have purchased for the purpose of manufacturing or for this purpose of supplying for the others, then for that whatever the input tax credit you are going to get, that will be there in the GSTR 2. Next, from GSTR 2A, that is details of inward supplies made available, know the recipient on the basis of form GSTR 1 furnished by the supplier. So through the GSTR 1, they are going to collect the information and they are going to create a report in the GSTR 2A. Next, GSTR 3. So monthly returns on the basis of finalization of the details of outward supplies and inward supply. So what is your final output supply you have made and input supply you have made? That will be taken in the monthly wise GSTR 3 form. Next, under the GSTR 3A, notice to a registered taxable person who fails to furnish the return. That will be given in the GSTR 3A. Next, the GSTR 4. So the quarterly return for compounding taxable returns. So in the GSTR 3A, we are going to get the monthly wise, correct? But in the GSTR return 4 or in the form of 4, we are going to get the quarterly wise. That is 3 months of report we are going to get. And the compounding taxable value is going to give. Next, from GSTR 4A. So details of inward supply made available to the recipient registered under the composition scheme on the basis of form GSTR 1 furnished by the supplier. So the supplier is going to give all the inputs, right, in the GSTR 1 form. That will be, we can take in the use of 4A also. Next, the form GSTR 5, written for non-resident foreign taxable person. Okay. So whatever the return the non-resident or the foreign person or foreign taxable person is going to claim or is going to make the entries, that will be taken care in the form GSTR 5. Next, form GSTR 6, it will be taken care by ISD returns. Next, form GST or 6A, the details of inward supplies made available to the ISD recipient on the basis of form GSTR 1 furnished by the supplier. So here GSTR 1 form is the mandatory, because from that only they can get to know the whatever the supplier or they are going to give the inputs in that GSTR 1. Next, the form GSTR 7, written for authorities deducting tax at source. So from which sources they are going to deduct the tax, that will be taken care in the GSTR 7. And next, form GSTR 7A, TDS certificate, that is whatever the tax deducted at source, that certification they are going to made in this GSTR 7A. Next, the form GSTR 8, details of supply affected through e-commerce operators and the amount of tax collected. Your online sites, that is your Flipkart, Amazon or Meesho, all those commerce companies are there, correct? So they are going to take all this, whatever the supplies they have made, that they are going to tax collected, that they are going to take care in the GSTR 8. Next, the GSTR 9, that is the annual return. So combination of all this, like transactional wise, day wise, monthly wise, quarterly wise, off yearly or annually, all this information they are going to collect and they are going to generate this GSTR 9 form. Next, the GSTR 9A, simplified annual return by compounding taxable person registered under section 8. Okay. So the compounding taxable registered person as per the section 8. Okay. They are going to get the simplified annual reports for this GSTR 9A. And next, form GSTR 9B. So reconciliation statement. So if any changes are required or whatever the entries you have made, okay, that is wrong. Then what they are going to do, this 9B, as per the 9B, the reconciliation will be done and they are going to verify. And the next, the form GSTR 10, the final return, whatever you are going to submit for your company or for your business, that you are going to submit the final return as per the GSTR 10. And the last one, that is form GSTR 11, details of inward supplies to be furnished by a person having UIN, that is unique identification number. Okay, the detailed inward supplies they are going to given for in the GSTR 11. Next, the annual return. So the annual summary of all transaction, I have already told you, right? So in that annual transaction or annual return, so the each transaction wise, day wise or monthly wise, quarterly wise or half yearly, okay, all this information they are going to furnish and they are going to give the annual return. Next, accounts to be certified by the chartered accountant. So before you submit all these documents or all this transaction, that needs to be audited or the verified by the CA or etc. That is your accounting manager or internal audit team. They need to do the auditing, verified, then they need to. So if your turnover more than rupees 2 crore, then the CA should be audited or verified. If your transaction is less than 2 crore, then no need to go for the auditing. Next, the personal details, that is the proprietor details. If for example, any person you are going to supply the goods and that person GST number or personal details that you need to given. Next, detail of expenditure, whatever the expenditure you have made for your transactions that you need to mention. Purchase, that is goods or services, or intra or interstate you are going to purchase the goods and services, that you need to mention in the annual return. Imports, if you are going to do any imports of goods and services or the raw material or ancillary service products for your supply, that you need to mention in the annual return. Next, the details of income, how much income you have generated, that is your gross profit, net profit, all this information should be there. Supplies, goods or services or intra or interstate. So if you are going to supply goods and services of intra or interstates, then if you are a supplier of a goods and services of any intrastate or interstate, then you need to mention that in the annual returns. Exports and imports also you need to mention, and not to be filled by the ISD, TDS deductor, casual taxpayer and non-resident taxpayer. So this is about the annual report or annual return you are going to submit. Next, the refund from the GST. So how we are going to get the refund from the GST? The time limit for claiming the refund enhanced 2 years from the relevant date. So if for example, for this particular date or in this month, whatever the date, okay, you are going to do the transaction. From that date to 2 years of time is there. So within the 2 years, you need to claim the refund. After 2 years, you can't claim the refund from the GST. Next, the refund of input tax credit allowed in case of exports or where the credit accumulation is on account of inverted duty structure. So whatever the exports you are going to make or the accumulation of all the accounts, that is also refund of input tax credit. So next, refund shall be granted within 60 days from the date of receipt of the application. So once you submit the application for refund, within 60 days you will get the refund amounts. In case of refund claim on account of exports, 90% of the claim can be given immediately within the 7 days of provisional basis. So if you require the urgent basis money, then within 7 days they are going to give the 90% of the whatever the refund claim is there for exports. Next, no need to furnish evidence against the unjust enrichment if the refund claim is less than rupees 2 lakhs. Self-certification would be sufficient. Okay, so whatever the less than 2 lakhs rupees of refund if you are going to apply, so self-certification is enough. And the last one, interest payable after 3 months from the date of receipt of application till the date of refund. So you need to pay after 3 months, interest payable for after 3 months from the date of receipt of that whatever the refund date you have mentioned or you have applied. So in this video we are going to discuss the what is the GST website, how it will be looks like, and what are the features, or how we can get to know what is the new updates are there in the GST portal, how to log in. All those things we'll discuss in this video. Okay, so this is the GST platform. Okay, so here you can see how this GST interface look like. Okay, so here they are given goods and service tax, the home page. If you go for services, here we can go for registration. I already explained you, right? So application. If you go for new registration, so if you go for new registration, if you click, then whatever the details, we have 4 steps, correct? In the first one, the application. So in that we have so many details or the information they are going to ask, that proprietor GST number or the business entity name, all these things you need to give, and the whatever the supporting documents is required, you need to submit in the new registration. Then they are going to verify, and they are going to issuance of GST number, and if you have any issues or the litigation or any other problems, then they are going to revert the application. So this is what I explained in the application of GST registration. Next, after applying, you can track your application status also. You can go and click on that, and you can see what is the status of your application, whether it may be in a verification stage or assurance, or if any litigations are there or any problems or issues they are facing, and if they require any supporting documents, all those things you can track your application. And application for filing the clarification. So if any issues they have raised, okay, on that time you need to resolve that issues, or you need to give the clarification for that particular issues, correct? So on that time you can go for this tab, and you can click, and you can give the whatever the clarifications or supporting documents is required for that particular application. So this is the registration one. Next, if you go for payments, so if you need to pay GST, okay, as a taxable person, okay, if you want to go for create a challan, and then you can go and download that challan, and you can go for a banking, and you need to pay. That is also available. Or grievance against any payment system. For example, I have paid the money, but it is under the process, or it is not reflecting in our bank account, or some other issues are there. Then you can go for this grievance against the payments, and they track the payment status. So whatever the amount you have paid or payment you have made, that tracking system is there. Okay, you can go and you can check here. User services. So all this HSN code or generate user ID or unregistered applicant, cause list, verify RFN, holiday list, everything will be there. You can check. Refund, ITC, the input tax credit. So track whatever the input tax credit we are claimed or we are going to apply, that you can go and track in this application status. E-way bill system or track application status. All these things are available under this service tab. Next, the GST law. So under the GST law, you can see what is the rules and regulations or notification, or any central government or state government, if they are going to give some new changes or if they made any new updates. All those things will be given in this tab. Next, the downloads. So offline tools, GST statistics. So in the offline tools also, the returns or the GSTR 3B offline utility or ITC 03 offline tool, all those things we have explained, right? So GSTR 1 to GSTR 11 or ITC 1 to ITSF 4, all those things will be there in this offline tools. And GST statistics. So whatever the data you required for the GST, that is available here. Taxpayers. If for example, search by the GST number or unique identification number, through that we can search that person or the business. Okay, search by the PAN number of the proprietor or the temporary ID, or the search by the composition taxpayer. All those things are the available in the website. Other than that, the e-invoice are there. So if you want to log in, once the application is success, and then if you got the whatever the GST number, then you can go here, click on login, give the whatever the GST number as a username, and whatever the password is there, just click on the password or enter the password. Then you can log in and you can do the whatever the GSTR 1 to GSTR 11 or ITC 1 to ITSC 4. All these documents you can fill and you can submit and take the whatever is required from the GST portal. And see here, whatever the new updates are there in the GST. Okay, whether it may be a state government, central government is going to give an update, right? That is give year. So recently what is happened or recently what is the update, everything will be given here. And the FAQs, usually we give it as a frequently asked question. So popularly help tips or topics. So how can I opt for the composition? How can I use the returns offline tool? How do I apply for refund? All those things, the answers also they are given. Just click on this, whatever the questions you have, then you can get the answer. So help desk number or whatever the taxpayer, if you want to register or find a GST practitioner, all those things information they are going to give here. And if you come here about GST, so the GST council structure, I've already explained you, right? The GST council is a team or a panel member headed by the central finance minister. So now the central finance minister is Nirmala Sitharaman, correct? So they are heading this GST council member, and the structure is also available here. If you click here, you will get to know. And the GST history. So when it is implemented or amended in the India, and when they have started executing this GST in India, and the GST rates, everything is given in this GST history, website policies, all these things, related sites or Central Bank of Indirect Taxes and Custom, CBIT and state tax website, national port, all this information is available in this GST website. So once you have the number or your GST number, then only you can go and you can log in for the GST claiming, or you can do the whatever the transaction you are going to update, or you are going to fill the information through this login only. So summary, here is a quick recap of what we have learned in this particular session. Okay, so India's tax structure includes both direct tax and the indirect tax. For direct tax, it is a income tax, and it comes to indirect tax, that is the GST, the custom duty or the excise duty. GST is a crucial part unifying various indirect taxes. That is they have done the so much of replacement of so many indirect taxes, and then they have implemented this GST. That is the cascading effect they have done. Okay, next, the GST goods and service taxes is a unified tax system in India, replacing a complex web of indirect taxes. It's designed to simplify taxation and promote economic growth. So to reduce the tax burden, they have eradicated or they have reduced so much of other tax burdens, and then they have implemented this GST, and they can promote the economic growth for this implementation of this GST in India. Next, the GST structure in India comprises, that is, the different types of GSTs, CGSTs, SGSTs and IGST, each with specific rules and regulations. Okay, it also features different tax slab rates for goods and services, that is your 0%, 5%, 8%, 18%, 28%. So these are the few tax rates they have done, correct? And the next point, the GST registration is mandatory for business that meet specific criteria. It grants legal recognition as a GST taxpayer. So if you are registered under the GST, then only whatever the advantages or whatever the benefits offers is given, okay, that you can enjoy. Otherwise, you cannot get the any benefits from the GST portal or from the government, because you need to be a taxable registered person. Then only you can get all these benefits. Next point, the business must regularly file GST returns to report their transaction, sales and purchases. Compliance with return filing is essential for GST compliance. So we have discussed that GSTR 1 to GSTR 11. So continuously or the regularly we need to update all the transaction or the quarterly wise, monthly wise, all this information in the GST portal, so that you can generate the annual reports. So ITC, that is input tax credit, allows business to claim credit for GST paid on purchases, reducing the overall tax burden. So whatever the input tax credit, the taxable person can refund from the government, and he can purchase on whatever the purchases and expenses. Next, the online GST portal that we have already seen, right? So how the GST portal looks like, and what are the features or whatever the tabs are available in the GST portal for the users, okay, are the government platforms that facilitate GST registration, application of GST, return filing and complaints for the taxpayer. All those things we can use in the GST portal. So these are the few things we have discussed in this particular session. Thank you. So in this session we are going to discuss about the first one is introduction to GST, that is the basic concepts like definition, purpose, or what are the different rates of GST are available and what is composition scheme, regular scheme, all those things we are going to discuss in this first point. Next, we are going to discuss about the configuring GST in Tally. So if you want to install or if you want to execute the program, okay, so what are the configuration are required in the Tally software, that we are going to discuss. Next, GST complaint invoicing. So is there any complaint receipts against our GST number, okay, and how to create an invoice, all those things we are going to learn. Next, we are going to discuss about the input tax credit in Tally. In short, we call it as ITC. So whatever the money or the claim we are going to get from the government, that is called ITC. Next, GST returns filing. So we have various types of GST returns, correct? From GSTR 1 to GSTR 11, okay? So that we are going to look in this. Next, RCM, that is reverse charge mechanism. So what do you mean by reverse charge mechanism? How to charge or how to create a voucher and how to make an entry, all those things we are going to discuss. And the next we are going to discuss about the advanced GST topics in Tally. And the last one we are going to discuss about GST audit in Tally. So next we are going to discuss about configuring GST in Tally. So here we are going to discuss about, so what are the features we are going to enable and which are the features we are going to disable, all those things we are going to discuss. Why we need to disable and enable the features means according to our business or the turnover of the organization, depending on that the GST rates or the products and services of the organization, depending on that also we need to add some features or we need to disable some features of Tally, that is GST in Tally, okay, that we are going to discuss one by one. So first one, the enabling GST features in Tally. So which are all the features we have and which are we need to enable, that we are going to discuss. This is the gateway or this is the way to enable the GST features in Tally. So first one, to activate the GST in Tally, open the Tally software. Okay, whatever the Tally software you are going to download, install, and whatever the license key you got from the Tally website, that you need to enter, then you need to open your Tally software. Okay, that is the first step. Second, select the company. You already created some companies, right? Whatever your organization or any other business, that is your competitors, suppliers, or any other organization. If you are created a company or created a voucher on the company name, then you need to select which company you need. Okay, you want the suppliers or you want the your creditors, debtors, whatever it may be. Okay, you need to select their company. Third step is to enable GST features. You will have one more tab called enable GST feature. If you click on yes, then it will open what are all the features are available in the Tally software. Okay, next select statutory and taxation features. Once you enable the GST feature, next tab will be the select statutory and taxational features. Okay, in that whatever the according to your company goods and services or nature of the industry or whatever the turnover limit of your organization, all those things they are going to check, and then few features are shown in the Tally software. Next, enable GST. After selecting which are the features you require, then you need to create or you need to click on enable GST. Then you need to configure GST details. If for example, if you are taking the XYZ company name, so for that XYZ company name, they have to register under the GST portal, and then they will get the 15 unique digit of GST number, that is goods and services tax identification number. Okay, that GST number they need to give, and what are the other details they are going to ask, that they need to submit. Next, save configuration. So once you added whatever the configuration details it's going to ask, once you filled, okay, next you need to click on the save configuration. After that, update masters and ledgers. You need to link to the whatever the master report is there and whatever the ledgers we created on the XYZ company name. Okay, for all those things we need to link all these GST number, because all the each and every transaction, okay, with that XYZ company name, that will be linked and that will be take it as a count. Okay, next, set GST rates. So I already told you, on the basis of nature of your industry and whatever the goods and services you are going to produce or you are going to trade. Okay, so what is the GST rate for that particular goods, whether it will comes under the like standard goods and services or zero exemption or the luxury goods. So based on that we are going to give the GST rates, correct? So that you need to give the GST rates for the each products and services. Next, enable GST vouchers. So for each and every vouchers, okay, the GST number will be mandatory. So it is there in the company name, GST number, because for each entry we are going to categorize with this GST number only. And the next, save changes. So what are the GST rates you entered or whatever the GST vouchers you have given, for that you need to do the save changes. And the last one you need to do is verify the reports. So once you enter, you need to cross verify all the details were correct or not, or in the report it is showing or not, that you need to check. Just I will show you the steps in the Tally software also. So once you go to the Tally software, here we have a gateway of Tally. In that we have create, alter or charts of accounts. So in that we need to go for create if you are creating new, okay, because I have already created ABC Private Limited, so I need to go for alter. So if you go to alter, you will show the options of accounting masters, that is group, ledgers, and in inventory statutory master. I already told you, right? Statutory and taxation options will be there. So you need to create on company GST details, because we need to give our company GST details, then only we can create for other companies, correct? If you are not registered or your company is only not registered under the GST, then how can you are going to give other company GST details, correct? So first you need to go for this company GST details. So it will open here. So this is the tab. Here we need to give the all the details. See here, HSN or SASC details, the GST classification. So specify details here or US GST as classification. Just I will click on that. So classification XYZ, because we already created our company. So XYZ. Next, the GST rate details. Suppose that if you have, for example, so whatever the goods and services you are going to trade, depending on that you can click here, specify details here, then you can enter all the GST rates or specify slab based rates or use GST classification. I will click on use GST classification. And next, the classification. If you want to create any classification or if you are already created, then you need to select here. Next, effective date for revised GST details. So for your books of entry, for example, we are going to start from the 1st April of 2023 and end on the 31st March of 2024, for example. So you need to select on this is 1st April 2023, because last entry we have made on 1st April. So this is our books of accounts that we need to enter. Next, the e-way bill details. So we can fix the threshold limit also. So interest threshold limit. So 50,000, here also 50,000, or according to your company. So what is there in the GST portal, you can enter the value here, because this is dummy I am creating. So I am not going to in depth, not going to what is the value for that goods and services, all those things. Just we have given the value of 50,000. So here threshold limit includes the list of values, value of invoice, value of taxable and exempt goods, value of taxable goods. I will select the value of invoice because we are entering the invoice values only. Okay, we don't know what is the invoice taxable value or invoice other values. Okay, so next, so show GST advances for adjustments in the transaction. If you want to know what is the adjustment they have done in the GST invoice, you need to click on yes. Otherwise, if you are not required, then it is no only. So I am not going to enter yes, it is no only. So just after that, click on tab, then it will ask the pop-up here. So whatever the transaction or whatever the details we have entered here, that you are going to accept or not, or if you want to create these details or not, just click on yes. Okay. Next, the company details are created. Next, you can go for GST registration or GST classification. Okay, that will also I will explain you once the theory part is completed. Okay, so after activating the GST features, next we need to do the configuring GST taxation. So once we activate, okay, next we need to check what are the GST taxation are available in the Tally software. Okay, so first one, open Tally software. Okay, that is the first step for all this, whatever enable, disable, configuring, activating, for everything. Okay, next select the company. Why this is mandate means which company you are going to enter the details. Okay, randomly we can't enter any details. If for example 10 companies are there, okay, so in that which company you are going to enter the details, that is very important, right? So that is the reason we need to select that company. It may be your competitors or your whatever the suppliers or vendor or your any other companies. Okay, so that company you need to select, then access the company configuration. So what are the configuration are there for that particular company, you need to check first. Next, enable GST details. GST details is nothing but the GST number or whatever the address, authorized address or the head office address, phone number, mail ID, all these details will be there, correct? So that you need to enable. Next, set GST details for stock items. So individual stock items. For example, in the same company, we have 5-6 categories of products. Okay, so each product have the different GST rate. For example, so one category will be 0%, one category will be 5%, another will be 18%, and some goods are comes under the 28%. So in that category, you need to select each and every stock items, which category that belongs to or which GST rate it will be implicated for that particular goods. Okay, that is very important. Next, configure GST ledger accounts. So once you enter this GST rates for the particular stock items, then you need to link it to the ledger accounts. If for example stock, we are going to create a ledger account, or we are going to create the particular debtor name or particular creditor name, all those things we need to link this GST ledger accounts. Next, define GST classification for services. After goods, okay, we have services, we are providing some services also, or that particular company is in the service sector also. So for that, we need to define what is the GST classification, which category it will comes under. Okay, that we need to do. Next, configure GST parties. If for example service sector means 2 or more persons will come, correct? So on that time, which are all the parties are involved in that particular services. Okay, that you need to select which are the parties. Next, check GST reports configuration. So what are the GST reports and what are the configuration are there or required for your GST reports. So if for example we are preparing financial reports, then also we need to, based on our inventory turnover or the net worth or the turnover of that particular company, we need to select the which type of balance sheet is required or which kind of reports we require, correct? Like that also in GST, which kind of or which configuration are required for the GST reports, that we need to enable. Next, enable GST voucher types. So we have different kinds of voucher types are there. Okay, that is your purchase, sales, purchase return and sales return, credit note, debit note, all these entries. Okay, for that we need to create each entry or each voucher for the particular transaction. And the last one is save configuration changes. So what are the configuration you have done or added or the enter in your configuration item, that you need to click on save changes. In the bottom right corner it will show, right? Pop-up will come. Accept yes or no. If you click on yes, that will accept and it will generate. If it is no, again if you want to do any changes, you can do it and then you can click on yes. Now I will show you in the Tally software also. So before that, activating, we have come to statutory details. In that, company GST details we have given, correct? Next, here we need to go for GST registration or the GST classification. So first I will go to GST registration. See here, GST registration already exists for the company. Do you want to alter the existing GST registration or create a new GST? So I've already created for my reference. So if you want to create new, you can click on create new, or if you want to alter, you can if you want to alter, then you need to click on alter existing. Okay. So for your reference, I will show it on create new. Just if you click on create new, it will show registration status active. So your GST number is active or not. Okay, that first one it will show here. And next state, you need to click on Karnataka or whichever the state it is, you need to select that particular state. Next, registration type, you are a regular or composition or regular SEZ. Okay, which one you are belongings to, that you need to select. I will select as composition. Why? Because we can use goods and services, assessee of other territory. If you are assessee for other territory, if you yes, then you need to click on yes, otherwise it is no. Just move on. Next, GSTIN or UIN, that is goods and services tax identification number or unique identification number. The 15 digits of unique number it will be there. Just you need to click on that, then you can look for yes. So if you are not given any GST number, it will show it GST or UIN is not provided. Press any key to continue. So if you have, you can give, otherwise for dummy I am creating, so I can go move on for the next category. So tax rate for taxable turnover, whatever the tax rate is there, you need to click or you need to enter here, and then you can go for next. Calculate tax based on taxable value or taxable exempt nil rated values. I will take this one, first one, that is taxable exempt and nil rated, because one company have the several goods and services, correct? It may be comes under the 5% category, or it may be 0% or exemption, anything, correct? So next, the e-way bill details. E-way bill applicable, yes, applicable from 1st April 2023, that is the books beginning year from that. So next, applicable for interstate, yes, because if you are doing intrastate or interstate, that is also depends. Based on that, you need to select this. Okay. Okay, no issues. So here I need to create it for any other state now. So I will check on Maharashtra. Okay, same thing, we need to select. Now we can select, that is accept yes or no, because already created for Karnataka. So again it is asking for other state. Same state we can't create one or the other time or one or the more time. Okay, so yes. Okay, so I have already told you, right? So different types of vouchers are available. So these are the features, that is the voucher types are available. Contra entry, credit note, debit note, delivery note, job work in order, job workout order, journal, material in, material out, memorandum, payment, payroll, physical stock, purchase, purchase order, receipt, receipt note, rejection in, rejection out, reversing journal, sales, sales order, and stock journal. So these are the 24 types of voucher are there. Okay, so for each one you need to select the what is the GST rates or whichever the applicable GST tax rates, all those things you need to create and you need to enter for each type of voucher entries. So these are the 24 types of voucher entries are there. So if you want to create any one organization company's details, means you need to enter all these details with the whatever the applicable GST rates, and then you can go for the further steps in the GST in Tally. Next, we are going to discuss about the GST rates and HSN or SAC codes. Okay, so we'll discuss about what you mean by HSN, what you mean by SAC, and how it will impact on our GST reports. Okay, first, assigning HSN or SAS codes. So how to assign these codes first? Okay, so first open the Tally software. Next, select the company. These two steps are mandatory or standard for all these whatever the codes we are going to enter or whatever the configuration we are going to do or activating for everything, these 2 steps are standard. Next, access inventory configuration. Why the inventory is required? Because these codes, HSN or SASC codes, are configured for the access inventory configuration. So why it is inventory is important here means, so for all the stocks or the goods are there in the organization, based on that only we are going to enter this HSN or SASC codes, correct? So for that reason we need to access the inventory configuration first. Then enable use advanced entries. So you need to activate this, enable the use advanced entries. Then you can go for assigning a HSN or SASC codes to stock items. If you are not enabled, then this feature will not available in the Tally software. First we need to enable, then we need to assign the HSN or SASC codes. Next, assign HSN or SASC codes to services. After goods, we need to enter the same for the services also, based on their whatever the rates or the HSN codes are there. Okay. Next, bulk assignment of HSN or SASC codes. So for example, if you are going to enter for one goods or one services, then whatever the bulk or the multiple goods or services are there, just you need to go for bulk assignment of HSN or SASC codes. Next, verify HSN or SASC assignments. So what are the you have done, or you have done the bulk assignment, correct? So whether it is properly showing or not. HSN or SASC codes are available for all the stock items or not, just you need to check that also. And the next step, we need to go for update the masters. So master ledger entry you need to check there also, and we need to update. And the next step is generate reports with HSN or SASC codes. Okay, so we can generate the reports with using this both the codes. And the last step, that state inform about HSN or SASC codes changes. Then you can go for save configuration changes. So once you save, then only it will create or it will show in the other whatever the stock items or the inventory items are there in the organization. Okay, so just this I will show it in the Tally software also. See, if you go for master creation, there you have GST classification. If you click on this GST classification, so whatever the company name, that is GST name, we can give the GST name, for example XYZ. Name already exists, so we can give one more name, that is ABC. Next, specify the HSN or SASC details here. If you have, you can specify. Next, HSN or SASC, just I will create XYZ. Next, description. Okay, it should be maximum of 8 digits. Next, GST rates related details, GST rate details, specify if you have, or slab rates, which is based on your organization, you can select. Next, taxable type, taxable, non-GST, nil rated, exempt, because we have all categories. 0% is there, 5% is there, 18% and 28%. So it is which category it will comes under, exempt or nil rate or non-GST or taxable. Okay, just I will select exempt. Yes. Next, if you want to create one more or whatever the other entries for goods and services you need to create, just you can select it here. Okay, this is how HSN and HSAC codes will appear. Once you create, then only you can go for individual stock item. So whatever the stock we created, like exempt or nil rate or taxable, based on that you can go and you can map to that particular inventory in the organization and the services of the organization also. Next, the GST compliant invoicing. So types of GST invoices, that is first one, tax invoice, bill of supply, and the debit and credit notes. So tax invoice is nothing but, so whatever the taxable value you are going to trade, or you are going to sold, or you are going to buy, that taxable value, that invoice is available. So once the other company, if for example I am going to purchase goods of 50,000 from the XYZ company, so that XYZ company will create one voucher and they are going to give a receipt, correct? So that entry you can go here in the tax invoice if it is a GST bill. Next, bill of supply. If you are going to supply the goods for the other person, that is your company suppliers, okay, you are supplying goods for the other company, then that bill of supply you need to enter here. Debit and credit note, this is called the purchase return and the sales return. If for example whatever we have purchased, some damages are there, then what we need to do, we need to return that goods to that particular company or to that vendor, correct? So at the same time, if we have sold goods to the customer, so on that time if damages are there or if some changes are there, then what they are going to do, they are going to return that goods to us, correct? So that is the debit and credit notes in the types of GST invoices are there. So these three are the broadly classified categories of types of GST invoices. Creating GST invoices in Tally. So first, what is the invoice format and the components are there? First we need to learn that, correct? If you know this information, then we can easily create a GST invoice. If you are not sure what are the components are there, then we need to search and we need to check the details for each and every item. So first one, assessing invoice voucher type. So which type of voucher it's belongings to, whether it may be a tax invoice, bill invoice, or the debit and credit note, that we need to enter. Next, we need to enter the invoice number or the bill number we need to enter, and what is the products we have purchased, how many quantities, and what is the rate per goods or per product, and what is the total amount we paid. Okay, all those things we need to enter here. Next, selecting stock item, which goods or which stock we have to enter here, that we need to select. Next, HSN or SASC codes that we can easily enter, because for these goods and services or this particular service, this is the code. Okay, we can enter. Next, tax classification. So under which category or under which rate of GST it will fall, that we need to check, and tax classification we need to do. Next, any input tax credit is available for this particular transaction, that we need to check. If it is any ITC is available, we need to enter. If not, there is no need of entering ITC here. And the next one, invoice total, that is how much is the number of quantity you are going to purchase, what is the price per quantity, multiply with that, you will get the total of number. For that, what is the GST rate is applicable and what is the ITC is available. Based on that, you will get the total invoice. And the final step, if you want to keep an hard copy, okay, or if you want to file it, then you need to click on save and print. Otherwise, you need to only click on save. Okay, so this is the steps involved in creating the GST invoices in Tally. Next, we are going to discuss about the input tax credit or ITC in Tally. So in simple, ITC is nothing but, so whatever, for example, in income tax, whatever TDS they are going to cut from our salary, the employer is going to deduct TDS, correct? So after that, what we are going to do, we are going to file the income tax, then whatever the amount we have paid extra or they have deducted from our salary, that we are going to get as a refund, correct? Here also in the GST, same. So whatever the company, that is B2B, okay, so if for example they are going to purchase, because GST introduced only for the remove the cascading effect on the goods and services, correct? So that is the main intention. So here also, already if they paid tax for one time, if again they are going to transaction for the other time, then they need to reduce the tax burden of that particular goods and services. That is the reason they have introduced this ITC in Tally or ITC in the GST concepts. Next, understanding input tax credit. So eligibility criteria for ITC. So first one, only for the registered business or the registered organization, they can claim this ITC. If you are not a registered business or registered organization under the GST, then you cannot claim this ITC. That is the first eligibility criteria. Next, second one, documentary evidence. So whatever the documents you are going to produce or you are going to provide in the as a kind of vouchers, then only you can get this ITC. The first is you need to register. Second one, whatever the bills you are going to produce or whatever the invoices you are going to provide, on that basis you are going to get the ITC. Because if you are already paid the GST for that particular goods and services, again if you are going to pay, then the voucher should be very important to show for the claiming this ITC. Next, business purpose. Only for the business purpose, if you are going to purchase or if you are going to trade that goods and services, then only you can claim the ITC. If for example, I am going to purchase that XYZ product from the other company for my personal use, then I cannot claim the ITC for that particular transaction because it is for my personal use, not for the organizational use. GST is applicable for the businesses, not for the individual person. Correct? So only for the business purpose we can get this ITC. Next, tax paid to registered suppliers. If you are paid the tax to the registered players or the registered suppliers, then only you can get the ITC. If you are not paid for the registered supplier, then you cannot claim the ITC. Next, filing of returns. While filing also, if you are filing the returns, then only you can claim the ITC. If the example, for example, I have given the income tax, right? The TDC is deducted from our salary from the employer. If you want to claim, then you need to do the income tax filing. Then only I can get the refund, correct? Like that only in the organization, if you are filing the returns, then only you can claim the ITC also. Next, receiving goods or services. If you receive that goods and services, then only you can claim the ITC. Matched invoices. If for example, I have submitted the invoice for 50,000 rupees of goods purchased for the business use. At the same time, whoever they have given the goods, that voucher entry is also should be matched. Next, timely claim. So for that, they have the specific duration. From this time to this time, they need to claim, or 3 months of the invoice or 2 months of the invoice. Particularly on that time only they can claim. Otherwise, it is not possible to claim. Next, exemption and blocked credits. If it is exempt goods or if it is a blocked credits, then you cannot claim the ITC. Next, cross verification, that is invoice, the matching of the invoice they are going to do. Next, accurate classification, regular reconciliation and the compliance with the GST rules. So it should be in order with the GST rules and regulations. Then only you can claim the ITC. Otherwise, we cannot claim the ITC in any other scenario. So these are the few eligibility criteria for claiming the ITC in the GST portal. Creating GST invoices in Tally. So input and output tax calculation. So if you want to create a GST invoices, first we need to select what are the input and output tax calculation, or what are the things are required for the input and output tax calculation. Okay. First one is ITC, that is your input tax credit. How much we can reclaim or we can claim from the GST portal, that is the input tax credit. Next, output tax. So how much we have already paid for the outsiders or to the other businesses, that is we need to take consideration. Next, net tax liability. From the input we need to deduct the output, then we will get the value of net tax liability, how much we need to pay for the GST. Next, is there any complaints checks? Okay, that we need to check. If it is there, we need to resolve. Then we will have to go for the GSTR filing readiness. Okay, so these are the few things first we need to consider for calculating the input and output tax credits. Understanding the input tax credit, I have used the word of block credit. Correct? So what do you mean by this blocked credit? Blocked credits refers to the specific categories of goods and services on which business cannot claim ITC under the GST regime. Tally assists business in identifying the and handling black code credits to ensure accurate GST compliance. So if it is a black code credit, then we cannot claim the ITC for that particular goods and services. Okay, so based on that, we need to enter these details. We need to check before applying for a ITC only whether it is a blocked credit or not. If it is blocked credit, then we cannot claim. Then we need to disable that goods or disable that whatever the goods entry or the voucher entries are there. So for example, which are all that block code credits means motor vehicles, food and beverages, outdoor catering, beauty treatment services, membership of club, health, fitness centers, travel benefits extended to the employees, works, contract services for immovable property construction, goods or services used for personal consumption, goods or services acquired for resale, works, contract services for plant and machinery, contribution to employee welfare schemes, educational and recreational events. So these are the few block code credits as an example. Okay, so for all this, whatever the invoices are there or entries are there, that we cannot claim the input tax credit. Recording ITC transaction in Tally. So recording ITC transaction, first one, assessing ITC transaction, navigate to that is gateway of Tally. From that we can go for accounting voucher. In that accounting voucher we can create, that is 24 types of vouchers are there, correct? While creating only we need to select ITC or not. Okay, that is blocked credits or not, that we need to check there only. Selecting the ITC ledger, allocating ITC to output liabilities, cross verification and the complaints check. So these are the standard procedure or standard steps we need to follow for the recording the ITC transaction. Next, reversal of ITC. Identifying reversal scenario, which are the scenario we can reversal of that ITC, that we need to check. Next, adjustment entries we need to pass, documentation we need to provide, that is whatever the proof is required, and next regular reconciliation we need to do. Next, ITC utilization, mapping output tax liability, automatic adjustment, real-time monitoring, complaints reporting and year-end adjustments. So we need to map the ITC with the output tax liability. Next, whatever the automatic adjustments were there, that we need to do. A real-time monitoring, each and every transaction if you are entering, then only you need to check whether it is a blocked credit or we can go for the claiming the input tax credit. Okay. Next, complaints, is there any complaints report or not, that we need to check. And the last one, in the year end we need to adjust the whatever the entries are required. Here we are going to discuss about the GST returns filing. So here we will look at what are the different classification of GST returns are there and how to claim or what is the due date for each and every GSTR filings. Everything we are going to discuss here. Okay. So let's begin. Overview of GST returns. So we have GSTR 1 to GSTR 11 are there. Okay. So form GSTR 1, it contains of details of outward supply of taxable goods or services affected. Next, the GSTR form 1A, it is details of outward supplies as added, corrected or deleted by the recipient. Next, GSTR 2, it is a details of inward supply of taxable goods or services claiming input tax credit for ITC. Next, GSTR 2A, details of inward supplies made available to the recipient on the basis of form GSTR 1 furnished by the suppliers. Based on that, they are going to get the inward supply here. Next, GSTR 3, the monthly return on the basis of finalization of the details of outward supply and the inward supply. So monthly wise they are going to enter here. Next, 3A, notice to a registered taxable person who fails to furnish the return. If he has not paid or if he fails to submit that, okay, then they will get the notice under the GSTR 3A. Next, GSTR 4, quarterly return for compounding taxable person. Okay, So quarterly wise, the returns of the compounding taxable persons, it will be generated in the GSTR 4. Next, GSTR 4A, details of inward supplies made available to the recipient registered under the composition scheme on the basis of form GSTR 1 furnished by the supplier. So it will cross verify with the GSTR 1, whatever the supplier I have added. Next, GSTR 5, a return for non-resident foreign taxable person. Next, GSTR 6, ISD return. GSTR 6A, details of inward supplies made available to the ISD recipient on the basis of form GSTR 1 furnished by the suppliers. And the next, form GSTR 7, that returns for authorities deducting tax at source. TCS will be made, right? For that, GSTR 7 will be taken care. Next, GSTR 7A, that is TDS certificate, that is tax deducted at source. For that certificate, we can generate in GSTR 7. Next, GSTR 8, details of suppliers affected through e-commerce operator and the amount of tax collected. Next, the GSTR 9, annual return. GSTR 9A, simplified annual return by the compounding taxable person registered under the section 8. Next, GSTR 9B, reconciliation statement. So if any changes or any adjustments are required, then they can go for this GSTR 9B. And the GSTR 10, the final return will be done in the GSTR 10. And the 11th one, details of inward supplies to be furnished by the person having the UIN, that is the unique identified number. From that, we can get the details of inward supplies. Okay, so these are the few different types of GSTR forms are available. Next, the due dates for filing the return. So for which form, which is the due date, okay, that we will see. First one, GSTR 1, that is the outward supplies. So monthly by the 11th day of the succeeding month. So whatever the current month is there, in that month within 11th day, we need to complaint or we need to complete this return. Next, quarterly for taxpayers with aggregate turnover up to rupees 1.5 crores by the 13th day of the month following the end of the quarter. So for example, if your quarter is April, May, June, next is July, correct? So in that July month, 13th day, you need to, by 13th day, you need to complete this due dates of GSTR 1. Next, GSTR 2A, that is inward supply, auto-generated and can be used by the recipient on the continuous basis. Okay, day by day or day wise, you can generate and you can see. GSTR 2, inward supplies, currently suspended. The filing of GSTR 2 has been deferred until the further notice. So until the GST portal, if they are given the any other next notification, till the time it is suspended. GSTR 2 inward supply and GSTR 3 is also monthly returns, that is also suspended. Next, GSTR 3B, summary return by the 20th of the succeeding month. Next, GSTR 4, the composition scheme return. Okay, so annually by the 30th of the April following the end of the financial year. GSTR 5, non-resident foreign taxpayer returns monthly by the 20th of the succeeding month if the registration is cancelled or surrendered within the 7 days of the occurrence of the event. Next, GSTR 6, input service distributor return by the 13th of the month succeeding for the tax period, and the GSTR 7, the TDS return by the 10th of the succeeding month. Next, GSTR 8, e-commerce operators return by the 10th of the succeeding month. GSTR 9, annual return by the 31st December of the following the end of the financial year. GSTR 9A, the composition scheme annual return by the 31st December following the end of the financial year. And the last, GSTR 9C, that is reconciliation statement and audit by the 31st December following the end of the financial year. Next, the filing GSTR1 in Tally. So preparation and submission of GSTR1, assessing GSTR1 module, selecting the return period, reviewing outward supplies. Next, reviewing and confirm submission. Next, acknowledgement and challenge generation. And the last one, record keeping. So preparation and submission of GSTR, these are the few steps we need to follow. Next, when it comes to amendments in GSTR1, assessing amendment section, that is gateway of Tally, then you need to go for return filing, and then you can go for GSTR1, then you can click on amendments. Next, selecting the appropriate selection or sections we need to select. Next, editing and updating the details, generating and updating amendment JSON file on GST portal, verification and confirmation. So while amendment, these are the few steps we need to follow in the Tally software. Next, the sample report of GSTR1. This is how in the Tally software we will get to know, or we can easily show the, or we can see the GSTR1 return filing. So here they have shown GSTR1 returns of summary and whatever the company name, XYZ, everything they have written, and after that they have given table number, particulars, count, taxable value, integrated tax, central tax, state tax, okay, cess amount, tax amount and the invoice amount. Everything they have given, you can see here, and this is how it will looks like. And the last part in this video, filing GSTR 3B in Tally. So computation and submission of GSTR 3B, access GSTR 3B module in Tally, summary of tax liability, data entry for outward and inward supplies. Next, inbuilt validations and JSON file generation and upload to GST portal. Next, is there any late fees or any penalties? On that time, timely submission of, that is very, very important. Next, late fees calculation, if any late, if they have applied or if they have uploaded, then they need to calculate the late fees also. Then penalties for non-compliance, and the last one is preventing financial implication. These are the few instances of late fees and penalties will be there for the GSTR filing the 3B in Tally. So next we are going to discuss about the reverse charge mechanism, RCM. So this is also very, very important in GST, and in Tally also for entering the details, RCM details also very, very important. So let's see what is the RCM and how to track in the Tally software, all those things, okay. So filing GSTR 3B in Tally, so goods and services under the RCM. So reverse charge mechanism under the Tally for GSTR 3B return form. So under this RCM in GST, the liability to pay tax is shifted from the supplier to the recipient for the certain specified goods and services. So how this will work? Okay, just I will give you an example. So person A is the company, they are going to purchase goods from the Mr. B. Okay, so Mr. B is not a registered GST practitioner, but Mr. A is registered GST practitioner. So on that time, Mr. A, if he pays GST to the Mr. B, then we cannot claim. Why? Because he is not the registered person, correct? So on that time, they are going to, whatever the money they need to pay as the GST for that B, okay, that will be paid by the A only to the government. So here the B has to pay that GST money to the government, but he is not a registered person. Hence, Mr. A only pays that money to the government. That is called a reverse charge mechanism. Here are example of goods and services typically covered under the RCM. Goods, precious metals, gold, silver and other precious metal are often subject to the RCM when purchased from unregistered dealers. I have given the example, right? A is the registered GST practitioner, B is the unregistered, is not a registered one. So on that time, whatever we are going to purchase, that we can do the RCM. Next, cashew nuts. So cashew nuts in shell and processed cashew nuts may attract RCM. Next, tobacco leaves. Tobacco leaves are often subject to RCM when acquired from the unregistered suppliers. And the last one, used vehicle. Purchase of used motor vehicles from unregistered dealers can attract RCM. So these are the few scenarios or the example when we can go for this RCM. So when it comes to services, legal services, certain legal services provided by advocates and law firms into business may be subject to the RCM. Manpower services, hiring a manpower or security service from the unregistered suppliers may attract RCM. Transportation services, hiring transportation services from unregistered suppliers can be subject to the RCM. And the insurance agent services, commission paid to the insurance agents may attract RCM under the certain conditions. And the last one, work contract services, certain works contract services provided by unregistered contractors may be subject to the RCM. So that are the few example of goods and services can attract the RCM in the GST. So reverse charge mechanism complaints in tally involves accurately recording and reporting transaction where the liability to tax or liability to pay tax is shifted from the supplier to the recipient. Here in this example, A is the supplier, B is the recipient. Okay. So in this supplier and the recipient, the example I have given, supplier is the B and the recipient is the A, because B is going to supply the goods to the A, but B is the not the registered practitioner. On that time, A is the registered practitioner, he need to go for this RCM. Next, RCM complaints in tally identify RCM transaction. So which are the transaction comes under the reverse mechanism or reverse charge mechanism that we need to identify. Second one, configure RCM in tally. So in tally, we need to enter this RCM details. Next, record RCM transaction, specify RCM in vouchers, calculate and record tax liability, generate RCM reports and reconciliate RCM data, verify input tax credit, and the last one, maintain documentation and engage professional assistance. Next, TDS under the GST. TDS is nothing but tax deducted at source. Okay. So TDS under the GST law is to be deducted at the rate of 1% on the payments made to the supplier of taxable goods or services where the total value of such supply under an individual contract exceeds Indian rupees of 2,50,000. If any transaction in the Indian currency, if it is exceeds 2,50,000, then they need to deduct the 1% of TDS from that, whatever the invoice value is there or the transaction value is there. However, it is to be noted that no tax deduction is required where the location of supplier and the place of supply is different from the state where the recipient is registered. Okay. If the registered person in Karnataka, but they are going to supply goods to the other state, then this will be there. Next, who needs to be deduct TDS under the GST? As per the GST law, the following people or entities need to deduct TDS. First one, a department or establishment of the central or state government. Second one, the local authority, they can cut the TDS or they can deduct the TDS. Next, the government agencies, they can deduct the TDS. And the last one, the person or the category of a person as may be notified by the central or a state government on the recommendation of the council. So these are the few authorities or the persons they can deduct the TDS under the GST. Next, the TCS under the GST. TCS is nothing but tax collected at source. Okay. So any dealer or a trader selling goods or services online will get the payment after deduction of 2% TCS. So in the TDS, they are going to deduct 1%. If it comes to TCS, they are going to deduct the 2%. Under the GST, the main TCS deductor or the e-commerce aggregators who are made responsible for deducting and depositing TCS at the rate of 2% from the each transaction. Rules for TDS deductor need to follow under the GST. That is first one, mandatory GST registration. If they are registered under the GST, then only they can cut this TCS. Next, TCS remittance. TCS collected must be remitted by the 10th day of the month following collection as reported in GSTR 8. So they need to send that money to the GSTR or GST portal. Next, annual statement filing. File an annual statement by December 31st after the financial year. Rectify errors by the return filing deadline of the September or deadline for the September month. Okay. GSTR 8 details availability. Details filled in GSTR 8 electronically available to suppliers in GSTR 2A post the filing due date. And furnishing details to officers. Furnishing details upon the request by the Deputy Commissioner within 15 working days or face penalties up to ₹25,000. Next, we are going to discuss about the troubleshooting GST issues in Tally. So, what are the troubleshooting? That is, what are the issues are there in the GST using the Tally? On that time, how to overcome from that challenges. Okay. So, we'll see one by one. So, common GST errors in Tally. So, first one, the incorrect invoice detail. So, while entering, if you are done a mistake of entering the invalid number or invalid voucher number or the bill number, then that is a common error. Next, mismatch in GSTR 1 and GSTR 3B. Okay. So, these are the in two filings or in two forms. If you are going to do any mismatches, then that is also an error. Next, ITC, that is input tax credit mismatches. Okay, the RCM will be there or any other things will be there, right? On that time claiming this ITC, if you did some mismatches or mistakes, then that is also an error. Late filing. So within the due dates only you need to file the returns. If it is not within that, then it is also an error. Next, incorrect tax calculations. Non-reconciliation of books of accounts with GST returns. Non-compliance with e-way bill rules. So if you are not following or if you are not adhere to the whatever the e-way bill rules are there, then that is also a error. Next, incorrect classification of goods and services. Next, errors in TDS and TCS reporting. So tax deducted at source, that is 1%. Tax collected from source, it is 2%. While reporting, if you did any mistakes, that is also cause an issue, or it is an error in the GST in Tally. Next, for rectification, whatever the incorrect reporting you have done, that you need to rectify. Mismatches of ITC, amending inaccurate informations, filing omitted information, and adjustment of tax liability. So this you need to first rectify which are those things you have done the mismatches or the mistakes in the return filing. Once you rectify, then you need to go for the reconciliation, that is the adjusting the entries, correct? So in that first one, whatever the matching or mismatches you have done in the GSTR 1 with the GSTR 3B, for that filing you need to go for match the GSTR 1 with the GSTR 3B form. Okay. Once you done that, then you can go for reconciliation of ITC with GSTR 2A. So that you need to reconciliate, then you will ITC will be clarified or the verified. Next, the books of accounts reconciliation. So whatever the entries you have made mistakes or mismatches, that entries you need to go and you need to do the adjustment entries. Then the e-way bill reconciliation. So if you are not followed the whatever the rules and regulations given by the e-way bill, then you need to follow and reconcile that e-way bill also. And the last one, RCM, reverse charge mechanism reconciliation you need to do. So this is the reconciliation of statements you can do for the filing the GSTR returns. Next, the backup and recovery for GST data. Next, the backup and recovery of GST data. So what is the backup? Backup is nothing but whatever the data we are going to enter in the GST or for the tally software, whatever the vouchers or whatever the book transaction we are going to enter, we need to keep a backup. Why it is important for keeping regular backups? Okay, the first one is the data security. So if you are made any entry, if something crash or software, any crashes happened for the software or to your organization, whatever the building or premises, hardware, on that time, this whatever the backups that will helps for the organization to get the data back. Second one, complaints and audits. So if it is any complaints or there any auditings will be there, on that time this backup data will be helpful. Next, the business continuity. So for your organization, whatever the business you are running, you are not going to start a business for 1 year or for 1 month. We are going to aim to sustain in the market for a longer time, correct? That is the reason we require this backup data also. And error recovery. So whatever the error are pop-ups when you enter for the tally software. So on that time, that recovery of that error also you require this backup entries. And next, the disasters preparedness. So I already told you, right? If something crashes or something happens for your hard drive or something happens to your premises or whatever the office premises are there, on that time this backup data or recovery that will help you. Okay, and whatever the tally version updates, sometime it will give the new updates. On that time if you click on the update, whatever the data is there, it can be erased also. So on that time it is very, very important. And the client and vendor relationship. So these are the few importance for regular backups in the whatever the entries you are going to make. Next, steps for data recovery. Locate the backup, means in which drive, for example C drive, D drive or E drive, where you need to save the data. You need to locate that backup data, copy the backup file, paste the backup in the tally data folder, rename the backup file, whatever the month or whatever the year you are going to backup, that year you can mention, launch tally, select the company, click on restore, choose backup source, select the backup file and initiate restoration. And the last one, verify the whatever the restored data is there, whatever the selected, located or whatever the space you are given, whether it is saved or not, just you need to cross verify. That is the last step. Types of GST audits. So first one, statutory audit, internal audit, special audit, departmental audit. So concurrent audit, GST audit by CAG, that is Comptroller and Auditor General of India, information system audit, audit by authorities, and the last one, annual audit under section 44 subsection 2. So first one, statutory audit. So while we are entering the GST information, then only we have shown this statutory, correct? So in the statutory audit, the whatever the rules and regulations is given for the tally software, according to that it will generate and it will give the auditing report. Next, internal audit. So the internal management or internal managers, they are going to do this audit, special audit or departmental wise audit they are going to do. For example, the purchase department is going to do the production departmental audit, or production department is going to do the finance audit, or marketing team will go and do the audit. Like internal department wise only they are going to conduct the audits. Next, concurrent GST audit by CAG. This is the other body will do the auditing. IS audit, audit by tax authorities, and the last one is as per the section 44 subsection 2. This is the one more type of audit they are going to do. Next, preparation for GST audit in tally. First one is review of financial records. So whatever the financial records or the transaction you have entered as a voucher or creating the any entries, that we need to check first, or we need to review that. Next, verify GST returns, that is GSTR return 1 to GSTR return 11. Okay, so we need to verify all these GST returns. Next, reconcile books of accounts. If any changes are required, then we need to pass the adjustment entry and then we need to reconcile the books of accounts. Check the input tax credit, if it is any claims are made or not. If it is not made, then we need to take it for this current whatever the report you are generating. Next, review of e-bills. Ensure reverse charge mechanism complaints. Okay, is there any RCM complaints are there or not, that we need to check. Documentation of supporting documents. Prepare reconciliation statements. Review TDS and TCS complaints, and the perform internal audits. And the last one is engage professional assistance and stay informed about GST updates. So these are the steps we need to follow, and we need to be prepared for the whatever the GST audits in Tally. Next, we will sum up the recap of what we have learned in this particular course. Okay, so first we have discussed the comprehensive understanding of goods and services tax. It covering its key features, importance in India, and the overall GST system we have discussed. That is the theory concept of GST, correct? Next, we have discussed about the enable and activate GST features in Tally, configure taxation settings, manage rates, and ensure seamless integration for accurate tax complaints. After that, we have learned the create various GST, that is complaint invoices in Tally, including tax invoices, bill of supply, and debit or credit notes, ensuring accurate tax calculation, that we have discussed. Later on, we have discussed about understanding the eligibility criteria for claiming input tax credit, that is ITC, navigating blocked credits, and master recording of input tax credit transaction efficiently in Tally. Okay, that we have already discussed. Next, we have discussed about navigate the complexities of GST return filing. Then we have discussed comprehended due dates for each GSTR. What is the due dates, that we have discussed, and the step-by-step procedure for filing the GSTR 1 and GSTR 3B in Tally. Why we have selected only these two is in GSTR returns, GSTR 1 and GSTR 3B, that is very, very important. We can create in the, or we can generate in the Tally software itself. Okay. Next, grasp the content of RCM, that is reverse charge mechanism under the GST, and the identify applicable goods or services under the RCM, that we have discussed, and ensure compliance with RCM using the Tally software. We have discussed that one also. Next, we have explored the advanced features in Tally such as e-waybill generation, TDS, that is tax deducted at source, tax collected at source, that is TCS, complaints, troubleshoot common GST issues, and implement the backup strategies, or what are the importance of this backup strategies, that we have discussed. And the last one, understand the whatever the types of GST audits are there, and prepare for the audit process within the Tally, and ensure comprehensive compliance with the GST regulations. These are the few things we have discussed in this particular course. Welcome to the course on Tally for Payroll Management. The title only indicates the clear picture of what we are going to discuss, correct? So, you know the meaning of payroll management. So, whatever the compensation related things, how they are going to manage in the organization using the Tally software, correct? So, that we are going to discuss in this particular course, okay? So, first we'll see what are the agenda for this particular course. Next, we are going to discuss about the overview of payroll in Tally. So first we'll discuss about what is the basic meaning and definition of payroll, okay? And we'll discuss about the features of payroll in an organization, okay? So the term payroll refers to a series of accounting transactions involved in the process of paying employees for their service rendered after taking all the statutory and non-statutory deduction into account in conformance with the terms of employment. So company policy and the law of the land, that is payment of payroll taxes, insurance premiums, employee benefits, and other deductions. So what do you mean by this payroll? According to this definition, okay, so that payroll management is literally the accounting system, like how we are going to enter or entering all the transaction. Like that only in the organization, whatever the employees, okay, their details, their attendance, insurance, professional tax or provident fund or whatever the deductions they need to do, or if any employees has taken the any advances or any increment hike, everything, okay, we need to calculate, and then we are going to the money for that particular employee we are going to pay. So that we are going to calculating using the tally software. In the earlier methods or in the earlier days, what we are going to do, so we are going to like using the ledger books of a particular employees or Excel sheet, or it may be a Google sheet, whatever the company, okay, using the methods for calculating the employee salaries, okay, they are going to calculating using all these available, whatever the methods they are followed. But after ERP 9, Tally ERP 9, so in that the payroll masters are there. So in that, if they're given all the information of a particular employee, what we need to deduct as a TDS or the professional tax or a provident fund or for any insurance premium or any advances, everything, okay, if they're going to given clear information in the Tally ERP 9 means the Tally only calculate and generate the clear report or clear salary report of a particular employee. After that, it is going to generate the pay slips also. So what is the gross salary, and in that what are the deductions they have made, and what is the professional tax they have deducted, everything they are going to show in that pay slip, and what is the net salary drawn for that particular employee. And for the tax calculation purpose also, how many employees are working in that organization, whether they are professional tax or TDS or whatever the provident fund, all the clear information that they are going to collect with these pay slips, and that only gives the report for the taxation or auditing purpose also. So this is the payroll management using the Tally software in any organization. An efficient payroll system facilitates an error-free, accurate and timely employee payment while ensuring that the employment is well within the valid work permit. So using this Tally software, okay, so the efficient Tally software or efficient whatever the features of Tally software if we are using in an organization means on time we can give the salary to the employees, correct? So whatever the calculation time that they can reduce, and number of months or number of HR, okay, that they can reduce, all those things will be happening using efficient Tally software in the organization. So next we are going to discuss about the features of payroll. What are the main feature of this payroll? Leave the Tally software, okay, just we are discussing about the features of an payroll in any organization, okay. Instant access to employee information. So in this payroll, what they are going to do, they are going to clearly take all the information. For example, what is the employee joining date, what is the employee Aadhaar card number, PAN card number, all the family member details, and whatever the certificates or whatever the education qualification of a particular employee, okay, and whatever the achievements and whatever the past year experience, okay, all this information they can access in this payroll feature, whether it may be using the any software or if they are maintaining in the books of accounts or in the ledger book or whatever the methods they have followed. All this information is easily they can access in this payroll. And what is the gross salary, net salary, whatever the deductions, if is taken any advance payments from the employer, all these details will be there, correct? So next one, pay the right amount on time. So in a month, so in that 30 days, okay, he is going to work for a 26 days. So in that 26 working days, how many days he took an leaves, or if it is any LOP, that is loss of pay is there, or any attendance shortages like early logout, early login, or whatever the idle time, if they are calculating all these things, they can calculate. According to that, they can easily give the payment. That to on-time payment they can make for an employee. So that will increase the efficiency of an employee in an organization, or he is going to get the feeling of the own. Company is our own. So the on-time payment that will create a satisfaction in the employee also, and it's indirectly it will affect the efficiency. The high efficiency of an employee can be taken from an organization also. Next, the improve employee satisfaction, manage increments and arrears. So on-time payment, it will leads to the improve the satisfaction of an employee in an organization. So that will manage the increments, whatever the yearly wise or the whatever the depending on the company HR policies. Okay, whatever the increments they are going to give, that they can manage, and if it is any arrears. So if for example employee joined on April, but their salary cycle start from March. So 1 month arrears should be there, correct? So that arrears also they can easily calculate because they have the date of joining. All this information with them only, it is there, correct? So they can easily manage these increments and arrears for an employees. Next point, on-time recovery of loans and advances. So I've already given this example, correct? So if the employee is taken any loans or any advances from the employer, in few organizations this policy is there. So based on their salary, they can go for taking the any loans in a particular organization, like 0% loan, or they are going to charge only the minimum interest rate, or sometimes they are going to give the small amount of advances to the employee. All these are available, correct? So on that time, these payroll features, or in the payroll, they can easily access how much loan is taken, or what is the term of loan, what is the rate of interest they are charging, how much monthly is going to pay. All these details will be available easily, correct? So that they can take and they can recover that loans and advances from a particular employee. So next, meet all accounting and regulatory norms instantly. So I already told you, right? So the whatever the TDS, that is tax deducted at source, the employer can cut the or they can deduct the TDS from an each employee based on the whatever the norms are there, correct? And professional tax, monthly 200 rupees they are going to deduct, correct? Provident fund also they are going to deduct, correct? All these things will be given to the taxation. So the whatever the accounting records and the whatever the regulatory norms, as per the norms they are going to cut TDS, professional tax or provident fund, all this information they need to clearly maintain and they need to show it in the while filing the tax returns for a particular employee or with the organization. And the last point, payroll and statutory reports. So the total per month, if for example take 120 employees working in that particular organization. So that 120 employees, whatever the salary they are getting for that particular month, that statement easily they can take, or quarterly wise they can easily take, or the yearly wise, off yearly wise, whatever the requirement comes for an organization, they can get the payroll reports also. And as per the statutory, following all the legal norms, okay, they can generate and they can get the statutory reports of an organization. So these are the few features of payroll in an organization. Next, we are going to discuss about the role or functions of payroll. So the more important task performed in the HRM or in the payroll cycles are, so first one, recruiting and hiring new employees. So you can have a question, right, in your mind. How recruiting and hiring will comes to payroll? So take an example. In this particular year or whatever the financial year, in that year the company or the management has allotted 5 crore rupees for only for the employee salaries. So what is the role of HR in this payroll? So they need to plan accordingly. Whatever the employee salary for that particular financial year, they need to complete within that 5 crore rupees only. So based on that, they will go for recruitment, or if any hires or if any requirements are there in that particular organization. Based on that budget, they are going to check and they are going to recruit and hire the new employees in an organization. That is the first role or functions of payroll. Because what is the actual budget for that particular organization for the giving the salaries for the employees, or how much they are capable to pay for a particular year for a employees. That is very, very important, correct? So they need to check with the payroll. simply or randomly they cannot give the whatever the packages, just 15 lakhs per year, 20 lakhs per year, not like that. So according to the budget only they need to plan, and then they are going for this recruitment and hiring the employees in an organization. Next, training. So for giving this training also it costs. So some companies, what they are going to do, bulkly they are going to allot these trainings, or whoever the new recruitees or new hires, okay, only for them they are going to give the training. In some companies, based on the changing the technology in the market or in the economy, based on that also they need to provide the training facilities for an employees, correct? So on that time what they are going to do, if it is a only minimum numbers are there, on that time what they are going to do, they will go for any outsourcing or agencies, whoever is going to provide that particular training facility for that particular employees. Or sometime in other case, what they are going to do, they are going to take one trainer only, and they are going to fix some amount for the trainer to train all the employees. These are the two scenarios, correct? So for that also they need to pay money. So they are going to check with the budget how much is allotted for the training or research and development, all those things, okay? Based on that they are going to go for this training. So it is directly the payroll is involved in this training activities also. Next, the job assignment. What kind of job we need to assign for that particular employee? For example, if we are given the training for X skills, but we are allocating that employee to the Y skills required products or Y skills required production activity. So that is wrong only, correct? So what we have trained for that particular employee and what he is going to do, in which production line or in which product line he is going to work. So that is also very, very important. So job assignment is also directly involved in the payroll. Next point, compensation or payroll. So compensation is nothing but the salary or the wage, correct? So how much we need to pay for that particular employee. Already we have discussed. So in a month, 26 days is the working day. So in that 26 days, how many days of leave he has taken, or is there any LOPs, or is there any idle time or machine hour rate or the labor hour rate, based on the company policies, okay? They need to calculate, and they need to calculate this, what is the compensation for that particular employee. And in that, whatever the deduction, is there any loans and advances or any TDS, professional tax, provident fund, all those things they need to check and they need to deduct, and then they need to calculate the accurate compensation for that particular employee for that particular month. Next, the performance evaluation. So based on the performance only, they are going to give the increments, hikes, correct? So they need to evaluate the whatever the performance of an particular employee. Based on that, they are going to give this hike in their salary. And the last one, discharge of employee. So discharge in the sense, voluntarily he is going to retire, or non-voluntarily he is going out of the organization. So on that time, is there any amount or the loans and advances are balanced in his payment, and he is having any company assets with him or not, like companies provided laptops or mobile phones or UPS or some other extra benefits or any assets given to that particular employee in the duration of his service. Okay, so all those things they need to check, and then they need to discharge of that employee from an organization. Next, we are going to discuss about the benefits of using Tally for payroll. So now we will elaborate on what are the benefits or what are the advantages of using the Tally software for our payroll management in any organization. Okay, so first one, accuracy and complaints. So if you are using the Tally software in your organization for a payroll management, then whatever the employee salary or whatever the calculation of a particular employee salaries, that will be accurately, you will get the values, because whatever the inputs, once if you are given, okay, that will be taken care and that will be managed for that throughout the year. Is there any changes, then only you need to interrupt there. Otherwise, it will calculate and it will give the accurate value of a salary of a particular employee. And attendance also it will take consider in ERP only, how many number of days are present, absent, whatever the LOPs, everything it will take from the ERP only. So it will give the accurate value, and there is no complaints only. So minimum complaints you will get from the ERP regarding your salary or whatever the salary calculation part. Next, automated calculation. So in the beginning, if you are given what is the gross salary of that particular employee, how much professional tax we need to deduct, what is the TDS percentage on their salary, what is the provident fund, employee contribution, employer contribution, all this information if they are given, okay, that will automatically calculate, and there is no need to every month we need to check, or every now and then we need to check and we need to do the updates or whatever the corrections we need to make, nothing. Okay, the automatically tally software only take the attendance from the ERP, and it will take the whatever the deduction, whatever the gratuity or whatever the perquisites or fringe benefits given for that particular employee, whatever the additional benefits given for that particular employee also, that will take, and that will calculate, and it will give the result of that particular employee salary, and it will generate pay slip also. So next, efficiency and time savings. So if for example 120 employees are there, so for that 120 employees, if manually they need to calculate the salary or manually calculate the monthly wise salary or all the other things or other things, then the whatever the human resource required to calculate that 120 employees, that man hour savings that they can save, and the efficiency in the minimum time. If the manually, if they are going to conduct this whatever the monthly salary, they require 1 to 2 days, but ERP it will take 1 to 2 hours to generate all the reports of that 120 employees in an organization. That is the efficiency, and it will take minimum hours, correct, or few hours only, 1 to 2 hours maximum, correct. So they can save the remaining 1.5 day of that particular employees or whoever is going to calculate this salary, that they can save, correct. Next, employee self-service. So is there any, like employees are not done the whatever the punch in or log in, log out, all those things, on that time they selfly they need to declare that they, if they miss punch in or if they not logged in on that particular day or any field visits are there, all those things, okay, that they need to given for this tally software or in the ERP, and they can easily go and they can check the pay slips, whatever the deduction they have made, why they have done that deduction, everything is there in the pay slips, correct. So employee can go for self-service also. Next, tax complaints. So there is no tax complaint also. Why? Because TDS, if for example this employee salary is range between 5 lakhs to 10 lakh rupees. So as per the income tax or whatever the slab rates, okay, based on that 5 lakhs to 10 lakh rupees, what is the tax percentage and how much we need to deduct at a TDS, okay, that they have already given that instruction, means automatically it will deduct whatever per month, whatever the TDS percentage for that particular employee, that is also they are going to deduct, and as usual 200 rupees of professional tax they are going to deduct from all the employees. So that tax complaints also they can easily avoid. Next, customization. Based on the company needs or the HR needs, okay, they can go for this customization of all the features also, whatever the features they need to do, enabling, disabling, or any percentage or threshold limit they need to fix, everything that they can go for this customization. That is the one more benefits of using the tally in payroll management. Next, integration with accounting. So why they have to integrate with the accounting? Because the funds come from the accounts department, correct. So how much fund is there, or cash inflow, cash outflow, or what is the bank balance, all these things are required, and the ledger accounts or the journal entries, all these things are required to calculate this salary, correct. So that is the reason the integration with the accounting, and that whatever the salary they are paying for the employees, that should be reflected in our P&L account or in the trial balance or in the balance sheet, then only we can get the accurate financial reports also. So next, audit trials and security. So there is no need to prepare for any auditings, because ERP only in a click we are going to get all the reports, and they can easily, that only gives the auditing report also. So that security checks, all those things will be very, very easy in the Tally ERP9. Next, scalability. So based on the salary range, they can scale, and whatever based on the tax slab rates also, they can easily categorize or classify, and they can get the TDS or any tax also. And the last one, reporting and analytics. So the total report for the financial year, how much they have paid for that particular employees in an organization, how many number of employees are working in that organization, what is the deduction they have made, and how much they need to pay for the tax. That is, as a government, whatever the tax collected from the employees, that is TDS deducted, that they need to pay to the government, and professional tax they need to pay to the government. All these reports and analysis, analytical reports, everything they can generate through Tally software. So these are the few benefits of using the Tally for payroll in an organization. Next, we are going to discuss about enabling payroll in Tally ERP9. So enabling the whatever the features we require, like customization, I have already explained you, right? So whatever the company needs and wants, they are going to enable and disable the features. So enabling or creating payroll in Tally ERP9. So step 1, first we need to set up the company, correct? If you go to ERP software, so in that ERP software, go to Gateway of Tally. In that you have a tab called company information. Double click on that, then you will get some like features or tabs, alter, create, all these options will be available, correct? So there you can go and click on create company. This is the pathway for creating the company setup. Okay, Gateway of Tally, company information, in that create company. So in the company creation screen, select nation as an India in the field of statutory complaints from the list of countries provided. Next, type the financial year. For example, whatever the financial year, 2009 to 10, 19 to 20, or 21 to 22, 22 to 23, whatever the financial year, type that financial year from the date and press enter. So whatever the calendars appear there, correct? On that you need to click which is the financial year, from which, that is, if you are going to start with the 1st April, you need to click on 1st April month, whatever the year, and we are going to end at the 31st March, whatever the number of years. Okay, that we need to select. After that, press enter to accept the complete company creation. So after creating all this information, you will get one pop-up. Accept, yes or no. If you want to create, click on yes, it will create. If you want to do any alteration, just click on no, and then you can go and do the whatever the changes are required. Okay, this is the first step. I will show you how it will looks like. See here. So the directory, the whatever the data, name, mailing address or mailing name, address of that particular company, statutory complaints, India, I already told you, right? India, Karnataka, whatever the pin code, telephone number, email ID, okay, currency, what currency you are going to use, Indian rupees or whatever the other currencies, maintain accounting with inventory, financial year from which to which, or books beginning from which year to which year, all these details of given in this screen, then it will, the pop-up will come, accept, yes or no. If you want to create, click on yes, or if you want to do any changes or alteration, just click on no button. Okay, so this is how looks like. Next, step 2, enable payroll. So for that, the pathway is go to Gateway of Tally. In that, press F11, that is functional 11 key, and then the company features tab will be opened. In that, again you click on F1, the accounting feature will appear. So in that accounting feature screen, okay, set maintain payroll. We need to maintain the payroll in our organization, correct? So click on that and click on yes. Next, set more than one payroll, because we are not calculating for only one employee, correct? We have multiple employees, correct? So we need to click on more than one payroll or cost categories. For that, we need to click or we need to type as yes, and it will show like So general, integrated account inventory or income expenses or outstanding management, cost or profit center management. So here maintain payroll. Okay, click on S. Maintain cost center. If you want to create S, you can create S, otherwise no. Use cost center, job costing or more than one payroll category. Click on S because multiple entries or multiple employees are there. So this is how we need to create in this accounting feature. Next, step 3, enable payroll statutory features. So for that pathway is gateway of tally, press F11, that is company features. In that you can click on F3, that is statutory and taxation. So in that screen, set enable payroll statutory. Click, or you can type it as yes because we need to go with the statutory regulations only. Next, set or alter payroll statutory details. So if you want to set or if you want to alter, you need to click on yes, because once you are given, for example, for that particular employee, gross salary is 7 lakh rupees per annum. But in between, okay, increment is happened or hike is happened. On that time we need to alter, right? So that is the reason we need to give it an yes. So I will show you how it will looks like. See here, enable payroll statutory, yes. Set or alter payroll statutory details, yes. After that it will pop up, accept yes or no. You need to click on yes. Next, payroll calculations. So payroll involves the calculation of amounts due for an employee on the following basis. So pay on hourly wages. Some companies, like we already discussed, right? So number of units they have produced or overtime or per hourly also they are going to pay. Okay, for laborers they are going to pay in wages, correct? So we need to check how much they are going to pay for that particular employee for the or particular labor for 1 hour. That wage, hourly wage we need to specify. Second one, pay on a fixed basis such as certain amount per week or per month and so on. So whatever the basis they are following, if it is on labor, we are going to pay as a hourly wages or day wages. But if you are paying for an employee, then the yearly wise package will be there. In that, how much monthly he is going to get, that they are going to fix. Next, pay to salesperson on commission. For example, they are going to set, if you are going to reach a target of 5 lakh rupees per month, then you are going to get 1% or 2% commission on the turnover. So on that, whatever the sales he has made, multiply with the how much percentage they are going to aggregate to give for that particular salesperson, or they have accepted to give so much of percentage, correct? So that they are going to fix. Reimbursement of expenses such as travel expenses, either as paid by the employee or based on the per time rate. Okay, so for whatever the marketing team, sales team or sometime finance team, they are going to pay some this travel expenses. So for going to bank or going from the one place to other place for the whatever the work, okay, all these reasons they have to reimburse the expenses also. And the last one, pay on the basis of number of pieces produced or manufactured or sold. Sometime they are going to fix the how much number of units they are going to produce or manufactured in the organization. So I have given the example of garments. So if that particular one person has produced 50 units in per day, so 50 units into how much is per unit, or how much manufactured goods they have done for the number of days or in one day. All these things we are going to multiply, correct? And the last one, for the sales or the marketing team, how many number of goods they have sold. Based on that also they are going to get the salary. This is the basic or basis of they are going to calculate the payroll in an ERP. Next, payroll calculations, payment to employees. So these are the features or these are the tabs we can see in the Tally software. Employee masters, so all the employees details are the database, it's there in the employee masters. Then payroll masters, in that whatever the gross salary, net salary, deductions, tax, everything we are going to get in this payroll masters. Next, pay its. So whatever we have discussed, hourly rate or number of goods they have produced or number of products they have produced or manufactured or sold. Based on this heads they are going to categorize here. And next, the salary details of each employee, that is also we are going to get in this tabs. This I will show you in the software also. Next, the employee setup in Tally ERP9. So how to create a tab for these employees. Okay. So the employee master records employee information like department, DOG, that is date of joining, date of leaving the organization if it is for contract basis. Okay, they are going to keep the whatever the date of leaving also, because he is going to start on 1st April and he is going to the whatever the period contract is going to end at the 31st March for the next year. So that is the date of leaving. That also they are going to mention. The employee ID numbers, okay, whatever the designation, in which location he is going to work, whatever the functions, that is key role played in that organization. Employee bank details, whatever the statutory details that is related to tax, loan, all these things. Okay, passport and the passport numbers is going to enter in this database, or visa details and so on. So many other database they are going to collect and they are going to keep it in this employee masters. To create whatever the steps we are going to follow is, or steps to create employee masters in Tally ERP9 are first employee category and then employee groups, and the end we are going to create the employees. These are the three categories are there. There only we are going to give all these informations. So creating the earnings pay heads in Tally ERP9. So pay head name I have given, right, or in the earlier slides also I have informed the pay heads like basic pay, that is a heading, HRA, conveyance, overtime pay or variable pay. All these things are the headings. Next, pay head under that types earning for an employee. This is the basic pay they need to get. For HRA, earnings for employees, conveyance is also earnings, overtime is also earnings for an employee, or variable pay. So these are the earnings, correct? Under which heads it will come means, basic pay will comes under the indirect expenses, HRA is also indirect, conveyance is also indirect, everything, okay, that will comes under the indirect expenses. It is not a direct expenses for an organization. Next, if you are going to make any changes in this all these 5 heads, okay, it will affect any net salary. Yes, of course, it will affect all these whatever the 5 heads are there, whether it may be basic, HRA, conveyance, or whatever the overtime and the variable pay. It will affect the net pay of that particular employee. Name to appear in the pay slips. So under which headings it will come? Same headings only, like basic, it will comes under basic, HRA, conveyance, overtime and variable pay. Next, in these 5 heads, which are all the things we are going to use for calculating the gratuity? Only basic pay we are going to consider for calculating the gratuity of an employee, not other things. HRA and we are not going to take. Only basic pay plus DA we are going to take for the consideration of calculating the gratuity of an employee. Next, calculation type, basic pay we are going to calculate on the basis of attendance, HRA as commuted value, conveyance, flat rates, overtime on production they are going to calculate, variable pay as user defined. And when it comes to calculation period, basic pay monthly wise they are going to calculate, HRA there is no calculation periods, and the conveyance is also monthly wise, overtime pay, so on the basis of how much number of hours he has done, that is overtime he has done, that basis, and the variable pay depending on the company they are going to pay this variable also. So creating the earnings pay heads like we have discussed, right? So whatever the headings like pay head types, earning for employees, in that list of pay head types we have so many like bonus, deduction from employee, earnings of employees, employee statutory deductions and employee other charges, gratuity, statutory contribution, loans and advances. These are the headings are there, we can select. Okay, so if you go to ERP, go to Gateway of Tally, there you have list of masters. So in that list of masters you have accounting masters, inventory masters and payroll masters. These are the 3 broadly categorized categories. Okay, so in that payroll master, first employee categories we already discussed, right? Employee groups, employees, attendance or production types, pay heads. So if you click on employee categories, see here it will give the list whatever the employees are there. So primary caste category, so it is showing like for the financial year 1st April 2023 and it's going to end on 31st March 2024, correct? Like that all this information will appear here for the whatever the list of employees or the primary cost categories. Okay. Next, if you go to employee groups, like either it may be unit wise or it may be a departmental wise, or based on the whatever the company customized thing, they are going to get these all the details here. Okay. Next, if you go to employees, here the individual employee details you can see. All the cost categories, employees groups and employees. Here it is showing, right? All these are like how many employees details you have entered here and how many groups are there, cost categories are there, everything it will appear individual employee details. You can sort it out by whatever the employee ID, whatever the names or department, like so on. Okay. Next, attendance or production types. So based on the number of attendance, like how many days he has present for the organization, how many days, number of working days, and whatever the production, that is number of units they have produced, everything it will appear here. Next, pay heads. So under the pay heads, it will generate like 5 heads: basic pay, HRA, conveyance, overtime and the variable pay. All these under the heads that will categorize and it will gives the report here. So this is how the Tally software looks for this payroll management. Okay. So once we start giving the inputs in this, whatever the employee categories, group, employees, attendance, production type, pay heads, everything it will generate the reports and it will show it here. And it will useful for whatever the salary we are going to pay for employees on time and other things, pay slip generation, number of working days of an employee, all these details easily we can take from this Tally ERP 9. Next, we are going to discuss about the payroll in Tally ERP 9. So what are the different roles or different features, whatever we have discussed till now, that is there in the Tally ERP 9, we'll discuss very briefly. Okay. So the first one is employee database. I have already given the explanation, correct? So the employee database in the sense of like date of joining, whatever the employee name or any family members details, how many like spouse, children's are there, what is the qualification of that particular employee, past year experience, all other details will be there in this employee database. That will easily they can take and they can calculate or they can use for any other purpose. Next, leave and attendance. So in the earlier days, what will happen? So if I want to take a leave, so I need to write in the paper what is the reason as per the letter. Okay, we need to write the letter and then we need to submit to the manager. But now using the software or using the Tally software, easily we can in one click we can apply for any leaves. Just we need to inform managers and then we are going to apply in the whatever the softwares or the ERP software using in the organization. So manager will approve. Okay. And attendance also, the attendance regularization will be happening parallelly. If once the manager has approved the leaves, that will automatically reflect in the whatever the attendance of that particular employee. If for example this month 2nd and 3rd I'm going to apply for a leave, so on that time what will happen, once the manager approves for that leaves in this ERP, okay, that will automatically reflect in my attendance. Okay, these 2 days whatever the casual leave, ELs or sick leave, whatever it may be, that will taken of this particular employee name and so on, so date. Okay, that will be reflected. So that is very, very important for calculating the payroll in an organization. Next, in the production companies or in the manufacturing companies, this overtime or the production, okay, that will be there. If for example the working hours of an organization is 8 o'clock to 4 o'clock, so after 4 if the employee is going to stretch and is going to do the work, if for example 1 hour, 2 hours, 3 hours, so double the hour as per the rule. So for the normal working hours, how much that employee is getting, in the overtime he needs to get the double the amount. Just an example, in the normal hours for that particular employee they are paying per hour 200 rupees. So if the employee is going to do for an overtime of 2 hours, then that 200 into double, that is into 2 into number of hours extra he is going to do or overtime he is going to done in that particular day. Like that they are going to calculate and they are going to give as a overtime salary or overtime benefits for that particular employee. And in some companies, what they are going to do, number of units they have produced, usually in the garments, number of pieces they have produced or number of units they have produced. So based on that also they are going to give the salary, correct? So if for example per unit 100 rupees they are going to fix. So that number of employee or that particular one employee, how much number of units he is produced for that particular day into 100 rupees. If it is in weekly basis, so in that particular week, how much number of units he has produced and 100 rupees. Like that they are going to calculate and they are going to pay the salary for that particular employees. So that is also one of the role or functions in the payroll. Next, bonus and gratuity. So the bonus, if the company has the sufficient profit in that particular year, or if they are going to make profit for that particular year. So on that time, the company, what they are going to do, they are going to issue the bonus. On which basis they are going to issue? Based on the salary or based on the how much productive or efficiently he has worked for the organization. Depending on that also, they are going to give these bonuses. In that, two forms are there. One, they are going to pay in the form of cash, either through cash or the bank. Second one, they are going to pay through stocks. Stock in the sense shares of a particular company. Bonus shares they are going to issue. Money they are going to give to that particular employee. And when it comes to gratuity, so for every employee who is going to complete 5 years of service in that particular organization and he left the organization after completing the 5 years of services in that particular organization, he is eligible for this gratuity. Correct? So based on the whatever the last done salary, as per the tax, we need to calculate the gratuity, and then the company going to give the gratuity for that particular employee also. So that is also easily we can calculate through ERP software. Next, salary revision and increments. So is there any salary revisions for that particular employees or any employees in the organization, or is there any increments given to that particular employees? All these informations, if they are given properly, then easily it will automatically change the calculation and it will give the what is the gross salary, net salary, everything. And the last one, PT, that is professional tax, PF, provident fund, and ESI, that is for whatever the medical reason or for the hospitals. Okay, they are going to collect the ESI amount from the particular employees. That too based on the salary of that particular employee as per the norms, whatever the limits were there. So if the employee is getting 18,000 rupees and below, okay, only they are eligible for this ESI. So they are going to cut some 400 rupees or 500 rupees from each employee, and that will contribute to any medical emergencies for that particular employee. So on that time they can use this ESI. Professional tax. So for each employee they are going to deduct this 200 rupees as a professional tax. And provident fund, employee contribution is there, employer contribution is there. So how much employee is going to contribute for that particular provident fund, the same amount the employer is also going to contribute, and they are going to invest or they are going to deposit to the PF authority. So all these things easily they can access and they can clearly calculate the salary of a particular employee using this Tally ERP 9. Okay, this is the payroll in Tally ERP 9. Next we'll discuss about the what are the features of payroll in Tally ERP 9. So I will just brief about whatever the points are there. It is fully integrated with accounts to give you the benefits of simplified payroll processing and accounting. This is the major feature of a ERP software because it is integrated with the accounts department or whatever the accounts are there and simplifies the payroll processing. So whatever the manual reporting or manual calculation, it is eradicated everything, and in a click you will get the all the salary details of employees in an organization. Second one, it has user defined classification and sub classification for comprehensive reporting. So individually also you can get the reports, and the team wise or the unit wise or the departmental wise they can get the salary or whatever the budget for that particular units or for the department, how much salary we are paying for this particular unit, everything you can easily get. Okay, Next, it provides the facility to create user defined earnings and deductions pay heads. So pay heads is nothing but whatever the headings, or like for example salary, perquisites, fringe benefits, all these things are the headings. Okay, if you are taking as an heading, under that how much is paid for this employee, how much we need to pay for this, all these things will be calculated easily. It allows flexible and user definable criteria for simple or complex calculation. So whatever the complexities are there, or whatever the problems are there to calculate in that particular person's salary, okay, the software is going to easily calculate and it will give the report. Next, it allows unlimited grouping of payroll masters. So I will explain you about this, what are the different masters are there. So easily we can create these masters, and that will take all the information and it will generate the report. It provides flexible payroll processing period. Like for example, every month of the last day of that particular month, they are going to get the salaries, or employees is going to get the salaries, correct? So for that, they need to start processing all these activities in a 1 or 2 days back, and they are going to give the checks to the whatever the banks are tie up with them, and then they are going to credit the salary to that employee. So this is the flexible payroll processing. Okay. Next, it provides comprehensive cost center as well as employee wise costing reports. So how much cost they are paid, for example per hour, or take per day or per month, how much the company is investing on that particular person, how much return they are going to get from that particular person, that they can easily calculate. It facilitates an accurate computation and deductions of ESI, EPF, professional tax and gratuity, etc. We already discussed, right? So all this, whatever the deductions they are going to make, that they can easily deduct and they can show it in the pay slips also. It facilitates computation of arrears pertaining to the prior periods. So is there any arrears paid to that particular employee, that they can easily calculate. And the last point, it helps in tracking the employee loan details. So if the employee has taken any loan from that particular organization or any advances from that particular company, so easily they can track and they can take or they can recover the loans and advances from the employees. Next, we are going to discuss the summary, okay, summary of this particular course, whatever we have learnt in this particular course, okay. So first one, introduction to the fundamental features and functionalities of Tally. So what is the meaning of Tally, what are the different versions are available, and what is the fundamentals or features of the Tally ERP9, or whatever the functions we can easily taken from this ERP software. All these things we have discussed, correct? The accounting softwares, how to generate the reports, or how to check the payroll management system, everything, okay? Providing a fundamentals for efficient financial management also, okay? Second point, explore the key aspects of payroll management within Tally, emphasizing its role in handling the salary related process of organizations. So how to calculate the salary, or whatever the basis of calculating the salary in the ERP9. So on which basis they are going to categorize, or which group, employees group, employee category, all these things, okay, that we have learned. Next, understand the specific features and functions that Tally offers for effective payroll management, ensuring accuracy and compliance, okay. Here we have discussed about the employee database, or whatever the loans and advances, or recovery of loans and advances, or professional tax, employee provident fund, or ESI, all these things we have discussed, right? So that functions and features of Tally ERP9 related to the payroll management, that we have discussed. Next, the step-by-step guidance on activating or enabling the features of payroll masters in Tally, correct? Allowing of customization based on the organizational requirements, or based on the whatever the company needs or metrics needs, we are going to customize all the features in the Tally. Next, delve into the payroll calculation using Tally, covering aspects such as salary, components, deduction and statutory complaints. All these things we have discussed, correct? And the last one, the hands-on part, that is in the Tally software, how the employee master or the payroll masters looks like in that employee category, employee payroll, or employee information, production or the overtime, all these things we have discussed, right? So these are the few things we have discussed in this tally for payroll management. Thank you. Here is a quick overview of what we covered in this tally course. We started with the basics of accounting, what it is, how to keep records and track and report transactions. We also went over important accounting concepts and the accounting cycle. Next, we looked at financial accounting. We learned about financial accounting, the difference between accrual and cash accounting, and how to prepare balance sheets, income statements, and cash flow statements. We also covered financial ratios to help you interpret these financial documents. Then we moved financial management. We talked about the basics of finance, broad areas of finance, and the goals of financial management, including profit, wealth, and market share. We also discussed the functions of financial manager, the principal-agent relationship, financial system, and securing investments in business. In corporate finance, we covered an overview of the field, the goals of corporate finance, and how decisions are made. We looked at factors affecting capital structure, the relevance of debt and equity, dividend decisions, and addressed the agency problem. We also explored mergers and acquisition. Finally, we wrapped up with tally. We discussed GST, key terms, GST registration, input tax credit, that is ITC, and the return process. We also looked at online GST portals and summarized the goods and service tax. Thanks for watching, and I hope the tally skills help you in your accounting career.